Namaste friends. So today we are going to talk about the AFM theory. In our exams, the theory part has a weightage of around 20 marks in exam. And if you look at the paper pattern, there's a 30 mark of MCQ, 70 marks of descriptive. In the MCQ section, majorly practical question, rarely a theory question may come. In the descriptive section, every question will have one subpart which is theory oriented. So you have 6 questions of 14 marks, and in that majority of the question will include one theory question. So what unfortunately or fortunately happens is you will be forced to answer theory for around 15 to 20 marks in exam, and that is why we can't miss out on theory preparation. The weightage of theory is as high as maybe a derivatives chapter or a forex chapter, where we at least spend around 20-25 hours. So the request is for theory also we need to spend at least around 15 hours so that we have good clarity on answering the theory areas. Now, from an exam point of view, I can say there is a different weightage for different chapters in theory. These are theory heavy chapter, chapter 1, chapter 2, chapter 4, chapter 7, and chapter 15. These are theory heavy chapters, and high probability a theory question may get tested from all of these chapters, but not mandatory. They may test from outside also, and we've already seen what they did in the recent exam. So majority it will come from here. And for theory preparation, for these 5 critical chapters, I have my latest recorded theory videos which are uploaded in YouTube. And for other chapters also we have theory videos recorded. And for some chapters we will try to do a fresh recording. But for those 5, the main 5 chapters, already theory is available in YouTube. For the balance set of chapters, I have uploaded a video maybe 2.5 years back for the other chapters, and I will try to maybe record one more for some of the chapters. So the content, I don't see any major changes in theory, but still we will try to record maybe for few chapters one more video. So whenever you are preparing for theory, please focus on 5 chapters, but just 5 alone will not help. We will have to cover all. And it is essential that you go through other chapters as well. If you see this index, it starts with page 470, goes on till your page 549. After the chapter of startup finance is completed, after it is completed, I'll just show you. You will have something called a summary theory, which starts from page 558, goes on till 591. Summary theory notes are there and detailed theory notes are there. Initially, we will go through detailed theory. At your revision phase, you will go through summary theory notes. Around 40 pages is what you have to prepare to secure your 14 to 16 marks in exam. Will I get full marks in theory? Difficult, but there are set of students who have secured at least, if it's a 6 mark question, ICA has awarded even 5. Rarely they have awarded 6. But theory people can score around 12 marks. 12 out of 16 is possible in theory. It is far better than scoring a 0. There are students I know who have scored 0 in theory because they have not prepared. They are very clear. We will not prepare theory. Despite telling so much, they are very, very clear saying that no, I will not prepare theory. Adamancy, I can't help it. So here, from my page 558, summary notes will be there. This summary notes, you will see it later whenever you want to do revision. Whenever you are planning to do your revision or whenever you want to cover any chapter, quick coverage will happen through the summary theory. Now come to page chapter 15. That's the chapter I'm going to start today with. I'll complete chapter 15 maybe in the first 1 hour today, and then we go back to our security valuation. Then we go back to
security valuation. In fact, I wanted to keep it at the end of the session, but I'm not able to estimate the time. So I don't know what time it will take. That's why I'm doing at the beginning of the session. We come to chapter 15, starting from page 549. You will be in listen mode. You want to make any notes, you can make running notes. Make running notes, but broadly, you will mostly be listening. In case you want to make some notes, it's up to you. Okay. Now, my explanation will come through a PPT. Okay, I have a PPT in front of me. With the PPT, I'm going to explain the question, explain the concept. You will be seeing your book. Okay, in your question bank, the discussion is there, and I am going to explain it through a PPT. I'll share this PPT later to you. Okay, first question: what is a startup? Okay, the chapter first. Let's broadly discuss the chapter. The chapter name is Startup Finance. Why did this chapter come into picture? Now, if you see from an Indian context or as well as global context, many startups are coming into picture. You may have seen a show called Shark Tank, where lot of startups pitch for funding. Lot of startups are trying to come out with some innovative solution. We saw a lot of startups growing from a small company into a big corporate, and the risks which are there in a startups are entirely different from the risk which you see in a mature kind of a business. For example, if I tell you that you'll have to invest in a startup, if I invest in 10 startup, only 2 or 3 will become successful. Balance everything, value can even become zero. In a startup, the value can even become zero. So the purpose of this chapter is to give a context as to what is a startup, why does startup need money, from where can it get money, because we are bothered about finance, from where can it get money, what are the sources of getting money, something called a succession planning, because in a startup, founder is the face. Once the founder is removed, how does the startup manage its business even after the founder exiting? So this is the broad context of the chapter. We are learning this chapter because post qualification, maybe you are working in a startup, maybe you end up working in a startup. So the purpose is, what does a startup do, what is the definition of a startup, how does it get money, from where does it get money, what are the different sources of investments it has, what are the risks which you see in startup. This is a broad discussion. The broad discussion of the chapter is around this area. In that, the first question I have is, what is a startup to avail government scheme or explain Startup India initiative? In India, government is encouraging startups. Government is encouraging startup. If you see, as I said, you will be only, this is the explanation, this is the material which you will be using. My explanation will flow from a PPT. You can look at the material whenever I tell you that please look at the material, otherwise be in listen mode. For example, this question has come once in exam, November 23 in exam. Otherwise, November 2019, November 23, 2 times it has come in exam. Many times in MTP, many times in RTP they have tested. In exam already 2 times it has come. Now let's discuss the question. Okay, as per the Government of India definition, there is a definition there is a notification which came in the Startup India initiative. They have defined a startup. First, it can only be a private limited company or a partnership or an LLP. Public limited company is not allowed, as per the definition. As per the definition, it's a private limited company or a registered partnership or a limited liability partnership. Why public limited is not allowed is, startup normally risk is on the higher side. So maybe government doesn't want to encourage the public putting in money there. Because the money can even become zero. In a startup investment. Age, 10 years is the time period. So today in 2025, any startup which is incorporated before 2015 is not a startup. If you have incorporated before 2015, 10 years is the time period. Incorporation not prior to 10 years. This is the time limit decided. Turnover should not exceed 100 crores in any year. If you are a startup today, and in the current year, if you cross 100 crore, you will not be recognized as a startup after that. You will not be recognized as a startup moment you exceed 100 crores turnover. This is as per the Startup India Initiative definition. Originality. What is originality? TCS. Let's take the example of Tata Consultancy Services. TCS has 10 segments. One segment is a very small segment. It is only 50 crore turnover. What TCS did is it demerged. It demerged that small segment and made it as a separate company. Made it as a separate company. It's a private limited company. Separate private limited company. Incorporated only 2 years back. Turnover less than 100 crore, but must not be formed by splitting or reconstruction of an existing business. You cannot split your existing business into 1 to 10 parts and make everything less than 100 crores. Make everything less than 100 crore. That is also not a startup. That is not a startup. And the last thing is focus of a startup should be innovation, new products, new services, new technologies. This is what a startup should bring. It should bring new products, new services, new technology. One example which I have is artificial intelligence based healthcare diagnostic. What is artificial intelligence based? I do a test on my body. It gives me a lot of parameters. With the parameters, AI tells that after 5 years, there's a possibility that you may get sugar. There's a possibility that diabetes can come to you after 5 years. Please take caution now itself. Or it can say there is a risk of heart disease after 10 years, after 8 years. If at all an AI can give this, maybe there are AI around that also now also in the practical world. But basic thing is doing something which is not there already. I want to do coaching for CA institute, CA students. That can't be a startup. That can't be a startup. Now I come with certain innovative way of doing classes. I don't know. I'm not able to think, but if there's some innovative way of taking classes, which makes it very easier for students, then maybe it is a startup. Then maybe it is a startup. Now, why this definition is needed or why? Because startups are eligible for one, I think some income tax benefits are there. Apart from the income tax benefits, certain other benefits are also there from a compliance point of view. There are, for example, in your labor laws, certain compliances are not applicable for a startup. So they get a lot of benefits from this. That is where the definition is given. The definition basically tells what is a startup, why this definition is needed. This is given in Startup India Initiative. The definition came from there. With this definition, we are able to decide whether you are a startup or not. There are four major conditions. One, your legal structure, partnership firm, private limited company, LLP. Participate, partnership firm, private limited company, LLP. Age is how many years? 10 years. Turnover should not exceed 100 crores and no reconstruction of existing business, and it should focus on innovation, new products, new technology. Why are we this definition? This will ultimately tell whether you are able to get tax benefits and other allied benefits. Clear? Any doubts on this? Now, if I go back to your theory material, read this question only. Read this question and tell me, is it a startup or not? NIA Healthcare. Read that NIA Healthcare. Read the question. NIA Healthcare is a proprietary concern engaged in the manufacture and development of pharmaceutical products since last 5 years to scale up business operation, increase the present turnover, which is hovering around 500 million. Proprietor decides to convert the existing business into a private limited company. He also wants to get access to various tax benefit, easier compliances under the Startup India Initiative, get recognized as a startup company, advise whether NIA Healthcare can be recognized as a startup company in view of the criteria considered eligible for the startup recognition initiated by the government of India. Think through for a minute and then we will discuss. You think through for a minute. Okay, does it fulfill the turnover condition? Participate guys, does it fulfill the turnover condition? 100 crores is the limit, 500 million is 50 CR. Less than 10 years, less than 10 years. Only problem is it is reconstructing your existing business. It is reconstructing your existing business into a private limited company, which may somebody may debate saying that no, it is just a proprietorship becoming a private limited company. You can debate on all that, but I think as per the definition, reconstruction of existing business. If you see, Nia Healthcare is converted into a private limited company. In other words, there is a reconstruction of an existing company business into a private limited company. In view of the above, this cannot be recognized as a startup company. Clear? Any doubts on this? Why we want recognition as a startup is tax benefits and easier compliances. I move to the second question. What are the major reason for the development of startups in India? This has also come once in exam. This will be question 2 in your material. Now, if you look at, there is a map in the side, which the map is not very clear, but the map basically indicates that how many startups are there. For example, Maharashtra has some 18,634 startup. This is recognized number. So startups are growing increasingly. There is an increasing number of startups available in the practical world. Why startups are increasing in India? Multiple reasons are there. First, government support. Government has launched the Startup India scheme. Second, there is also something called as fund of fund for startup. What is fund of fund is? This fund will give loans or will give money to the startups, because the major thing a startup needs is finance. Without finance, it is difficult for them to proceed. So this finance can come from this area called fund of fund for startup. Second, India has diverse talent. The talent force is unlimited. There are IIMs in India, there are IITs in India, chartered accountants. Many of them, instead of getting into an MNC, may work on a startup, may work directly on a startup. I think 3-4 batches back, one of the student of mine, he cleared chartered accountancy, but he's still now working on a startup. He wanted to do something on credit analytics. He's working on that startup. Instead of working, maybe money problem is not there for him, so he is ready to take that risk initially, and instead of going into a proper MNC work, he is working on creating a startup which will give employment to a lot of people. So pool of talent is there. Other element is, in India you can get workforce. Around 1 crore people join workforce on an annual basis because of the huge population India has. This indirectly makes it easy for companies to get cost effective workforce. When you get cost effective workforce, it is easy for us to compete with others, and that also led to growth in startup. Internet penetration is, before Geo came in, the penetration was on the limited side, but after Geo came in, India currently has the second largest internet user base. Because of this largest user internet base, it makes it easier for the startups to attract wide variety of customer, because startups will mostly be using newer technology will need internet. From the user point of view, internet is very much needed. I think my niece had some eye issue. There are technologies which are coming for treatment of eye. There are some softwares people develop where at home she can do an eye therapy. Earlier what used to happen is, she used to go to manually to the place, travel around 30 minutes, go there, get an eye therapy done and come home. Certain technologies got developed. Because of that technology, she is able to do the therapy at home. But the most important element is internet. Without internet, none of this is possible. The internet is the main connecting point. If internet is not there, then those startups would have died. So India major growth is also because of internet accessibility. Emerging technologies, new technologies keep coming in. There are names like artificial intelligence, blockchain, efficient data processing. All these are coming. I'll give you an example of artificial intelligence. The PPT which you see, I did not prepare. This PPT is AI based PPT. I have not prepared this PPT. I just uploaded my PDF. I gave certain comments. I made changes. But the entire PPT which you see now here is basically made out of an artificial intelligence prompt which I had given, and it has given me this PPT. If the same PPT I had to prepare, it will take good amount of time. It is going to take good amount of time. So newer technologies make it very easy. Make it very easy for a person to develop things. And if I want to develop a startup, these newer technologies will make it easier for us to work on anything which a startup is trying to solve. As I said, that healthcare example, understanding after 5 years what can happen to a person, maybe an artificial intelligence tool can look at past data of millions of patients. It can look at past data of millions of patients and do something called as predictive analytics. What is predictive? It is predicting what is going to happen to the health of a person. Funding variety. What is funding varieties? Money availability. Earlier, money availability was limited. Now, money availability is becoming more and more. If at all you have seen this show called your Shark Tank, or I think in Tamil also there is a version available. So all these are coming into picture. Why? Because startups are growing. There is an increasing number of startup. When you have so many startups available, funding is also very critical. So this is the reason for sustainable development of startups in India. 6 reasons. Please tell. First reason is what? Government support. Second, we have a diverse talent force like IIT and IIMs. The third one is cost effective workforce. The fourth one is your emerging technologies. Then you have internet penetration and funding. Funding availability is not a problem. Third question. What are some of the sources for funding a startup? What is funding a startup is, where is the money going to come from? Startup. The first source is myself, personal financing. If it says skin in the game, what is skin in the game is, I develop a startup. Startup needs 5 CR. I put only 1 lakh and ask all of you to put the balance money. All of you to put the balance money. I need 5 crores. My money 1 lakh. All of you put the balance money. Lot of people, I get the money. When I do this, if the startup fails, I am not bothered much. If the startup fails, I am not really bothered much. I am putting my time and all. But if it fails, I may not worry much because my only 1 lakh is there. Mine only 1 lakh is there. So many people say initial capital you bring from your side. Initial capital you bring from your side. If you bring from your side money, use your own savings account funds, use your personal sources, bring the money. After that is brought in, others will give money. Others will give money. This also in your ratio analysis called debt equity ratio. What is debt equity ratios? I will give debt if there is a equity from your side. If there is a equity from your side. Second, this is personal financing is using my own money. Personal credit is, I have a startup. Startup is not able to take a loan. Startup is not able to take a loan. I take a loan at my personal end. What loan I take? Maybe a credit card loan, or I take a personal loan, or I take some other loan and use that money for my startup. Use that money for my startup. Personal credit. Personal credit. The third main source is family and friends. These are the initial sources for a startup. The initial money can only come from these 3 places. Either your own money, or take a loan, or third, family and friends contribute money. Family and friends contribute money. An example is soft loan from a parent. My parents give me some money to do my startup. This is the initial sources. Once these initial sources come in, then you have multiple other sources coming in. Peer-to-peer lending. Peer-to-peer lending, it's called P2P lending. There are certain lending platforms which are available in the practical world. An example is FairCent. If you want, you read about it later. In the peer-to-peer lending platform, what will happen is, a startup will say, I am in need of money. It is an RBI recognized portal. It will do some credit checks. And if the credit checks are satisfied, money would be lent by this portal. Where is the portal going to get the money? Portal may get money from lot of investors and even individuals like you. If you are happy with what Faircent is doing, you may give your money to Faircent. Faircent will pay interest to you. Faircent will pay interest to you, and this money will be diverted to a startup. This money will be given to a startup. So you have peer-to-peer lending. In this case, only lending can happen. There's something called as crowdfunding. In crowdfunding, lending can happen, equity can happen, or donation can also happen. Lending can happen, equity can happen, or even donation can happen. For example, I am developing a startup. I need 5 CR. I go through a crowdfunding platform. What is crowdfunding is? All of you will give money. You are liking my idea and I ask you to give donations to me. Maybe I get donation. Maybe I get donation from people like lot of investors, or maybe I tell you give money, I'll give one equity share to each of you. I'll give one equity share. It could be in the form of equity, could be in the form of debt, could be in the form of donation. Peer-to-peer lending is only lending. P2P is only lending. Crowdfunding can be in multiple other ways. There is again a portal available like called Kickstarter. If you go through it, you'll understand. This portal does crowdfunding. It can help you in getting crowdfunding done. Micro loans, classic example is Pradhan Mantri Mudra Yojana. Pradhan Mantri Mudra Yojana, where small loans are given to people. With the small loans, a budding entrepreneur starts his startup. Maybe the money is not sufficient for a huge growth and all, but small amount of money is given, with which you are able to do your business or initiate your business. Also, we have vendor financing. What is vendor financing is? I buy raw material. From ABC Limited. I tell ABC Limited to give me credit. See, what is funding is? What and all can come in your liability side. What is funding is? Creating liability in your balance sheet. Unless you create a liability, you cannot create an asset. So I want raw material asset. Against that liability is creditor. I create a creditor. With the creditor, vendor financing, manufacturer extending credit. PO financing. What is PO? Is purchase order. I give an order to you. For 2 crore rupees. I give an order to you for 2 crore rupees, saying that you are a catering company and 2 crore order came to you. So now you need to supply this 2 crores to me. To supply this 2 crores, you need to buy a lot of things. No, you need to buy some products and then do manufacturing. For doing this manufacturing, you need money. So there are certain companies where you show this PO, you show the purchase order, you show purchase order from Reliance Industries Limited. When you show this purchase order from Reliance Industries Limited, the company becomes happy, saying that okay, you have got an order from a reputed company. I am happy with this. I will give you a loan. And last is factoring. I think a name which you would be aware of. What is factoring is? Your receivables are sold to an external agency and money comes to you. So there are 9 possible sources. Again, it can keep coming in exam. They'll say, what are the non-banking sources for financing a startup? First, my own sources. What is my own sources? Personal financing, personal credit, family and friends. Personal financing, personal credit, family and friends. Then after that, we have 2 sources. One is called peer-to-peer lending. Another one is crowdfunding. Apart from this, if you can get some micro loan, classic example, Pradhan Mantri Mudra Yojana. Apart from that, something on your creditor and debtor. What is creditor and debtor? On the creditor, you get some funding, creditor funding. That is called your vendor financing. On your debtor, when you get an order, you get a funding against that order called PO financing. And once the sale is done, for quick realization, we can do factoring. Any doubts till this? I give 2 minutes to you. You go through Question bank, question 1, 2, 3. You can read the all three question 1, 2, 3. 2 minutes, I'll wait. Okay, we proceed ahead. I go to question number 4. What do you mean by pitch presentation in the context of startup business? What is pitch presentation is, I come here, stand in front of you, you are the investor, explain about my company, and convince you, saying that you give me money. Again, I go back to the Shark Tank example only. There people come and do a pitch. The pitch will tell what company is doing, who is the promoter, what is the problem they are trying to solve, how are they going to do marketing, how much revenues are they going to achieve, who are the customers, what are the technologies they are using. So it's a small presentation, a short and brief presentation, usually less than 20 minutes, to investor to explain about the company and why should you invest in my company. What and all will it cover? A quick introduction. I'll give example, you'll understand. Okay, we are the Uber for tractors. Now the startup which I have is something related to tractors. Okay, and what is Uber for tractors? Today you want to go from place 1 to place 2. You have your own car, you can use it. Otherwise, you take car on rent. When I say car on rent, you just do it in Uber. A person comes, takes you from place A to place B. So I am, the startup name is Uber for tractors. Team, founders who is having 20 years experience. Next I'll explain about the founders. Third, what is the problem we are solving? The problem is many small farmers do not have money to buy a tractor. They need tractor for their farming purpose, but they do not have money. What is the solution? On demand machinery rental app. Whenever you want a tractor, just press an order, and immediately a tractor will come to you. This is the solution I'm trying to give. If at all a solution like this come, no farmer will be without a tractor. So you need a tractor, you need money. Money is not there. On demand machinery rental app. This is what I'm trying to give. Then in my pitch, I'll explain the marketing angle. What is marketing angle? I am targeting 50,000 villages in North India. This is the target I have. Targeting 50,000 villages in North India. So I'll come and only tell whatever is there in the bracket. The bracket is just for your understanding. Okay. Examples are easy to understand. In exam, how do you write? With the keywords. Okay. Projection. I want to achieve 100 crore revenue by year 2. I want to achieve 100 crore revenue by the year 2. This is what my projections are saying. Competition. I talk about who are the other people who are there in this business. Uber will tell there's a Ola, there's a Rapido, like that. Who are the other people in the business? Business model. I'll talk about business model again in some time. There's another question on business model. Business model basically tells how do you earn revenue? Any idea? How does Jio Hotstar earn revenue? What is the revenue earning potential? Through subscription, anything else, and ads. These are the main sources, subscription and ads. So in their business model, their income comes from subscription and ads, and they buy content. Which is streamed in their app. People view the content and automatically they get income. So business model will tell how is the income going to come from. Financing is the last angle we will have in a startup pitch. What is financing is, did I raise any money till now? If I have raised money till now, how did I use that money and what did I do with that money, and how much equity I have given to other people. If you have not raised money, then you will tell how much you have been able to achieve, even without money. So I come here and say, we are the Uber for tractors. We are trying to serve farmers. Farmers are finding it difficult to have a large machinery because of lack of money. I am bringing an application which will give something called as a tractor rental based on the order you place. We are targeting around 50,000 villages in North India. We are planning to achieve 100 crore revenues in year 2. Our competition is very limited, and our business model is, the farmer, whenever he takes on rent, he has to pay money to us, and we will be buying tractors and keeping them. And for this purpose, I need 100 crores from you. And for this, we will give you 10% equity stake. This is a pitch presentation. This is a brief pitch presentation which I have done. If you get convinced with the pitch presentation, obviously you will give me money. Clear? Any doubts on what is pitch presentation? In the pitch presentation, normally these documents may have to be added. In documents which, when not in the presentation, but these documents may have to be given to the other party. What are the documents? An income statement, maybe a cash flow statement, and a balance sheet. Your income statement, cash flow statement, and balance sheet. Income statement, I need not explain what is income statement and all. So income statement, initially when you are in the first year, maybe give me a monthly income statement. Initial period, give me a monthly income statement. Second, third year, maybe a quarterly income statement. Later on, give me annual projection. When you are forming a startup, initially give me data month wise. Then later on, this is just a brief point, okay? What you follow, it's up to you. All these are just few pointers. So I need an income statement, I need a cash flow statement. What a cash flow statement does and all you are aware of. And I'll be needing a balance sheet which will list out the various assets and liability. With this, the investor will make a view whether to make investment in your company or not. Clear? Any doubts in this? This was the fifth question, okay? Now, what are the modes for financing for startup? Now, what are the sources, modes of financing? To me, both are similar only, but IC has separate question, okay? Modes of financing is a separate question. Sources of financing is a separate question. We saw 9 sources. Modes of financing, when I saw it for the first time, I thought both are same only, but they have different names. Modes of financing, the first mode, they are talking about 3 modes. Bootstrapping. What is bootstrapping? Is building a company from your personal sources, building a company only from your personal sources. What is personal sources? Personal savings, personal credit lines, and maybe family and friends. One big startup, when it was formed, now it's a very big company, but one big company which did bootstrapping is your Zerodha, which is an application you may be using. That is a classic example of a bootstrapped startup. Classic example of a bootstrapped startup which did not raise money from outside people. I'm not sure today it has raised or not, but I think it has not raised money. It is a classic example of a bootstrapped startup. Angel investor. Classic example, Ratan Tata, he had invested in multiple companies, or even take the example of Zerodha. Zerodha's promoter, the Kamath brothers, they invest in lot of companies. They are called angel investors. These people will provide capital through the early stage. They say often family or friends can also come under bootstrapping model. That's a view you can have. But angel investors are normally reputed people. They are reputed people who are investing in your startup. And the third one is venture capital. This is own source. This is basically a formal investment. A venture capital is basically a formal investment. Practical world, you may call it as private equity investment. You may call this as private equity investment. A venture capital may end up investing in my company. Venture capital will again give money for long-term purpose. Their focus is on rapidly growing company. Venture capital may not normally support at the very initial stage. At the very initial stage, money may not come from venture capital. Once initial traction, so by definition it says it can give initial money also, but once some traction comes, a lot of money will come from your venture capital funds. The angel investors, classic example here, Ratan Tata, who can invest in this. Any doubts on this? Okay, this came in exam. Define angel investor. Are these only individuals? There is a question which came in exam. Define angel investor. But are these people only individuals, or they can be a partnership firm, private limited company, a limited liability partnership? Definition: individuals who invest in small startup. I'll explain only if something is critical to explain. They provide seed capital. Seed is when you are initially growing a plant, the base is the seed. Without the seed, plant cannot grow. So initial money comes from these people, which is the first time injection or first time start. Regular money may also come in, but their main purpose is to give that initial capital, This capital can also come through crowdfunding platform. crowdfunding platform where I tell all of you, please give me money, please give me money. You are my angel investors. You are my angel investors. You give me money. Practically, an angel investor can be any of them. LLC, limited liability companies, or LLP, trust can be there, investment funds can be there, corporate entities can be there, venture vehicles can be there. Individual is not the only point. It can be any of these form. It is not an individual investor. Even Kamath brothers, they are investing, or when Ratan Tata had invested, he may have invested from one company or maybe from a limited liability partnership. I'm not sure. Normally not the personal investment. They will have one legal structure. From the legal structure, investments will happen. This is the answer to the question. Define angel investor. Are they only individuals? If not, list the entities. Now going back to your merge, going back to your question bank, you please read 4, 5, 6, 7. 4, 5, 6, 7. I'll give you a minute or two. 4, 5, 6, 7. Okay, I go to the next segment, which is on venture capital financing. If you see mode of financing of startup, bootstrapping was one. Second was your angel investor. Third is venture capital financing. Venture capital financing is money provided by professionals. Normally, there are set of people. You could be working in a venture capital in future, where you could be part of a company where I will come to you saying that I need investment. You will do analysis on it, and then money could be given from your venture capital to me. Money provided by professionals who, alongside management, invest in. Major focus of them is rapidly growing companies. It should be a rapidly growing companies. Now there are few characteristics of this. One is, it is normally a long-term investment. Long-term investment. Ideally, you may have to wait for 3 to 10 years. If at all an IPO happens, you may get an exit. Otherwise, exit could be a question mark. Exit could be a question mark, or you find another venture capital. From one venture capital, money shifted to another venture capital. Lack of liquidity, it will be mostly private limited companies or unlisted companies. When it is unlisted company, selling my shares to another person is difficult. So lack of liquidity is inability to sell your shares. High risk, high return. High risk, high return concept is very simple. If you invest in 10 startup, every company you invested 2 CR, 1, 2, 3, 2 CR can even become 200 crores. 2, 3 CR can become 200 crores. And most of the company may even become zero. Most of them may become zero. If your luck is bad, or luck, or whatever, your analysis went bad, all 10 can become zero. All 10 can become zero, and you will lose entire money. Or out of the 10, 5 can become successful, or 4 can become, even 2, 3 become successful. That is more than sufficient. That is what they try. They are thinking whether a 2 crore investment can become 200 crore or not. Equity participation, mostly they'll take equity. Along with that, they'll take active role in the management. The venture capital partners will be taking, when I say active role, not day-to-day operation. They could be part of the board of directors of the company. When they are part of the board of directors of the company, they will cross question you. They will cross question you in the board meetings. Every month there could be a review meeting. In the board meeting, you will have to give clarity to what the company is doing. So they are going to take active role in your participation. What are the advantages of bringing venture capital? See, if I give money to someone else, or a bank gives money to someone else, it's just money. Venture capital is money along with lot of other things are there. What are other things? They can give me access to lot of contacts. For example, Shark Tank. If you take the example of Shark Tank, whenever these people have invested, they have tried adding extra value addition, saying that we will give you contacts of so many people, and that can help you in growing your business. So access to contact, they will become a risk sharing partner. They will guide me. They'll help me in setting up my processes, setting up SOPs, ensure that I don't get stuck at few places. Long-term equity base, and they can give me future equity base also. Whenever I'm in need of money, future money can also come. It is money. Along with money, contacts can come. Their experience will help. Their guide will be there. Their team, they may have a team which can help my team in growing my business. and ultimately it can also help me in doing an IPO placement. In the end, an IPO can be done with the help of a venture capital partner, which will give an exit to them, which will ultimately give an exit to the venture capital partner. So these are the advantages of bringing venture capital into a company. These are the various stages in which a venture capital make investment. This came in one of the exam question itself, where this table was given in the question with certain question marks. With certain question marks. So a venture capital may do first a seed money. Seed money is the initial capital they are bringing in. This is for an initial idea or an R&D stage. This includes extreme amount of risk. Extreme amount of risk. A 2 CR can become 0, 90% chance. 10% chance a 2 CR may become 200 CR. There's a 10% chance that a 2 crore may become a 200 crore. If you have been successful in this stage, then you get into a startup stage, then a first stage funding, second stage funding, third stage funding, fourth stage funding. Risk will keep going down. Risk will keep going down. Returns will also keep going down. Returns will also keep going down. When I invested at the seed money stage, value of the company is 10 crore. I gave 1 crore, got 10% stake. At this stage, value is 50 crore. If I give 1 crore, I'll get only 2% stake. At this stage, value could be 150 crore. Value is 300 crore. Value is 1000 crore. Value is 2000 crore. Value keeps going up. Your returns will keep going down. If you invest at the later stage, initial stage, if you make investment, you are indirectly helping an idea to become successful, but high risk, high return. Extreme risk, very high, high, sufficiently high, medium and low. Time period, initial 7 to 10 years, 5 to 9. You may have to remember these terms, okay, if at all it comes directly in an concept is very simple. Initial stages, if you invest, risk is on the higher side, return is also on the higher side. Then this is practically the process followed for venture capital. You are part of I am part of a venture capital company. You came to me saying that we are in need of funds, or I have lot of people, like I am tied up with some chartered accountants. I tell these chartered accountants that you tell me whenever any company needs money, So first thing is I need a deal. A deal has to come. I can directly source it, or I can source it through an intermediary. An example, referral from another founder. I have funded 10 companies. One of the founder gave me a referral of saying that there is a startup which needs money. Can you fund that startup? Once that comes in, I'll call you. After I call you, I will screen your initial proposal through my board. There will be a board. Later on at some stage, I know a student of mine who's part of the committee of the venture capital now. He is part of one company and he is sitting in that committee. So you could be sitting in the committee after maybe 10-15 years, where a lot of people are asking for funding. You will screen that initial proposal, initial pitch review. Pitch review means either I come and do a physical pitch, or it could be a video pitch, or it could be a document also. With the document, I do my analysis. Due diligence, where a lot of big four and chartered accountants come into picture. You have given me so much information. I need to check whether the information is accurate or not. So I'll do a financial due diligence, tax due diligence, legal due diligence. All the checks will be done to check whether the documents provided are fake or real. After this, I will structure the deal. What is structure the deal? How much equity you will give me? When will you give equity? Is it in the form of equity? Is it in the form of debt? Is it in the form of convertible debt, convertible preference share? What are you going to give me and how is it structured? Then I will do a regular review, post investment activity. What is regular review? Every month I will ask you to give me your MIS, your management information system. Give me information on sales traction. Give me information on number of customer. Give me information on new products, new technologies, new services. And maybe I sit in the board also. And do the review. And ultimately, I need an exit. This is the process a venture capital will try to do. A deal will come to me. A senior board will review the deal. After the deal is reviewed by the people, A due diligence will be done by an external professional. I know people, friends of mine who are part of due diligence team. They will do, there are big four which has a division separately for due diligence. After the due diligence is done, if everything is fine, you look at that startup Shark Tank. A lot of people will say we are investing. If 40 deals have passed through, out of that 40, in the end only 10-20 deals would have passed through. There they'll say we are investing. After that, a due diligence will be done. In the due diligence, you may fail. In the due diligence, it could be a failure. Structuring will be done. Post investment review will be done, and finally an exit plan is developed. Explain the structure of this venture capital fund. How are you going to structure the venture capital fund? There are two structures. Okay, one is domestic fund, second is offshore. Offshore means outside India. Outside India, domestic funds and offshore funds are an outside India fund. In domestic fund, India allows only trust or company. In India, only two forms are allowed: trust or company. In one of the exam, they asked, does limited liability partnership be structured as a domestic venture capital fund? Answer is no. This came in exam. It will be there in the book when you read it later. It will be there as one of the question. So your trust structure or company structure, in that also trust is preferred. Why company is not preferred? Company will have dividend taxation, lot of other taxation. I don't want all this headache. So trust is the preferred form. What is domestic fund? Domestic investors like you, me, are proper companies. What are proper companies? Kamath brothers. They want to contribute money to a venture capital fund, and this venture capital fund with some 10 professionals, 10 professional will do all the 6 steps which you saw above and make an investment. They will do all the 6 steps and make investment. My job is to give money only. My job is to give money. So raises money from domestic investor, invest in mostly in Indian company, invest in Indian company. Offshore funds, there are two structure. What is offshore fund? The fund is outside India. It is registered outside India. It is not registered in India. In India, because of your DTAA rules and your taxation rules, there are certain countries where if you are registered, lot of tax benefits are there. Lot of tax benefits are there. So maybe you register there. One is offshore structure. What is offshore structure is? Fund registered outside India, money coming only from outside investor, and that money is invested in Indian company. That money is invested in Indian company. Best for funds that raise money only from foreign investor, money from only foreign investor like US, UK and Japan, and want to invest where? In India. There's another structure called unified structure. Offshore funds are normally listed outside India, not listed, structured outside India. They are structured outside India. One is offshore structure where money comes only from outside India investor. Unified structure means money comes from both the people. Outside India investors are also there and inside India investors are also there. Both the money is pooled together into a locally managed trust. That is, the money is there outside India. The structure will be something like this. Fund, this is outside India. Lot of investor, Indian investor, outside investor give money. This money will invest in a trust in India, and from the Indian trust, ultimately money will be invested in so many companies. Money will be invested in so many companies. To put it very simple, there is a domestic fund and there are offshore fund. Domestic fund, domestic investor, domestic investment. Offshore fund will ideally have outside India investor investing in Indian company, where only outside investor, offshore structure. Outside India investor and Indian investor, you may have a unified structure. Any doubts on this? Again, I give you 2 minutes. You go through your, I think, question 8 to 8, 9, 10, 11, 12, 8 to 12. Okay, next set of question. I've decided to do bootstrapping. What is bootstrapping? Is raising my money from my own personal sources or from the operating revenues of the company. In this also, they are talking about what are the methods of bootstrapping. Method is basically using my own money. That's all. I'll have to use my own money. But in that also few things they are talking about. It's little bit debatable points. One is trade credit. This is understandable. What is trade credit is taking creditor funding, not a loan funding. How will creditor funding come? Creditor funding will come in case I'm a very well reputed company or my reputation is good. My reputation is good. I may get credit. Leasing is I needed a tractor. No tractor I need. One is to buy a tractor. If you cannot buy a tractor, go through rental mode. Factoring is like technically taking outside funding, but this is also part of bootstrapping as per ICI material. This is part of bootstrapping, but I can talk about this being a proper funding source. This is like a, what is factoring? You are aware what is factoring is? I sell my receivables to an outside agency and they give me money against it. Bootstrapping is good. Only problem with bootstrapping is lower growth. It is a very cautious approach. It is a very cautious approach and can lead to lower growth. When you have lot of money available, it is easy to grow. When money availability is limited, growth can be a challenge. There are set of people who are saying we are okay with lower growth. Classic example, Zoho. If at all you have seen what they do, the promoter is very clear. I don't want to raise any money from anyone. Mr. Sridhar Vembu is very clear that I don't want to raise money from anybody. I will have my own money. I will grow at a slow pace. I don't want any rapid growth and all. Whereas you look at your Swiggy, your Amazon, you look at all these, they want to grow at a very rapid pace. They are ready to lose money. They are burning money like anything. But there are people who are saying, no, I don't want this rapid growth and all. Slow, steady growth. I don't want an outside person to come and torture me saying that grow and all. So this is bootstrapping has benefit, but the only problem is it will lead to cautious and slow growth. Compare and contrast startups with entrepreneurship. Startup is basically bringing an idea into a product. Entrepreneurship is a broader concept which includes startup. In entrepreneurship, even startup is part of it. But what entrepreneurship try to do is, after that product is over, initial stage is over, you want to make it into a bigger success. Where the logic of entrepreneurship will come into picture. Entrepreneurship is a broader concept which includes startup as well as the post startup activity. When you are in a startup stage, your focus is more on innovation. You don't have a focus saying that I want to make profits. Entrepreneurs, they want to make profits. They are very clear. You have to make profits. Profit objective is 100% there. Without profits and all, no entrepreneur will be there. I want to make profits in the end. At a startup stage, focus on profits is not there. Similarly, here we are building from scratch. Once that built up is reached a stage, optimize your existing information, optimize your existing product, existing services as part of entrepreneurship. Then, what are the priorities and key challenges of a startup? This is also there in ICI material. Priorities is focus is more on need. Need means coming out with newer technologies, coming out with newer products, coming out with newer services. Today, I am teaching CA students. Because there's an opportunity existing for CA students. But if I try something innovative and try to bring something new for students, that is technically part of startup. Saying that if you do all of this, then this will improve your employment opportunity, something which is not even done by anyone. So if I try to do something to enhance your skills, which is really innovative in nature, that is the focus of a startup. Here, we encourage self-employment. We are encouraging self-employment. We want people to be self-employed rather than getting into your MNC and other places. In India, still some challenges are there. Though we have lot of talent, but the other challenge is talent is still not of right quality. Right quality talent does not exist. There are people who are ready to employ, and there are set of people who are unemployed. Both are not able to find a match because of skill issue. Regulatory cost, government has lot of restriction, lot of compliance requirement. Because of these compliance requirement, you will have to comply with PF Act, you have to comply with Gratuity Act, you will have to comply with your sales tax, you will have to comply with GST, you will have to comply with Income Tax Act. So many compliances I do, my cost will keep going up. My cost will keep going up. And break even is very difficult. Break even takes a lot of time. These are the key challenges a startup is facing as of now. I said I'll explain business model later. How a company generates revenue and makes profit. How a company generates revenue and makes profit. Example, PVR. PVR earns money mainly by selling movie tickets. Mainly by selling movie tickets to customer. Large part of profit comes from food and beverages. Food and beverages sold inside the cinema hall. It partners with film producer to screen new releases. This is where my expenses are there, and malls for prime location. Some formats are there, all that is fine. So this is how PVR operates. Hotstar, simple idea. Content like IPL, movies. Some content is free with ads. Some there is a premium content which needs a paid subscription. Money is earned from subscription and advertisement. Subscription and advertisement. Movie rental. Movie rental. They have given certain example. You can see this later. But what is a business model is how do you earn money? I used to work in a rating agency. When we used to work in a rating agency, I used to do financial analysis as well as business analysis. First thing my senior used to ask us, how is the money made by the company? You understand the business properly and tell me, how are they earning money? What is that? For example, Bharadwaj Institute earns money by conducting face-to-face classes, by conducting live online classes, by giving your recorded classes, by selling books. This is what is our business model. How is the money being made? So in the startup pitch presentation, focus will be on business model. Focus will be on business model. They'll see, you will do all the presentation, everything. If at all you have seen that show, they'll ask suddenly, how are you going to make money? You please explain me. Where is the money going to be made? It could be rental income. It could be some other income. How is the money going to be ultimately made? Is the focus of business model. Peer-to-peer lending and crowdfunding, is it same? This came in one of the exam. This came in one of the exams saying that is peer-to-peer lending and crowdfunding same? Answer is no. They are distinct mechanism. Peer-to-peer lending mostly is for lending purpose. It is only for lending purpose. Lending means giving a loan. Giving a loan. Crowdfunding is using social media and platform where it could be in the form of equity. It could be in the form of debt. It could be in the form of donation. It could be that I will tell, give me money, give me, there was one crowdfunding which can be done where I'll say, give me 1,000 rupees, all of you give me 1,000 rupees, I'm coming out with a new gadget. Once I come out with new gadget, I'll be giving the gadget first to all of you. You are the initial user of my product which I'm developing, but all of you have to give me 1,000 rupees. Whoever gives me 1,000, indirectly, I'm selling my product in advance to you. I'm selling my product in advance to you. That can also be an example of crowdfunding. Concept of unicorn. Unicorn is one which has a valuation of more than 1 billion US dollar. More than 1 billion US dollar. And obviously, it has to be a rare company. Customer focused should be there. And innovation is very critical. These are the critical key traits of a unicorn. You cannot simply become a unicorn. For becoming a unicorn, you need to be a extremely rare company. What is unicorn today? The valuation of around 9,000 crore rupees. The company has to have a valuation of 9,000 crore rupees. $1 billion is 100 crore dollar. 100 crore into 90 rupees is 9,000 crore. 9,000 crore should be the value. Small company and all cannot have. In the startup, in that Shark Tank, if you have seen, none of them would have been a unicorn. None of them would have been a unicorn. Unicorn is one which has a valuation of how much? 1 billion. In India, in Mobi, ad tech, this was the first startup. This was the first startup. After unicorn, we have something called as decacorn. Deca is 10%, 10 billion. 10 billion. Uni is 1, deca is 10. So next one is decacorn, which has a valuation of greater than 10 billion US dollar. Greater than 10 billion US dollar. Any doubts on this? Okay. After the startup discussion is done, entrepreneurship discussion is done, ICI has discussed on something called as succession planning. This is a very critical item. Succession planning is extremely critical. Classic example, I'll tell you, Tata Group. Tata Group, they have done proper succession planning. They have ensured that there is the founders were there, founders went out, or they took managerial role, or they took board management role, and then the next set of management kept on coming in. Tata Consultancy Services, Infosys, they ensure that what succession planning is, after promoter, who is there to take care of the company, who is there to take care of the company. Lot of companies ensure that proper succession planning is done. There are some challenges in succession planning, and there are certain benefits out of succession planning. Identifying critical position, developing action plans for individuals to take care of those critical position. If you don't do succession planning, then there can be a struggle later on. Just to give an example, not very good example, but something which you can still relate. In cricket, there'll be a captain. If he is going to retire, for example, in India's scenario, Rohit Sharma is not likely to continue for a very long period, so he moved out as a captain. A new captain is in his place. Now he is giving his knowledge, passing on his knowledge to the new captain, so this guy, the new captain, is going to take care of the team for the next 10, 15 years, or next 10 years, or next 8 years. Then once he becomes older, you will tell him that please quit your captaincy. You play like an player with some advisory role, with some advice. You guide the next set of people, so that when you are quitting, there is no big vacuum. We don't want a vacuum when a person suddenly quits and the other set of people are not able to take care of the business, which is what succession planning is doing. Succession planning is ensuring that you groom new set of people. Why should I do succession planning? Risk mitigation. What is risk mitigation? Suddenly founder quit the company. If you want a new person, practically it may take even 6 to 9 month time. It may take a 6 to 9 month time to bring in a new person. If the founder is not there at that time, what will happen? Second, talent pipeline. What is talent pipeline? I am part of a company. For example, you are part of a big four. Let's assume you are working in a big four. In big four, you are told that as you grow, you will ultimately become partner of a big four. You are given this promise. You are given this path. You are very happy. You are motivated, and you are there in the big four because you feel you can become a partner at some point of time and replace the existing partners. So it motivates you. Conflict resolution. What is conflict resolution? Is in case any leadership dispute happen later, if you have extra people add on, if you have other people available in the pipeline, one, it is possible to avoid this dispute, and second, even if dispute happens and you exit, there's another person who is ready to take care of the company. I think recent the person who has exited, boat which is the investor, I think is Aman Gupta. I think he is exiting from that company, and there are other people who are going to take care of the company. He is the face of that company. But he is exiting from the company, and other people will take care of the company. Professional management will take care of the company. Infosys would have been founded by Narayan Murali some 20 years back, 30 years back, but now it is a well professionally managed company. There is a proper board of directors, there's a proper management which takes care of the company. So unless you have the second pipeline, it is very difficult for the company to grow. These are the steps you will follow. Evaluate roles. Roles is which roles will need a leader. Maybe sales head is needed, maybe an R&D head is needed, maybe a production head is needed. Which are the roles which are very critical for the strategy of the company? Identify the skills which are needed and see if you have any internal person who can take care of that skill. If there's an internal person who can take care of that skill, great. If not, bring out an external person or bring an outsider to mentor these people, so that they can take care of the skills later on when a person exits. When a person exit is part and parcel of any business. Any business. I used to work in a rating agency. After 10 years, I exited. This next layer was already ready, saying that if you exit, we have a next layer who will take care of what you are doing. In your audit firm, if you exit, there's a next layer already available who is going to take care of your work. We don't want to struggle. We don't want to struggle without one person being there. So if founder is exiting, next set of people should be ready, or maybe founder's son. I don't know, whatever you do, but there should be a next layer ready, saying that who is going to take care in case. Now Zoho, if Zoho, the promoter, exits from the company, I don't know, outsider, I don't know whether they have the next layer ready or not. Maybe in their company they could be having the next layer ready, but you need to have that next layer ready. Otherwise, suddenly it will collapse. There will be a sudden collapse of the entire structure. Challenges in implementing succession planning. Founder mindset is, I am the founder. I say I don't want extra people and all. Please don't tell these people to come. I recruit a very good person. He is very knowledgeable. But as a founder, I don't give respect to him. When I say I don't give respect, I don't agree to his views. He is saying this is what we have to do. As a founder, I feel this is what has to be done. I don't agree to the views of these external professional, because of which the seasoned leaders may not be willing to join a startup. They may not be willing to join a startup. Second, succession planning and all is very good, but there is something called as process versus growth. What is process versus growth is, in the initial stages, don't tell me that I need to have proper processes and all. In the initial stages, let's just start. Proper processes and all I don't want to develop. In the first 5 years, don't tell me do succession planning. In the first 5 years, let me make it a decent stage. Then we will think about all these processes. From day one, if you think about processes, growth can become a problem. If you think about processes from day one. Processes will be used later. And many places, founder is the face of the company. If founder exits, even after good succession planning, the value of the company may go down significantly. Even after good succession planning. This is what this entire chapter is all about. I will share this PPT to you later on. You can go through the PPT to understand broadly the quick points. How will you do it from an exam point of view? You will read all the questions once, twice, thrice, 4 times. You will read just a plain reading. I don't want extra things. Just do a plain reading. After your plain reading is done, what you can do is, you can go to the summary theory. In the summary theory, various points are there. You can read these various points and complete your preparation. For summary theory, my advice to you, sit in a calm place today. In your mobile phone, do the recording of this. You read in your own voice and do the recording. Definition of startup. Just read, incorporated as either private limited company or a registered there is an error in the summary theory, okay? Not prior to, this was the earlier definition. Not prior to 10 years, turnover does not exceed 100 CR. You just do a plain reading of this in a calm place. Entire chapter, the reading will take 15 minutes. You read it, record it. Keep playing that recording multiple times. Whenever you obviously spend time on social media, you spend time there, you listen to music, sometimes listen to this, so that you are aware. That 5 chapters I want you to follow religiously. Other chapter and all not very critical. There you do whatever you want to do. So today at home, chapter 15, 3 pages. Just read it like this. Incorporated as either private limited company or a partnership firm or an LLP. You want to add extra points, you add it. That's up to you. But read it like this. After you have read this, you have done the recording. After the recording is done, keep playing that chapter. Keep playing. Students have told, sir, why don't you give me recording? Don't ask me everything. Everything I can't give. You also have to do something at your end. If everything only I have to give, then I'll write your exam. So ultimately, that is what is the last thing which can be done. So you do some things at your end. Go through these 3 pages. I was not even doing theory in the regular class. I used to give theory as video to students. This batch I felt maybe I'll do the theory also. That also not every chapter. I will decide to do few chapters. Everything will come to you. Everything will come to you, but some could be in the form of video, some could be in the class. So we are done with this chapter 15. Later at home, do the recording and all. I will be taking a break, but before that, I'll just tell one thing: theory is critical. That's the only point. You cannot ignore theory. You cannot ignore theory. Whatever I've done now, high probability 4 marks is done out of this. One question will 100% come from chapter 15. Very high probability. One question will come. 4 marks guaranteed. If you are able to write logical points. Logical points. Need to write these points as it is. Not able to write, that's okay. You cannot exact write words, but don't write some random things and all. If you can write exact words, okay. If you cannot write exact words, at least related points, right? PPTs will be given to you. PPT is just to do a quick reading, just to do a, because PPT you're able to visualize the entire content so that it's easier for you to read through and do it. Clear? And I'm being very honest, PPT I did not prepare. There are artificial intelligence tools which does these tasks. You also try play around with these tools which will help you in other subject. My subject I'll give you, other subject you can take it. Okay, we'll take a break of 10 minutes and then we'll go to security valuation. Okay, in the previous theory session, I had explained the importance of theory, where I said certain chapters are extremely important. In that, chapter 15 is done. Now I move to the second most important chapter, which is chapter 7. Again, this is a full theory chapter. So in the entire material, there are few chapters which are exclusive theory. One of them is chapter 7 as well. Now, I'll first explain the term securitization. You can come to the question bank where this is covered. Page 507 is where it is covered. You open the question bank, and now I'm going to discuss the concept first. And as I did for the earlier chapter, I'm going to discuss it through a PPT. I'll share the PPT to you in the end. High probability a 4-mark theory question will come from this chapter. So let's understand what is this term securitization. That is what we need to understand. Once we understand the term securitization, then everything else is very simple. Let's see this with an example. Okay, there is ICICI Bank. Once we understand the term securitization, then I come to every question. Okay, ICICI Bank, their job is to give loans to people and accept deposit. So what ICICI Bank has done is home loan. It has given to 1 crore people. It has given home loan to 1 crore people. Lot of people like you, me have taken a home loan from ICICI Bank. What ICICI Bank is going to do? This in their balance sheet will be an asset. In the balance sheet, this item will be an asset. What will happen? Every month, you will have to pay your EMI and ICICI Bank will receive the money from you. You will pay EMI, ICICI Bank will keep receiving the money. This will happen for next 10, 15 years, 20 years. Home loan has a very longer duration. Suddenly, ICICI Bank says, no, I need money immediately. I need money immediately. What purpose and all we will discuss later. But I need money immediately. I tell the home loan customers, can you pay all the money today? They say very, very difficult, impossible. I have taken a loan of 1 crore rupee, 10 crore rupee, 5 crore rupee, 2 crore rupee. Plan was to pay it over a period of 15 years. Suddenly in one day you are saying you give me the money. I am now in a lot of trouble. So no customer will pay, and if I push for this, lot of NPS will happen. What is NPS? Non-performing asset. You will not be able to recover the money. Unnecessary problems will happen. But ICICI Bank is very clear. I need money. They are very, very clear. They are in need of money and you are not in a position to pay. I am also a home loan customer. I also can't pay. Both are struggling to make the payment. So what ICICI Bank does is it creates a company called ICICI SPV, Special Purpose Vehicle. It creates a company called ICICI SPV, Special Purpose Vehicle. Whatever name you want to give to that company, you will create another company. In this company, I prepare its balance sheet. In the balance sheet, that home loans were there, no? ICICI transfers from its balance sheet to the balance sheet here. ICICI says, from my balance sheet, I'll remove it. From my balance sheet, I will remove it, and home loans 1000 crore asset. Home loan 1000 crore asset is there in which balance sheet now? In the SPV balance sheet. Maybe you draw the diagram also. ICICI Bank, right? ICICI Bank. I don't know how you draw the diagram, but draw the diagram. ICICI Bank, home loan given to 1 crore people. You have the full page. Maybe do it in the landscape format. You will need a lot of space. Okay. ICICI Bank, home loan, 1 crore people it has given. 1000 crore is the loan, or whatever. 1000 crore is the loan it has given. In the balance sheet of ICICI, it is the asset. In the balance sheet of ICICI, it is the asset. It creates ICICI SPV. It creates ICICI SPV. And transfer the asset from the balance sheet of ICICI to the SPV. Clear? It has transferred this balance. Then I'll explain a various question and all. First, let's understand the concept very clearly. I transferred this to the ICICI special purpose vehicle. Now, I had some asset. I give it to you. Will I give it free of cost? Nobody does it. Nobody will give free of cost. So, this SPV has a payable. Don't write this, okay? Has a payable of 1000 crore. Don't write the payable, okay? It has a payable of 1000 crore. ICICI saying, give me 1000 crore, because ICICI wanted the money immediately. ICICI wanted the money immediately. I asked all of you, you are not ready to pay. So I created one company. In the company, I transferred this asset. What this company will do is, it will collect capital. It will collect capital of 1000 crore from lot of investor. It will collect capital of 1000 crore from lot of investor in the SPV. In the SPV, lot of investors will put money. Who will put money? Some financial institution, insurance companies, banks, whoever has lot of money, they'll put this money in the balance sheet of this company. What will the SPV do? Collect this 1000 crore, transfer it to ICICI. Transfer this money to ICICI. ICICI very happy. They have got the 1000 crore. They have got the 1000 crore. So now what will happen is, this SPV, right, capital 1000 crore, capital 1000 crore collected from investor and passed on to ICICI. Will it be exact 1000 crore? Can be more, can be less. Just a broad concept, okay? Collected from investor and passed on to ICICI. One of the investor can be ICICI Bank itself. They may put some 50-100 crore rupees in that. They may also put some money, and others will also put money. This entire scene is not even known to you. You are the customer. You don't even know that this something like this has happened. What will you do? You will repay EMI. You will repay EMI. To whom? The SPV will collect EMI from you. The SPV will collect EMI from you. So SPV, when it prepares its P&L, this will give income. Against this income, SPV will return something to the investor in the form of dividend or interest. It could be in the form of dividend or could be in the form of interest. What will SPV do? SPV will collect money. Collect money from whom? Collect money from all of us. Collect money from all of us. ICICI Bank is out of the scene. ICICI Bank is out of the scene. What did ICICI Bank do? It had an asset of 1000 crore. It told you to make the payment. You said nothing doing, which is logical. How can I pay 1000 crore immediately? So what I did, I transferred the asset to the balance sheet of the SPV. I transferred it to the balance sheet of the SPV. Then I went to some financial institution, mutual funds, insurance companies, banks, fund managers, lot of private equity, and told them, I have this asset of 1000 crore. Can you give me money? On this money, I'll be collecting interest from the investors, from the people who have taken loan, and I will keep paying you as per the terms. There will be terms decided, whatever the terms and all, we'll see later. So investor will be paid. Investor will be paid something out of the home loan income, something out of the housing loan income. This transaction is called securitization. This transaction is called securitization transaction. Any doubts first on the term securitization? Now let's see it again. Who are the participants in securitization? Who are the participants in securitization? Originator. Is it visible? Not visible. Okay. Okay. Originator, initiator or securitization sells asset lying in the book, transfers legal and financial interest. Example, ICICI Bank. ICICI Bank transfers this to the SPV. What it transfer? It transfers the assets. It transfer the assets. SPV created solely to execute the deal. Created solely to execute the deal. Holds legal title. Holds legal title. Remove assets from the originator's balance sheet. This is question number 3. You see that under later. Okay. Remove asset from the originator's balance sheet. Investor, buying of the securitized paper. Who are the investor? Mutual funds, insurance companies, financial institution, FIIs, DIIs. All these people will give the money to the SPV. All these people will give the money to the SPV. What will the SPV do? Transfer this money to ICICI Bank. Obligor. Who's obligor? You are the obligors. You taken the original loan. Original borrower who owe the money. Original borrower who owe the money is called obligor. The technical name is obligor. That 1 crore loan was there, no? All these people are called obligors. Rating agency. Now, ICICI Bank says, I want to transfer this asset to the SPV. SPV says, banks, financial institution, give me loan. Now, banks and financial institution are asking whether that loan is good or bad. How do I know whether the customers will make the payment, whether these people are already making the payment, NPA there, NPA not there, is it good loan, bad loan? Somebody has to analyze this. That will be analyzed by a rating agency. The rating agency will scrutinize the asset and give a credit rating. It can be a AAA rating, AA rating, A rating. This credit rating is basically on the loans which all of you have taken. So many people have taken the loan. That entire 1,000 crore loan, I analyze and tell whether everybody will make the payment. Some NPAs can happen, because if a lot of NPAs happen, investors will lose money. Receiving and paying agent. SPV will say, I don't understand this collecting money process from the customer and all. So can somebody collect the money? That somebody is called receiving and paying agent. Practical world, receiving and paying agent will mostly be the originator itself. Who is originator? ICICI Bank. ICICI Bank will do the task of collecting the money. They'll do the task of collecting the money and will charge some fees for that. SPV is saying, I don't know how to collect money and all. You already have so many branches, so many people are there. Why don't you do the task of collecting the money from the customer? That is called receiving and paying agent. Credit enhancer. I did the credit rating. Gave credit rating of BB. BB is a very bad credit rating. So the investor said, we are not giving this money. Entire deal will be called off. The investor is saying, we are not giving money because credit rating is bad. In this case, I may get some additional comfort. What is additional comfort is, ICICI Bank or some other bank is giving a guarantee saying that if these customers delay the payment or not make the payment, I will take care of the bad debt risk. I'll take care of the bad debt risk or NPA risk. If this comfort additionally is given, credit rating can go up and the investors will give the money. And last is, somebody has to do this entire process. He has to bring ICICI Bank, he has to bring ICICI SPV, he has to bring investor. All this together is done by an investment banker, which maybe in future could be you. You could be part of a company which is helping in doing the structuring. In the end, somebody has to structure the deal. Somebody has to say, ICICI Bank will transfer 1,000 crore loan to the SPV. SPV will get a credit rating done. SPV will find the investor who will help in doing this entire process. Some external professional. I'll explain it again. One, there's an originator, which is ICICI Bank. It has asset in its balance sheet. It wants immediate money. Second, SPV is there. What SPV is going to do? Transfer asset from here to the SPV and transfer in the liability side, issue securities to the investor. What form? Can be equity, can be debt also, issue securities to the investor. Who are the investor? Mostly mutual funds, insurance company. There are obligors. Who are obligors? The people who have taken the original loan, the financial institution is saying, I don't believe all these people, so do a credit rating and come to me. Credit rating is bad. Some enhancement is needed in the credit rating. SPV is saying, I don't know to collect money, receive money. So an agent can come called as receiving and paying agent, which can be originator, can be others also. And finally, somebody is going to structure the deal. Any doubts what is securitization? Why this is happening is very simple. ICICI Bank needs immediate money. Why it needs and all, let's not debate on it. It needs immediate money. So it may transfer part of its assets to the SPV and tell the SPV to do this. ICICI in the past have given auto loans. What is auto loan? Is for auto customers, whoever is into transport business. Now ICICI wants to discontinue this business. All the auto loans, they will securitize and transfer to an SPV and tell the SPV to take the headache, saying that ICICI Bank says, we don't want any auto loans in our balance sheet. So let's transfer it. This is the concept. Any doubts on this? Clear? Understood till this? Let's now come to question 1. Explain the concept and features of securitization. Securitization is the process of pooling and repackaging of homogeneous. What is homogeneous? Is similar. What is similar is, do all home loans, do all auto loans, do all personal loans. Don't say I'll do personal, home, auto, all put together and do securitization. Homogeneous, illiquid. What is illiquid? You are going to pay over 20 years. Into marketable security that can be sold to investor. An example, auto finance company has 5,000 car loan. It bundles them into a single pool of 100 crore. Sells this to an SPV. SPV then issues, what is pass-through certificate, you will understand in some time. SPV then issues 1 lakh each. They issue a certificate with value 1 lakh to how many people? 100 crore divided by 1 lakh, so 10,000 investors are there. You could also try to become an investor if you are interested. Practical world, there are certain restrictions, but this is what SPV does. Any doubts? Features. Creation of financial instrument. What is creation of financial instrument? Is the loan which was there is now converted into a financial instrument. It has converted into a financial instrument. There are technical name called PTC and PTS. I'll explain that in some time. It is converted into a financial instrument. Creation of pool. As the name indicates, we create a pool of assets where we club what? We club the entire housing loan, entire auto loan, entire personal loan, entire whatever loans you are giving, you pool them. Bundling and unbundling. What is bundling? Is 10 or 100 home loans is clubbed and become a 100 crore bundle. Then bundle means aggregating. After you bundle it, you unbundle it by saying 1 lakh each security. You unbundle it by issuing security worth 1 lakh. Bundling, aggregating into a pool. What is unbundling? Issuing securities of denomination against the pool. Issuing securities of fixed denomination against the pool. Any doubts till this? Homogeneity. What is homogeneity? Is that entire pool should either be home loans, should either be personal loans, should either be your whatever home loans, personal loans, education loan. All are home loans. All are credit card receivable. Trenching. What is trenching? Is structuring the deal. What is structuring? Is after that 1,000 crore came in the asset side, I have to issue it in the liability side. When I issue it in the liability side, I can issue equity. I can issue senior equity. I can issue junior equity. All these technical terms not very critical for you, but I'm going to issue different forms of instrument. What are the different forms? It can be debt, it can be equity, it can be debt, equity. Debt has low risk and low return for the investor. Equity has high risk and high return for the investor. High risk and high return for the investor. Marketability. What is marketability? Is ultimate objective is transfer some good loans, so that you can issue ultimately securities to the investor. If you are transferring some bad loans and all, no, it cannot be marketable. I have a pool where NPA is 20%. Nobody will take that. If NPA is 20%, transferring that doesn't serve any purpose, because no investor will invest in that pool. This is what merchantable quality. What is merchantable quality? Is the quality means those loans which are given, the end customer should have the ability to repay. I have a pool where I have given loans to Reliance, Anil Ambani companies and lot of bankrupt companies, and now I want to transfer this. Impossible. That and all doesn't make any sense. Who will invest in such type of a pool where all are bad loans? Trying to transfer that doesn't make any sense. Liquidity means collecting immediate money. ICICI Bank wanted immediate money. Any doubts on this? This is the features of securitization. First, I explained various parties to the securitization. Now I explain the features of securitization. Any doubts on any of this? Explain securitization in India. What is securitization in India? Historically, how did securitization came into picture? This securitization in India came through Citibank. Citibank had started the concept of securitization in India by doing something on auto loans. They had given loans in the auto sector and did securitization of that as the first. Later they expanded to aircraft receivable, sales tax receivable. Now you can do home loans, education loans, anything which is of a good merchantable quality. Why are we doing this? I need immediate money. Why do I need immediate money? For giving further loans only. Market growth. After this started, it has been continuously growing by players like ICICI Bank, HDFC Bank, National Housing Bank. It reached a value of 1.9 trillion. 1 trillion is, I think, 1 lakh crore. 1 lakh crore. So it reached a value of 1.9 trillion in the value FY 2019-20. Certain regulations came in. Why regulations are needed? Mostly of non-performing assets. If there are any non-performing asset, who will suffer the loss? The SPV will suffer the loss. Investor will suffer the loss. So certain regulations came in. Because of the regulation, non-performing assets are also getting sorted out without the lot of legal formalities. Because of this also, the growth is there. And also foreign participation is there. What is foreign participation? Investor is needed. No. Investor, where is the money going to come from? That money can come from foreign participation. What is foreign participation? Foreign portfolio investor, FIIs or FPIs. These people are giving money to the SPV. If SPV gets the money, securitization value will keep going up. Any doubts on the concept here? One example for securitization is also this. Indian microfinance institution. What is microfinance institution? Is those give small loans, 10,000 rupee loan, 5,000 rupee loan. ICICI Bank, as per the RBI regulation, will have something called as priority sector lending to be done. Priority sector 5%, 10%. So ideally ICICI Bank should give loans to agriculture, should give loans to microfinance. They are not able to do it. So what they do is they call an MFI, microfinance company, and tell them that you sell your loans to me. You sell your loans to ICICI Bank. You sell the loans to the ICICI Bank is like an SPV there. You sell the loans to the ICICI Bank, and this helps the ICICI Bank to meet their priority sector lending target. It helps them to meet the priority sector lending target. ICICI Bank has a lot of money, so it tells the microfinance institution, you transfer this money to me. You transfer the money to me. Any doubts on this? What are the benefits of securitization? Some of this will be clear, easy to understand. Off balance sheet financing. What is off balance sheet financing? Is I remove that asset from the balance sheet. Moment I removed the asset from the balance sheet, I got immediate money. I got immediate money. Whatever money I got will not be looking like a liability in my liability side. Whatever money I got, it is not a liability in my liability side. There are certain rules in Ind AS. I'm not getting into all that. Okay, a student asked me later. I'm not getting into your Ind AS accounting and all. I remove it from the asset side, and automatically I get the money without creating any liability. That is called off balance sheet financing. Focus on core business. I don't want this loan and all which I've given. I want to focus on my core business. My core business is home loans. I don't want education loans, so I'm removing the education loan and transferring. It will improve my ratio because my values goes up in the assets. Liabilities is not increasing. Automatically capital is there without any loans there. Automatically my ratios will improve, and this can have a reduced cost also. What is reduced cost is I transfer this to the SPV. SPV mostly will be ICICI own company only. SPV will mostly be ICICI own company only. This SPV will be able to take the loan at a very low rate. Maybe loan means investor. From the investor, they'll be able to take the loan at a lower rate, and ultimate beneficiary will be ICICI Bank. Ultimate beneficiary will be ICICI Bank. From an investor angle, who is the investor? Mutual funds, banks, financial institution. They get diversification benefit. What is diversification benefit? They want to invest in multiple things. They want to invest in home loans. How will I give home loans directly to you? So home loans is given by ICICI Bank, and I become an investor in the home loan portfolio. Education loan is given by HDFC Bank. I become an investor in the education loan portfolio. Diversification. Regulatory compliance. I told you about that microfinance institution transferring their MFI portfolio to ICICI Bank to meet the priority sector lending. Protection. Sometimes in the securitization deal, the investor will tell the risk of NPA will go back to ICICI Bank. That is a protection I may add. And ultimately, it can give me good returns. As an investor, it can give me good returns. This is the concept. Any doubts on this? Okay, I'll wait for a minute. Read question 1, 2, 3, 4. You can just read at your end. 1 minute for you. 1, 2, 3, 4. Question 1 to 4, we are done. Please read all the 4 questions. Okay, mechanism of securitization. I think this will be easy to understand. Identification is the first one. Originator selects assets with similar maturity, interest risk, and frequency of payment. First, you'll have to identify which securities. Second, transfer it. Third, issue papers. What is issue papers? Is issue securities to the investor. There are 2 types of security called as PTC and PTS. I'll explain that in some time. I'll have to issue securities to the investor. Then I may need a credit rating. Technically, credit rating may happen even before the issue. Ideally, it will happen before the issue of security. Then after the credit rating is done, bad credit rating, credit enhancement. Then administration. What is administration? Is collecting the money. Who will collect the money? Receiving and paying agent. Who will be the receiving and paying agent? Mostly originator for some fee, because he is not going to do free service for you. He is an outside agency. You are an outside company now. He may charge. And repayment. What is repayment? Is collecting money from the customers and passing on final money to the investor. What will SPV get? SPV will collect 100, pass on 2-3 rupees to the originator if he is doing the job of collecting. Investor will get 80-90. Balance 10 rupees could be the profit of the SPV. Which will be enjoyed by the equity investors of the SPV. In the SPV, there will be an equity investor, there will be a debt investor. What will debt guys get? They will get interest. What will equity guys get? balance money left over after meeting the commitments. Balance money left over after meeting the commitments. So you can be an equity investor in the SPV. You can be a debt investor in the SPV. Any doubts on this? Any doubts on the concept? So very simple. Identify, transfer it to the other party, issue papers. What is issue papers? Issuing securities, do a credit rating, do a credit enhancement if needed, do the servicing and repayment. In the entire process, in case there is an NPA, this NPA may go back to ICICI, depending on the terms of the agreement. Clear? What are the problems in securitization? Though securitization has been growing, but there are certain challenges which the entire process is going through. First challenge is stamp duty. Some states charge a very high stamp duty on this transaction. The securitization transaction itself involves a stamp duty. Example, if Karnataka charges 12%, this is not the exact number, I'm just giving an example. Maharashtra charges 0.1%. Securitization in Karnataka is difficult. Securitization in Karnataka is difficult. Second is taxation and accounting. The accounting itself is a little bit of a debatable issue. Can you remove it? Can you not remove it? Is the ICICI Bank still has some risk? No risk? Can this asset be removed from the balance sheet, or it should be carried as a contingent asset, contingent liability? All those challenges are there. Uniformity is not there. They're just saying that there is no uniformity, and also challenges from a taxation side. What is foreclosure loss? Lot of legal laws are there. You have taken a home loan. You have taken a home loan. You did not make the payment. What should I do? I should come seize your property. But seizing the property itself is a challenging task. Seizing the property from you is a challenging task. Ineffective laws. Laws are not very effective. If the laws are not very effective, you are not worried to make the payment. When you don't make the payment, I suffer loss as an SPV, and ultimately investors suffer loss. So ineffective foreclosure laws. MBS means mortgage based securities. The process of securitization becomes unattractive in case these laws are not properly given effect. If you give it proper effect, no problem. But if proper effect is not given, the entire loss ineffectiveness leads to slow growth of securitization. Lack of standardization. What is lack of standardization? ICICI does standard securitization. It does its own form of documentation. The process is still evolving in India. So standardization is not there from an accounting point of view, taxation point of view, documentation point of view, because of which there can be a problem. Inadequate debt market. What is inadequate debt market is? I transfer to the SPV. SPV need money. People are not there to invest itself. People are not there to invest itself in the SPV unless there are people. Inadequate means it is still a developing market for us. In India, it is still a developing market. Also, I invested in the SPV. After investment, I suddenly needed money. What I would do? I would want to go to a stock exchange and sell my shares to you, sell my bonds to someone else. That secondary market is also not there. Secondary debt. What a secondary market is? I want to transfer to someone else. As an investor, I want to transfer, but there are no people. If this is the problem, I don't want to invest in the SPV. If SPV doesn't get money, how will securitization happen? Securitization can happen only. Growth is still there. It is a very evolving area. I used to work in a rating agency where we had a separate division for doing securitization rating, and highly profitable division in the company which I used to work, because huge growth is happening in securitization. People are doing securitization, but the question is talking about problems. There are 5 problems which ICI material talks about. One is stamp duty, taxation and accounting is not proper, ineffective foreclosure laws, lack of standardization, inadequate debt market. Okay, what are the various securitization instrument? First type you have to understand is there is a debt type, there's an equity type, which is a different story. In this, I can do PTC, pass through certificate, PTS, pay through security. This can 100, lot of times this has come in exam. Pass through certificates and pay through securities. PTC and PTS. What is PTC? Is as SPV collects money, it will pass on to the investor. you as the customer did prepayment of 1 crore, did prepayment of 1 crore. I will transfer this 1 crore to my investor saying that I prepay your debt. You prepaid, I also prepay. What is PTC? You are paying me 1 crore, I'll pass on 99 lakhs to my investor. You prepay. If you are prepaying, I will pass it on. What is PTC? Is entire receipt is transferred immediately. Is transferred immediately. As a customer, I had 1,000 customers. Somebody will do prepayment of home loan. I cannot stop you and all. You can do prepayments of your home loan. When you prepay, I transfer this directly to the investor. So investor carry a risk called prepayment risk. What is prepayment risk? Is investor didn't even want money, but suddenly you are saying I will pay you interest and principal also back, a part of the principal. He's saying don't give me. No, no, it is PTC, I'll give you. It is pass through certificate. What is pass through certificate? Whatever money is collected will be transferred fully. What is pay through security? You did prepayment, I don't pay to the investor. I invest this money. I invest this money and I'll pay as per the original terms of the agreement. What is original term? Every 1 year, I'll be paying 1/10 of the loan, 1/10 of the money to the investor. So here permits restructuring. SPV can reinvest the surplus fund. SPV can reinvest the, this is the core difference. Okay. This is the core difference. What is PTC? You did prepayment, I pass on the money to the investor. I pass on the, you are the customer, this side are the investor. You give it to me, I pass it on to you. They give the money to me, I don't pass it on to you. What I do? I reinvest. I reinvest. When will I give you? As per the terms. What was the term? Every year pay 10% interest and repay 1/10 of the principal. Repay 1/10 of the principal. I'll pay as per the terms. I'll pay as per the terms. So I can do reinvestment. I can do reinvestment and it allows me to create different tranches. What is different tranches? Is some can have 2-year life, some can have 5-year life, some can have the security which I issue 2-year security, 5-year security, 10 years. In PTC, as money comes in, money will come back to you. Be mentally prepared. If money comes from the customer, I'll pass on the money to you. This is first two type, PTC, PTS. There's another category called stripped security. Stripped security, it could be a subpart of PTC, could be a subpart of PTS also. But what is stripped security is, the investor who is investing in my company, I tell them that you will either get only interest or you will either get only principal. What is interest or principal? If I get interest from the investor, I'll pass on the interest income to you. If I get principal from the investor, I'll pass on the principal income to you. Principal, not income. Whatever principal I get, I pass on the principal. Holder receives only interest. Interest only security. Principal only security. There are two types. Interest only security. Principal only security. What is interest only security? I issued 200 crore interest only security to you. I issued 200 crore interest only security. This 200 crore, how I am going to repay? I will repay out of the interest income. I'll repay out of the interest income. What is out of interest income? 10 crore comes, I'll pass on 10 crore. 20 crore comes, I'll pass on 20 crore. Only payment out of the interest income. Only payment out of the interest income. I also issued 500 crore principal security. This 500 crore will be repaid out of the principal which is coming from my obligor. Out of the principal which is coming from my obligor. 500 crore means principal due could be 700 crore. So 700 crore will go back to the investor. 200 crore interest due could be 300, 400 crore. 400 goes to the investor. This is normally not preferred by the investor. Normally not preferred by the investor. Why is it not preferred by the investor? Very simple. Why I want this headache of only interest, only principal? Let me get both. Let me get both. So either it is PTC or PTS. What is PTC? Prepayments passed on to the investor. Prepayments passed on to the investor. There is a prepayment risk. You have a direct claim. What is direct claim? Is as money comes in, money passes on. Here no direct claim. Different tranches. 2-year, 5-year, 10-year, 15-year, depending on what I want to do. How is the pricing of the securitized instrument done? What is pricing? Is I transferred 1,000 crore. against this 1000 crore asset, would you pay me 950 CR, 1000 CR, 1100 CR, 1200 CR? What are you going to pay against this? What are you pay against this 1000 crore? I transfer 1000 crore asset. No, you have to transfer this 1000 crore to you, and you need to give me some money. How much money will you give? From an investor angle, investor will want the SPV to pay 800, 900, 1000, 1100, 1200, whatever number. How will they calculate? They will tell the SPV to do present value of future cash flow discounted at WACC. Present value of future, or SPV will be getting future cash flow, first year so much, second year so much, third year so much, fourth year so much, fifth year so much. Discount the cash flow at the yield to maturity, and arrive at the value. This is what investor would want the SPV to pay. Investor would want the SPV to pay. I am ICICI Bank. ICICI Bank will think in one logic. What is the logic is, if I transfer the asset, I am not going to get first year interest income. I am not going to get second year interest income because I transferred this. No, I am not going to get income. So whatever money you are paying me, when I reinvest this money, I should at least get that earlier income. I am transferring asset to you. When I transfer asset to you, you have to pay me 2000 crore. Why 2000? With that 2000 crore, I will give new loans and earn the interest earlier I was earning. So priced at a rate where the outflow can be amortized by investing over the amount raised. See, they have given different terms, but logic I'll explain. Logic is very simple. You have to pay an amount. Which can compensate the loss in income. What is the loss in income? 1000 crores loan is removed. You were paying me interest. What interest? Maybe 10% for a year. 100 crore I was getting. Now entire 100 crore is lost. So you at least give me some amount with which I reinvest and get 100 crore. This is the logic they are saying. Rate where the outflow can be amortized. They give something like this, but logic is what I'm explaining. Logic is very simple. I will invest the amount raised. Cost of funds versus the deployment return. What is deployment? I'll deploy this funds and get the money. What will SPV investor say? Give them. Very simple. SPV investor will tell, give them an amount which is equal to present value of future cash flow discounted at yield to maturity. Any doubts on this? There are risks in the securitization process. The first main risk is, all of you, when the customers are not making the payment, that is the biggest risk in the securitization. That's called credit risk or counterparty risk. None of the customers are making the payment. That is the biggest trouble. This happened in US 2008 subprime crisis. If you want, you just read about it, where a lot of loans were given and none of the customers were able to repay. The amount. Legal risk. What is legal risk? Is one, I transferred this asset to the SPV. No, whether that happened properly, not happened properly. Is there a dispute which can come? ICICI, can it claim that that loan is still in my books? That is one. Second, you did not make the payment. I'm not able to seize your property also. I'm not able to take back your vehicle also. Then that is the other risk which we have. Market risk. What is market risk? Is macroeconomic. Today, I have given loans to all of you. What happened is, Indian economy went through recession. Some of the customers lost their job. When jobs are lost, they are not able to make the payment. This is a market risk. A macroeconomic risk where industry downturn has happened, because of which customers are not able to make the payment. If customers don't make the payment, I'll take another 10 minutes. I'll have to complete this. Customers are not able to make the payment. This will lead to default. Prepayment risk. What is prepayment risk? Is early repayment. Investor may not find the same yield again. In case of PTC, you pass on the money. When you pass on the money, they are saying, why are you passing on the money? I don't want this money. I don't want this money. But you still passed on. You still passed on. Any doubts till this? Okay. Securitization has some linkage with a technology called blockchain. What is the linkage? You'll understand in the last question. A term which a lot of us may have heard, blockchain. It is a very big term. I'll just explain simple terms for us to understand. What is blockchain is, let's assume I create a Word document. I create a Word document, give access to all of you, give access to all the people, give access to all the students. When I give access, some student can start writing in page 1. They can start writing in page 1. Page 1 return, then page 2 will open. Page 2 can be written by any other person. Page 3, page 4, page 5, page 6. Page 1, if it's written and if it is okay, nobody can delete it. None of you have access, but you cannot delete the page 1. All the students are having access to that Word document. You can write page 1. Somebody can write page 2. Somebody can write page 3. That page 1 is called a block. A block. One block. One block. Page 1. In the page 1, you will write some transaction. What transaction? We'll see later. You will write something in the page 1. If it is a okay kind, then it is over. Nobody can tamper that page 1. Nobody can edit that page 1. Nobody can make any changes to the page 1. Like this, page 1, page 2, page 3, page 4, page 5, page 6, page 7, page 8. Like this, millions of pages will go. This millions of pages together is called chain of blocks, blockchain. Chain of blocks, blockchain. Every page is a block. This page will have some transaction. What transaction? Simple example, real estate. You purchased a property. You purchased a property. The owner details is mentioned in page 1. First property. Second property, another owner. Third property, another owner. Government is using blockchain technology where the owner details are mentioned in every page. It's not practically page, it's every block. In every block. Nobody can delete that. Nobody can delete that. So if you are able to maintain this property records in a blockchain, nobody can do double registry. Nobody can create fake records. All those will get eliminated in the practical world. You will get access. Lot of people. When I say humans, practically you are not going to get access. Whoever has to get access to that blockchain will get access to the blockchain transaction. In a blockchain, every participant has copy of the Word document, has a copy of the Word document. Once data is written, it cannot be changed or deleted. It cannot be changed or deleted. No central authority. Notes must agree on validity. Notes means whoever are the participant, they have to agree on the validity. Where can it be used? One example they have given, supply chain. Supply chain, how it can be used? If I have a blockchain, for example, let's assume I'm buying milk. I go to a store and buy milk. That milk turns out to be bad. The milk turns out to be bad. In blockchain, you'll be able to track which retail store the milk came. This retail store bought it from which factory. This factory got the milk from which cow. Ultimately tracking it to the cow and understanding there is some problem here. So maybe give treatment to that cow. Walmart uses blockchain, something else to track lettuce. In case there is any outbreak, some bacteria or virus outbreak, they can identify from which batch, which farm this has come, so that you do treatment of it. This is one place where blockchain can be used. Supply chain, real estate, smart contract. What a smart contract is? I set a rule. What is a rule? We have entered into a transaction. In the blockchain I have mentioned, if it rains today, I will transfer 1,000 rupees to you. I'll transfer 1,000 rupees to you. Blockchain will track it. If it rains, automatically I'll transfer 1,000 from my bank account to your account. Automatically. Another example, insurance payout. Insurance payout is triggered automatically in case there is a delay of more than 4 hours. They are talking about something like smart contract means automatic execution. Why is the blockchain coming in securitization in the end? In the end, I'll tell. Finance. In finance, there are, for example, I want to transfer money from India to USA. Earlier, India will have to transfer to some in between account, then it will go. Lot of transactions have to happen. If blockchain is there, in seconds the money will be transferred, and in the block this transaction will be recorded. Dinesh transferred to someone else, my account value went down, another person account value went up. There are also risks in the blockchain technology. The major risk is there is nobody sitting at the top. Nobody sitting at the top. What is nobody sitting at the top? For example, if I have to use some accounting standards, how accounting standards are used, ICI is sitting at the top saying that you'll have to do it like this. In blockchain, who's responsible if something goes wrong? Who's responsible if I give access to a Word document and I become central authority? I'll take care. But I am also a participant. You all are participant. Somebody did something with one of the Word document, one block. Something has gone wrong. Who is going to sort out this issue? Who will sort out the issue in case something happens? Second, control and monitoring is little difficult. In case my controls are not properly implemented, again it can go bad. In case there is a bug, who is going to sort out that bug is the biggest problem of blockchain in the current world. Reliability of technology. If that underlying technology itself had an issue, then again the blockchain can fail. And the last important part is skilled people are not there who understand blockchain. I have not understood blockchain till now. Again and again I've read it multiple times. Ultimately I've got some clarity, and that's why I'm explaining it. But still, a lot of people don't understand what is blockchain itself. So who's going to do all this development? Finding competent people to design and performing this is difficult. Finding the competent people. Now you will understand why did blockchain come into picture in this chapter. It came because of a term called tokenization. What is this tokenization? Let's understand. But this came in this chapter only because of tokenization. Another 5 minutes and we are done. Let's see an example. There are 100 commercial buildings. There are 100 commercial buildings are there. ICICI, let's assume, has 100 commercial building as an asset. It's not loan, 100 commercial building. It transfers this 100 commercial building to an SPV and tell the SPV to collect rental income. Tell the SPV to collect rental income. That is practical word called real estate investment trust, REIT. It's technically called REIT, but this is a securitization process. What is tokenization is, I have a luxury apartment. The value of the apartment is 500 crores. It is a 500 crore. I wanted to sell this 500 crore value. No investor. I could not find any investor for 500 crore. Then I tell everybody become owner of 1 by 100. 1 by 100. What is 1 by 100? Pay 5 crores each. Pay 5 crores each. A single luxury apartment divided into 1,000 tokens. Divided into 1,000 tokens on a blockchain, allowing people to become owner of 1 by 1,000th of the apartment. This is where blockchain came into picture. Why blockchain came into picture is, you want to convert an illiquid asset into a liquid asset. One way is securitization. Another way is tokenization. What is tokenization? Converting that real estate property into a asset in the blockchain and converting into something called as 1,000 tokens. What is 1,000 token is? Every token gives you ownership of 1 by 1,000. 1 by 1,000. Process of converting tangible and intangible asset into blockchain token. Practical world, a painting can be converted into a token and sold to people. Liquidity, both give liquidity. What both liquidity? Converting the, ultimately this is why we have learned blockchain, to compare it with tokenization. Diversification. As an investor, I want to invest in real estate portfolio, but I can't buy 10 crore real estate building. So I'll buy 1 by 1,000. 1 by 1,000, or I can become a part owner of the SPV. Trading, it can be traded in the market. You can transfer your token to someone else and it will be recorded in the blockchain. Why blockchain? Because blockchain has the data which can never be deleted. It has proper information which can never be deleted. Opportunity, the financial institution may generate some income out of it. Whoever is doing this deal, whoever is doing this deal, it may generate some income for it. Again, I'm repeating, it's a very important thing. I'll close it with just one discussion. What is securitization? Again, securitization is very simple. ICICI Bank is there. It has asset side 1,000 crore. It wants money today, transfers to SPV. SPV has the asset. SPV will create a liability. What is the liability? Equity capital 100 crore, junior debt 400 crore, senior debt 500 crore, and this money will be passed on to SPV, to ICICI Bank, and SPV will collect money from all of us and pass on the returns to the investor. Clear? Any doubts on this? Any doubts on this? Do go through this. I'll share the PPT to you. With this, 2 important chapters theory is over. 5 important chapters are there. Mostly I'll do all the 5 in the class. Clear? Any doubts on this? We'll end with this. Thank you, friends. Good morning, friends. Okay, first today I'm going to start with another theory chapter. We are done with 2 theory chapters. Totally 5 dedicated theory chapters are there. Our important theory chapters are there. We are done with your securitization part and the startup finance. I'll now move to chapter 1, which is financial policy and corporate strategy. Again, a chapter which is fully dedicated to theory. There are 3 fully theory chapters. 2 main theory and some practical is there, and others are practical and theory. So this is in page 470 of the question bank. I'll first quickly discuss a broad overview what we are doing in this chapter, and then we go through various questions. Now the chapter is very simple. The focus of the chapter is what is financial policy, how do you decide financial policy, what is the use of the financial policy, what can an organization achieve by following a financial policy, how can an organization become something called as sustainable. Sustainable means staying for a very longer period. If you go back to history and check, maybe 40 years back or 50 years back, 100 companies were there. Out of those 100, today maybe only 20 survive. Lot of companies go out of business, become bankrupt because of some company which have been extremely famous when our parents were growing, but now those companies may not even exist itself because they were not sustainable. So somewhere a focus on sustainability will come, and something called a strategy. How does an organization develop a strategy? What is financial strategy? What is corporate strategy? So certain elements around that is what the focus of the chapter is all about. At CA Inter, we learnt something called as role of a financial manager or a chief financial officer. There, when we would have learnt that, we saw that CFO main focus was on something called as wealth maximization. The role of a CFO is to enhance the wealth of an organization. That was called traditional role. Explain about the advanced role of CFO in various matters, including wealth creation. This is question number 1. The CFO's role earlier the role was primarily focusing on wealth maximization. Wealth maximization means increasing the wealth of the company by following certain policies which enhance the wealth of the shareholders. We used to have 2 principles. If you remember, there will be something called as profit maximization and wealth maximization. Now the CFO is not a person who's only bothered about wealth maximization. He is a person in the company who will have a say on multiple things. He can even talk on something called a supply chain management. What is supply chain management is, how does the product from a manufacturer reach the end customer? There are different ways it will reach the end customer. That's called supply chain management. A CFO may focus even on that, even on something called a supply chain management. Focus on risk management. Because of the growth of technology, an organization is now impacted because of various risks. You can get impacted because of a technology risk which is there, or a cyber security risk which is there. All these roles are available with the CFO. He is going to take care of the technology part as well. M&A restructuring. M&A is mergers and acquisition. Structuring or restructuring, whatever way you want to call. You can do a merger, you can do an acquisition, you can do a demerger. All these places, the CFO plays a predominant role. There's one more item which is coming now called as ESG financing. What is ESG financing? Is environmental, social and governance based funding. Many companies in the practical world issue something called as green bonds. What is green bonds? Is those companies which comply with all the environmental norms, social norms and take care of the governance within the company. You will learn this maybe in your SCPM subject. There's an area called triple bottom line, which is called people, planet and profit. An organization earlier focus was just making profit. Now only profit and all will not work. You have to take care of the environment. You have to take care of the environment. You have to take care of the society at large. Societal consideration. What is society? Is doing good for all the stakeholders. A stakeholder can be employee, can be customer, can be supplier, can be shareholder. You need to take care of all the set of people. So these are the newer roles which a CFO is going to perform now. Earlier, wealth maximization, just focus on financial angle. Just a practical example, a CFO of a technology firm today just doesn't manage books. It is not just managing books of accounts. What is managing books of accounts? Recording of transaction and ultimately declaring the results of the company in form of financial statement. He may decide on investing on green data center. Data centers are those which takes the information, where the information is stored. Green data center means no major impact on environment. And hedging against the cyber security risk. Cyber security risk are because of the technology improvement. I think a lot of us are aware. Suddenly a link will come in your mobile. You click the link, your mobile gets hacked. Because of that, you may lose the entire money which is available in your bank account. So many risks have started coming in. Lot of times, suddenly a message will come saying that there is a fine of rupees 100 on your traffic violation. Pay the fine. If you click that link, you will see that was a bogus link, and moment you click it and give some information, your account will get hacked. And after that, they will get access to your account, send information to other people. So a lot of risks have started coming in. A corporate has to protect itself from these risks, and CFO may have a role in that as well. Clear? That's the first question. Explain the role of an advanced role of a CFO. Earlier, wealth maximization. Now we are going beyond wealth maximization. At any stage, whenever you are going to revise theory, you'll first read the PPT once, and then you can quickly go through the question, because the PPT will give you a broader view of the question. Next, what are the three elements of any business? Three elements of any business is SFM. We used to call the subject as strategic financial management. These are the three elements. SFM is S means for strategy, F for finance, and M for management. Without SFM being there, a business can't survive. What is SFM? Strategy. Strategy is what I want to achieve and how am I going to achieve it. How am I going to achieve it? Lot of linkage is there in this chapter to the SCPM portion, because unless that is clear, this may not get you good clarity. There you will learn something called as vision, then there's something called as mission. Based on this, objectives will be prepared, and based on the objectives, something called as strategy will be decided. This is how it normally happens. At the top, there is a vision or a mission. Based on that, corporate objectives are decided. To meet the objectives, I need a clear and a realistic strategy. I have a good strategy, good business, but still I go to Shark Tank India because I don't have money. I don't have money. Without finance, nothing can happen. Without money, nothing can happen. And once money is available, you need right set of people to grow your business, which is the management angle. Not sure if you have tracked this. Recently, there was an announcement by Zomato, that is Eternal, where the main person is exiting out of the company and there is a CEO change which is happening. These things may matter a lot in the practical world, and even share price may react because of these news. So right management is very critical. So fundamentals of businesses, SFM, strategic financial management, is the name. Earlier we used to call the subject. What is SFM? Strategy here. F is financial and M is management. These are the three clear fundamentals of a business. Simple example: a startup may have a disruptive idea, skilled founders, but without funding it cannot execute any of that. Without money nothing can be done. So money is very very critical if I want to implement some strategy. What is the meaning of a strategy? Strategy is very simple. You want to achieve something, you may prepare a preparation strategy to clear your CA exam. You are going to write your exam maybe in May 26, September 26, Jan 27, May 27, could be 28 also. But you prepare a strategy. What is the strategy going to tell? How are you going to complete all subjects? How are you going to do revision? When are you going to write your mock exam? If the strategy is in place, it will help you in achieving your objective of clearing your CA exam. Your objective is to clear CA exam. Long term direction and scope to achieve competitive advantage. What is long term direction? Next 3 years, the strategy tells you how you are going to prepare. Assuming you're writing your exam after 2-3 years, the strategy will tell how are you going to prepare in your to write your exam. Once you are able to decide the strategy, it gives you the direction and ultimately gives you an advantage as compared to the other students. You are at a better position as compared to the other students, and that ultimate objective is very simple. Will I clear my CA exams or not? Ultimate objective is fulfill stakeholder aspiration. What a stakeholder is? Mostly shareholder. Shareholder means he would want share price to increase, he would want huge dividends to be paid. Apart from that, other stakeholders are there. Customers are there. Customers would want a good quality product. Suppliers are there. Suppliers would want regular orders to be given. Ultimate objective, I have to meet the stakeholder. Stakeholder means shareholder, lenders, customers, employees, suppliers, society at large expect CSR activity from many company. There is an expectation that you will do CSR activity. Many corporates expect this to happen. A practical example: Tesla is into the EV cars. Tesla's strategy isn't just selling car. You just sell car doesn't help, because it is trying to build a charging infrastructure and battery technology. Infrastructure has to be developed. In India, EV is under the growth phase as of now. But still, lot of people want the charging infrastructure to be there. Today, whenever you want petrol, every 1 kilometer or 2 kilometer you may get a fuel station within the city, and outside also you go every 10-15 kilometers you may get a fuel station. So petrol filling is not a problem, but like that charging can't happen. So charging infrastructure has to be developed. There is continuous investments which are happening in that. Once the charging infrastructure develops, maybe a lot of people may migrate to the EV mode. As of now itself, a lot of migration is happening, but later. So my strategy should not say I want to sell cars. Along with cars, build an infrastructure, then only your customers are going to buy. What are the functions of strategic financial management? See, first, let's before I come to the function, there are four important decisions which a CFO takes or finance takes. You may be aware of this. One is called investment, second is called financing. You would have learnt what were the 3 and 4: investment, financing, dividend, and working capital. These were the four important decisions which a CFO takes. Investment is raising money, investment is investing the money, financing is raising money, third is at the end of the year you decide whether to pay dividends to your shareholders or not, and manage the working capital. The functions will more or less focus around these four. What is this for? Search for investment opportunity. Search for investment opportunity. Without investments being there, I cannot generate returns for my shareholders and debt holders. Debt holders also want return. They want interest to be paid. Best profitable opportunity. Best profitable opportunity, that is, identify good opportunities there, make investments. To make the investment, optimal mix of funds. What is optimal mix of funds is, do you raise debt? Do you raise equity? Do you raise in the form of preference? Analysis of results. I analyze the performance of the company. After the analysis, I may decide to pay dividends. I may decide to do certain correction in the company. I may decide to take certain future decision of raising more money, making more investments. All of this are purely functions of the SFM. Okay, as I said, the key decisions are here: financing decision, investment decision, dividend decision. Okay, at inter level we learned working capital. Here they have used the term portfolio decision. Portfolio is mix of various investments which are happening. You, instead of analyzing it on a standalone basis, coffee business and ice cream business are not that good, because coffee may do bad at few times, ice cream may do bad at few times, risk is on the higher side. But when you combine it as a portfolio, maybe both are good. As a portfolio, coffee business and the ice cream business together is a good business. Coffee and ice cream together is a good business. On a standalone basis, I'm not getting that much amount of comfort. But when it is combined together, I'm very happy with the business. So, four important decisions. Financing, you are aware. Financing is debt, equity, and preference mix. You would have learned it as 3 chapter in CA Inter: cost of capital, capital structure, and leverages. Investment decision we have learnt here also as advanced capital budgeting, and at CA Inter as capital budgeting. Dividend decision was again a chapter. What is dividend decision? Division of earnings between shareholder payment and reinvestment. Portfolio decision, evaluation of investment based on contribution to the aggregate performance. The aggregate performance can be from a return point of view, can also be from a risk point of view, because on a standalone basis, some business may not be good. For example, I am an EV manufacturer. What I am doing is I'm installing thousand EV charging station in the entire city. Loss making. That charging infrastructure does not give me any profit. But because I develop that infrastructure, I'm able to sell more cars. So charging infrastructure is good, even it's loss making. Even if it is loss making, it is still preferable, because people are now buying more cars. Clear? Any doubts on this? And I'll give you some 2-3 minutes. I want you to read question 1, 2, 3, 4, 5. Till 5, you just do a plain reading. 1, 2, 3, 4, 5. I give you some 2-3 minutes. Page 470. Okay. Next comes, what are the three different types of strategy? Whatever you are seeing here, I hope you have already seen it at maybe CA Inter. There are three types of strategy. One, strategy for Reliance Industries, that is called corporate strategy. Second, in Reliance Industries, Reliance Geo, which is a subpart of Reliance Industries, they develop a strategy that is called business strategy. And within that, the HR managers, the HR is hiring engineers. So HR develops its own strategy. Three types of strategy. Corporate level is Reliance will decide what type of businesses they want to do. As of now, they are into multiple businesses. Then within Reliance, so many businesses are there. Each of the business will develop his strategy, that is called business unit level strategy. Every business will have multiple functions. What are multiple function? Production function, sales function, R&D function, purchase function, finance function, HR function. Every function will develop their own strategy, that is called functional level strategy. So three layers of strategy is there. One is corporate level, then there is a business level, then there is a functional level. A very simple example: Reliance Industries enter the telecom market, that is the corporate level strategy. Geo deciding pricing strategy for capturing the market share, that is the business level strategy, and HR hiring engineers. The HR is hiring engineers to build the 5G network. That is the functional level strategy. Reliance said, I want to enter into Geo. Moment they said enter into Geo, from the corporate strategy came the business strategy. Geo has developed its strategy to build the market share. When Geo developed the strategy, I informed my HR saying that I am increasing market share. I will need lot of telecom towers to be installed. Network has to be strengthened. So HR is hiring the engineers. HR is hiring the engineers. From the top, the bottom level strategies will come. What is the function of corporate level strategy? What are the three basic questions it should answer? Corporate level strategy is very simple. It is going to decide which businesses we are going to do. Today, Reliance may not get into an education business, or they have a I think there is also a wing which talks into education, but there are businesses where they may enter, there are businesses where they may not enter. This is decided at a corporate level strategy. Basically, it is going to focus on these three things: suitability, feasibility, and acceptability. When I say suitability, whatever business I'm going to enter into, is it suitable for me or not? Example, Reliance wants to get into, let's take an example of automobile car manufacturing. If Reliance wants to enter into car manufacturing, is it suitable for them or not from their overall mission point of view or overall vision point of view? Suitability is checked first. With the suitability, is it feasible or not? Car business, randomly anyone can't enter. Reliance does have all the possibility. Maybe in future they enter also, but to enter into, maybe they have to do some tie-ups and other things. Feasibility is there or not. Third is whether my shareholder will agree to that business or not. Acceptability to my shareholder. Suitability, feasibility, and acceptability. These are the three core things which my corporate strategy is going to answer. If something is not suitable, not feasible, not acceptable, don't get into that type of a business. Clear? Any doubts on this? Financial planning and what are the components of financial planning? At my personal end, I keep talking about financial planning because I'm in a wealth management firm. Very simple. We speak to a person. What is financial planning? You come to us. I ask you, what are your inflows? What are your outflows? Inflows is salary and other things which a person gets. What are the outflow? He may have certain regular expenses, certain one-off expenses. Is there any balance money available? How are we going to use those balance money? Are we making investment? Financial planning is how are we going to use the available resources or use the available money. At my home, the financial planner could be my mother. She takes care of she knows where the money is coming from and where the money needs to go. In a corporate, the CFO is going to take care of the financial planning. Financial planning is the backbone of the business planning. Whatever business plans you are putting in, see whether there is a backup available. What is backup? Backup is whether money is available. Without money being there, nothing can be done. Without finance being there, none of the activities can happen in the practical world. CFO plays an extremely important role. He is equally important as the CEO and other people in the practical world. You could be a production manager, you could be a sales manager. They are only bothered about their segment, but the CFO has to take care of everything. So first, what are the resources available? If resources are available, how do you want to manage them and put together? This will help you in achieving your financial goals. Resources plus tools. For example, you have the resources. What is resources? Your salary minus expenses. Every month surplus is 50,000 rupees. What are tools? I say that we will invest 20,000 in mutual funds, 10,000 in gold, 5,000 in silver, another 5,000 in some FD, another 10,000 we will keep it safe. These are the tools I'm using to manage your funds. What will this achieve? It helps me in achieving my objective. What is the objective? I want some money for my child education. After 20 years, I want some money that the resources plus the tools will give me some 20, 25 lakh, 30 lakh, 40 lakh, 50 lakh, whatever I want. I want some money for my retirement purpose. That money is going to come through the resources plus the tools. The resources plus the tools. Financial resources plus the financial tools will help in achieving your financial goals. Clear? Any doubts on this? Outcomes of the financial planning, that is after you do the financial planning, what can be the outcome? I'll first tell my personal end. Okay, personal end, the outcome will say we are going to invest around 20,000 in mutual fund, 10,000 in this, 5,000 in this, 5,000 in this. You will keep making these investments on a regular basis. We will review our performance at a regular monitoring and see whether your objectives can be met or not. Sometimes we have advised our clients saying that no, you do not have adequate money available. Either reduce your expense or reduce your goals. Your goals will have to be, somebody will say, I want 1 crore for my kids' education. The money available is not saying that that is possible. We advise clients 1 crore is not feasible for the kind of income you have. Either increase income, reduce expense, or reduce your goal. Reduce your goal. So here, financial objectives will be there. Decide at the beginning. For example, ROI of 15%. Personal end, 5 crore needed after 10 years. I need 5 crore after 10 years. Decision making, analyze and decide the course of action. What is course of action? One example, they're saying lease versus buy. I need money regularly, but money is not available in the business. So you may go through lease versus buy. Personal end, I keep talking about the personal end. The personal end, I tell certain people that either reduce your goals or reduce your expenses. That's a decision. Let's take it now. Are you ready to reduce your expenses if feasible? Third, I want to regularly monitor the performance. Financial measure, we do a review. Review can be done through ratios, can be done through cash flow analysis, and this will ultimately tell whether our objectives are going to be met or not. Clear? Any doubts on this? I give you again maybe 2-3 minutes. Question 6, 7, 8, 9. I think 6, 7, 8, 9. Yeah, go through 6, 7, 8, 9. 3 minutes. Okay. Next is interface between financial policy and strategic management. Strategic management is what you learned at inter level. Very simple. Any company, whatever strategy you do, the most important part is money. Money is the starting point of an organization. They use a term called money is the starting point of an organization and technically the end point as well. So starting is money and the end point is also money. You cannot develop any strategy. Zero strategy can be developed without keeping the financial policy in mind. Anything happens in a practical world in any company, any big decision, the CFO will have a role in that. The CFO is going to have a role in that. So whatever strategy you are developing, before that, the starting point is money. It is like this. This is the circle I've given. Money, this, it's a cycle. Start with money, you develop your strategy. Strategy will give you certain money again, and it's a continuous cycle. So financial policy cannot be done in isolation. If your strategy is expansion, then maybe sources of finance have to be thought about. If you're planning to expand, sources of finance come into picture. You need to decide whenever you are expanding, what is the capital structure I decide. Investment decision is where the money is to be used, fixed assets purpose or working capital purpose. Dividend policy, one, meet the needs of the shareholder. Second, meet the needs of the future growth. You need to balance both. So there is a huge linkage between financial policy and the various other strategies which are being developed. you should write in exam that the starting point is money and the end point is also money, and based on that all other strategies are being evaluated. How financial goals can be balanced vis-a-vis sustainable growth. I'll explain first what is this term and then I explain this. You see here, demarketing campaign, save fuel. You will see many petrol station tell you to save fuel, tell you to save fuel. If you save fuel, will their sales go down or go up? Petrol place. If you reduce the consumption of fuel, will it reduce their sales or increase their sales? Why should a company tell you? I am telling that don't take my classes. Why will I tell that? Why will I tell that don't take my classes? So similarly, the petrol companies, the oil and marketing companies in India, BPCL, HPCL, IOCL, all are telling people to save fuel, save fuel. Reason is very simple: sustainability. What is sustainability? Is if everybody consumes fuel a lot, the world may run out of fuel at some stage. The world may run out of fuel at some stage. What is sustainable? Ensuring that it is available for the next generation also. Ensuring that it is available for next generation. Resources are limited. Judicial use is needed for future generation. Demarketing campaign, save fuel, save fuel. This deviates from the usual what, sales growth strategy, but ensures what, survival. If I keep on selling fuel at a rapid pace, after maybe 30-40 years, petrol may not exist in the world. Petrol may not exist in the world unless we are finding out new sources of petrol. Petrol may not exist. So that is why people are saying no, please don't consume it a lot. You save fuel, you save fuel. Sustainable growth, consider the financial consequence of sales increase. Sales increase is always not good. Okay, you will, I'm not sure if you, okay, there is this company, Cafe Coffee Day. The Cafe Coffee Day at some point of time was rapidly growing. What is rapidly growing is every 10-15 days 5 new outlets, 10 new outlets. They were rapidly increasing the outlet. Got into debt trap because they were rapidly increasing outlet. They borrowed lot of money. Outlets were also not performing well. So much money was spent, debt is taken, they got into a debt trap and was almost on the verge of liquidation. Some recovery has happened recently is what I get to know, but very rapid growth. Let's take an example of Hotel Sangeeta. If Hotel Sangeeta starts opening 20 another outlets in Chennai, 40 outlets in Chennai, 60, there is continuously, they are also opening as of now. But if you continuously keep opening 20, 40, 60, 80, 100, business will get tougher. So sales increase is not always very good. It's not always very good. There's a conflict arises if you keep increasing sales. If you keep increasing sales, there's always a conflict. Many a times it's like very simple. You are running a marathon. If you run in a marathon, there are people who will start running very fast. Very fast you run 1-2 kilometer over, story is over. After that you cannot run. You will not be in a position to run beyond that, or your speed will significantly fall down. The people who have done marathon training, if I suddenly go into a marathon, I get excited saying that okay, marathon, I run for 2 kilometers at a rapid speed and that's all. I break down at that stage. I will not be able to run beyond that. This is what sustainable strategies say. Sustainability is very simple. Keep growing at a rapid pace, keep growing at a regular pace, not rapid pace, not regular. There are businesses which do a rapid growth also. It depends on whether we are in the introduction stage of the product or growth stage, maturity stage, decline stage. So the Cafe Coffee Day is a very good example to understand sustainability part. Because they were growing at a rapid pace, most of the outlets became non-profitable. They became non-profitable. What makes an organization financially sustainable? And ICA also talks about sustainable. They have asked what makes an organization financially sustainable. They've also asked what makes an organization sustainable. To me, both were same only, but ICA has two different terms. Financially sustainable is very simple, that whether I will have adequate amount of money, whether I'll have adequate amount of money to meet my future growth at my personal end. Income diversity. What is income diversity? I get income from Bharadwaj Institute. I get some income from mutual funds. I get some income from shares. I do some consulting work. I get income from there. So more than one sources of income is there. Kind of comfortable. I'm kind of comfortable if my one income stream goes down. Planning rigor. What is planning rigor? Is I do a regular planning for the next 1 year, what I want to do, how much I want to earn, where I want to spend, where I want to invest. All this, I keep saying this in the practical world, that this is, I keep saying for CA students, that you need to prepare a plan for writing your exams. Your exams is happening maybe 3 months down the line, 6 months down the line, 1 year, 1.5 years, 2 years down the line. Many students mindset is, we will see later, we will see later, we'll see later, and once it come closer to the exam, you start panicking. If you have a plan done, that plan will ensure that most of you, some of you could be writing exam in 2027 or 2028. You are attending classes now. Reason is, maybe you have done a plan and attend the class, or maybe somebody has told that it's better to attend the class earlier. Ideal thing is, prepare a plan. The plan will tell, first two subjects I'll complete this time, next two subjects I'll complete, final subjects I'll complete, the final two subjects I'll complete very close, and then I will do revision, and then I'll write mock exam. That is the planning which needs to be done. Planning will ensure that I again go back to that marathon exam only. If you had a plan in place, first 5 kilometers slow speed, warm up is done. Next 5 kilometers speed is enhanced. Again 5 kilometers speed is reduced. Again 5 kilometers speed is enhanced. Then maybe I bring down the speed. Then last final 10 kilometers I increase my speed again. So that is your plan in place. Adequate systems need to be in place, because if systems are not there, again, because of lack of internal controls, many organizations have reported lot of frauds and losses. Public image. I give an example of Satyam. How many of you are aware of what happened with Satyam? Any idea what happened with Satyam? Mahindra Satyam. The earlier name was Satyam. What happened there? Any idea? Have you read about it? Anybody? Anybody aware? If you are aware, tell me, else I'll tell you. Okay, Mahindra Satyam, it was a tech company. Before it was acquired by Mahindra, it was managed by promoters. They started to show inflated profits in their books of accounts. Inflated profits by doing window dressing, technical name. What they did, sales did not happen, still book the sales, show debtors, inflated debtors, show cash which does not even exist. They did all of this. Share price continuously went up. Share price continuously went up. Single day, promoter came and admitted to all these things. I think around 85 to 90% fall in wealth. The share price crashed by 85 to 90%. So that image of that Mahindra Satyam was not good. Course correction have happened. Tech Mahindra has acquired it. After that, the image correction is happening as of now. Today also, Reliance has a different image and Tatas have a different image in the practical world. There is a, whatever you said and do, whatever be the scenario, Reliance may be very successful, but their corporate image is not as good, not as good as Tatas. Whatever could be the reason, you can debate on it. Adanis are successful, but still the public image, there are again and again some news articles will come, something against them will come. So public image is very critical. Autonomy is giving independence to my various managers. There is a top level manager, there is a mid level manager, there is a lower level manager. Give them autonomy to take decision. Finally is this, long-term survival, run for entire 42 kilometers, marathon, run for 42 kilometers, don't break down in between. ICI also has what makes an organization sustainable. I really did not understand much of difference. One is financially sustainable, second is sustainable. To me both were very similar, but still if they ask financially sustainable, you'll have to write those points. Sustainable means you'll have to write these points. To me both are interchangeable, but still be very clear, because if they ask financially sustainable, you will write a different answer, and sustainable you will write a different answer. Sustainable, clear direction is corporate strategy. Prepare a corporate strategy. Context scanning, what is context scanning is, look at the environment or industry and see if there is any opportunity for making an entry into an industry. Example, Reliance found out an opportunity in the telecom sector and entered into the telecom sector. Talent management is recruiting right resources, that is recruiting right people and retaining them. Now I can write this even in financially sustainable. I don't see any big difference. That's why I said no big difference. Infrastructure is availability of resources can be men, material, machine, money. All the resources need to be available. Impact leverage, what is impact leverage is demonstrating the impact of whatever resources you have utilized. Once you show the impact, further resources will come. Today I want to raise more money, people are not ready to give. Reliance wants to raise money, he will get money because he's already demonstrated the impact. He has been showing the impact of using the resources. Community support is CSR. Do CSR for the society. Many organization do CSR activity. They do CSR activity. CSR activity does not contribute to profits, but still you will have to keep doing it. Clear? I'll tell you the question number. Question 9, 10, 11, 12 and 16. Just read them. 9, 10, 11, 12 and 16. I'll give you around 2-3 minutes. Okay. Next part. What is sustainable growth rate? Sustainable growth rate is the rate at which I can grow. Without any impact on my survival. What happened in case of cafe coffee days? They grow at a very high rate which could not be managed. This you are aware already. There was a formula for growth rate called ROE into retention ratio, and that is technically my sustainable growth rate. Sustainable growth rate is equal to ROE into retention ratio. This is a comfortable rate. This is the comfortable rate I can grow. Maximum rate of growth in sales that can be achieved given the profitability, asset utilization, dividend payout, debt ratio. What is debt ratio? Is debt divided by debt plus equity. Here, how much can I grow without borrowing more money? Not without borrowing money, without borrowing more money. What is without borrowing more money? You have your debt equity ratio, maintain the debt equity ratio. If equity increases by 20%, increase debt also by 20%. The ratio has to be maintained. What cafe coffee did? Equity did not increase, debt doubled 3 times, 5 times, 10 times. Then trouble will come. Then trouble is going to come. I have a target capital structure. I want to maintain the target capital structure. I also want to maintain a target dividend payment ratio. Sustainable growth rate is the rate at which you can grow without borrowing more money. I'm using the term more money. A variant of this is internal growth rate. Internal growth rate means without borrowing any money, without raising equity, without borrowing any money, without raising equity, without raising max growth achievable only using internal resources. What is internal resources? Retained earnings. Here I can have an increase in debt. I can have an increase in debt. Focus, self sufficiency, here consistency, both have a target dividend payment ratio. You will have a target dividend payment ratio. Point is very simple. If an organization has to grow, somewhere it has to borrow money. It has to borrow money. There are businesses which don't borrow money also, but somewhere if you want to grow, borrowing money is very critical. uh, Today Infosys, TCS, everyone is following internal growth rate concept. What is internal growth rate? They don't borrow money because their debt equity ratio is zero. Their debt equity ratio is zero. They may not borrow money. They in fact don't even have or don't even know where to use the available money. So much profits they are making, they are not able to find the purpose of using that money, so it goes in the form of dividends. So sustainable growth rate is without borrowing more money, and internal growth rate is without borrowing any money, without borrowing any money. Clear? Any doubts in this? Often a conflict can arise if growth objectives are not consistent with the sustainable growth. What is this sustainable growth rate? Says ROE into retention ratio 20%, and you want to grow at 50%. Your sustainable growth rate is saying you can grow only at the rate of 20%. You are suddenly saying I want to grow at the rate of 50%. If you grow 50%, you will see one question when I go to business valuation. Ideally, I should have done it in this chapter, but I do that in business valuation normally. You want to grow at 50%. How will you grow at 50%? By borrowing more money. Because if you want to grow at 50%, all your assets may increase, liabilities may increase little bit. So extra money, where is it going to come? Debt. If you borrow more debt, ultimately it can get into trouble. It can get into trouble. If an enterprise grows too fast, it may run out of cash or become over leveraged. If an individual runs too fast in a marathon, he may run out of energy. He may run out of energy. If it grows too slow, it wastes resources. Growing too slow is also bad. Growing too fast is also not good. So I should ensure that my financial policy and growth speed aligns, and growth speed matches my sustainable growth rate, matches the sustainable growth rate. Anything above sustainable growth rate is leading to trouble. That is going to lead to trouble. Clear? Any doubts on this? One example on sustainable growth rate: total asset 250, total liability 220. What can be the difference between the two? Equity is 30. Sustainable growth rate is ROE into retention ratio. Don't look at the other part of the answer. Okay, this is 30. Net income is PAT. Net income is PAT. 12 by 30 is ROE. ROE is 40%. 12 divided by 30. Net income, which is PAT. PAT divided by the equity. PAT divided ratio analysis. Dividend paid is 4.5. Payout ratio is 4.5 by PAT. Payout ratios 4.5 by PAT. Can you tell me 4.5 by 12 is how much? 37.5. 62.5 is the retention. 62.5 is the retention. ROE into retention ratio. ROE into retention ratio. I'll repeat again. Total asset. I don't want to spend much time on this. This is ratio analysis understanding. Total asset 250. Total liability 220. Gap is 30. Net income is 12. 12 divided by 30 is 40%. 12 divided by 30 is 40%. ROE into retention, I can grow at 25%. Max sales increase 100 plus another 25% you can do. 100 plus another 20. If you want to make 100 200, then that can lead to trouble. That can lead to trouble because you may have to borrow money and other things have to be done. Clear? Any doubts on the concept here? Any doubts on this? So We are kind of done with the chapter. We saw first sustainable growth rate. This sustainable growth rate is given by a person called Robert C. Higgins. Why I'm saying this term, I'll explain in a minute. Then there was a sustainable growth and internal growth rate, conflict part, and there was a November 22 exam question on sustainable growth rate calculation. I will give you around to page 466. Question number 10 case study. Read and answer all the 5 questions. Read and answer all the 5 questions. I give you time. I'm not discussing anything. Okay. You read the case study. If you want to refer the theory notes, refer the theory notes. 5 questions are there. Go through it. We will discuss after 6-7 minutes. After 6-7 minutes, I'll discuss it. September 25 MTP. XYZ Limited, a medium-sized company in the renewable energy sector, is experiencing steady sales growth. Company's management is concerned with about balancing rapid growth with long-term sustainability in the past year. Growth objectives have led to aggressive expansion plan. But management now realizes that such growth may not be financially sustainable, which is what I had explained in the theory, saying that it is not sustainable. How to maintain financial health while achieving the objective? Sustainable growth rate. Company now needs to decide that operational financial policy aligned with the growth goals. Must avoid expanding too quickly. This will strain your financial resources. Excessive borrowing. Management must also consider long-term implication of the resource consumption, particularly in the renewable energy industry, where sustainability, they're saying if you keep consuming the resources, we may run out of the resources, some story, but renewable shouldn't be a problem. Renewable means you can continuously keep producing it. It needs to focus on building its growth capability alongside the growth strategy, necessary infrastructure and financial planning in place. If you remember, these were the points for financially sustainable. These were the points there saying that you need to have an infrastructure, you need to have a financial planning in place. Furthermore, the company is aware of the risk of relying too much on external financing and wants to maintain a balance. Concept was introduced by, I really don't like this question. Who was the person? Robert Higgins. Sustainable growth rate represents rate at which the company can grow by issuing more equity. No, we don't issue equity. Maximum rate of growth without borrowing additional funds. It is right, but it should have been worded little better. What is without borrowing additional funds? Without borrowing additional funds beyond the debt equity ratio. Growth determined by market demand, rate of growth, all this is of no use. It should have been worded little better. Without borrowing additional funds in excess of the, I can borrow money in line with my debt equity ratio. What's the answer to the third one? If you grow too quickly, what can happen? Liquidity issue. I don't know why they gave question number 4. Somewhere they have talked about the, what are the 2 points they have talked about for growth? Somewhere it is mentioned here. Growth capability along with the growth strategy. Fifth one was a good question. In an inflationary condition, if creditors require that you maintain historical cost debt to equity ratio. What is historical cost debt to equity ratios? I have some values in my books of accounts. Go with those values and maintain the historical cost debt to equity ratio, means whatever was the value in the past, maintain that debt to equity ratio. If inflation increases, whatever assets I buy, the value of the assets will go up. But I may not be in a position to borrow more debt. For example, I want to buy a machinery worth 10 crores. When you buy a machinery worth 10 crores, historical cost was only 5 crores. So your borrowing could be on the basis of 5 CR, whereas now you need 10 CR. Now you need borrowing. What is borrowing? My debt equity ratio is 1:1. So I'll borrow In 5 crores 1 is to 1, not in 10 crores. So if you borrow less, you have to retain more money. If you have to retain more money, so indirectly what is going to happen is this money which I'm retaining ideally should be used for growing the company, but that retention is not used ideally for growing. It is replacing my assets, it is replacing my assets and not giving me that growth momentum. The growth is not going to come in, because whatever money I'm retaining earlier with a low retention, I could have got the growth. So if you are in an inflationary condition and you are not having adequate resources, ultimately growth rate will get impacted. Ultimately growth rate will get impacted in case you are not able to get the resources, not able to get the resources. See, I need 10 cr, but I do not have the resources. So what I do, instead of expanding my plant capacity by 10%, I expand only by 5%. If you expand by 5%, obviously you cannot grow, you cannot grow. Clear? Any doubts on this? Any doubts on this? I'll see one more case study. We will do this together. In a recent board meeting of N Limited, following financials of N Limited for the year ending 31st March 2025 were presented. Case study 9, equity capital, 10% bond, sundry creditors, bills payable, other current liability, not very critical. Then there is a director A said that the company can maintain a certain growth even though the profit margin remains constant, assets increase proportionately to sales, and it distributes 30% of its net profit. It will not require any external fund. It will not require any external fund. Director B proposed, just by maintaining a target capital structure without issuing additional equity, maintaining target dividend payout ratio, more growth can be achieved. Division C though agreed, but is of the view that in the coming year sales will grow, we can go for issue of equity shares, bonds or debenture. 3 points are there, I'll repeat. Director A saying I can maintain a certain growth, though the net profit margin will remain constant, assets will increase for the sales increase, 30% I will distribute, 70% I'll retain. I don't want any external fund. No external fund means no external equity, no external debt. Director B saying, no, what you are saying is right, but let us maintain a target capital structure. Target capital. What is target capital structure? Debt to equity ratio. Don't raise any equity, but you can raise debt. How you can raise debt? Because your equity increases because of internal equity, because of the internal equity. Director C is saying, you all are good, but I feel we have to grow by 15%, and let's issue equity share also, bonds also, debentures also. Look at the three and tell me what is answer to 1, 2, 3. Options are same. Director A, what is he talking? Director B, what is he talking? And Director C, what is he talking? What is Director A, B and C is talking? Okay, correct. Director A is internal growth. Reason is without borrowing any money. Our sustainable said without borrowing more money, more money. Then question number 2, sustainable growth rate. So this is internal growth rate. This is sustainable growth. Question number 3, there's nothing like an external growth rate. It's called external funding requirement, EFR. I have a question on EFR. I don't know why I've kept it in business valuation, but I've kept it there only. So I'll do that question when I go to business valuation chapter. And this question I'm not doing now. There I will discuss. This got tested in the recent exam. This got tested in the recent exam as a 4-mark question. External fund requirement. And unfortunately, that's unfortunate. CA Inter latest attempt, they ended up asking CA final question for 8 marks. This question, external fund requirement. This question got tested in CA Inter also. Unfortunate, but okay, that's okay. But it got tested there also. Same thing. The concept was external fund requirement. I'll discuss external fund requirement. I have it in my business valuation because I discuss certain things and then I discuss that. So we will discuss it there. We are done with the theory element. We are done with the theory element discussion. One problem is there on EFR, institute study material in chapter 1 only, but I do that question in chapter on business valuation. We will see that. Any doubts on the chapter? Again, I'll not summarize and all, but I'll tell you the importance only. One question has come from in this chapter every attempt except for the recent attempt. But in recent attempt they asked the EFR question. They asked the EFR question, how much funding requirements will come, that got tested in exam. So chapter 1 is very critical. Securitization chapter, which we have already done, one theory question has come in all the attempts till now. All the attempts till now. And chapter startup finance, one question has come in all the attempts. Again and again I'm repeating, theory is very critical because of only one reason. Paper becomes very tough. Theory you will have to handle and then secure marks. Clear? We are done with this. Post break we'll do the other areas. Okay, till now we are done with 3 theory chapters. I'm starting with the 4th theory chapter now, which is on an area called risk management. This chapter had some practical area as well as a theory area. The practical portion was very minimal. We had an area called value at risk computation, which was basically telling us how much is the maximum loss an organization can suffer. In the context of that only this chapter is, as the name indicates, in this chapter we are going to learn what are the different risks which are there for a company and how can I manage that risk. So how can I manage this? How can I reduce the risk? Risk as such mean something which can go wrong for an organization. Anything which can go wrong is called as risk. You start for your classes, you run a risk of missing the class if you start little late. So that is the risk which you carry. You are trying to catch a flight, you go little late, you will say it is risky to go late because you may miss out on catching the flight. Risk basically means what can go wrong, and multiple things can go wrong for a business. So first thing is different types of risks faced by an organization. They have classified into 4 different categories in the ICI material. Apart from the 4 also, I can talk about multiple other items. First risk is strategic risk. What is strategic risk is the strategy which I developed itself is wrong. I have developed a strategy, and because I have developed a wrong strategy, either it is a wrong strategy or execution is difficult. So strategic risk is risk where a company's strategy becomes less effective, leading to a struggle in achieving goals caused by technology changes, new competitor, or shift in customer demand. When maybe when I was in some 8th standard or 9th standard, at my home we had a camera. With the camera we used to take photos and print the photos. That is was available, which is where a film camera company was making revenue. There was a film camera company, they were making revenue. Today they are non-existent because the technology has changed. Hardly you will see people printing photos. You take photos, but printing of photos is almost negligible except for some special occasion. So that company's strategy became less effective because of shift in customer demand. Because of the shift in customer demand, whatever strategy they were developing or they were using, it became less effective. This is the first main risk. Second, compliance risk. As the name indicates, compliance risk means if you don't comply with any rules and regulation, you are going to suffer huge penalty. So inability or not able to comply with rules and regulation can lead to fines, penalties, rarely it can even go to imprisonment. All of this you would be aware under different laws which you are reading. Income Tax Act has certain provision, GST has provision, your Legal Companies Act has provision. Like that, so many acts are there. If you don't comply with them, it can lead to trouble, paying fines for breaching data privacy. So there is something called as general data protection rules. So I get customer data, I have to protect that data. If I don't comply with that rules, this example is just for your understanding, this is not there in ICA material. So you need to comply with the rules. If you don't comply with the rules, huge penalties can come. Third is operational risk. What is operational risk? Is people and process. There are two main things which are there in an organization. If for example, a customer comes to my shop, he comes and orders a product. What I do as a person is I don't record that sale itself. I don't record that sale itself. That time either my people have failed me or the processes were inefficient or both are problematic. Both are problematic. You come to my shop, buy a product. Ideally, that product should get recorded in the books of accounts and that money should come to me as a promoter, as a company, it should get accounted. What somebody may do is, because your processes are ineffective, it is not even recorded in the books of accounts. Internal risk, failure to cope, day to day operational problem. This can come from people or process. People or process. Another example is machinery breakdown, halting production line because people did not manage the machine properly or the processes were not fine. You could see this problem happening. Last one, this is what we are going to focus on, financial risk. This is what is going to be focused in the entire chapter. Financial risk is unexpected changes in financial condition. In financial condition, such as prices change. Very classic example. Yesterday silver went down by around 30 plus percentage. This would have changed the financial position of many people. Many people would have got, if they were on the wrong side of the silver buying or selling, they would have got stuck significantly, 30 plus percentage in a single day. If they had managed this risk properly, they would not have faced this trouble. Prices, exchange rate. What is exchange rate? Dollar going up or dollar going down. Credit rating is, I give a rating on the company's ability to service debt. When credit rating change, the impact of credit rating will be on the interest rate. Anything changes. I have taken a home loan. If interest rate go up by 2-3%, I'll be under deep trouble. 2-3% interest rate going up, significant problem it can create for me. So four major types of risks are there. Strategic risk. Strategic risk is strategy becoming ineffective. Compliance risk, as the name indicates, not complying with the rules and regulation. Operational risk, people and process related, and financial risk. Now we will focus on what are the various types of financial risk. What is financial risk? Is our change in financial position due to changes in the financial condition, like your interest rates, credit rating, lot of things in that. Various types of financial risk. First type is counterparty risk. What is counterparty risk? I sold product to someone, he did not make the payment. Counterparty is not fulfilling the obligation. Payment is one thing. You told me to manufacture product for you, I did not get advance, unfortunately. After manufacturing, you're saying you don't want the product. I customized a product for you, and ultimately what you are saying, you don't want the product. What will I do with that? Non-honoring of obligation, failure to deliver goods or payment, failure to accept goods, also you can say different things. Political risk. Political risk is, I invested in, let's assume, as of now, in Bangladesh, I have a manufacturing plant. The Political scenario is little bad between the two countries. Because of that, my manufacturing facility is suffering. My manufacturing facility, which is in Bangladesh, I am not able to do well. There is a possibility that my entire investment can even get wiped out because of the political risk. Entire investment can get wiped out. Adverse action by the host country. Today, if Bangladesh country says confiscate all the manufacturing plants by Indian company, don't allow them to operate, directly it will have an impact on my financial position. Interest rate risk, changes in the interest rate. You learn this as a part of a chapter called interest rate risk management. Changes in the interest rate going up, going down, both are trouble. Going up is also bad, going down is also bad. Changes in interest rate affecting asset or liability value, primarily for companies which have lot of interest sensitive asset. Banks very much there. What is interest sensitive asset? If you have lot of fixed deposit or lot of loans taken, you will suffer when interest rates are changing. Currency risk, these two chapters we are yet to do. Interest rate is learnt as part of interest rate risk management. Currency risk we learn as part of forex chapter. So any changes in currency exchange rate, people are going to suffer. A classic example, there are students who do international courses. The fees for the international courses for Indian students is up by around 20%, not because they have increased the fees, because of the exchange rate. Earlier $1,000 means 80,000. Now same $1,000 has gone up by around 15-20%. Pounds same story, euros same story. So currency risk can impact even a small person like us who are dependent on one international transaction. Like that, lot of companies can suffer if they have huge imports and exports. Liquidity risk, a lot of time what will happen is I am in urgent need of money, urgent need of money. Yesterday event, I'll again go back. Silver, when it crashed down, in the market we have something called as ETF. We learned about close ended mutual fund. These close ended mutual fund, when the real fall was 20%, the close ended mutual fund even fell by 30-35%, because everybody went ahead and said no, no, let me go out, started selling it, started selling the ETF. When supply increased significantly, demand was not there. Price which should have gone down by 20% went down by 25-30%. In the ETF market, you see yesterday price went down significantly, then even the real fall. Reason, people panic started happening. Because of the panic, everybody started going and selling it. Inability to meet liability when they become due. Why when they become due? The silver is one example. But I wanted urgent money. Yesterday I wanted urgent money. I will sell at asset at discount. Selling asset at a discount to pay urgent debt. Clear? So these are different types of financial risk. A very small chapter. One question has been continuously coming from this chapter. Recent attempt, question came in normal paper. Also in IBS a theory question came. So both paper they ended up asking one theoretical question from this chapter. Now this financial risk, again we focus little bit more. What is financial risk? Also the financial risk can be viewed from different perspective. We have understood financial risk refers to unexpected changes in financial condition, which can be prices, exchange rate, credit rating, interest rates. Anything can change. Whenever there is an unexpected change, it is going to impact people. Now the financial risk meaning is different for different people. If I am a shareholder, or a bond holder, for me, financial risk is measured through debt by equity ratio, debt by assets ratio. We have learned this term business risk, financial risk. So different people view this differently. First is stakeholder. Stakeholders are worried about gearing. Gearing means debt by equity or debt by assets. This is viewed as a ratio, as an indicator of financial risk, as an indicator of financial. Equity shareholders view financial gearing as risk. In liquidation, they are the least priority. Even lenders are also worried if you have a very high, gearing. Company will be worried if you have an excessive borrowing, or you do an excessive lending to a person who is going to default. Excessive borrowing can lead to your own default. Excessive lending to a person who is going to default can ultimately lead to your default, can ultimately lead to your both the things. One is you borrowing excessively. So here, when I want to view what is the financial risk position of the company from a company point of view, they'll see, are we having excessive borrowing, or are we lending excessive to a person who is likely to default, can force, or lending to defaulters can force liquidation, and insolvency can also happen. Third thing, government also views it. I'll tell you which is not going to happen, but if it happens, see, if ICICI Bank collapses or if SBI Bank collapses, entire Indian market will take a big hit. So failure of a large institution is the problem for the government. It happened Lehman Brothers. When it happened, because of this, there was a huge crisis in that country. So in India, S Bank went through a trouble. Somehow RBI managed it. But if S Bank had collapsed, you would see a huge distrust in the market. What I will say, let the money be there in my home. I don't even want to put money in bank account. Let me keep it at home. I don't want money even in the bank account, or let me buy gold, silver and keep it at home, because there's a distrust even with the large financial institution. Governments would be bothered about these things. Government wouldn't want these things happening, any failure of a big institution. So what is financial risk for the government? If there is any failure of a large or big institution. Any doubts on this? Go to page 475. Go through first three questions. Go through first three questions. Okay, we proceed ahead. Fourth question, you are already aware. What is value at risk? Explain its features and application. We did a problem solving earlier. Why value at risk is coming? Because it's a measure of a risk. It's a measure of risk. VAR can tell me how much loss I can have in the worst case scenario. Z score into SD will give you the percentage loss you are going to suffer. Into the Z score is that multiple we had for 95% and 99%. That multiple into the standard deviation into amount invested will convert into rupees. You want for more number of days, less number of days, into number of days square root. Key features, it has a component which is one, there will be a time period. You want it for 10 days, 15 days, 20 days. Second, there will be a confidence level 95 or 99. Third, loss are the amount which is going to be there. It uses standard deviation concepts. Time horizon you can do for 1 day, 1 week, 1 month. Now a classic example again. Yesterday's silver loss. None of the 99% also wouldn't have predicted that much amount of loss. Even 99% confidence interval, because yesterday in single day 30-35% fall has happened. That can't be predicted. That can't be predicted even by the concept of value at risk. Probability, that 95-99 gives a multiple, no, this comes from something called as a Z score probability, normal distribution table, and it can help me in setting limit. What is setting limit? In the bank, I have a person called as front end desk. They are doing trading. What is trading? Buying dollars, selling dollar, buying dollar, selling dollar. I have told him maximum loss you can suffer is 1 million. With this 1 million, I reverse worked and told you can invest 10 million. You can invest 10 million. We did reverse working questions when we were solving problem. So I set the limit. Measure maximum loss. It can help me in measuring the maximum loss. Fixed limit. A bank calculates that its daily VAR will be 1 million at 99% confidence. This means there is only a 1% chance the bank will lose more than 1 million in a single day. With this 1 million max loss, I decided the limit to be 10 million or 20 million. Performance benchmark. What is performance benchmark? Is to measure the performance of my trading desk. Are they suffering more loss or less loss? And it is also called as a ALM tool. You will learn this in interest rate risk management chapter. Asset and liability management. You will have to manage both. You will learn this when I go to IRRM. So these are the various features and application of value at risk. I'm not spending much time because we have done practical question solving on this area. Various hints indicating counterparty risk and how to manage the same. What is counterparty risk is? I am doing a transaction with, let's assume I am ABC Limited. I plan to acquire XYZ Limited. We entered into a deal, everything. Ultimately, if I've entered into a deal on the last day, you need to give me. Or let's take another example. I purchased silver. I purchased silver when the price was 1 lakh. I made the payment to you, but you are not delivering the silver even after 1 month, 2 months. This is called counterparty risk. Why are you not delivering? Failure to obtain the resources. You don't even have the silver with you. You don't even have the silver with you. How will you deliver it to me? You wanted to act smart. I purchased at 1 lakh. You thought, okay, price will go down. We will buy at 80,000 and give it to this person. But 1 lakh became 2 lakh, 2 lakh became 3 lakh. So you do not have the resources itself. How are you going to give the product to me? Regulatory restrictions by government. If at all government puts in some restriction, maybe a counterparty may help. A counterparty may delay. A counterparty may delay if there is a regulatory restriction which comes from the government side. Hostile action of a foreign government. I was to import the product from some other place. Because of the actions taken by a foreign government, I am not able to deliver it to the other party. This also includes to a larger extent political risk. Political risk. Let down by third party are ultimately insolvency. Insolvency of the third party. How do I manage this? Because the question will ask, what are the various hints indicating counterparty risk and how can you manage it? How can you? Where did we learn counterparty risk? We learned this the first risk in the financial risk. In the financial risk, the first risk was counterparty risk. I think this came in the recent exam. I don't remember, but two questions have come. One in normal, one in the your IBS paper. Due diligence. What is due diligence? I speak to lot of people and check are very simple. Before starting my classes or before joining my classes, you would have checked at least with few people saying that how the classes are going to be. Will he complete full syllabus? Will he complete on time? Some discussion you would have had with your friends or your personal experience will be there. So that is due diligence. Due diligence is before you take up my classes, you did some extra checks. Same thing you have to do before you deal with any person. Diversify. You want to buy 10 kg of silver. Buy from 5 different people 2 kg. Buy from 5 different people 2 kg. So even if one fails, at least 8 kg will come to you. At least 8 kg will come to you. Exposure limits. That is what? With a single person, don't deal beyond a level. With this excessive buying, excessive selling, excessive borrowing, excessive lending with a single person. We used to call, when I work in a rating agency, we used to call this as concentration risk. If you have concentration with, we have customer concentration, geographical concentration. Your entire sales was happening in Bangladesh. From India, you are exporting entirely to only Bangladesh. You are under trouble. Another example. Lot of ready-made garment manufacturers in the practical world were exporting to only one country, USA. They were exporting to USA. because of the tariff talks which are there or which is already implemented, many of them have lost significant business. Many of them, many listed companies prices have crashed significantly because of their exposure or concentration to a single geography. Here we are talking about single customer, counterparty. Single customer, if you overcome it or don't set a limit, you will get under trouble. Rapid action. The moment tariff was announced by US, lot of companies started diversifying to other countries. You could have done this little faster itself. Moment there were starting of talks saying that something is going to happen, rapidly act and try to move to other places, and ultimately if you can get some insurance or guarantee, many a times when you sell from Indian country to another country, you are exporting some product, you may insist on letter of credit. This letter of credit is a guarantee given by a foreign bank. Company may fail, but bank may not fail. A foreign bank may not fail. Or we used to have something called as we still have ECGC cover, export credit cover. So with that cover, insurance cover, I take care of the counterparty risk. I take care of the counterparty risk through this way. Any doubts in this? Go through question 4 and 5. Okay. In the financial risk, the next risk was your political risk. What is political risk? Is actions which are taken by government which can lead to effect on the financial position of a company. Some of the actions which they can take, which is happening in many Indian states itself, they'll say you have to insist on local labor. In Tamil Nadu, you should have only Tamil Nadu labor. Don't take the labor from other states. These are actions which are being taken by some of the governments. All these are an indication that there is a political risk. There is a political risk. So first I have to identify the political risk, which is like insisting on local labor or any adverse actions which are taken by them. How do I assess them? Refer to political ranking in business magazine. Or I would understand how is the position of that government. Stability check, whether this government will continue or not continue. In India, as of now, the popularity of the current government is fine. But in case you feel a risk that the government can change, it will lead to again different action. Once the government changes, they may reverse certain decision, they may take new decision, evaluate the economic stability. If the economy is doing well, then the government will not intervene much, will not try to take lot of action. If you are stable company or stable country, those countries will not have major political risk because government may also continue and the policies continue that way. How do I manage the technique? How do I manage this political risk? First, very simple. Don't even go for other countries, raw material, other countries, labor, or even if you are two things. One, I am an US company. I don't even interfere with other countries, people or material for my purchases. That's one way. If I've set up a facility in India, please use local raw material and local labor in India. If you do that, the government may not intervene much. The government may not interfere much if you use local labor. Two things. One is if you are set up a facility in India use local resources. Don't try to import a resource. When I say import a resource, employees from US come and then do the work in India. It can lead to some challenges. Joint venture. Joint venture means partner with local country. If you are having an Indian partner available with you whenever you invest from USA, he will take care of some of the risks which are there. Raise debt within the host country, raise money here, and prior negotiation. What is prior negotiation? Let's assume Microsoft wants to, or Amazon wants to invest in India, wants to set up a big office, some manufacturing facility they want to enter into. Prior itself, they go to a state government of India, do a discussion with them saying that we are doing this, we don't want any disturbance for the next 10-20 years. Is your policy okay? No, no, we are ready to welcome you, please do it, please do it. So if that prior negotiation has happened, the political risk goes down little bit. The next one was interest rate risk. Interest rate risk we have been learning at different places. Interest rate risk is, one is what is interest rate risk, second is how do you manage, is chapter 12, 11 or 12, interest rate risk management. There's a separate chapter to manage this risk. Okay, what is interest rate risk? Variation in interest rate, variation in interest rate. Why will variation happen? Multiple option reasons are there. Monetary policy, you are very well aware, repo rate, reverse repo rate, this will be changed by the RBI. Government action, if government is deciding to borrow more, borrow less, invest more, invest less, all that can have impact on the interest rate. Economic growth, economic growth, if you are a growing company or if a growing economy, high demand for money will be there, that will again impact the interest rate. Industrial data, foreign investment and stock market position, these are factors which impact interest rate. How do you manage is not discussed here, you discuss this in another chapter where we have multiple techniques called interest rate options, futures, caps, collars. There are multiple things there, forward rate agreements. All these are techniques to manage the interest rate risk. Similarly, what are the parameters to identify the currency risk? Management of this is in chapter 10 or 9, number I don't remember. There's a separate chapter on foreign exchange. That chapter you'll understand how do you manage, how do you identify, is there a currency risk or not? How do I identify? Today, many companies are going through this problem of currency risk. Whoever is import dependent, they are gone. Export dependent, happy. Import dependent, gone because of the currency movement which is happening. Government action. Government action means through RBI. RBI try to influence the exchange rate. You have a theory called interest rate parity theory, you learn this in forex chapter. It's a very, there I spend around half an hour on interest rate parity theory, that will impact exchange rate. Purchasing power parity theory, another 20-30 minutes we spent there, that also impacts the exchange rate. And external shock, external shock, India is going through a lot of this problem now. External shock, natural calamity, war, rebellions, change of government, war is happening at some other place, our exchange rate is taking a big hit and India is suffering because of other problems, and a lot of issues are going, we are going through. All these are parameters to identify the currency risk. This came in IBS paper, this came in IBS paper in the recent exam for 5 marks. Clear? Any doubts in this? Go through 6, 7, 8. So the chapter is almost over from a theory discussion point of view. I have two case study type of question. I'll discuss them. But broadly, what we learned is there are 4 major types of risk. One is a strategic risk, which is strategy becoming ineffective. Compliance risk, not complying with rules and regulation, which leads to fines and penalties. Operational risk, process related risk or people related risk. And financial risk, changes in financial condition like prices, exchange rates, all these changes. Then we focused a lot on financial risk, where we learned that the financial risk can be a counterparty risk. How do we assess? How do we manage it? Political risk, how do we assess? How do we manage it? Interest rate risk, how do we assess? Managing part we did not see. Currency risk, how do we identify? There was also something called as a liquidity risk, which is your, if in any case you want some urgent money, what happens? Let's go through question 9. TRC Cables Limited, an Indian company, is in the business of manufacturing electrical cables, data cables, including fiber optics cable. While mainly deals with manufactured cables to other country, it has also established its production facility at some African countries, due to due availability of raw material and cheap labor. Some of the major raw materials such as copper, aluminum and non-ferrous metal are also imported from foreign country. Hence, overall TRC has frequent receipt and expenditure denominated in non-INR currency. So TRC make use of long-term debt and equity to meet its long-term fund requirement. To finance its operation, it also makes use of short-term financial requirements such as CP, bank credit, term loan from bank. If any surplus cash is left with TRC, it is invested in interest yielding security. Recently, due to stiff competition from its competitor, it has relaxed its policy for granting credit, and to manage receivable, it has formed a separate credit division. Further, to hedge, it has entered into OTC derivative contract. What is OTC derivative contract and all? Not your worry, because you learn this when I go to the futures chapter. Major risks which they are exposed to. I have told you different types of risk. It can be outside that also. Now tell me, what are the risks they are facing? First one is country risk or political risk. Where is the country risk? By putting your facility in African country, any adverse action by the African government can trouble you. What are the other risks? Currency risk, because your receipts and expenditure are in non-INR. To hedge against this, we have done derivative contract, but there's something called as OTC. OTC means over the counter. OTC contracts have a risk called the settlement risk. You will learn this when I go to the other chapter. So let's not worry about that. Settlement risk, let's not worry. What are other points? Interest rate risk, because we are borrowing money. Interest rate variation can impact. What else is there? Counterparty risk, because you have relaxed your credit policy. I also see one more risk. I see some of the major raw material are like this. I see technically a commodity risk or a price risk, where this is not discussed. It may be there in the answer, not there. But these commodities are highly volatile in nature. Copper prices can go up, can go down significantly. That can also impact me. Currency risk, non-INR. Commodity risk means prices can change. Interest rate risk, you borrow as well as invest. Counterparty risk, due to relaxation of norms. Okay, liquidity risk I did not discuss. What is liquidity risk? Inability to meet your liability, because you have short term borrowing. If there's an urgent need to close that, you will get into trouble. Political risk, it is also dealing with African country, because of which you will have political risk. And there's something called as a settlement risk, which you will understand later. OTC derivative. Next one, go through this and let me know. You imagine the risks which are there. Very simple point. May 25 exam question. What are the risks you have? Visualize and then tell me. You visualize 3-4 points. It will be a 4-mark question. At least 4 points you have to write. May 25 exam question. Tell me, what is the first risk you will face? Political risk, because you are dealing with Chinese imports. Suddenly China puts a stop, you are gone. You're also selling it in American market, where US is already pressurizing us with tariff and other things. So practically happening also. China is restricting export of few products, practically happening. US is also penalizing us for the export which we do there with the tariff. That is first risk. Then what else? Currency risk, which is self-explanatory. Currency risk is 100% there. Then Sorry, country is your political risk. What is the compliance risk you see here? Okay, maybe I don't see that to be a bigger risk, but yes, compliance risk, but I don't see that to be a bigger problem. What else do you see? Interest we cannot say, maybe there, may not be there. Counterparty, I'll say, whenever I deal with anybody, if I'm dealing with anybody, I see a counterparty risk. These are the three which comes to my mind. Okay, counterparty risk, there's a point from a student. Commodity risk can be there, commodity risk can also be there, depends on what type of product we are manufacturing. But I do see three mainly I'm seeing. Fourth, I don't know what is there in the answer. First one is your counterparty, second one is your political, third one is your currency. Let's see the answer now. Currency risk, since raw material are imported from China and finished goods sold in the USA, fluctuation in yuan, which is Chinese currency, Indian rupee and US dollar. Political and trade risk, change in trade policy, tariff, political instability in China, India or US. These two we have told. Market risk, okay, this is nothing, that's why I said this is a general point. This has come as a general point. Demand for finished products in the US may fluctuate, affecting sales and profitability. This is a general point which anyone is going to have. Regulatory risk, okay, as he said, compliance risk, you have to comply with rules and regulations of each country. If you don't comply, that trouble can also come. I felt counterparty may also come. Commodity could have also come if we had known what is the product here, what is the product here. So a straightforward question can come, or a question like this can come, anything can come. With this, the discussion of this chapter gets over. Only one more important theory chapter is pending, which is your security analysis, which we will see later. Any doubts in this chapter? Four important theory chapters are done. Any doubts in this? Okay. Good morning, friends. Okay, today we'll first start with chapter 4 theory discussion. Will take around 1 hour of time, and then I go back to what we were doing. Till now, we are done with 4 important theory chapters. Now I'm going to start with chapter 4, and I'll also tell you what you need to do for the balance theory chapter. As I said initially, theory carries around 12 to 16 marks of weightage from exam point of view. Becomes very critical in case the paper is tougher or a student is aspiring to score an exemption. For them, theory preparation is very critical. As I said, there are 5 important theory chapters. One was your chapter 1, chapter 2, 7, 15. Those 4 are done. I'm now starting with chapter 4, which is on security analysis. The discussion on this chapter is an extension of what we did in the practical segment. We did some question solving. We did some discussion on the practical segment. An extension of that is what you're going to see here. Now, what is security analysis? Security analysis is nothing but deciding whether to buy a share or sell a share. In order to decide this buying or selling, practical world, I can go through 2 approaches. One is called fundamental analysis and second is called technical analysis. Fundamental analysis is what we did in various chapters like security valuation, business valuation, or even in mutual funds, you were deciding whether to buy a mutual fund which is performing better, which is not performing better. So fundamental analysis focus is on financial statements, what is the company doing, how is the economy performing. The focus is long-term wealth creation. Example, Warren Buffett bought Coca-Cola because its brand value and the cash flows were undervalued relative to the stock price. The price was something, and he felt the brand value of Coca-Cola or the cash flow which is just generating is very high. Somewhere market should give a better valuation. He purchased it. He's a legendary investor. He purchased it, and maybe then the share price starts moving up. So this is one approach where I try to find out the intrinsic value of the business, and objective is to very simple: buy undervalued security and sell the overvalued security. Technical analysis is based on psychology, supply and demand. You work with certain charts. With the charts, you understand what is the pattern the chart is going to follow. For example, I see something like this happened in a share, then this happened. Moment this happens, I feel now it will go like this. So let me buy the share at this point. Let me buy the share at this time. This is my pattern analysis. I am expecting the pattern to continue. Once it reaches this, maybe sell it because I feel it may go down. It may go down again. It will go up. It will go down. Somewhere a pattern, if you are able to find, you feel the pattern will continue, and because of this you are trying to buy a share, then sell it. Buy, sell, buy, sell, buy, sell. This is short term trading gain, and this is long term wealth creation. For long term purpose, you can only do fundamental analysis. For an interim period, I can do short term analysis through technical analysis. A trader buys Tata Motor because it broke a resistance level at 500 with high volume. What is resistance? Is whenever it was touching 500 in the past, it started going down. Again it touched 500, it went down. Again it touched 500, it went down. It was coming closer to 500 but not able to go beyond 500. There was a resistance at 500. A trader was tracking this. Moment it broke out 500, people felt that it will start going up further. Silver for a very long period could not break down. I think $50 or $47 an ounce was the rate. It was not able to break that for a very long time. Once it broke it, it even went to 100, 150, and now it's from an ounce point of view I'm talking. So once the resistance level is broken, you feel that it will start inching upward, so you buy the share. So these are two ways. Now in that, what is fundamental analysis? Fundamental analysis is, as I've been saying again and again, fundamental analysis is forecast the financial statements of the company, forecast the cash flows of the company, do the valuation based on the cash flow, year, cash flow, PVF, DCF, do a terminal value calculation, follow a Gordon's model, follow a Walters model, follow an FCFE approach, follow a proxy company based valuation model. You are trying to go through some logical data from the financial statements along with something called as EIC. What is EIC? Is economy, industry and company analysis. Economy, industry and company analysis. And based on this, I ultimately decide, should I buy a share or sell a share? Undervalued, buy it. Overvalued, sell it. Undervalued, buy it. Overvalued, sell it. Focus is very simple. True value by discounting the future cash flow. By discounting the future cash flow, whatever you did in business valuation, whatever you did in security valuation, all that will come into picture. And one example, analyst valued HDFC Bank at 2000 intrinsic value based on its loan growth, because loan as it grows, interest income increases for HDFC Bank, cash flow increases. So based on that, an analyst said 2000 rupees is the value. Many analysts are there in the practical world, research house. For example, ICICI Securities will say HDFC Bank is undervalued, buy it. Overvalued, sell it. They will release a research report. Maybe in future you could be working in that research wing also, where they will release this research report which will tell you should buy, sell or moderate stance. So fundamental analysis will say please buy the share of HDFC, buy the share of HDFC because it is currently undervalued in the market. This is fundamental analysis. Fundamental analysis, three things: economy, industry, company. Indian economy was going through tough time, again became good, now kind of neutral or still in a good. But one industry which is struggling at this point of time is information technology. IT industry is struggling at this point of time because of artificial intelligence issues which are coming in. Because of AI, many of the IT companies in India are struggling. So I did first economy analysis, then I went to industry analysis. IT could be struggling, but some company which is very well aware of what is happening in the AI and able to do something on the AI, they may still end up going up. They may still end up going up. So economy, then industry, then comes the company analysis. In this, what is economic analysis? Economic analysis is very simple, trying to predict GDP growth of India, trying to predict the GDP growth of India or the national income of India along with certain other metrics. Main focus is at what rate will India grow? At what rate will India grow? Will India grow at 7%, 8%, 10%, 15%? Obviously, that growth is dependent on various parameter. But first thing is the bigger picture is economy, then the in between picture is industry, and then the picture is on the company side. So, is the Indian economy likely to grow or not? First thing, if you have a high GDP growth, certain sectors will do really well during high GDP growth, like steel and cement, because GDP growth is depend on various parameter. One of the parameters infrastructure development. So if there is a good infra development, steel sector will do well and your cement sector will do really well. Inflation may have an impact on the economy, may have an impact on ultimately the various companies. If you have high inflation, maybe auto sector suffer, they are saying, but pharma sector may not still suffer. Pharma sector may still not suffer. Why auto is suffering? Prices are going up everywhere, my incomes are not going up, I do not have that much money, so I can avoid buying a car, but I cannot avoid essential medicines for me. Some medicines I'm taking, I may not avoid medicine, but so technically pharma sector is inflation proof. Inflation, whatever happens, doesn't affect the pharma sector, but may affect the auto sector. Interest rates again will impact. One example of interest rate affecting is, let's take real estate. If interest rates continuously go up, real estate demand will start going down, because most of real estate purchases in India are backed by a home loan. If the interest rates are high, I may avoid taking a home loan. I may avoid taking a home loan. So another factor which matters is interest rate. Monsoon, major part of the demand, that is a still sorry major part of the demand comes from urban areas, but still rural has a significant population, and a significant part of India's demand is going to come from rural areas. Rural will do well in case you have good monsoon, because agriculture dependency is there in rural. So if you have good monsoon, tractor sales may go up, FMCG sales may go up because of higher rural income. So what is economic analysis is trying to predict how is the Indian economy going to perform. Is it only on the GDP growth? No, GDP, inflation, interest rate, monsoon. Is it the only this? No. You can add up unemployment rates, you can add up poverty rates, you can add up any macro factor. In economics, you have learned macro factors and micro factors. Any macro factor which is affecting India as a whole can be considered under this category. Now, what can I do for economic analysis? What is economic analysis? Is how do I know whether India will grow at 7%, 8%, 9%? Many RBI comes out with a news saying that India will grow at 7.5%. I used to work in CRISIL Limited. I was part of the credit rating wing, but we had a research wing which always used to come out with at what rate India will grow. They used to give data points on India will grow at 7%, 7.5%, 8%. How do I arrive at that number? See, normally when you do a company analysis, you try to forecast the financial statement of one company. That itself becomes challenging. Now we have to forecast how India is going to perform as a whole, at what rate will it grow. One approach people follow is anticipatory survey. I take a survey in different industries, understand from Maruti Suzuki and some big companies in auto sector. I try to understand what is the likely auto performance. from IT sector, some bigger companies, likely see what is the performance. So one example is RBI does something called as consumer confidence survey. Consumer confidence survey. This will give me an idea whether consumers are likely to spend more or less in the next year. If they are likely to spend more, there is a possibility that our economy will grow bigger, will keep growing bigger. Second, barometer or indicator approach. This can end up coming in exam. Barometer or indicator approach, where they talk about three types of indicator. One is called leading indicator. What is leading indicator is Indian economy will grow in the next quarter, but before that, in the earlier quarter, you may see Sensex going up. You may see Sensex going up in quarter one. When will Indian economy grow? Quarter two. Leading means it is happening before the real growth happens. Growth, degrowth. It can be either ways. Growth or degrowth. Leading indicators will tell what will happen in future. What will happen in future. Building permits. If lot of permits are getting issued or lot of approvals are being given, it is an indication that in the next quarter, real estate growth will be very high. Real estate growth will be very high. Coincidental means as it happens, you see the performance. GDP is growing and GDP numbers are coming out at the same time. GDP numbers and GDP growth. You say GDP is growing at 8% and numbers is getting released at the same time. So looking at the GDP number, I will say Indian economy is doing well. Looking at Sensex, I will tell Indian economy is likely to do well. Likely to do well is next quarter it will do well. I tell now. GDP numbers have come now, and now you are saying Indian economy is doing well. This is future. This is present. IIP in India, we have something called as industrial production, which is measured in every sector. Every sector we come out with IIP numbers, index of industrial production, that will tell what is happening today. Lagging means past issue. Unemployment rate is going up now. The reason is it is going up. The effect has already come in. Indian economy started struggling. One sector, IT sector is struggling. Unemployment will start happening in the next quarter. Unemployment will start happening. Our layoffs will start happening. Not past, not future prediction. Layoffs are happening means it is not future struggle. It is the past struggle. The struggle has already happened in the past. So leading, future, coincidental, present, lagging is past. Lagging indicator, unemployment rates going up. Corporate profits are going down. Why did it go down? Last quarter struggle. Last quarter was the struggle, not the future struggle. So these three indicators can tell you where is the Indian economy likely to move. Where is the Indian economy likely to move can be identified through which approach? Barometer or indicator approach. Third one is economic model building approach. Now very simple. I'll quickly tell you this way. An economist predicts India's GDP next year. Next year I'm predicting by doing what? Projecting household consumption. Projecting the household consumption based on salary hike, government infra spending based on the budget. Budget got announced by India some time back. Private investment. I try to predict each of this, add up all of that together and say what India is going to do. Add up all this together and say what India is likely to do. Estimate demand based on inflation. Forecast various component, consumption, investment, government spending, exports, and finally arrive at a forecasted GNP. What is economic analysis is very simple. Tell me ultimately, will India grow at 7, 7.5, 8, 8.5, 9, 9.5? What rate will India likely to grow? Any doubts on this? To page 82, read question 1 to 4. Please read it once. Question 1 to 4, page 482. I'll give you around 2-3 minutes. Okay, the second segment of fundamental analysis is industry analysis. Today, certain industries will do well, some industries may not do well. What are the factors affecting them? First is product life cycle. What is product life cycle is? You would have learned something called as introduction, growth, maturity, decline. Good examples are there that will give you clarity. Growth, EV sector. EV sector, electronic vehicle sector, it's a growing sector. So if you are in the EV sector, you would continue to grow. FMCG is your bigger companies which are there, whatever products you take. So all these products are having stable growth. The various companies like HUL and others are in FMCG. Low profit, decline, landlines. Landlines are almost non-existent now. Still, you could be a player who's manufacturing landline phones. In that case, your company will struggle. Your company is going to struggle because demand is not going to be there for landline phones. Demand supply gap. In case there is any demand supply gap, more demand is there, lesser supply is there, you will enjoy, and vice versa. Excess supply lowers the prices. Example, perfect example is telecom. In the telecom sector, once Geo came in, they came in, competition got increased, and because of which lot of rates came down. Now the reverse is happening because players are not there in the market. Reverse is also happening. So it depends on what is the demand supply scenario. Barriers to entry. If there are any big barriers to entry, for example, I want to open a small restaurant. No major barriers to entry. I want to develop an airport. I cannot develop an airport. High entry barrier in airport infrastructure. Developing an airport needs a lot of money, lot of resources. I don't think I can enter, or most of the companies in India will enter that sector. Whereas restaurant business, anyone can enter. No major entry barrier. External factor, government attitude. Government will support certain industry and will restrict certain industry. Example, tobacco. Tobacco is an industry which government is going to try to cut it down. It will continuously cut it down. Whereas certain industries it will support. It will support PLIs, production linked incentive scheme they give to make people produce more. Competition again, I go back to telecom sector only now. Monopoly will command premium, though we don't have a monopoly, but we have almost a duopoly. We have a duopoly which is leading to price increase. Cost structure. Certain industries will have high fixed cost and certain industries will have high variable cost. If you have high fixed cost, there's a problem in that industry. Example, airline has a high fixed cost structure. Many companies in the airline sector could not sustain. You can take example of Kingfisher, you can take example of other companies which started, went out, and many are still not profitable. We are almost at a monopoly kind of a situation in the airline sector because companies are not able to survive. Technology. Because of tech development, certain industries are almost non-existent now. 20-25 years back, at my home we used to have a camera. We used to take a photo, then take a print of the photo. Now that industry is almost non-existent. There are the Kodak which was selling that films, now no business for them. Technically you don't have any business. DVD rental. I have rented out DVD. I have taken DVD on rent, watched a movie. All that happened at some point of time. Now that industry is non-existent. You can't have such industry at this point of time. So technology development can also affect. What are the techniques for industry analysis? First is regression analysis. What is regression analysis? Let's assume a regression equation is like this. Y is equal to A plus Bx. Now Y is growth. Growth in pharma sector. Growth in pharma sector is equal to 2% plus 2 into 2% plus 2 into GDP growth. If at all there is a link, 2 into GDP growth. If GDP is growing by 10%, pharma will grow as 2% plus 2 into 10%. This is what regression is trying to say. If if IIP grows at 5%, CV sales will grow at 10%. CV sales will grow at regression tries to find link between hotels. Hotels industry will grow at 2 plus 4 into per capita growth. 4 into per capita growth. If per capita incomes of people are growing at 5%, the tourism sector may grow at 2 plus 4 into this. Degrows, it can degrow significantly. You are trying to establish a link. Input output analysis. What is input output analysis? It tracks the flow of goods or services through the entire economy. If some sector is growing, for example, infrastructure spending is increasing, that would mean increased demand for cement, increased demand for steel. All these are, steel demand is going up, it can indirectly indicate that infrastructure is going to have a huge boost. It can be either ways. So if I feel one sector is growing, there could be a link with another sector and try to, for example, IT sector, India is struggling in the IT sector. As news keeps coming out, IT index of India went down by 15%. When one single day IT index went down by 5%, same day real estate index also went down. Is there any link between IT and real estate? 100% link is there. Most of the real estate purchases in India are expected to be done by high earners, and these high earners are from the IT sector. So if there is a layoff happening in the industry, layoffs happen, these high earners are not there, who will buy the house? Who are going to buy the house? So there is a link between IT sector and the real estate sector. And if IT is not doing well, companies are not going to open offices are not open, commercial real estate goes down. Today most of the Indian IT companies in Chennai are in the outskirts, and outskirts growth happened because of what? You see many projects coming up in the outskirts, your OMR, ECR, all that, you see a rapid growth which had happened. One major factor is TCS office, one major factor is Infosys office, one major factor is Wipro's office, one major factor is CTS office. All these led to many millionaires, and what they did, they ended up buying. IT goes down, real estate will go down, auto can also go down, that is the linkage we are trying to find. Next comes the company analysis. This I will not discuss much, because this we have discussed significantly when we did something called as your normal analysis. Net worth analysis, book value analysis. You are aware of what is net worth, what is book value. So depending on the book value of a company, maybe the price of the share is estimated. Sources and uses of funds, where the funds is coming from, where the funds is going out. I do an analysis to see how is the company likely to perform. Time series analysis, cross-sectional analysis. What is cross-sectional analysis? Compare TCS with Infosys. What is time series analysis? Compare TCS 2025 with TCS 2024, with TCS 2023, with TCS 2022 to understand how is the company performing. Company performance. Size and ranking. How is the size of the company as a proportion of the overall industry, or how is the company performing in relation to the industry? Growth record, financial analysis, competitive advantage, quality of management. Today also we believe Tatas have a different quality, Reliance has a different quality. One is the performance, second is the integrity angle. Corporate governance, yeah, as I said, the integrity angle will come in corporate governance, regulation, labor availability, stock holding, marketability. All these factors will affect the price of the share, will affect the price of the share. Now, is it only these factors? These are company level, on top of it industry level, on top of it economy level, on top of it economy level. Clear? Any doubts on this? What are the techniques I will do in company analysis? Correlation and regression analysis. Regression I've already told you. Correlation is, again, I am going to find out, is there any real linkage between factor 1 and factor 2? Example, forecasting the sales growth, forecasting the sales growth based on advertising spend, based on advertising spend. If advertising spend is going up in one quarter, I forecast next quarter company will grow at a very healthy rate. Next quarter, it will grow at a very healthy rate because there is a positive correlation between ad spend and your sales growth. This is my understanding. Trend analysis. What is trend analysis? Is looking at the past data and forecasting the future number. Forecasting the future number. Decision tree analysis. Decision tree analysis, doing sequential analysis. Understanding phase 1, if you get a success, value is 100 CR. If you get a failure, value is 0. After that, you get further success, further failure, further success, further failure, and try to do a reverse valuation. Try to do a reverse valuation. Any doubts on this? All this part is part of your fundamental analysis. So whatever I discussed now is part of fundamental analysis. I'll give you again 3-4 minutes. 5, 6, 7, 8. Go through 5, 6, 7, 8. Okay. Now I move to the next part, which is technical analysis. Fundamental analysis focuses on financial statements, industry, and the economy. Technical analysis does only one thing. It looks at the price graph of the past, demand and supply data. What is demand and supply? Is volume, volumes of sales, volumes of buying and selling which is happening, and based on that it will give a signal whether to buy or sell. Method of share price prediction based on study of price graph or chart, that price trends are repetitive. Price trends are repetitive. For example, if something like this happens, comes down this much, again goes up this much, again comes down this much, goes up. If this is the pattern I find, I feel this will continue. Buy at this, sell at this place. Exactly predicting is difficult. Again buy, again sell, again buy, again sell. Market value depends on supply and demand. There is nothing else. It is only dependent on supply and demand according to technical analysis. Okay. Supply are governed by rational and irrational factor. What is rational is logical thinking. What is irrational is COVID came in. COVID came in. At that time, Indian index went down by 10%, and not, I think, around 10%. Many companies fell down by around 20-25%. Next day again fall happened. That is because of irrational thinking. Irrational thinking is, even after 25% fall, you still feel it will go down, it will go down, it will go down, it will go down, because of the psychology. Everyone is thinking, no, now lot of uncertainty is there. I cannot leave this. Silver prices were going up continuously, and it went on going up. Irrational buying. People were least bothered whether it will reverse or not. They were only thinking it will only go up. Stock prices generally move in trend. Relies on chart analysis. I only focus on charts. I don't want to focus on financial statement. If technical analysis is what is going to work, and you are part of an equity research team, entire AFM, whatever you learnt, is of no use. It is technically of no use at all, because you are not going to look at financial statement, you are not going to look at economy analysis, you are not going to look at industry analysis. Your only focus is what? Price trend. A technical analyst buys Adani Enterprises not because of debt to equity ratio, but because the stock price broke out a 3-month resistance level. It broke out a 3-month resistance level. It broke that resistance level. Resistance means it was not going above that. Resistance level is broken. Buy it because it will now move up. According to this, market discounts everything. What is market discounts everything is whatever analysis you are trying to do, saying that economy will grow, industry will grow, company will grow, is known to everyone. Everyone knows that price already considers the data. Most of the time in the practical world, good quarterly results are going to come. Two things can happen. One, people predict it and start buying it before itself. That is one element. Second, there is some element of insider trading which can also happen, but most of the time the share price up will happen before and the results will come later, and bad results are going to come before that itself. Fall can happen. That is called market discounts everything. Price moves in trend. It moves in trend and the trend will continue. History tends to repeat itself. These are the three principles. Market discounts everything, price moves in trend, and the trend is going to repeat itself. The trend is going to repeat itself is what technical analysis is trying to see. There are 3-4 theories there in this. One is called Dow theory. This is based on first two indexes. One is called Dow Jones Industrial Average and Dow Jones Transportation Average. Dow Jones Industrial Average and Dow Jones Transportation Average. There are three types of movement here. One is called primary movement, second is called secondary movement, and third is called daily fluctuation. This is a very important theory, can come in exam. There are three types of movement which will happen in the stock market. Now, what is three type of movement? This is the Indian market. I feel Indian market will have this. This is the primary movement. This is the primary movement is it will go up. What is secondary movement is? Goes up, reverses. Secondary is fluctuation, reverse. Again goes up, again reverses, again reverses, again goes up, again reverses. Long term trend is it is going up. Long term trend it is going up. Main trend, last correction, opposite to primary. It has to go up. It has to go up. So long bull run 2009 to 2020. Secondary sharp crash happened because of COVID. Did it stop there? No. After 2020, COVID crash happened. Still went up only. Jan, Feb up, March down. April, May, June up, July down. Corrections will happen. And daily fluctuation, random up and down. Daily up will happen, down will happen, up will happen, down will happen. That is of no use. This is random noise. So either the primary movement is successively you are getting higher highs. What is successively higher high? This is the high. Next high is higher than the earlier high. Next high is higher than the earlier high. Next high is higher than the earlier high. This is a bull market. Successive higher highs. Is a bull market. What is going to happen? Primary movement will be there. Secondary is also going to be there. And daily fluctuation will be there. Opposite is this is the trend. Bear market. Goes down, reverses. Goes down further, reverses. Low. Successive lower low. Successive higher high, successive lower low, successive higher high, successive lower low. Bear market is coming. In this, there are three phases in the bull market, or you can say three phases of bear market also. 3 years back, any marriage I used to go or any social gathering, everyone was talking about stock market. Everyone was talking only about buying share, selling share, because everyone thought market is really up. It will keep going up. Today, nobody talks about the stock market. Whenever I go today, nobody talks to me about the stock market, because today we are in phase 1. Bull market phase 1. Phase 1 is today nobody wants to buy shares. Today, nobody wants to buy share. Some 6 months, 12 months back, nobody was talking about gold. That was phase 1. Everybody started talking about gold. Phase 2. And now somebody who doesn't even understand gold or stock market, they entered at silver at 4 lakh rupees. They entered into silver at 4 lakh rupee. Phase 3, speculation, huge speculation. So phase 1, you don't even see market going up. That time, the smart people will enter into the market. This is the phase where news is bad, prices are low. Prices are low. I personally feel we are at the phase 1 of the bull market. Phase 1 of the bull market. Phase 2, earnings start improve. Trend is coming up. Gold prices started going up. Silver prices started going up. People got excited. After it went up, participation is increasing. Further goes up. Further go. Speculation peak. Smart money from silver. Lot of people moved out to stock market. That is the smart movement. That is the smart movement. So phase 1 is there, phase 2 is there, phase 3 is there. Phase 1, accumulation, April 2020. What is April 2020? It's COVID time. COVID time, people accumulated. Participation, people saw recovery happening, started participating in the stock market. Distribution, late 2021, 2022, even 2023, it went on. After that, no major returns from stock market. Lot of people enter at the third phase. Lot of people enter at the third phase. Elliott wave theory. This is another theory which is almost similar. There are 3 or 5 waves in the direction of basic movement. 3 or 5 waves is basic movement is up. So up 1, reversal 2, again up 3, reversal 4, up 5, reversal up down, up down. There is a reversal which is going to happen. According to this theory, there will be 3 or 5 waves, 3 or 5 times up will happen. Reversal will also happen. With 8 waves, cycle is over. A fresh cycle will start. A fresh cycle will start. Elliott wave theory said this. He said that there are going to be impulsive pattern, 3 or 5 waves in the direction of basic movement. Direction of basic movement is either it's a bull market or a bear market. Reversal is corrective patterns, and once 8 times this happens, maybe the story ends. A bull market can now become a bear market can now become a bull market, or another bull market can start. Another bull market can start. This is what Elliott wave theory said. Random walk theory. This is very simple. He has said stock prices can never be predicted. Can never be predicted. I toss a coin. Nobody can say whether it is going to be heads or whether it is going to be tail. It is a random. It is a random thing. Stock prices can never be predicted because there are statistical up and down, not a result of underlying factor. Not a result of underlying factor. Successive peaks and troughs are unconnected. Efficient market. What is efficient market? Market is highly efficient. I had talked about something called as efficient market earlier when I did that question solving. I'll also be talking again. Efficient market means people are aware of information, and because you are aware of the information, right action will be taken. Price movements are as random as a roulette wheel. In a roulette, any number can come. 1 can come, 2 can come, 3 can come, 4 can come. So any day price can go up, any day price can go down. A blindfolded monkey throwing darts at a newspaper financial pages could select a portfolio, that could just as well perform well as compared to one selected by an expert. I randomly select 5 stock from Nifty, an expert selects 5 stock, my performance and the performance of that person, random selection by anybody can perform as like what an expert is predicting. So there are 3 theories. One is a random walk theory, Elliott wave theory, and a Doe theory. Go through 8, 9, 9, 10, 11, 12 minutes for you. Okay, next is what are the different type of charts you may prepare to find out the price pattern. All of these are going to be very, very technical in nature, but still I'll discuss it. The first type of a chart people will prepare is a line chart, which is like this. It will connect the prices of every day. Just the prices are connected in this chart. With the line chart, I may able to see a trend, and based on the trend, I may able to take a decision. Second is a bar chart, which is similar to a line chart, but it has multiple data. One is, this is single day data. Okay, in this is the opening price. There is a highest price, there is a lowest price. So highest price is also there. If for example, if something like is there, this is the highest price of the day, this is the lowest price of the day, highest price of the day and the lowest price of the day. There is a opening price here, closing here, or there's a opening this side, closing this side. Open at one place, close at one place, high is there, low is there, all are there in the chart, all are there in the chart. Every day 4 data points you have to note down: opening price, closing price, highest price, lowest price. All the 4 will come in the chart. Candlestick chart, this is used by many people in the practical world. Again, I'm being very honest, I have never interpreted all these charts and I also still don't understand many of them. So candlestick chart is going to disclose this information. The bar chart displays stock opening, closing, high and low. Candlestick is trying, color of the candlestick is trying to indicate the trend, it will come with a color. A black candlestick indicates a lower closing price, black candlestick indicates a lower closing price. White candlestick indicates a higher one. A doji indicates no change or near no change. Practical world, I have seen people doing a candlestick chart, not for the entire day. For every minute they look at a candlestick, for every minute they look at a candlestick and say that okay, candlestick is showing something, maybe it will go up. Buy at 2-1, sell it at 2-2, sell it at 2-2. At 2-1 you buy it, at 2-2 you sell it. It's a very, very tricky scenario to be in technical analysis, because you're trying to look at minute trends and then take a decision. Point and figure chart is going to plot the prices, the prices are plot as X and O. Point and figure chart, they are used to detect reversal in the trend. Again, as I say, most of the charts you may not understand unless you are a technical expert. Here you are going to again look at the price data, put the price data in terms of this. Every day you look at the price data, write XO, and there is some reversal technique they have. Again, not an expert this side, so I'm not getting much into it, but this is another type of a chart which you may prepare. All the purposes is to find out, is there a trend and a reversal of trend. Market indicators we have already discussed when we solved question. Breadth index is advance to decline, net advances divided by number of shares traded, net advances divided by number of shares traded. We had a separate concept itself for this. So for breadth index we had a separate concept. If index is up by 80%, but most of the stocks are falling, it is a technical weakness. Volume, what does volume says? Price is going up, volumes are also going up. Price is going up, volumes are also going up, which means many people are trying to buy it. The trend is likely to continue. Price is going up, but volumes are down that day. Maybe reversal is going to happen next day. Prices are going up, volumes are going up, trend likely to continue. Price is going down, volumes are going down. Prices going down, volumes are going up here also. Price is going down and volumes are going up. Prices going down, but many people are trading. Again, the reversal may happen. happen. So price rise with the volume rise is a bullish market. Price fall with the volumes rise is again a bearish market. Volumes going down, price other way round, there could be a reversal which is going to happen. Confidence index, again we saw as part of the theory discussion, ratio of high grade bond to the low grade bond. It is going to precede the rising market and precede the falling market. Support and resistance level. Now this is the price trend, okay? This is the resistance. Above this it is not going. Above this the price is not going. Every time it comes closer to it, suddenly starts falling. Why? Because there are a lot of people who have decided moment it touches 50, we will sell this share. Moment it touches 50. So when it comes closer to 50, lot of people start selling it. Lot of people start selling it. So there is a resistance. There is a resistance at 50. Moment it touches 20, lot of people start buying it. Lot of people start buying it. So there is a support level. There is a resistance level. What is the use of this? Stock touches 100 3 times but fails to cross 100. Any day it crosses 100, be mentally prepared. It can even go to 150. It can go to 150. Moment the resistance is broken. Moment the resistance is broken, stock can go up significantly. Moment support is fallen. If you have gone below the support level, be mentally prepared that it can go down drastically. It can go down drastically. Price pattern, tools to interpret the trend. Tools to interpret the trend. I never thought ICA will ask price pattern question. Jan 26, there was a question from price pattern. I didn't expect them to do it, but they ended up asking it. I'll discuss it again. One is called channel. This, what does it say? Price is going like this, price is going down, price is going up, price is going down, price is going up. If you are able to find a trend like this, if you are able to find a trend like this, the successive highs are higher than the earlier highs. It is an upward sloping. Price is likely to go up, please buy it. Price is likely to go up, please buy it. A series of uniformly changing tops and bottom giving rise to a channel formation. A downward sloping channel. Downward sloping channel means this is a downward sloping channel. This is a downward sloping channel. A downward sloping channel, declining prices. Upward sloping channel, going up. Looking at the trend, you are deciding whether to buy the share or not. Wedge. A wedge is formed when the tops and bottom change in opposite direction. What is change in opposite direction? Top is there, top is going down, top is going down, bottom, successive bottom is going up, top is going down. Look at the difference. This successive tops are up, successive bottoms are also up. Tops is up, bottoms is also up. Successive high is higher than the earlier high. Successive low is higher than the earlier low. Successive high is higher than the earlier high, and low is also higher than the earlier low. Upward sloping channel, downward sloping. What is wedge? You reach this 52-week high. Next high is going to be lower than the earlier high. Next high is going to be lower than the earlier high. Next high is going to be lower than the earlier high. Last bottom. Next bottom will be, the next bottom is continuously going up. Next top is continuously going down. At some stage, both become very close to each other. That is called wedge. That is called wedge. Now, technically remembering all this can be very, very challenging, but I will discuss the chart for you. Heads and shoulder, this is the pattern. The pattern is, this is technically a head and shoulder. Very simple way. This is the technical head and shoulder. There is a shoulder, there is a head pattern, and there is again a shoulder pattern. Head and shoulder pattern means there is a head, there is a shoulder, and this pattern will keep reversing. You see here, you go up, you go down, again go up, again go down. If you are able to find this, if you are able to find this, a large lump for head, large lump for head in the middle of two smaller hump shoulder, in the middle of two smaller hump shoulder. If you are able to find a pattern in this, if you are able to find a pattern in this, triangular or coil formation presents a pattern of uncertainty and is difficult to predict which way the price will go. Practical world, whenever I have looked at a chart, for me every chart is like this only. I've never been able to find out which side the price will move with the chart. There are a lot of technical analysts there. It's a very big market. Technical analyst is a very, very big market for the person to earn, not for you. You become a student of technical analysis, you will only lose money. You will only lose money because you are going to fight against machines. Machines does algo trading. They do algo trading. Obviously, you cannot compete against all of them. Flags and pennants form. This form signifies a phase after which the previous price trend is likely to continue. Again, as I've said, I am not a big expert in this. The trend is like this. It goes up, reverses, again goes up, reverses, again goes up, reverses, reverses, goes up. This is the pattern. Now, personally, I did not find any big difference between this and maybe something like this also. I am technically trying to understand different things, and I have not been able to exactly find out a difference between many of these items. Double top form is M. 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 Double top form is M. There's a top, goes down, again a top. Double top is M. M. And double bottom is W. Double bottom is W. You can just write it. Double top is M, letter M, and double bottom is letter W. Letter W. There is a bottom reached, goes up, and again a bottom reached. Again a bottom reached. Gap. What is gap? Is gap up and gap down. What is gap up and gap down? Is it closes at some level. Next day opening closes at 100, but next day opens at 105. That is called gap up opening. And for example, Monday, there is a big expectation that Nifty may have a gap up opening as of now because of whatever happened in USA, the tariffs getting removed. There is a possibility of a gap up opening is what people are expecting. Gap up opening means market will open at higher level as compared to the previous close. Gap down opening is opens at a lower level as compared to the previous one. You may not understand much of this, but still I give you time to go through 13 to 16. Go through 13 to 16. I give you around 2-3 minutes. Okay, something which came in exam. A technical analyst at a portfolio management firm is tracking the stock price movement of 5 different companies. Analyst has decided the observed chart pattern as follows. ICI said to come out with the answer, one which is easy to interpret. Scenario 5, read and you look at your notebook and tell which one is this. Scenario 5 is easy to do. It is a wedge where the price highs are consistently falling and price lows are consistently rising opposite. This will come under the category of wedge. Scenario 4. There was one scenario where it says there is uncertainty. I'm not able to find any trend. That will be the answer. I don't even remember what is that. But where you're not able to find a trend, that is what is going to be the answer here. Like this, they ended up asking 5 scenarios. Whether you'll be in a position to manage this even after my class, I have my own doubt. I have my own doubt on this type of a question. Comes in exam, because I know what I'm delivering, because if I'm an expert in it, I can deliver it really well. Somewhere I feel I am not doing justice to this area itself. I never used to teach this technical analysis part because I myself not very comfortable. Unless I am very comfortable in teaching it, I can give you clarity. So this question, if it comes in exam or something like this comes in exam, can become challenge. But okay, we'll be let us be aware of various points and then somehow face it in exam. Okay, next part is moving average analysis. We learnt about simple moving average, exponential moving average, where you look at the data. Now, what is the purpose of doing this is, with the moving average, I'll be able to decide a buy signal and a sell signal. Very simple logic is, if the moving average is going up, if the moving average is going up, it is likely that price will go up. If the moving average is going up, what moving average? You can take exponential moving average, you can take 50-day moving average, 200-day moving average. Normally people prefer 50 and 200-day moving average. With the trend on 200-day moving average, if the moving average is going up, it's a bull signal. And if the moving average is going down, if the moving average is going down, it is technically a bear signal. It is technically a bear signal. This is the most important point. Moving average going up, moving average going down, moving average going up, moving average go down. Price drops and then starts rebounding. It comes closer to moving average. It will cross the moving average. Objective is ultimately, are we going to see a increase in price or a decrease in price? Increase in price or a decrease in price? If the moving average is going up, you are likely to see a continuous moving up. You're likely to see a continuous moving up. Moving down, you're likely to see a moving down of the prices. This is the broad point. Apart from that, they are saying price drops, rebounds, price will rebound, means it has reversed, the reversal will continue. Price falls, price has started falling, but moving average is a flat line, but price is still falling. Maybe it will continue to fall further. Moving average is a flat line, price is falling, it will continue to fall. Moving average is a flat line, price is rising, it will continue to rise. It will continue to rise. Main indicator, increasing moving average, decreasing moving average. Apart from that, there are other points. Arguments in favor and against the technical analysis. Many people, this has come 2-3 times in exam. Favor means who are supporting this. Who support? Trends happen and hence the trends will continue. Hence the trend will continue, because trend is dependent on human behavior. What is human behavior? Moment silver touched 3 lakh, lot of people said let us go and sell it. It came down to 250. Human behavior said let us buy it. Touch 3 lakh, sell it. Touch 2 lakh 50, buy it. Touch 3 lakh, sell it. Touch 2 lakh 50, buy it. Human behavior, psychology, because of which trends happen and trends will continue. Gradual shift. Demand supply shifts are gradual. Gradually the demand supply shift happen. So trend can be detected. Trend can be detected. Fundamental info is absorbed gradually. Gradually means I am doing a merger and acquisition. Merger is a good merger. Market may not give the full benefit immediately. Gradually it will give benefit. If you are giving gradually, technical analysis will detect a trend and the trend will continue. Technical analysis will detect a trend and the trend will continue. Against, there are a lot of people who are against it. Who are against? One is random walk. What is random walk? Random walk theory said, what is price change? Roulette wheel. In a roulette wheel or in a dice, when you throw a dice, will number 1 come, number 2 come, number 3, 4, 5, 6? Nobody knows. Similarly, in the stock market, whether price will go up, price will go down, nobody knows it. Practical world. There are people, morning they will say 9 o'clock price will go up. 9:05 another point they'll say price will go down. Both they will say, and ultimately say at 9 I said price will go up, it has gone up. At 9:05 I said price will go down, it has gone down. So there is no logic at all. Price going up, going down has no logic up according to this theory. Random walk theory says it can go up, it can go down. Ultimate trend is dependent on fundamentals. Ultimately, they depend on fundamental. Self-defeating. What is self-defeating is if everybody becomes an expert in technical analysis, everybody has detected the trend, everybody says buy, who will sell then? Who's going to sell? Somebody has to sell, no? If everybody has detected the trend and everybody is buying it, how will technical analysis work? Self-defeating. If everyone uses it, everyone uses. Lag factor. A signal came, you bought, in this gap the signal is reversed, in this gap itself the signal is reversed, the signal is reversed. So people are in favor of technical analysis, people are against. They'll ask supporters and detractors of technical analysis in exam. Okay, this is, we have already done. Fundamental analysis, technical analysis. Fundamental analysis is technically investing, technical analysis is more of trading analysis, economy, industry analysis, market data, future earning, price discounts everything, price moves in trend, history repeats. Intrinsic value, is it cheap, is it cheap? Find trend or timing, is it moving up? Long term purpose, short term purpose. Okay, efficient market theory. We did some problem solving on efficient market theory. There was one area called run test which we did, and we also did one correlation test. What is efficient market theory? Is very simple. Is it possible to predict market? Is it possible to predict market? If somebody says no, it cannot be possible to predict market, then it is an efficient market. In that we have three form of efficiency. One is weak form, second is semi strong form, and the last one is strong form. Last is strong form. What is weak form? Is price reflect all past data. Past data means one is price, volume. Apart from that financial statement released based on the past data, based on the past data, you are reflecting on the price. The price is reflection of the past data. Semi strong form means price is reflecting all public information. All public information is one, price data, volume data, earnings is released by the company, price reflect the earnings. Apart from that, you are also going to reflect the future earning, future some element, your future prediction is happening. Based on the future prediction, price is already reflected in it. Strong form means all public information is also reflected, insider information is also reflected in the price. What is the net effect of this? If you have a weak form market, if you have a weak form market, technical analysis no use. Why weak form technical analysis no use? Because price is already reflecting the past information, technical analysis is on the past data. Semi strong form fundamental analysis is also of no use, because price is reflecting the past data and price is reflecting the current news. The current news, merger announced, already reflected in the price, already reflected. Strong form, which is very rare, strong form which is very rare, even insider trading no use, even insider trading no use. Every day market is able to predict that what is going to happen to Infosys. Infosys is going to struggle, 5% fall. Infosys will do well, 2% up. Infosys will struggle, Infosys will do well. What is going to happen in the quarter is properly predicted, strong form. India or most of the market will have weak form of efficiency, weak form of efficiency. Market is irrational. There are two misconceptions. One, prices cannot fluctuate. If you have a strong efficient market, if you have an efficient market, two misconceptions are there. Prices cannot fluctuate. No, prices will fluctuate. Prices will fluctuate because of new information which keeps coming in. Though it is an efficient market, but prices can still fluctuate. Market is irrational. Market is irrational, which is more or less true. More or less true. In the practical world, market becomes irrational to a great extent. What is irrational? During COVID time, everybody started selling. Everybody started selling. No new news came, but everybody started selling. One good example of an efficient market is merger announced at 10 a.m. Merger announced at 10 a.m. Stock price reacted by 10 a.m. itself. Stock price reacted by 10 a.m. itself. If that happens, it is an efficient market. Efficient means everybody is aware what is going to happen because of the merger. Inefficient market means people are not even able to understand what is happening because of this. Is the merger good, merger bad? Not able to understand. They are not able to understand itself. Then it becomes an inefficient market. Because why it is inefficient market? Some people, a section of people have understood that it is going to go up after 3 days. These guys will benefit out of it. These guys will benefit out of it. This we have already done. Correlation test, run test, and filter rules test as part of the problem solving. As part of the problem solving, we did it. Challenges to the efficient market. For having an efficient market, first thing is, can people understand all information? Most of the chartered accountants themselves will not be able to tell whether this merger is a good merger for TCS or a bad merger. Chartered accountants who are experts in knowledge of finance, they themselves will not be able to tell how general public will react. General public cannot react to a news because they don't even understand what is the effect of the news. What is the effect of the news? They don't have. Irrational behavior. Irrational behavior is markets down, you should buy. What is irrational? Market down, sell. Further down, further sell. Further down, further sell. What is rational behavior? Down, buy. Further down, buy. Further down, buy. Up, sell it. Silver, irrational behavior. Went up, bought. Further went up, bought. Further went up, bought. Crash happened, down, started selling. Down, went further down, started selling. Went further down, started selling. That is called irrational behavior. And in the market, there can be some set of people who can influence the market fully. DIIs and FIIs. India is struggling because of the FIIs influence. So there is a possibility that I want to earn out of one single share. What I will do is, because of my influence, I do some 500 crore buying or selling. If I do that, the price can go down, price can go up, not because of fundamentals, not because of price pattern, but because of my influence on the market, my influence on the market. So it becomes an inefficient market. Reason is, I'm able to predict what will happen, not because of technical analysis, not because of fundamental analysis, but because of my influence. Information processing. I want an efficient market. For that, everybody should be aware of information. All information, awareness is there. But what will happen because of that information? Inability. I don't have the ability to absorb that information. Again, there is a problem. Irrational behavior. Irrational behavior is, if I feel silver is going to go up, irrational behavior will tell me it will continuously go up now, and I find that as a trend and start buying. And at some stage, I feel no, now the irrational behavior is going to reverse, and I start selling it. So efficient market is one where you cannot predict. And these are the tools available for equity research in the practical world. Somebody who wants to do equity research, what is equity research? Is trying to predict TCS growth, trying to predict India's growth, trying to predict IT sector's growth. So multiple tools are there in the practical world. I have not used most of it. I have worked on Bloomberg terminal, but most of it I have not used. So these are the tools which will give you information, past data, future data, lot of information is there. Practical world, I work in a wealth management firm. There is a tool available with us which tells us what is the GST filing done by most of the bigger companies. What is the GST filing done by? This data tells me what is the likely sales, what is the likely sales at the quarter end, what is the likely sales at a company level or at a sector level. We get it, some information comes out of the GST sales. This can tell me what is going to happen. Auto sector releases monthly sales number. This can tell me whether auto sector is likely to grow. Where will this information be there? Some of these tools can give you this information. Clear? I'm done with this chapter. Again, uh, point is technical analysis, something you see day before exam. Some of those price patterns and tools, because it can become little tricky. After reading also, you are not able to do then just live with it. 5 chapters we have done for theory. There are 10 more chapters which I'm not going to cover it in the class. I will try to give you a PPT for all of that. And what you can do for preparation is go through the summary theory itself. Summary theory or the PPT. Most of the exam student have seen question only from 5 chapters. Can questions still come from other chapter? May come. I cannot say no and all. First preference, all 5 chapters proper means very good reading of all 5 chapters. After that, time available, read other chapters summary theory, read other chapters. 5 chapters full. What are the 5 chapters were? 1, 2, 4, 7, 15. Most of the exams question have only come from this area. Apart from this, very rarely tested. So that is why I am not spending time on the other areas. These 5 chapters itself, we would have spent around 5 to 6 hours. I will give this 5 to 6 hours as a single YouTube video. Okay, you can watch it in Rio, but Rio has limitation. So I'll give it to you as a single YouTube video in maybe few days. So you can keep watching it multiple times later whenever you're writing your exam, because theory I had to cover it in the class. I could have done it at home also. I used to do it at home, but when students are in front of me, my delivery improves. So that is why I wanted to do it in the class. We are completed this. Most of you will forget what we have done in the theory. So that is why you have to go through it multiple times. PPT link, I will share it to you. Other chapters PPT will come to you. I have to prepare. The AI will give me the PPT, but I have to sit on it and make some changes. So I'll give you the PPT for all chapters. You can go through the PPT for other chapter. PPT itself will be self-explanatory. Here also PPT is self-explanatory. Only reason is I am discussing because of the importance. Clear? Any doubts on the theory part? Any doubts on the theory part? No ignoring theory. No ignoring theory. Again and again, I'm repeating the same thing because other subjects, you read so much theory. This subject, attitude of the student. I don't want to prepare theory. No. Please prepare theory. Recent exam, let's see what came from the theory. One was that difficult theory question. That is so very difficult to handle. But let's see other question. Most of it will be from this area only, these chapters. Okay, this came from differentiate how real option are different from financial option, from derivatives, but this is more of a practical discussion question. We learnt about real option, we learnt about financial option. Financial option was call option and a put option. What is underlying asset? Underlying asset in a real option is the project itself. It is the project itself. There is a capital budgeting project. There was a patent valuation we did, which were real option. Payoff. What is exercise period? Shorter exercise period in normally financial option. Real option will have a longer approach. How you do valuation. So this was one out of those chapters. It was not in these chapters. A large multinational company for host country. This came from chapter 2. Chapter 2, in risk management, we had a risk called political risk. We had a political risk discussion. This came from chapter 2. This was a difficult, but chapter 4. Difficult question, but from chapter 4. Explain the role of government in a sustainable startup. Chapter 15. Chapter 15 or this is from your chapter 7, securitization chapter. They have asked a question from securitization chapter. One question outside. One question was from outside chapter. Others were from these chapters. Your September paper, September 2025. 30 marks initially will be your MCQs. List the steps involved in business succession strategy. Chapter 15. Chapter 15, mandatory question. This was the mandatory question. So 100% you have to answer it. This was question 1. Mandatory question. Identify the key points that make an organization sustainable, done in chapter 1. Chapter 1 part of the important chapter list. Blockchain technology, chapter 7. Every question has it. Every question has one theory question, has one. I'm showing this because at least now you will get serious. Otherwise, seriousness is not there for reading theory. People feel I will go without theory. Then you have to score 60 out of 80. Mentally be prepared. 60 out of 80 you have to score, not 60 out of 100. And don't tell me you'll score less than 60. It will not work, because in your group 1, most of the time auditing pulls down the marks. AF and FR has to take care of your marks. So 60 is what we mentally have to be prepared. Question 4. Technical analysis has supporters and critic. We just now saw supporters of technical analysis and detractors of technical analysis. This came as question number 4C. Every question has one theory or other question, internal choice. What are the parameters to identify currency risk? Chapter 2. Chapter 2. 5 did not have a theory question. 6 did not have a theory question. So 1, 2, 3, 4. If you answer 1, 2, 3, 4, 3 out of 4, you have to answer theory. So 3 into 4, 12 marks. 3 into 4, 12 marks of theory you have to answer. 12 marks of theory you have to answer. I'll just show maybe one more paper, May 2025. Mandatory question. Mr. PK imports raw material. What type of risk? Chapter 2, we have learnt this. We have learnt this as part of chapter 2. Mandatory 4-mark question. Role of CFO in addition to traditional role, chapter 1. Chapter 1, part of the important question. Again, a theory question has come. Weak type of efficiency, various type of test. We saw correlation test, we saw filter rules test, all that got tested as a 4-mark theory question. Tokenization resembles the process of securitization, chapter 7. Venture capital, chapter 15. Chapter 15. Five, no theory. 6, no theory. So 1, 2, 3, 4 had a theory element. 1, 2, 3, 4 had a theory element from the mandatory chapters. Most of the time it will be from the mandatory chapters. I think there was one paper where theory was not tested much, which was May 2024. That's an exception paper. November 2024. Question 1C. Decision determines the division of earnings between payment to shareholder and reinvestment. Question in chapter 1. This is in part of chapter 1. Succession planning, chapter 15. Chapter 15. Okay, I think this paper, no major theory was tested. Okay, this is the paper, no major theory was tested. Only 2 questions were tested. But again, mandatory question has a theory. 100% we have to answer. Apart from that, other areas will also have theory. Again and again, I'm repeating. Don't ignore theory and go to exam. Don't ignore theory and go to exam. Then you will start saying that ICI awarded 58 marks. I wanted only 2 marks. You did not answer any theory. How will you secure that extra 2 marks? You are unnecessarily missing out if you don't answer theory. So 5 chapters, full reading. 5 chapters, full detailed reading. Multiple times you read it. Multiple times get clarity. One approach which I had said earlier also, sit in a calm room, do your own recording of whatever you want to do with the summary theory or with the PPT. Do your own recording and keep hearing it multiple times. Keep hearing it multiple times till you get full clarity on it. No by hearting. I'm not getting into by hearting part. I'm trying to tell you the logic, but still some memory power will be needed here. Clear? Okay, let's take a break now.
Okay, we'll now shift to portfolio management chapter. When we did problem solving, we learned about how risk is computed, return is computed in risk standard deviation, beta, APT model, CAPM model, portfolio strategies. An extension of that with certain extra things being there. I do see additional elements being there in this chapter, and this can be a chapter where institute can ask a descriptive theory question or an MCQ oriented case scenario. First, what are the activities we carry in portfolio management? Very simple. Select the securities. Securities are selected based on risk and return, based on risk and return of individual security. For example, I'm evaluating TCS, HDFC Bank, Infosys, and SBI bonds, shares and bonds. I find their risk, I find their return, and select some security. Create lot of portfolio, combine the selected security in every possible mix to build the full set of feasible portfolio. 20% TCS, 40% HDFC, 40% Infosys, or 10%, 10%, 10%, and 70% bonds, certain feasible portfolio. When you do this feasible portfolio, you decide the optimal weights and create the portfolio. These are the activities we carry in portfolio management. Select the securities, create feasible portfolios, deciding their optimal weights. What are the objectives of portfolio management? Objectives are very simple. I want to make money, also do not carry a risk of losing lot of money. That is, maximize return, minimize risk to the extent possible. It is not that I can make it with zero risk, but maximize return, minimize risk. Safety of principal, minimizing the risk. Capital growth or stability of income, maximizing the return, minimizing the risk, maximizing the return. Apart from that, marketability or liquidity, same, ability to convert back into cash in case we feel that we cannot continue with the investment. Can I quickly convert this back into cash? Like when we invest in shares, mutual funds and all, immediately they can be converted to cash. Diversification is investing in multiple businesses, and any tax benefits, if are there, try to get those tax benefits. For example, investment in ELSS funds, or earlier long-term capital gain used to be exempt on shares or equity mutual fund. So try to take all tax benefits also into picture. Third point, what are the phases of portfolio management? Or if you see, what are the activities carried out in portfolio management? They are very similar. Security analysis, portfolio analysis, portfolio selection. Those three we saw in the phases. After the selection is done, you may have to do a review, revision, and evaluation. Review, which may leads to a revision, and ultimately evaluate your portfolio over the investment period. Objective remains simple: maximize return, minimize risk. Maximize return, minimize the risk of an investment. Traditional approach to portfolio management. What is traditional approach? See, I work in a wealth management firm. We are doing, when we speak to clients, we try to understand what kind of investments they can do, and broadly this is the strategy we follow. First, we study the investor. What are we going to study? Age. If a person is young, he has more flexibility to invest in equity. If he's old, his ability to invest in equity type of investments are lower. Health status, if he has major responsibilities, he may not be able to afford any losses, and we may not put his money into the equity side, more of debt. Need for income, liquidity. What is his attitude to risk? Is he an aggressive investor or a conservative investor? And accordingly, we get a view that whether this person can invest more on equity or less on equity. Second, portfolio objective: maximize the investor wealth subject to the risk he can take. Higher his risk taking ability, higher is the expected return. But it all depends on whether he can take risk or not, depends on his age, health, responsibilities, if he has other assets, need for income, his attitude to risk. All this will decide how much is his risk taking ability. Investment strategy: balance your fixed income versus the equity, balance your dividend stock versus the growth stock. So you will have to balance. You can't get best of both the world. You can either go towards safety or go towards growth. We'll try to balance this, and based on this ultimately select the security, which can be a fundamental analysis or a technical analysis. You'll understand in this chapter something called as random selection also. Fundamental analysis is whatever we have been doing in AFM. Technical analysis is through price trend, and ultimately decide where can we invest. Some example, HUL, Asian Paints is where I want to make my investment. So traditional approaches: study the investor, see his risk taking ability, decide the portfolio objective, see how much risk he can take and how much return can we generate, decide the strategy, and ultimately select the securities. Elements of risk in investment. Risk is something which is unavoidable in investment. So the chapter basically says there are two broad risks which we are aware: systematic risk and unsystematic risk. Systematic is uncontrollable, whereas the unsystematic risk is the controllable or the micro risk. Systematic institute classifies into three. One is your interest rate variation, second is your inflation variation, and third is the overall stock market variation. Interest rate risk, purchasing power is inflation risk, market risk. When it comes to unsystematic, we have two types of unsystematic risk: business risk and financial risk. Business risk is ability of the company to command a better price in the market, sell its product, better market share. So from business cycles and tech change, tariff wars hitting, Vodafone, Idea. Financial risk generally from debt equity ratio or debt by assets ratio. So most of these things we have seen when we did problem solving, but if there are newer elements, you'll need more explanation. So this is broadly self-explanatory. Assumption of the Markowitz model. Markowitz was one of the person who has played a significant part in this chapter, and that the portfolio standard deviation we calculate is through the Markowitz approach. He basically says that you focus on risk return. This is what his focus is all about. So Markowitz basically said, if I'm investing in a company, the return I get out of the company summarizes my ultimate result which I get out of the company. Return summarizes what did I get back from the company. If I have two companies who have 10% standard deviation and they have 15% and 14%, I'll obviously prefer the higher return with the same risk. Higher return with the same risk. Or if I have same return and one has 10%, one has 9% risk, I will obviously prefer the 9% risk. Return adequately summarizes the outcome. All investors are risk averse. Risk averse is minimum risk for a given return. What is given return? 15, 15, 9% risk I will take. Maximum return for a given risk, 10, 10 risk, 15%. 15%. Investors can visualize a probability distribution of the return and weighted average we do. They are rational. Rational basically means greater returns to the lesser one. The meaning of the word risk averse does not mean they are not ready to take risk. They are ready to take risk. For a 9% standard deviation, I would want how much return? For a 10% standard deviation, 15 return is better than 14. 15 return is better than 14. Return is measured generally as yield. Risk is measured as standard deviation, and the decisions are based on only these two. More or less, they kept on talking about the same thing. We did one area called notion of dominance that is coming into picture here. Objective is to earn maximum return with minimum risk. So two securities, same risk, I'll obviously prefer the higher return one. Two securities, same return, I'll obviously prefer the lower risk one. CAPM model, we are aware, I think the model which is used extensively from CA Inter to CA Final is the CAPM model. RF plus beta into RM minus RF. RF plus beta into RM minus RF. CAPM measures securities return to a non-diversifiable systematic risk. As beta increases, the required return is going up. 0 is risk-free, 0.5 is HUL, 1 is Nifty, 1.5 is Reliance, 2 is Tata Motor. Beautiful chart. This explains. There are certain assumptions. It assumes there will be an efficient market. When we did technical analysis, we learned, or when we did security analysis chapter, or in the theory also you would have learned that there is an efficient market and an inefficient market. So assumption is efficient. Rational investment goals will be there. Risk aversion is balancing the risk and return. No transaction cost, no bankruptcy risk, divisible and liquid assets, and you can borrow money if you want at the risk-free rate. The CAPM model has good advantages and disadvantages. The main advantage is, if a company is not paying dividend, it can help me in calculating cost of equity of a company which is not even paying dividend. Cost of equity of a company which is not even paying dividend. Values no dividend company provides you a good risk adjusted return. What is risk adjusted return? RF plus beta into RM minus RF, but there are limitations. People are questioning the beta itself. People are questioning the beta itself. What data do I take? Do I take last 1 month data, 1 year data, 10-year data, 15-year data to calculate beta? And for many companies, the statistically reliable beta may not be there. Like beta is unreliable. The RF and RM issue can also be there. Getting a reliable RF and market return is also difficult. Sometimes multiple risk-free rates do exist. Multiple risk-free rates do exist, and the model completely overlooks the unsystematic risk, because there are people who may want to invest in an undiversified portfolio. Model unfortunately ignores the concept of unsystematic risk. Ignores the concept of unsystematic risk. Active portfolio strategy means doing continuous buying and continuous selling, or doing something called as re-evaluation of your investments on a continuous basis. In an active portfolio strategy, I may invest in some companies, alter their investments, see what are the market trends, keep rotating from one sector to another sector. Today IT is doing bad. Maybe I invest in IT company if I have a contra investor. Contra means opposite of what others are doing. Or I invest in well-growing sector like a pharma sector. So I keep changing market timing. Shift the long-run asset mix based on the forecast of the market. Sector rotation. Shift from IT to banking to pharma to some other sector. Select your security through fundamental and your technical analysis. And based on this, you may also do like sector rotation. Theme-based investments can also be done, saying that Make in India is a theme I want to invest with, followed by aggressive investor, most fund manager who do an active research. Active research. Keep doing research, keep finding which sectors are doing well, and keep altering your investment based on the sectors. Passive portfolio strategy, exact opposite of active portfolio. I will invest in Nifty 50 companies. That's all I've decided. I'll invest in Nifty 50 companies. Some weights I decide. Invest once and keep quiet. Invest once and keep quiet. Unless the objective is to create a good diversified portfolio. We have created a good diversified means multiple companies. Unless I feel my portfolio has lost the diversifiability, or it has become undiversified, or some other challenge, I will not alter. Diversify, create a well diversified, hold it unchanged unless you feel it is inadequately diversified or inconsistent. Example, as I said, UTI Nifty 50 index fund, HDFC index fund Sensex plan, which invest in the securities of the target index. So you just go and invest in the index. The active portfolio strategy as well as the passive portfolio strategy was more discussed from equity investment point of view. Now onwards, I think we'll also discuss on the bonds point of view. The discussion till now was majorly on the equity side. What are the criteria for bond selection? That is, should I invest in ICICI bond, SBI bond, or some other company? So they are saying four things. So most of it you are aware. One is YTM, yield to maturity, where you can earn more returns. You see it. Second, is there any risk? This is return angle. This is risk angle. Is there a risk of default? If there is a risk of default, don't invest. Tax shield means, are there any tax benefits which you can get? And liquidity is ability to convert this back into cash at a short notice. These are the four factors. I can also add another factor called duration or volatility, which is a measure of risk. So these are the criteria for bond selection. Three approaches. Okay, again we come back to stock. There are three approaches for selection of stock: technical analysis, fundamental analysis, random selection. Technical analysis based on price trends. Based on the past price trends, I'll judge whether it will move up or down. Fundamental analysis, doing research on earnings, revenue, EBITDA, PAT, competition, revenue growth, how is company performing with others, and deciding the intrinsic value. Random selection means all are good companies. You can go ahead and find anything. Now, these theories or these approaches will work differently in different situations, and that can come as a MCQ based question. The level of market efficiency and my technical, fundamental, and random. The market can be inefficient, weak efficiency, semi-strong efficiency, or strong efficiency. Inefficient means, using technical analysis, you can find the good companies to invest. So if it's inefficient, the best is technical. Best is technical because based on the price trend, I can find what will happen in future. Don't do fundamental analysis. Also, don't do the random selection because technical analysis works the best. If it's an efficient market, whatever be the efficiency, weak efficiency, semi-strong efficiency, strong efficiency. Again, these three efficiency we have seen in security analysis chapter. If it's weak efficiency or anything, all are poor. All are poor. There is no point in doing technical analysis if it's a efficient market. Technical analysis based on price trend. Weak efficiency means past data is considered in the market. Semi-strong means it is still more efficient. And strong means you cannot use any information and generate a superior return. So if it's a strong market, doing random selection, because there's no point in doing the research. No point in doing the research because with research also you can't do anything. If it's a strong form efficiency, randomly select. All are good companies only. All are fairly valued. All are good companies. So poor here, best. And weak form of efficiency, fundamental analysis is best. Other than that, fundamental does still play a good part, be it semi-strong or strong form of efficiency, and random selection is also okay in semi-strong. Random is bad if it's weak form efficiency because for weak form you have something else good. Something else good is this best. Best for fundamental analysis. See, inefficient market based on past trend, you can find what will happen in future. Go with the technical analysis. Don't do fundamental or random selection, and don't do technical analysis for all other three scenarios. Weak form efficient, do fundamental analysis. Strong form efficient, do the random selection. Other places you can keep shuffling between the fundamental and random selection. Clear? So this is three approaches for selection. Like that, portfolio rebalancing strategies we did. One was called buy and hold. This was one strategy. Second was constant mix. Third was CPPI strategy. Buy and hold is more like a passive strategy. Buy and forget it. Here it is more like an active strategy. where you keep rebalancing your debt equity mix, CPPI sets a floor value. Equity investment is equal to value minus the floor value into multiplier. It basically tells that if your value of the portfolio is on the higher side, you can take more risk. You can take more risk. Do nothing policy, do something policy. CPPI sets a floor value, and if you are able to increase the value of the portfolio, you can take more risk. I'll explain this table in a minute. This is how it will work. Buy and hold policy, as market goes up, your returns will keep going up in a straight line. Constant mix policy, market is up more, but your returns is slightly on the lower side. Rate of additional profit reduces. Why does it reduce? You'll understand. Rate of additional profit reduces as the prices increase, and CPPI, rate of additional profit, increases. Buy and hold, nothing to be done. In a constant mix policy, up, market up, I will sell shares and buy bond. This is how the strategy will work. So when it is a up moving market, you are selling your equity. So as it keeps moving up, your returns, additional returns, keep coming down because you are reducing the equity component. You are reducing the equity component in an up market. As market keeps going up, we did problem solving, sell shares and buy bonds. So when I shift to bonds, bonds can't give the returns which the shares are giving. So as market keeps going up, your additional return will go down. CPPI, as market up, you buy shares. You buy shares and sell bonds. So as market goes up, you keep buying more shares, earn higher return than the market return because your proportion of shares is going up. Proportion of shares is going up. CPPI, you will earn higher return when markets are going up than a constant mix policy. Buy and hold is standard. It is always in between the two. In between the two. So here, payoff straight line, diminishing returns, increasing returns. But constant mix is good if it is a flat market. Flat market, it will do good. Flat market, it will do really well. It's a continuous up market or a continuous down market, CPPI is better. Continuous up or continuous down, we have done problem solving there. If it's continuously up, CPPI will give more returns. Continuously down, CPPI will have lower loss than the constant mix. And buy and hold will always be between the two. Any problem you do, buy and hold will always be between CPPI and constant mix. Always between CPPI and constant mix in both the sides. In both the side, it will be between the two. It will be between the two. So up market, CPPI will do well. Continuous. It's not up, down. Continuous up, CPPI better. Continuous down, CPPI better. Kind of up, down market, flat market, constant mix is better. Buy and hold is always in between. Buy and hold is always in between. Okay. There are 4 types of asset allocation strategy. What is asset allocation strategies? I want to invest 1 CR. How much do I invest in debt? How much do I invest in equity? How much do I invest in gold? How much do I invest in silver? The asset allocation strategy will tell how much to invest in debt, how much in equity, how much in gold, how much in silver. First part is called integrated asset allocation. Integrated asset allocation means understand what the investor wants. Is he a guy who is ready to take risk or not ready to take risk? Also see the market angle. I am a guy who is ready to take risk, but I feel equity market is highly overvalued at this time. So in an integrated asset allocation, I combine investor with the market. Investor with the market, look at the market condition and decide the investment. If you are a guy who cannot take risk and I feel the stock market is undervalued and you cannot take risk, I will not be able to invest in equity. You are willing to take risk and market is overvalued, then still I will not put money in equity. I'll still not put money in equity. I am a guy who's ready to take risk, but the current markets are such that we can't invest in equity. We'll decide the mix according. Strategic is slightly different from integrated. In integrated, we look at the current market condition. Here we look at only the historical data. Only the historical data of equity returns, gold returns, silver returns, bond returns, not looking at the current situation. Look at historical data and do the allocation based on the risk preference of the investor. Here, only investor is considered. You don't look at what are the market condition. Here, investor plus market. Tactical, I will keep changing it. I'll keep changing the allocation. Make an allocation, change it. Make an allocation, change it. Make an allocation, change it. Insured asset allocation is like CPPI. CPPI. Invest a fixed amount in the safer investments. Above that, you can take risk. As wealth increases, you have more ability to take risk. You have more ability to take risk. To put it very simple, it is the CPPI policy. Insured asset allocation is the CPPI policy. Integrated, investor plus the market. Strategic, only the investor, not looking at the market condition. Tactical, I will keep changing the allocation. Insured, put a fixed amount safe in safer place, and as wealth increases, take risk and put it on the riskier side. Okay, now again we are coming back to bonds part of it. How are we going to compute returns of the bond? What is the process of investment? What are the strategies? Again, this question can get tested as an MCQ oriented question. Process is very simple. Why are we investing in fixed income portfolio? I need 20 lakh after 10 years for my kids' education. That is my objective. Against that objective, I am going to invest money. The return can be computed in multiple ways. Arithmetic mean. There are other ways called time weighted rate of return or rupee weighted rate of return. We haven't seen any practical problem solving, so I haven't got into that area. But you decide the return computation, compute the return for the fixed income portfolio. Now the strategy, there can be a active strategy or a passive strategy like we earlier saw. So passive strategy means buy, hold, buying 10-year government security, keeping quiet. Indexation, instead of investing in one bond, invest in an index bond. If at all there is an index called Nifty Sovereign Bond Index, which may have 10-20 companies. Immunization is basically a process whereby I remove the price risk with the reinvestment risk. Immunization ensures that portfolio duration is equal to investment horizon. And cash flow matching is a way to do immunization. For example, if I need money after 10 years, invest in a zero coupon bond with a 10-year life. So your cash flow matched, duration will also match, and immunization happens. It's a way to do immunization. Cash flow matching means immunization may not involve, may not always have cash flow matching. Immunization basically means duration has to match, but the cash flow may not match. I may get 1 year, 2 year, 3 years of money and repay at the end of 4th year. 1, 2, 3, 4, all 4 years I get money that and repay at the end of 4th year using reinvestment strategy. That is immunization. Cash flow matching is very simple. You need money in the 4th year. Money should come only in the 4th year. Only in the 4th year. These are passive strategies. There are active strategies. Active strategy means I will keep shuffling. One is called bullet strategy. Bullet strategy means investing all money in 10-year bond. Barbell strategy means if I have 1 year, 5 year, 10 year, invest in 1 year and 10 year 50-50. Invest in 1 year and 10 year 50-50. Not investing in 2, 3, 7, 9. Bullet, invest everything in the 10th year. There is one case scenario MCQ on this. Invest everything in the 10th year. Barbell, split it. Ladder, invest equally in all the maturity. Ladder, invest equally in all the maturity. This is active bond management. There are other bond strategies, bond swap strategy, pure yield pickup. What is pure yield pickup? Is SBI 10% yield, ICICI 9% yield. Both are same risk only. So replace 9% ICICI yield with a 10% SBI yield because they are identical quality, higher return. Substitution swap. I sometimes find that some bond is undervalued or overvalued. Replace the overvalued, sell your overvalued, buy your undervalued. Tax swap is selling at a loss to reduce your capital gain tax, and interest rate swap is converting fixed to floating, floating to fixed, fixed to floating, or floating to fixed. I just go back to this place again. First you decide your objective and invest according to. Passive strategy, buy and hold, buy once, ignore it. Indexation is invest in index bond. Immunization is ensuring bond duration is equal to investment horizon. Cash flow matching is matching the cash flows of the bond, matching the cash flows of the bond with the amount which I have to pay. Active bond management strategy, bulletin, everything in 10th year. Barbell, invest in 1 year, invest in 10 year, ignore the in-between period. Equal distribution is called ladder. Pure yield pickup is replacing 10% SBI return with a 9% ICICI return. Substitution swap, SBI undervalued, buy it. ICICI overvalued, sell it. Tax swap, selling it at a loss to save taxes. Interest rate swap is converting a fixed into floating or floating into fixed. Alternative investment. Now onwards it is going to be a more or less theoretical discussion. Alternative investments are not the normal set of investments which we do. What are the normal set of investments we do? We invest in debt, equity, preference, fixed deposits. So alternatives are outside this. They are specialized products. The transaction fees will be on the higher side. They carry lot of risk, less transparency. Because of this, lot of research is needed. Illiquidity, data may not be available, and in case you are doing investment through highly leveraged borrowing, then this can further increase the return as well as increase the risk. High fees, limited historical data, illiquidity, less transparency, extensive research, and leveraged buying. Real estate valuation is complex. Now we have done, well, some of us have seen real estate, could have invested in real estate, your parents could have invested in real estate, but doing the valuation is very complex because the main part is illiquidity. There is liquidity issue in the market. It is very, very difficult to sell or buy a real estate. Inefficient market. Inefficient is information is not available. Limited comparability. How do I compare one real estate project with another real estate project? No organized market. You are like, you want to buy a share, you go to a BSE, NSE and buy the share. And there can be high transaction cost, and also we have stamp duty and other things. But still your institute material talks about 4 approaches of valuation. Either P&L debit side, which is cost approach, P&L credit side, which is sales approach. Income approach is sales minus cost and doing a multiplier, are based on cash flow. Cost side, sales minus cost are based on the cash flow. Gold as an alternative investment. In alternative investment, I think in the recent exam, they asked one question on SGB bond return computation. So gold as an alternative investment, gold generally has a, generally has a negative correlation with equity. So people generally invest in gold and equity together. These are the various ways in you can invest gold. Jewelry involves jeweler charges or making charges. Gold bars are coins. You will have to physically store it. Again, some charges can be there. Sovereign gold bond, which government was issuing. Now it is kind of discontinued. Gold exchange traded funds is gold mutual funds, or electronic gold. These are the various ways of buying the gold. All are self-explanatory. Beyond this, major point is self-explanatory. Distressed security. Distressed companies are those which are going through tough time. They are not able to meet their fixed interest or their fixed cost, and if the distress continues for a longer period, it can go towards insolvency. We did look at the valuation of distressed security. Now, Institute Metal talks about one strategy for investing in distressed security, and this got tested in an IBS paper. In distressed security, you have a strategy called invest in debt as well as equity of this distressed company. Here you take a long position, here you take a short position. Long position means give loans to the distressed company. If company recovers, you will earn a huge interest. You will earn a huge interest, and you do a short position in the equity. So take a long position in the distressed debt, short position. If the company recovers, interest received will be better than the equity dividend, and if it worsens further, the short position will give you profit, the short position. But there are a lot of problems. Liquidity risk, that is difficult to convert into cash. Event risk, any specific event may affect that company. Market risk, and there's a human risk. Human risk is that tribunal, the tribunal, which is the IBC tribunal, they make a decision on the resolution of this distressed company, and their decision can also impact the investor. CPPI is basically keeping the portfolio value above a floor. Keeping the portfolio value above a floor. If you want to keep the portfolio value, I think I'll show it more from a theory oriented, that is rather than the PPT, how ICI drafted this question. Let us see this. This is how they drafted it. Strategy of portfolio under which the value of the portfolio shall not fall below a specified value. It will not fall below a specified value under the CPPI strategy. Concept of efficient frontier. Efficient frontier basically links. So this is the portfolio value, this is the floor value. As the portfolio value goes up, you have a higher cushion and you can perform better, or you can invest more. You can invest more. Efficient frontier is linking the expected return with the risk. Objective is very simple. If I have a company which is here, it basically earns a return lower than this point, carrying the same risk. This is a bad. Any company which is below the efficient frontier are bad. Anything which is above, which is rare, if it's above, then the efficient frontier changes. It changes. Objective is increase the expected return without risk, decrease risk without decreasing, or obtain combination. Basic logic is very simple. Any companies which is in the efficient frontier forms part of. You find out all efficient companies and do a graph of that. That is called efficient frontier. With this chapter discussion is over. A relatively bigger chapter, but again we have tried covering it in some 30-40 minutes. As I do, I'll revise it now. Activities carried out in portfolio management. We carry 3 activities. Select the security. After selection, create some feasible portfolio and decide the optimal weights. Second, what are the objectives? Safety of principal. Safety of principal means reducing the risk as well as increasing the return. How do you increase the return? By providing some capital growth. Liquidity is also important, marketability or liquidity, and if any tax benefits can come, please consider that. And diversification. Phases of portfolio management is same as question number 1. Security analysis, portfolio analysis, portfolio selection. After the portfolio is selected, do a review and revise the portfolio and do a re-evaluation of the portfolio. Traditional approach to portfolio management: study the investor and see what is his risk taking ability. After you find his risk taking ability, see what kind of allocation you want to do, and then do a fundamental technical analysis and select the security in the market. Elements of risk: there is a systematic risk, which is macro risk, unavoidable. Unsystematic risk, which is a micro risk. Unsystematic is business risk and the financial risk. And systematic ICA classifies into 3: interest rate risk, purchasing power inflation risk, and the market risk. Assumption of Markowitz model: maximize return, minimize risk. A risk averse investor, that is, if the risk is so much, I want so much return. If the return is so much, this much risk only I can take. Maximize risk, minimize return. That does not mean he's not taking risk. He's ready to take risk. He's a rational investor. He can compare multiple investments, and in the end, the focus is the return should be on the higher side, risk should be on the lower side. Capital asset pricing model is RF plus beta into RM minus RF. It has its own assumption. It says that there is an efficient market, information is freely available, no transaction cost, no tax related, no transaction cost, sorry, no transaction cost. Information is freely available. You are able to get all information. People are rational. People are able to make decision based on information. Efficient, rational, risk aversion, no transaction cost, no bankruptcy risk, market in equilibrium. There are advantages and disadvantages. Advantages is it can help in valuation of a non-dividend paying company, and it also provides a good measure of risk adjusted return. Reliability of beta is question mark, reliability of RF is question mark, reliability of RM is question mark, which is used in the formula. All three, there is a reliability doubt, and it ignores the unsystematic risk fully. Active strategy means continuously evaluating stock market and buying and selling, sector rotation, theme rotation, actively checking undervalued companies, overvalued companies, and keep making investment. Timing of the market, sector rotation, theme rotation, and security. Passive strategy, invest in one index fund, forget it. That's all. Invest in one index fund and forget it. And if the index is well diversified, I don't alter it. If I feel the diversification is lost, I will re-diversify the portfolio. Bond selection criteria, yield to maturity, return point of view, risk of default. You can also bring duration or volatility, any tax benefit, and the liquidity angle. Three approaches for stock selection: technical based on price trend, fundamental based on financials, random selection, doing no research, randomly selecting it. Random selection will work if it's a strong form of efficient market. Fundamental will work if it is a weak form of efficient market, and technical work if it's inefficient. Other places it's generally poor, but sometimes it can be good or fair as well. Portfolio revision, buy and hold, do nothing policy. Constant mix, do something policy. CPPI, invest the floor value, invest the floor value. CPPI, invest the floor value in the fixed area, and as your value increases, you have the ability to take risk. CPPI will perform better continuous up market or continuous down market. Constant mix will perform if it's an up down market. Buy and hold will always be in between. So buy and hold as a straight return, constant mix as a diminishing or concave return, and CPPI as a convex or increasing returns. Buy and hold straight line, constant mix like this, CPPI like the other side. Types of asset allocation strategy, integrated. I integrate the investor need with the stock market scenario or with the market scenario. Strategic asset allocation, just look at what the investor wants, look at the historical returns and decide the mix. Tactical means you'll keep altering your debt equity mix based on the market side movement. Insured means fixed amount in the safer, and as your wealth grows, your ability to take risk increases, more like CPPI policy. Fixed income investment, decide what is the purpose of investment, see how you want to calculate the returns from your investment. There are active strategy and passive strategy. In passive strategy, buy and hold, or invest in an index bond fund, invest in an index bond fund, do immunization of the portfolio or cash flow matching of the portfolio. Second is active bond management strategy. Under the active side, you can do a bullet strategy, invest everything in one bond. Barbell strategy, invest in the shorter bond, longer bond, medium, ignore it. Ladder bond, invest equally. And your bond swaps is pure yield swap, replace a 9% yield with a 10% if risk is without any change in risk. Substitution, sell undervalued bond, buy, sell overvalued bond, buy undervalued bond. Tax swap, selling with the purpose of reporting a loss so that I can save capital gain tax. Interest rate swap, fixed versus floating, fixed swap to floating, floating swap to fixed. Alternative investments are not the general investments. This will involve high fees because there is a specialized instrument which is getting created. They are illiquid in nature. Transparency is not there. Limited historical data. Lot of research is needed, and they could be that these are the places where you may do a leverage buying. Leverage means you borrow and then buy it. Real estate valuation is complex because again, no ready market available, illiquidity, the rationality may not exist in the market. It may be an inefficient market, and there can be a lot of transaction cost, high transaction cost, no organized market, inefficient, illiquidity limit. Still you want to do valuation either through the credit side, which is sales multiplier approach, or based on the cost approach, income multiplier approach, or based on cash flows. Gold as an alternative investment is, investing in gold is good, and you may want to create a portfolio which has gold and equity because they generally have a negative correlation, and these are the places where gold investments can be done: jewelry, gold bar, sovereign gold bond, gold exchange traded funds, or the electronic gold. Distressed securities are those which are going through trouble time. If you are going through trouble time, investing in this can give you very high returns or can wipe up your entire investment. They have a strategy saying investment in debt and do a short in equity. When you invest in debt, if company does well, your debt will be repaid with good amount of interest, and if company does poor, your short position may give you good profits. It carries a lot of risk: liquidity risk, market risk, event risk, any specific event impacting, or the human risk, the person, the tribunal is taking a wrong decision or something. CPPI is a policy which can help in investing or keeping our portfolio above a floor value. And efficient frontier is basically saying that there are securities which are forming part of the efficient frontier, where you plot the various securities and see which has the highest return and which has the lowest risk for that highest return, plot them. If your security is not on the efficient frontier, if you are below, sell that security and find a security which are on the efficient frontier and invest in that. Objective is to maximize return with the minimum possible risk, or for the given return have minimal possible risk. With this chapter is over. If there are any doubts, you can send me a message in WhatsApp. Thank you, friends. Okay, we'll start with the mutual funds chapter now. We have already seen the practical problem solving part of mutual funds, where we have worked on MF return, MF NAV computation, performance evaluation, Sharpe ratios, Traynor ratios. All those we saw as part of problem solving. Now we are going to focus on certain mechanics around the mutual fund. What are the different types of mutual funds? What are the schemes in mutual funds, and certain other allied areas. This is covered in our theory book. Starts with page 512, chapter 8, mutual funds. When I do my explanation, I have a PPT which is created, and I'll share the PPT also with you. With the PPT, I'll try to explain because it gives you a visual feel. But for your reading, for your exam preparation, the theory material is sufficient. PPT is just a tool to understand the concept a little better or faster. Okay. First question, what is a mutual fund? So a mutual fund is basically a trust that is going to collect money from lots of investors. Many investors collect money from all these people, pool the money together using a fund manager, make investments in stocks, bonds, debentures, money market instrument, government security, real estate assets, infrastructure related assets, make all those investments and provide returns to the investor. This is what a mutual fund does: collect money, pool the money together, invest the money, and earn returns for the investor. A classic example, SBI mutual fund, which pools money from lakhs of investor and invest it across stocks like Reliance, TCS, HDFC Bank, Infosys. So many companies, they make the investment. This is the first question. What is a mutual fund? Second question, what is a classification, or what are the different types of mutual funds? Now, ICI material talks about broadly a functional classification, a portfolio classification, and a ownership classification. There are three types of classification: functional, something on the portfolio side, and something on the ownership of the mutual fund. Let us go one by one, all the three category. Functional classification basically focuses on when can I enter and when can I exit out of a mutual fund. Open mutual fund, the lock is open. The lock is open. You can enter anytime, exit anytime. Enter anytime, exit anytime. It is an open-ended mutual fund. Lock is open. Enter anytime, exit anytime. One example is HDFC Flexi Cap Fund. Second, there's a close-ended fund which is locked. Locked means entry on one date, exit on one date. In between, we can't enter into the mutual fund. So whenever you want to buy a close-ended mutual fund or whenever you want to subscribe, it has to be through NFO, new fund offer. You will have to buy it through the new fund offer. Like we have IPO for a share, we have NFO for a mutual fund. So enter into the fund through NFO stage, new fund offer. In case you want to enter in between, these will be listed. So like you can buy any company share you want, you can buy the mutual from some other person. You are buying, some other guy is selling. You are buying and some other guy is selling. They generally have a limited life. Whatever is the periodicity, could be 5 years, 10 years, 3 years, and the corpus will be liquidated on maturity. So under a close-ended mutual fund, entry once, exit on the end of the life. And in case you want to enter in between through stock exchange, and you also exit also through stock exchange. Open-ended, entry and exit anytime through the fund house itself. Fund house means to the AMC I'll be giving the money. Interval funds is a mixed bag where there is entry allowed multiple times, exit also allowed multiple times, but it is not as free as open and it's not as restricted as the close. So here purchase or redemption can happen at pre-specified interval. Pre-specified interval could be every month end, every quarter end, or every half year end. One example is ICICI Prudential Interval Fund with a quarterly plan. Quarterly means every quarter end people can enter into the fund. This is functional classification. Open-ended funds, close-ended funds, interval funds, open-ended entry and exit at any time. Close-ended fund, entry once, exit once, but they are listed. So because they are listed, you can enter into the fund by buying it in the stock exchange and selling it in the stock exchange. An interval fund is a combination. Second classification is on the portfolio, where there are three types. One is equity side is there, debt side is there, and there is a third category called special funds. Equity means these type of funds will invest in equity shares of companies. They'll invest in equity. These mutual funds will invest in equity shares. What type of equity shares? Growth fund. Growth fund means primarily for very long term kind of investment. They are going to invest for longer period, suitable for long term appreciation. One example is Mirae Asset Large Cap Fund. Second is aggressive funds. Aggressive funds take abnormal risk. The name aggressive indicates that they take very high risk. They may invest in startup or IPO companies, or speculative companies, or small cap companies, or micro cap companies, which are high risk but high return kind of investments. Income funds, objective is to earn regular income through dividends. So these will invest in high dividend stock. One example is ICICI Prudential Dividend Yield Equity Fund. ICICI Prudential Dividend Yield Equity Fund. Purpose is to invest in those companies, which can give high amount of dividend income. Debt funds, this will invest in SBI equity. This will invest in SBI bonds. Just to give an example, it will invest in bonds, debentures, and any debt instrument. One is bond funds, which invest in government bonds, corporate bonds, money market instruments. They will give you regular income, carry interest income, all that is there, and it does carry those risks which we learnt in bond valuation. There's a price risk, there's a default risk, there's a reinvestment risk, all that is there. HDFC corporate bond. In the debt fund, there's a category called gilt funds, GILT, invest primarily in government security. They'll invest primarily in government security, either central government or state government bonds. Obviously, they are considered to be risk-free in nature. This is the second category, which is equity versus the debt part of it. Then comes the special funds, where ICI material talks about 9 different categories. Some of them are self-explanatory, some may need some explanation. Index funds are those which does not invest in one company. It invests in an index of companies. What is index of companies? Nifty 50 index fund. These companies will invest in all the 50 companies of Nifty. Our Nifty micro cap 250 fund. Micro cap has 250 companies. All the 250 companies they'll invest. Small cap 50, 100, 250. There are different categories. So they are investing in that index of companies. They are considered to be low cost because here no research is done. I'm not going to do any research. I will collect money, split among the 50 companies or 100 companies which form part of the index. International funds, offshore funds. International means Indian fund investing in US companies. Indian fund investing in US companies are called international. USA mutual fund investing in India company. USA mutual fund investing in Indian companies or Indian funds. This is Motilal Oswal Nasdaq 100 FOF, and this is Franklin India Feeder Fund. International Indian fund investing in US, offshore funds, US funds investing in India. Sector, as the name indicates, they'll invest in only one sector. Example, Nippon India Pharma Fund, ICICI Prudential Technology Fund, SBI Technology Fund. These companies will invest in that specific sector. Technology means primarily IT companies. Pharma means primarily pharma companies. Banking and financial services fund primarily in the banking sector. Only in that sector there is no diversification which happens in sector fund. Money market funds, as the name indicates, money market means short term instrument. So here the investments are going to happen in all those money market instruments which we saw in security valuation, commercial paper, certificate of deposits, treasury bills. All these places the investment will be made. Example, Axis Liquid Fund. Fund of funds. The role of fund of funds is to invest in multiple other mutual fund. I collect the money, put this money in one index fund, put this money in one international fund, put some money in one sector fund, put some money in one money market fund. I am trying to put my money in multiple funds, whatever the scheme objective says. Capital protection. Objective is very simple. Invest in most of the high rated debt. High rated debt means good credit rating debt instrument, so that risk is very limited. Protect the capital, and small amount can be invested in equity. Gold funds, as the name indicates, is invested in gold. Quant means it is basically going to use some algorithms, some data driven analysis Based on data driven analysis, it will automatically pick stock. Many a times when we are trying to buy something or sell something, human bias come into picture. Stock has gone up by 20%. Let us not buy it now. It will come down and then buy. That human bias is eliminated through a category called quant fund. Let me quickly read all the category. First is open-ended, close-ended and interval fund. Open-ended, entry at any time, exit at any time. Close-ended, entry once, exit once. Interval, entry and exit at pre-specified timeline. Equity funds can be growth, can be aggressive. Growth means investing in long-term investment, aggressive, high risk. Income funds, high dividend yield. Debt funds, bond funds, investing in corporate bonds, government security, everything. Gilt fund, only in government security. And 9 categories of special funds. Index funds, invest in Nifty 50. International fund, Indian fund, investing in US. Offshore fund, US fund, investing in India. Sector fund, investing only in pharma sector. Money market funds, investing in money market instruments, liquid fund. Fund of funds, investing in multiple other mutual fund. Capital protection, objective is to protect the capital by investing in high rated debt. Balance may go in equity. Gold funds, invest only in gold. And quant fund, selection of the companies for investment purpose through systems, through some software, through some algorithm, data driven stock selection, remove human bias. The third classification is ownership. Ownership means who is the owner of the mutual fund. The owner of the mutual fund can be from public sector. SBI mutual fund. SBI is a public sector company sponsored by a company of a public sector, SBI, UTI. Private sector, HDFC mutual fund, ICICI mutual fund. Or foreign means outside India. The owner of the mutual fund is from sponsored by foreign companies. So here either it could be sponsored by a company of the public sector. Sponsor is a person who is needed to start a mutual fund. So public sector sponsorship, public sector mutual fund. Private sector sponsorship, private sector mutual fund. And foreign mutual funds are sponsored by foreign companies who raise funds in India, operate in India, invest in India. But the owner, the main owner of the sponsor will technically be a foreign mutual fund. This is discussion of question 2 fully. Okay, explain about direct plan in a mutual fund. So this, we have completed this part. The full classification: open-ended, close-ended, interval, equity, growth, aggressive, income, debt, bond, gilt. Special funds as multiple category, ownership funds. So all these categories have been discussed. It can come as an MCQ question if Aisha wishes to, because in an MCQ you may have a category of a fund and you need to decide which category does that fit in. Okay, coming to direct plan in a mutual fund. Listen, when I invest in a mutual fund, there are 2 types of plans given by the asset management company or by the mutual fund. There's something called as a regular plan and a direct plan. Regular means some agent, are technically called MFD, distributor, mutual fund distributor, will help you in selecting the fund and then you invest through him. In this case, the agent or the MFD receives MF commission, something called as trail commission, which is paid to the agent because the agent helps you in selection of the funds. Direct plan means you directly invest on your own without any support from an agent, where investor invests directly without any distributor. Because of this, what happens is that commission is not paid, and we learned a concept called expense ratio, which I also will be discussing in some time. This expense ratio will be different for a regular plan and different for a direct plan, different for a regular plan. Lower because no commission, no commission. Direct plan 1%, regular plan could be 1.5%, and because of which the direct plan will always perform better than the regular plan. Only point is we should be aware of how to select the fund. If we are having that knowledge, we can go through the direct plan, directly go to the AMC website and invest it. If that knowledge is not there, or we are not able to find what to do, then an agent will help you in selecting the fund, which is called a regular plan. What are the schemes available? We earlier learnt about what are the various different types of funds, the classification. Broadly around that, but slightly different are the schemes. First is called balanced. We learned a category called, it can be equity funds or debt fund. Balanced is the hybrid. Hybrid means it will invest in both equity and debt. An example, 65% in equity, 35% in debt. This is a small example for a balanced funds or an hybrid funds, which invest in both debt and equity. Equity diversified fund, sub part of the equity funds. In equity funds, we learned a category called growth, aggressive. So in that category, institute says there's a category called equity diversified fund. Equity diversified means it invests in multiple sectors, multiple companies, multiple sectors and multiple companies. All my explanation is with PPT. You keep seeing the material, that is our normal book, and learn from there. ELSS. ELSS are those funds which gives you ATC benefit. ATC benefit. Section 80C benefit, if available in certain funds, they are called equity linked savings scheme. Sector we already saw. Sector means investing in banking fund, pharma funds. Thematic is very similar to sector, but it is related to one specific theme. For example, Make in India theme. With Make in India theme, whichever companies can get benefited across sectors will be invested across sectors, not one sector. If you find somebody from manufacturing can benefit, somebody from services can benefit, somebody from auto can benefit, somebody from steel can benefit, invest in that specific theme that is called thematic fund. Arbitrage means making profits by exploiting the differences, and primarily the difference in spot and futures market. We learned about futures valuation and derivatives, and there's a spot. If there are differences and if you find any undervalued or overvalued, arbitrage fund will try to take that benefit. Hedge fund. Okay, hedge fund has nothing to do with the word hedging. Hedge are those funds which takes extreme amount of risk. They are aggressively managed. They will take derivatives, futures, options, leverage, invest in cryptos, invest in high risk, extremely high risk investments will be taken by a hedge fund. Hedge, the word hedge has nothing to do with hedging, which we learn. Cash or liquid fund will invest in money market instrument. We already saw that earlier. ETF, exchange traded, means those funds which are traded in stock exchange, To put it very simple, all close-ended funds will be an ETF because they have to be traded in the stock market. Fixed maturity plan, FMP, these are close-ended fund with a fixed maturity, could be 2 years, 3 years, 4 years, 5 years. In that time period, these funds will go out of the scene. It will have to be redeemed. Quickly, this category, balanced mix of debt and equity. Equity diversified fund, these are going to invest across multiple sectors and companies. ELSS, equity linked savings scheme. ELSS is equity linked savings schemes, ATC benefits. Sector funds invest in specific sector. Thematic funds invest in specific theme like Make in India or other theme. where it could be belonging to multiple sectors. Arbitrage fund exploit the difference in prices between the spot market and the futures market. Hedge fund, nothing to do with the word hedging, invest in those companies or those places where extreme amount of risk is there. Cash fund, invest in money market instrument. ETF, close-ended funds which are traded in the stock exchange. And fixed maturity plan, again close-ended but has a fixed maturity date. Okay. Point number 5, question number 5. So we are done till question 4 of our book. What are the various types of schemes? Now, what are the advantages and limitation? I think there are multiple advantages. Most of it are self-explanatory. Professional management, a chartered accountant or an MBA or a person with good amount of knowledge of finance is going to manage your money. So they'll obviously try to perform better for you. Diversification, you can invest even 1,000 rupees and they will diversify across companies. Easy to administer it. You have a demat by which you can buy. Generally, they'll give higher returns than the other instruments. Low cost of management, technically the expense ratio. There are certain limitations on the expense ratio from the SEBI side. Liquidity, open-ended from the MF, close-ended exchange listing. Transparency, SEBI and AMFI norms are there. You also have SIPs, every month directly investment happens. SWP, every month directly you can withdraw, automatic, all are automated. STP, you can switch from one fund to another fund every month. Highly regulated. Economies of scale means it gets the benefits of multiple investors investing. Some of the funds are even worth more than 1 lakh crores in India. So because such huge money is being handled, they can afford a good research team with very minimal expenses percentage. Flexibility, convenience. These are some of the benefits of mutual fund. Limitations. The biggest problem I see is there's no guarantee of returns. It is not necessary that you will 100% make money in mutual fund. We have seen, I have personally do wealth management for people. We do see clients sometimes losing money if you are trying to exit in between. If you wait for a longer period, generally they give good returns. Selecting the fund can be difficult. If you are trying for a direct plan, you have to select on your own. A regular plan, some professional may help you. Diversification is good for reducing risk but may not maximize return. And mutual fund do carry an expense ratio. Though I do understand that the expenses are on the lower side, but still there is an expense ratio, and why should I pay if at all that thought process comes? Then these are kind of limitations of mutual funds. Trail commission. This is applicable in case of a regular plan. Trail commission means amount which I pay to the distributor or advisor. Amount which I pay to the distributor or advisor, and this is directly paid by the asset management company. We personally don't pay, directly paid by the asset management company, and in the end our returns will go down because this commission is paid to the distributor. You don't want to pay the commission, direct plan is there, but selecting is difficult there. Expense ratio, it includes all the expenses which are incurred to manage the funds. Generally 2 to 3% can be there, but there are certain SEBI regulation, includes fund management, travel, custodian, consultancy, advisory, audit, registrar, and it is very essential that we monitor this because higher expense ratio will reduce the returns of the investor, and if returns go down, our wealth will go down. I'll show you the trail commission part as well as the expense ratio impact here. This is what the fund is earning. This could be 25%. In this, expense will take away this, commission will take away this, and you will get only this much. You will get only this much. You are earning 25, 2% here, 1% here, 22 is given to you. 22 is given. Expenses are deducted directly from assets, reflected in the NAV. Now, I'm not billing it separately. Percentage of AUM charged annually, subset of regular plan paid monthly for the distributor. Paid monthly for the distributor. So earn that much, pay all this, and the net return will come to the investor. This is the trail commission part and the expense ratio part. Side pocketing. Okay, a very, very useful concept which people have used it in the past. Some of the funds have also used it. See, there is a category of funds called debt funds. What does a debt fund do is, the debt fund or a bond fund invest in company 1, company 2, company 3, company 4, company 5, company 6 bonds. They are investing in bonds. Now, bonds carry one risk called default risk. If some companies default, the value of the bond can go down significantly. It's not like equity which daily changes value. Here, all these are worth full money, but this may have reached value of 25%. C4, the company 4 bond, default has happened. Because of the default, the value has gone down significantly. So what SEBI norms allow is, you can leave these as part of the main mutual fund and one NAV for this. And this is called C4 alone, side pocket mutual fund. Side pocket mutual fund. Side pocket mutual fund. The company 4 alone will go to a separate bucket. That is like you have 10 apples, 9 good apples, keep it in good MF. 1 rotten apple, take it to a side pocket. Take it to a side pocket. Side pocket separates risky or stressed asset from a debt fund's other liquid and cash. Because if some bad fund is there in a company or bad company is there, all investors will say, no, I don't want to continue with this mutual fund. I want to go out of the mutual fund. That is why what they do is, money linked to a stress asset gets locked. It goes to a side pocket. From the side pocket, no money can be paid till the money is recovered. From the side pocket mutual fund, stressed until recovery, avoids forced distress sell. Avoids forced distress sell. In the past, Franklin Templeton and HDFC Mutual Fund has done side pocketing. I'll show you side pocketing with an image also. These are the companies. The good companies are here, and the bad one is pushed down. The bad one, the main portfolio and the side pocket and the side pocket. Whenever side pocketing is done, assets will go down, NAV will go down of the main fund, and the side pocket will have some NAV. For example, the main fund had an NAV of 20. Somebody has defaulted. So the main will have 16 and the side pocket may have 1 or 2 rupees only, not the balance 4. It can't be balance 4 because there is a loss which has happened. So now if you are exiting out of the fund, you will get 16. That side pocket MF will continue till the recovery happens. Till the recovery happens, no entry, no exit in the side pocket mutual fund. No entry and no exit in the side pocket mutual fund. Very prevalent, very useful in case there is a default which happens. And for bond funds, it is not for equity type of funds. It is only for the bond funds. Only for the bond funds. Maybe I'll give you numbers also. Let us assume you have 2000 crore main fund, 200 crore units are there, 10 is the NAV. In this, a 400 crore asset defaults, some problem. If there's a problem, this will become 1600 divided by 200. 8 is the main fund NAV. 8 is the main fund NAV, and 400 by 200 should be side pocket. But the problem is the value will not be 400. The value may be only 100 for this. The worth of this 400 may be 100. So main fund will be 8 NAV. The side pocket will be 50 paise. Will be 50 paise. This is a concept called side pocketing. This image tells you preventing a single stressed asset from sinking an entire debt fund. Entire debt fund separately. Good apples, bad apples. Rotten apples are kept separately. The good one are kept separately. Divergence of return against the benchmark called tracking error. How to compute tracking error is again there in our concept book. Basic concept is, in case you have a passive mutual fund or an index mutual fund, they invest Nifty 50 mutual fund, invest in Nifty 50 companies. So ideally, the returns of Nifty 50 index fund should be equal to the return of Nifty 50. But there can be difference in the return because of all of these. transaction costs are there, AMC fees is there, fund expenses, sometimes some cash is maintained and we are not earning returns on that, or the sample which we have taken is bad, but we should have as low tracking error as possible. As low tracking error as possible. If you see question 9 got tested once, how to measure divergence or deviation that replicates any benchmark, that replicates any benchmark index. Benchmarks is Nifty 50 or anything. This is technically called tracking error. In our concept book, there's also a problem to solve tracking error. Do go through it because ICA may ask a problem solving also. How to evaluate the performance of a mutual fund? In our analysis, we learnt about Sharpe ratio, Traynor ratio, Jensen's alpha. These were quantitative parameters, almost that. Quantitative parameter means risk adjusted returns. What is risk adjusted return? Is the return as compared to the risk taken. Return as compared to the risk taken. Are they superior or not? Is there a Jensen's alpha being generated? Alpha is actual return minus the required return. Compare Apple with Apple to the peers. SBI small cap, Nippon small cap, HDFC small cap. How is the performance? Return across cycle, bull market, bear market. How is the performance? And ratios are Sharpe, Traynor. There's a ratio called expense ratio, which we have already understood. And a variant is called Sortino ratio, which considers only the downward deviation. It considers only the downside deviation. Normally, Sharpe ratio considers standard deviation. Standard deviation considers upward as well as downward. Sortino considers only the downside deviation in the performance. These are qualitative parameter. Qualitative means subjective. What are the things? Quality of the portfolio. The companies where investments have been done, are they good companies or bad companies? What kind of investments have been done by the investor? Quality of portfolio. Track record and competence of fund manager. For example, Parag Parikh Flexi Cap Mutual Fund. There, the person who has been managing the fund, he is doing it for a very long period and he has good credibility in the market. So what is his track record? What is the credibility of the person who is managing it and the credibility of the research team or the fund house team? These are subjective parameters to assess the performance of a mutual fund. Okay, we talked about the fund manager role, the importance. Now comes role of a fund manager. In a role of fund manager, let us understand there are two types of funds: active funds, passive funds. Passive means index funds. My job is to just mirror the performance of an index. Active means I'll be doing stock selection. So if it's an active fund, earning returns is very critical. Alpha. You have to earn superior returns. Passive funds, low tracking error. Very less tracking error. Focus is on no tracking. I just want a passive fund to mirror the performance of the index, which is critical. If it's Nifty 50, give me Nifty 50 return. I don't know higher returns. Nifty 50 returns, you give me exactly. That is the role of a passive fund. Here, no alpha generation, no tracking error, and here generate alpha. Apart from other things are more of operational, compliance with SEBI, AMFI rules and regulation, monitor the performance, monitor the industry, wealth creation for investors. If you have outsourced any work to an outsider like your custodian or the outside RTAs, all this, have control over all that. But the primary part is earn alpha or no tracking error, and others are more of compliance or operational in nature. And the last question, role of FIIs in mutual fund. First of all, FIIs have been making Indian markets highly unstable over the last few years. You have been seeing them continuously selling, and that kind of impacts our stock market. FIIs are the large foreign group institutions who invest in India. They can invest directly in stock, hedge funds, pension funds, mutual funds. These people are extremely critical because if they are exiting then global confidence in Indian markets are going down. And these are the role of theirs. First of all, the main thing, they give capital. Because FIIs are investing, most of the companies improve their corporate governance. This also improves the competition within the market. When I say competition, in the stock market, when there's a buying and selling happening, if there are many buyers and sellers, it kind of leads to better price discovery, and they may also generate employment because capital is provided. With this, my entire discussion on MF chapter is over. So we have discussed a lot of points. I will try to revise this. Whenever you are trying to read MF again, focus just only on this last 5-minute kind of an explanation, because once you know everything, this 5 minutes is sufficient. First, what is a mutual fund? Take money, pool the money together, invest in companies and earn returns for the investor. Classification, functional classification, open-ended, enter, exit at any time, close-ended, enter at one time, exit at the end. Interval funds, enter and exit at predefined timelines, could be month end, quarter end, anything. Second, portfolio classification, equity funds, invest in equity shares, could be investing in growth funds. Growth funds is long-term wealth creation. Aggressive, high risk kind of funds. Income, invest in dividend yielding companies. Debt funds, invest in bond funds. Bond funds means investing in bonds, debentures of companies and government. Gilt funds, invest only in government. Invest only in government companies. Third, 9 special classification. Index funds, invest in Nifty 50 companies or Nifty next 50. International fund, Indian fund, investing in US. Offshore fund, US first, investing in India. Sector funds, invest the entire money in one sector like pharma or technology. Money market, invest in money market instrument. Fund of funds is investing in multiple other mutual funds. Capital protection, first protect the capital by investing in high credit rated debt instrument. Balance can go to equity. Gold fund will invest in gold. Silver fund will invest in silver. And Quantus, the fund selection through data driven algorithm, and it eliminates human bias. Third, ownership classification, public sector sponsored by companies from the public sector like SBI, private sector sponsored by companies from private sector like HDFC Bank, foreign mutual funds sponsored by companies from outside India like Franklin Templeton. Direct plan, you can buy a mutual fund either through a distributor or directly on your own. When you invest directly on your own, it is called a direct plan. This will have lower expense ratio, higher NAV and higher returns, but selection could be a challenge. What are the schemes we have? Balanced fund, which invest in debt as well as equity. Equity diversified funds, these funds are going to invest in multiple companies, multiple sector. ELSS, ATC benefits. Sector fund, invest in one sector. Thematic fund, invest in one theme, multiple sectors. Arbitrage, exploit the difference between the spot and futures and earn profits without taking risk. Hedge fund, nothing to do with no risk. Hedge funds is aggressively managed funds which invest in high risk instruments. Cash fund, money market instrument. ETF, listed in stock exchange. Fixed maturity plan, close-ended scheme with a fixed maturity or end period. Advantages, professional management, convenient administration, you can have a lot of flexibility, SIP, SWP, transparency, higher returns, lower cost. All these are benefits of mutual fund. Disadvantages, no guarantee of return. Diversification may not lead to the best return, reduces risk, but best return may not come. Selecting the fund can be a challenge, and sometimes the cost factor. Trail commission is the commission paid to the distributor. Expense ratio is the average expenses incurred in managing the fund, and this leads to this. You earn gross 25, expense takes away 2, commission takes away 1, and investor earns only 22%. Side pocketing is applicable in case of a debt fund. There are 10 good companies and 2 bad companies. Good companies will continue in the main fund. Bad companies will be shifted to a side pocket fund. The NAV will fall when the side pocket is created, and the original, the main fund NAV you can buy and sell. The side pocket one, they will not have any exit allowed till the recovery is done. Divergence of return versus a benchmark is measured through tracking error. The tracking error should be as low as possible. It can occur because of transaction cost, AMC fees, expense ratio, not able to manage the funds, not able to mirror the performance, not selecting the companies properly. Some issues happen there. Then there can be a divergence of the return. How do I evaluate the performance? Quantitative measures and qualitative. Quantitative risk adjusted returns are alpha generation, Sharpe, Trainor, expense ratio, Sortino ratio, peers comparison, industry comparison, cycles comparison. And qualitative is looking at the fund manager credibility and the fund house credibility and the quality of the companies which we have selected. Next, what is the role of a fund manager? Actively manage funds, generate alpha. Passively manage funds, no tracking error, and take care of operational things like compliance, monitor the performance, create wealth for investor, and there should be control over any outsourced work which is done. Role of a foreign institutional investors. FIIs are those people who are investing in the company in Indian market, and these are big investors. They impact our Indian markets because if FIIs are entering into the country, it means there is a good confidence about the country, and if they are exiting, there are doubts about the companies or the economy's performance. They provide capital. With the capital, employment opportunities can be generated, and it can also enhance the corporate governance metric. With this, our entire discussion on mutual fund chapter is over. Okay, let's now move to chapter 14, which is on mergers, acquisitions, and corporate restructuring. When we did problem solving, we would have learned that there is an acquiring company, there is a target company, and it is acquiring for certain synergy gain. The gain could come from your operation side or from the financial side, and we would have learned various terms like the gross cost of merger, net cost of merger, acquirer share of gain, target company share of gain, how is exchange ratio determined. All that is the practical problem solving. Now coming to the theoretical part, we broadly have almost the same things, but along with certain strategies and other things will be discussed, and a question on this got even tested in May 26 exam in the MCQ section. What is the rationale for M&A? Rationale is very limited or very simple. I want to ensure that the combined value means the merged value is 20,000, and which is greater than 10,000 plus 6,000. The individually the value is 10 plus 6, and when you merge it together, the value is 20,000. So the value of the merged firm should be greater than the sum of the parts. How can these happen? If there are operating economies. Operating economies means very simple. Economies of scale benefits either on the revenue side or on the cost side. Combined performance exceeds what each firm could achieve alone. Example, Tata Steel and Chorus in 2007. Diversification, that is the second reason why a merger may happen. Diversification means getting into some unrelated business to get benefit of diversification, or technically to reduce the risk of the overall business. Merging unrelated business reduces overall risk and lowers the required rate of return. We did learn about this concept in portfolio chapter, where if I merge two companies, or if I create a portfolio of multiple companies which are having negative correlation, indirectly that will help in reducing the risk. Good performance in one business may offset the bad performance of a second business. Taxation benefits. This is applicable in case there is a loss-making company and it is getting acquired by a profit-making company. A loss-making company is getting acquired by a profit making company. Objective is very simple. When a loss making company is acquired by a profit making company, there's a possibility to set off and carry forward the losses, and the profit making company will have lower tax outflow, faster growth. Individually, I'm growing at 10%, but if I acquire a lot of companies, I may grow at 25-30%. M&A shortens the time of the market versus organic. Organic means growing on your own. And if you do a merger and acquisition, you'll be able to scale up faster. You'll be able to scale up faster. Again, examples are Reliance Jio's rapid expansion and consolidation of market and power, technically consolidation of the market share. I have my market share and I want to consolidate that market share. For consolidating the market share, two companies which are into the same business may combine together. Example, Vodafone plus Idea together become VI, and here, because they are into same businesses, now they are having a better market share, better pricing power, reduced competition. Somewhere that merger is not very successful merger, but this is something which we can do. And as I've been doing, I explain in the PPT, and you can see more explanation in the theoretical material. Next, what are the various forms or types of merger? Whenever a merger is happening, we may do multiple types of merger, and an MCQ oriented question can come here. First merger is competition plus competition, technically called horizontal merger. Classic example, Vodafone plus Idea is called as a horizontal merger. Horizontal merger, competition plus competition. Example, two cement manufacturers, I can call two telecom companies merging together. Increases market share, reduces competition, achieve the economies of scale. Second type of merger is supplier plus customer or manufacturer. For example, Maruti Suzuki buys out a company which supplies any parts to MSIL. Maruti Suzuki acquires a company which supplies any parts for the manufacturing of car. It could be supplying tires, or could be supplying steel, could be supplying some plastic product, could be supplying certain parts. You acquire them. Supplier plus customer or manufacturer, secure supply, reduce cost, and improve the efficiency. Tata Motors acquiring a tire manufacturer. Conglomerate merger means two unrelated business joined together. Purpose is diversification, technically called as risk reduction. Purpose is diversification or risk reduction. Pharma company acquiring a hotel chain. Pharma company. There's no link between a pharma business and a hotel business. Conglomerate, entirely unrelated. Congeneric, they are unrelated or they are different, but some relation can still be there. Some relation can still be there. A classic example, a mobile phone company acquires a tablet manufacturer. Mobile phone company acquires a tablet manufacturer. They are not related business. They are not related business, but still they are not exactly the same business, but still there is some amount of relationship. It can help you in extending the product line, or I use my existing distribution. Wherever I sell mobile phone, same place I sell tablet also. And cross selling means when I'm selling mobile phone to the same customer, I'm trying to sell the tablet. That is called congeneric merger. Different but related. Horizontal, competition plus competition. Vertical, supplier plus customer. Conglomerate, entirely unrelated. Congeneric, different but related, different but some amount of relation is there on the product line or on the distribution line or cross selling. Reverse merger, a private company getting acquired or acquiring a private company. For example, let us take a private company which is highly successful, has 1,000 crore revenue. It acquires a listed shell company. Shell company means turnover around 1 CR are not there. So the purpose is the private company, instead of doing an IPO, acquires a listed shell company, and then the management changes and the private company manages that listed company and also renames. There could be a rename of the listed shell company. Acquisition means not acquiring the full entity, 50-60% you acquire in the other entity. So here a theoretical MCQ may come: horizontal, competition plus competition; vertical, supplier plus customer; conglomerate, unrelated plus unrelated; congeneric, different but some relation is there; reverse merger, private company buying out a listed shell company; and acquisition is getting a controlling interest. Unrelated companies coming together explain conglomerate merger. To see this, understand here. ITC Limited would have acquired certain businesses in all these segments. They were primarily a cigarette or a tobacco manufacturer. Now they have hotels and hospitality segment, which I think they have demerged also. FMCG segment, paperboard segment, agri-business, information technology. So they are acquired lot of unrelated businesses purely for the purpose of diversification. But despite they being unrelated, there could be some relation or some linkage. In congeneric merger, the linkages, I'm using same distribution. Here, the purpose could be that I want to utilize the financial resources which are there. I want to utilize the financial resources which are there in the company. That is, the ITC as a whole has a lot of money and I want to use them. Or enlarged debt capacity, enlarged ability to borrow more debt. And synergy of the managerial. Managerial means somebody is going to take over the management. Somebody is going to take over the management, or you have a CEO who is just managing one business. Can he manage multiple businesses together? So we make better utilization of his capacity. Synergy of managerial function. What are the various takeover strategy? Takeover strategy means I am trying to acquire the tactics adopted by the acquiring company to acquire the other entity. There are 4 tactics they talk about. Street sweep. Street sweep means quietly the acquiring company buys a large number of shares from the stock market. Quietly I sweep the shares of the other entity. Quietly I sweep the shares of the other entity. That is called street sweep. Quietly buying large number of shares from the stock market before making an open offer. Bear hug. Bear hug basically means the acquiring company makes a very attractive offer. Attractive offer. Bear hug, the literal meaning is the acquiring company is giving a tight hug to the target company and you are not able to escape from the same. Makes a very attractive acquisition offer, usually at a premium, and because this is made to the board of management, very high offer, 500 rupee, 700 is offered, the board is somewhere forced to accept it. Strategic alliance means I tell the other entity, I'm not acquiring you. Let us make an alliance. Let us work together. Let us do some joint marketing. After all this happens, if the other entity feels yes, it is a very good fit for us, maybe the acquisition can pass through. Gains influence, trust, and business integration, making a later takeover easier. Brand power means A wants to acquire B using the strength of some powerful brand. I weaken the brand of B and then acquire A and then acquire B. Use a stronger brand to weaken the target's competitive position before acquisition. I'm using my own company's trend only, using my own company. Company A wants to acquire company B. Company C is a subsidiary of company A or a part of company A, a segment of company A. Using a strong brand, weaken the brand. After it becomes weaker, it will say, I give up, you please acquire. Street sweep, quietly acquiring large number of share. Bear hug, giving a tight hug so that you are not able to escape. Strategic alliance, making a joint venture first and then later on you get acquired by the other entity. Brand power is basically using the strength of your brand. You are trying to, using the strength of your brand, you weaken the other company and acquire a weakened company. Okay, like AC has certain takeover strategy, TC has the strategies to protect itself from the hostile takeover. Hostile means I am not comfortable with the takeover, but still the other company wants to acquire. The first one is divestiture, and a related one is crown jewel. Divestiture means selling a part of the business. Selling a part of the business or an asset or a trademark or a patent. Crown jewel, selling the most important, that's the only difference, selling the most important asset of the business. So divestiture means I sell or spin off a business or a division or an asset, makes the target less attractive. Company separates its profitable IT division. Crown jewel, most valuable. The most valuable asset is sold. Most valuable asset is sold. Company sells its most famous brand or the patented technology. Then poison pill. For poison, again two things are there. Poison pill, put. Pill is given with the help of existing shareholder. This is for debt holder. For example, I tell my existing shareholders, or I have a clause in my rules that existing shareholders will get discounted shares or lower value shares in case there's a change in control. Existing shareholders receiving the discounted share, or I give convertible debt to my existing shareholders, convertible debentures to existing shareholder. So in case there's a change in control, 100 shares are there, existing guys now hold 60, the new company has acquired 40, then they make it 50-50. The existing shareholders with their debentures can convert the debentures into shares, and their 50% can again go back to 75-80%. Takes action that make the turnover more that make the takeover more expensive or unattractive, primarily for the existing shareholders. Poison put is for the debenture holder. I tell my debenture holder that in case there is a change in control, you can use these bonds and demand early repayment. At a premium. Poison pill is for the shareholder. Poison put is for your debenture holder. Green mail and a related area is Pac-Man defense. Green mail, Pac-Man defense. Green mail means acquiring company has purchased some shares of target company. They've already purchased some shares. The TC tells I will buy back. TC will buy back the TC shares itself. The target company will buy back the target company shares. Target company will buy back the target company shares at a premium. At a premium. Green mail means, green technically here means cash. With the cash, I am blackmailing the acquiring company, telling them, please don't do this acquisition. Don't do this acquisition. Whereas Pac-Man defense means target company now starts acquiring the AC. Target company now starts acquiring the acquiring company, makes a counter bid to acquire the hostile bidder. To acquire the hostile bidder, I am trying to acquire. So Pac-Man defense is your green mail is buying back your own shares. Pac-Man defense is hitting a 6. You are trying to acquire my company by maybe bowling a yorker, and now I am trying to hit a 6 and saying that no, it can't happen. Now I will try to acquire you. White knight and white square, again related area. White knight means a friendly company acquires the full entity or major entity. White square means acquires a minority stake. Maybe a 20-25% stake is acquired. White knight, major acquisition, full acquisition or majority acquisition. White square, minority acquisition. Golden parachute is for my board of directors or the managers. I'm promising large compensation to managers if they lose their jobs after a takeover, and because of this the acquiring company doesn't want to acquire the target company. So defense strategy, divestiture, crown jewel interrelated. Divestiture means selling a part of the business. Crown jewel is a part of the divestiture where you sell the most valuable asset. Poison pill is for existing shareholder. Put is for debenture holder. Green mail means blackmailing the acquiring company and telling them that I will buy back my own shares at a premium. And Pac-Man defense is hitting a 6 and telling that I am now going to acquire you. White knight, majority stake by a friendly company. White square, minority stake by a friendly company. Golden parachute, large compensation to the managers if they lose their jobs after the takeover. Reverse merger, we have already seen. Reverse merger means a private company which is bigger in size is getting acquired by a listed shell company. So in a reverse merger, a smaller company gains control of a larger one, also called as backdoor listing. Example, they are saying larger asset base. The asset of the transferor company is more than the asset of the transferee company. The equity shares issued. For example, the listed company originally had 1 crore share and now they are issuing 10 crore share. So it becomes 11 crore share and the equity is now owned by the TC shareholders. Control changes, the TC shareholders or the TC management starts taking care. One example they have is ICICI Limited. ICICI Bank, a larger financial institution, was merged into a smaller banking subsidiary to create a universal bank, a classic India reverse merger. A smaller company acquires a bigger company and then there's a change in control. The smaller company or the TC has more assets, more equity is issued, and there's a change of control. What is divestiture? Divestiture means selling a portion of its business or undertaking to another company, portion of business. And crown jewel is a part of divestiture where you sell the most prominent asset. Why should I do divestiture? Focus on core area. I am having 20 businesses. I am not able to manage all the 20 businesses. So let me focus on the top 10 business. Balance 10, I divest, make it separate companies or sell them to someone else or do something called as a equity carve out. You will understand as we proceed. Weak revenue contribution. Those businesses are not even contributing anything sizable. If they're not even contributing anything sizable, what is the purpose of running them? Too large to handle. Now, I have become a very, very big company, and my management, MD and other people are not able to manage this properly. And if there is any money requirement, I sell my part of the business to explore some other opportunity. The divestiture can be done in multiple ways. Sell off or partial sell off. Sell off or partial sell off. Sell off means I sell a part of the business to another company, get some cash. I may sell the full division or a partial division. Spin off. Spin off basically means, see, sell off. Let's take the example itself so that it's easy. ITC has A, B, C, D. Sell off means D is sold to Tata Motors. Spin off means D becomes a separate company. D becomes a separate company. Same shareholders receive. So now D is owned by the same shareholders of the ITC Limited. Same shareholders of the ITC Limited. And in this case, Steel Division became Steel Limited. Split up means ITC is removed and now it is A Limited, B Limited, C Limited and D Limited, 4 separate companies, several independent companies. Equity carve out means A becomes a wholly owned subsidiary. A becomes a wholly owned subsidiary, and then I do a partial sale of shares in this through maybe an IPO and earn some money. Equity, new company created, some shares are sold. Some shares are sold. Sale of a division is more like a sell off or a partial sell off. And family managed demerger means you are trying to split the businesses into multiple, and every one son may manage one business, one daughter may manage one business, another son may manage another business. So they may do various forms, sell off or partial sell off. Sell, get the cash. Equity out, get the cash. Sale of a division, get the cash. In spin off, a new company is formed, no money comes in, parent company still survives. Split up, multiple breakup is done, parent company does not survive here. Parent company does not survive here. And family managed demerger depends on the structure, and the parent company may or may not survive. Various ways of doing ownership restructuring. What is ownership restructuring is, today ITC 70% promoter, just an example, there this much stake is not there, 30% public. I want to change the shareholding pattern. How can I do? That is called ownership restructuring. One simple way is to do buyback of share. In the buyback, if promoter do not participate and public alone participate, then their percentage shares may go up. Company repurchases its own share. Going private means promoter is saying we are delisting the company and telling the public that I will pay for your shares, or you also be part of my private limited company. Some may agree, some may not agree, and the ownership percentages may change. Management buyout means business is not doing well, and I tell the board of directors, CFO, CEO, telling them that do you want to control this company and please buy the business. Promoter sells their business to the managers. Company's own management purchases the business or one of its division. Leveraged buyout means an acquisition is going to be done, mainly financed through borrowed funds. Mainly financed through borrowed funds. An MBO can also be an LBO if the manager means CFO, CEO, COO, the sales officer, marketing officer, all these guys buys out the entity. All these guys buys out the entity through borrowed funds, going private is delisting, equity buyback, or an MBO route or an LBO route. What is the difference between a management buyout and leverage buyout? Management buyout focuses on basically who is buying it. Management buyout focuses on who is buying it. Leverage buyout focuses on where the money is coming from. Initiator, internal management team, mostly a PE firm will acquire a venture capital firm. Internal capital plus some debt, highly leveraged, greater than 50% debt. Purpose, some of the non-core division, I want to sell it to the person who was managing those businesses, get some cash flow, and that person goes out of the company. Here, improve the efficiency and increase the cash flow. Tata Tea acquiring Tetley, 77% debt. This is one of the biggest LBO. Tata Steel buyout of Chorus. Chorus remains the largest LBO. MBO, who's buying it? LBO, where is the money coming from? How can M&A unlock value? M&A can bring value benefit or unlock value because of the initial benefits we saw, either an horizontal benefit or a vertical, that is a better pricing power, or a diversification benefit, or a loss making company getting acquired. Some of these will come here. Horizontal growth, optimum size, market share, capacity utilization. Vertical combination, cost economy and elimination of duty. Resource mobilization, synergy benefits. Shell companies, your reverse merger kind of a scenario. What are the steps in an M&A and reason for failure? See, an M&A can't happen just like that. To do an M&A, a lot of planning is needed. So first, there's a pre-acquisition phase where we are deciding what kind of companies do we want to acquire. I want to acquire a auto dealer. Screen the candidates. When I find there are 20-30 good auto dealers are there, eliminate out of the screened candidate, and whoever is good, value them, negotiate, and do a post-merger integration. I am a Maruti Suzuki company and I want to acquire some 5 auto dealers, technically called as a vertical merger. Why do, after doing all planning, still fail? Overpaying. I acquired the dealer for 1000 crores. The real worth is only 500 CR, but you pay more. Why? Because you overestimated the synergy gain. You felt that lot of synergy gains will be there, and because of this, you overpaid the other entity. Poor integration. Post merger, the integration is not good. Somewhere the culture of the two entities are different. The way both the companies work is different. The employees are not gelling well. Because of this, all these issues, and yeah, this is more like the psychological barrier or the people resistance leading to poor integration. Cross border M&A basically means the acquiring company and the target company are from two different countries, global growth, target and acquiring are in different country. Tata Steel Chorus, that is UK, Chorus is part of UK. Tata Motors JLR, Sun Pharma and Ranbaxy deal. Objective is globalization of production and distribution. I want some products to come from Nepal, some products to come from Bangladesh, some from Sri Lanka, some from USA. I want to source some products there. I am acquiring an entity there. Global economies, expand the trade and the customers. Sometimes some taxation benefits can be there. And the other reason they are saying privatization of the state-owned enterprises and consolidation of the banking industry. Privatization is any PSU company, when they want to privatize, maybe a part of the stake could be given to a foreign player. globalization of production. Major purposes to have expand the customers and suppliers and products in other location. Can company with no commercial operation raise capital via an IPO? Whenever we do an IPO, we release a draft red herring prospectus. The prospectus will have to tell what business the company is doing, what are the risks it carries. All that is mentioned in the IPO document or the DRHP. But here, business itself is not there. But still, we have something called as special purpose acquisition company. Special purpose acquisition company, also called as a blank check. Check is given. I really don't know where the money will be used. I give money to this SPAC. SPAC raises the funds, keeps it in a separate account called as escrow account. They identify a target company, sign a merger, shareholders approve, mergers passes through, and the target becomes a listed company. In case you are not able to do this, you will have to return the money. You will have to return the money to the shareholder. So advantages is access to capital, lower transaction fees, and negotiate with one entity instead of the thousands of investors. The problem here is you don't know whom you are acquiring, so whether money will be raised or not, and there are certain regulatory issue because there is no specific framework for special purpose acquisition company, and SPSE generally take 2 to 3 years to identify a target and then acquire them. Some of the sell side imperatives. Sell side imperatives means generally till now we were saying why an acquiring company is acquiring. Now, why does a target company want to sell? A target company may want to sell if they are not able to do good business on their own. They are running short of money. They feel they'll get good synergy benefit when they become part of a bigger company. So market pressures have become very weak. Increased competitor pressure make the sale inevitable. Nokia mobile phone, which used to be a very good brand, got sold to Microsoft. Tech lag. I'm not able to have new technologies, new R&D developments are not there. So please get acquired. Capital deficit, money is not there. Strategic focus, I want to do a divestiture because I want to focus on other business, and maybe a good opportunity came. And geographical presence, improving the geographical presence also, you may do a from the sell side there is a pressure to do a acquisition or a merger. All these are discussed as we usually do. Let's quickly revise them. First one, what is the rationale for M&A? Rationale is very simple. Value of the merged firm should be greater than the value of the sum of the parts. It may happen because of economies of scale benefits, your operating synergy benefit, some taxation side benefit. We have to do consolidation of market power or market share, diversification. These are the reasons why M&A may happen. What are the various types of merger? Horizontal, competition plus competition. Vertical, supplier plus customer. Conglomerate, two unrelated business. Congeneric, different businesses but some relation could be there. Reverse merger, smaller company acquiring a bigger company. Acquisition means not full acquisition. We are acquiring some 50-60% of the other entity. Then unrelated companies are joining together, that's conglomerate merger, but still there could be some relationship. The relationship could be that I want to use the available cash, want to use better utilization of financial resources, or improve the debt capacity which is available, or use the managerial function better, synergy of managerial function. Takeover strategy means when I'm acquiring another entity, what are the ways I can take it over? Street sweep means gradually acquiring some shares of the other entity and then trying to make an open offer. Tight, your bear hug, where I'm basically telling the other entity, that I am going to make an open offer. I'm threatening the other entity. Strategic alliance is forming a partnership, and after the partnership is formed, you then try to acquire it. Brand power, using a stronger brand to weaken the entity and then acquiring it. What are the strategies to protect, like acquiring company as strategies? Hostile takeover. Hostile means not a takeover, which I generally agree. Divestiture, selling a part of the business. Crown jewel, selling the most important segment of our business. Poison pill, giving certain extra benefits to existing shareholders, which because of that, once the merger happens, it will become unattractive for the target company. Poison put, giving something to the debenture holder. Green mail, blackmailing the other entity, saying that I will buy back my own shares with the cash, and telling them please don't do it. Pacman defenses, hitting back, saying that I am going to acquire your entity, like you acquire my entity, I'm going to acquire your entity. White knight, majority stake is purchased. White square, minority stake is purchased. Golden parachute means giving some hefty compensation to the CEO, CFO, saying that in case a merger happens, you will lose their jobs, you will get a huge compensation. Because of that, the target company is not trying to acquiring companies not trying to acquire it. Reverse merger is a process where a smaller company acquires a bigger company. The target company has more assets. The target company will have more shares. The target company will retain the control, or will take the control of the entity. Divestiture means selling a part of the business or a part of the division or more division. Why are we doing? I want to focus on core area, negligible contribution. It is becoming too large to handle, or if there's any urgent cash requirement. What are the ways to do divestiture? Sell off or partial sell off a division or a partial sale, get some money. Spin off means make it as a separate company, you don't get any money there, and now it is owned by the same set of shareholder. Split up means the parent entity is broken down into multiple companies. Equity carve out means do a spin off. After doing a spin off, do an IPO for a part of the share. Sale of a division is sell off, and family managed demerger. Ownership restructuring is changing the shareholding. You can do it through management buyout, where the CFO, CEO buys the business. Leverage buyout, another company buys it primarily through borrowed funds. Or you can do buyback of shares, where the shareholding is changing. Or you can do delisting, going private. MBO focuses on who buys it. LBO focuses on where the money is coming from. MBO, mostly the non-core divisions will be exited there. LBO purpose is to improve efficiency and improve cash flow. How can M&A unlock value? M&A can unlock value because of the benefits which we saw: diversification benefit, or reverse merger kind of a benefit, or better pricing power, better competition intensity. All these are the reasons why M&A can unlock value. M&A can unlock value. Horizontal growth, vertical growth, resource mobilization. Shell company, that is changing the ownership of a shell company or acquiring industrial license. Structural synergy. Steps in an M&A program: first, do the pre-planning, what kind of company you want to acquire. Screen the candidates, eliminate some of them, rest you do the valuation. Negotiate, do the merger. Still it may fail if you have overpaid, overestimated the synergy benefit, post-merger integration is bad, or there are people resistance, called psychological barrier. Cross-border M&A basically means that the M&A is between an Indian company and a non-Indian company. The acquiring and target company are out of two separate countries. Purpose: to expand your customer base, to expand your supplier base, to expand your product base, or to get certain fiscal benefits which are there in specific country. Can a company with no commercial operation do an IPO? Yes. Special purpose acquisition company. Purpose is to acquire another entity. Money is raised, kept in an escrow account. Target is identified. shareholders approve it, and then it goes through. It does face challenges because there is no specific regulatory framework for this. Sell side imperatives. Sell side is, why do I want to sell? I need money. I am a weaker company now. I'm not able to run my business properly. I do not have technology, good technology. Market pressure is there. I want to sell my business, or I got some good opportunity, or I want to focus on other companies. These are the reasons why I may want to sell my business from a target company point of view. We have covered all the concepts really well. Any place you have a doubt, you can send me a message. With this chapter is over. Thank you, friends. Okay, we now start with chapter 12, which is on interest rate risk management. We have done the practical part of it where we learned what is interest rate risk. We also learned the various techniques which are available for hedging this, like interest rate futures, forward rate agreements, caps, floors, collars, swaps. Post understanding all this, let us now get a theoretical understanding part as well. Now, as I did in my other chapters, I will try to do it through a PPT. I'll keep shuffling between the two. The first question is how interest rates are determined. Now, interest rate is a primary factor which influences investments in a country, and RBI has a lot of restriction, or RBI controls this number a lot. The first factor is supply and demand of money. As we are aware, any product, the price is influenced by supply and demand. Apple prices go up if there is a higher demand, lower supply. Similarly, interest rates will go up if the demand for money is more than the supply for money. For example, when economy growth is robust, lot of people want to expand, demand for money increases. If demand for money increases, you will naturally see the interest rates going up. And in case the demand for money goes down, which happens during slowdown and other things, that time RBI tries to reduce the interest rates, make it easily accessible, money easily accessible, and people start doing investments again. Inflation, a factor which has a direct correlation between the inflation and the interest rate. Higher inflation, interest rates will go up, and lower inflation, interest rates will go down. Logic is very simple. When you have higher inflation, the value of the money goes down at a rapid rate. The value of the money declines at a rapid rate. So that time, whoever provides you money, you need to compensate them with a higher interest. Government actions and RBI action. Government borrows more. The availability of money for private sector decreases. So high borrowing by government, demand for money increases, interest rates go up. So it is basically demand and supply part. Similarly, if you have something like open market operations, what is open market operations? Is RBI may buy the government securities or sell the government securities. If RBI through open market operations gives money to commercial banks, then automatically the interest rates will go down because the supply of money increases. And if the supply of money decreases, interest rates will go up. Similarly, CRR and repo rate, statutory liquidity ratio, cash reserve ratio, repo rate. Let us see this now overall. Economy growing fast, people are borrowing more, interest rate will go up. Economy slowing, borrowing fails, interest rate will decrease. Inflation, interest rate up. Inflation falls, interest rate down. Government borrows a lot. If government borrows a lot, less money available for private sector, interest rates go up. Repo rate has a direct correlation, go up. If you increase CRR or SLR, cash reserve ratio, the availability of money for lending goes down. The availability of money for lending goes down. If the supply goes down or the demand goes up, interest rates will increase. RBI buys government security. If RBI buys these securities, banks will get more cash. They can lend money. supply increases, interest rates go. Ultimately, see whether the money supply goes up in the country or the money supply goes down in the country, and that influences interest rate. That is point number one. How is interest rate determined? Explain the concept of benchmark rate. See, benchmark rate came into picture because whenever anybody determines interest rate, if SBI determines, HDFC determines, ICICI determines, they want some basis for determining the interest rate. Randomly, if people start determining interest rate, then every company or every bank will have significantly different interest rate. So most of the banks will have some basic rate, and on top of that, they will add their margin. We would have done many questions where they'll say LIBOR plus 2%, MIBOR plus 2%, MCLR plus 1%, repo rate plus 2%. Some benchmark rate has to be there. So a benchmark rate basically provides a basis for determining other interest rates in the market. The only thing is, this benchmark rate should be determined by an independent body. For example, if repo rate is the basis of determining the interest rates in India, repo rate is determined by RBI, which is an independent body. In this, what happened is, earlier people used to use London Interbank Offered Rate, LIBOR. This has been discontinued. Reason for discontinuing this is, there were points that somebody manipulated this rate. How LIBOR was determined in the past is, they used to take rates from maybe 10 banks, 15 banks, 20 banks, and take a simple average of that or a weighted average of that, and that was called LIBOR rate. Somewhere there were concerns that people are manipulating this, because if you manipulate this, then all these settlements can take a hit. From there, they moved to multiple other things like SOFR in USA, Sonia in UK, Toner in Japan, and coming to India, India generally uses these. Repo rate, which is the rate at which RBI lends money to commercial bank, this can become a basis to determine the interest rates. MIBOR, Mumbai Interbank Offered Rate, that is the rate at which banks borrow from another in the interbank market. MIBID is Mumbai Interbank Bid Rate. This is for borrowing. This is for investment. Mumbai Interbank Offered Rate, Ask Rate, and the Bid Rate. MCLR is basically the interest rate which is determined by the bank on its own through their marginal cost of funds. What is marginal cost of funds is, I calculate the cost of funds which I raise, technically called cost of debt, maybe a cost of equity or a cost of capital. I add all the funds which I raise and get marginal cost of funds, and MCLR based they determine the lending rate. This is why benchmark rate is needed. Without benchmark rate, none of the instruments can work in the practical world. IRS can't work, interest rate options can't work, futures can't work, swaps can't work. Everything needs one benchmark rate. Okay, now comes the point 3. Different risks primarily faced by bank. Let us first understand one thing. Bank's main thing for a bank is NII, net interest income. This is the primary income of a bank. What is net interest income? Is interest income minus interest expense. A bank earns interest income, also has interest expense, and their main worry is to protect the NII, or net interest income, or they can also call net interest margin. Let us visualize a balance sheet and P&L. If I look at P&L, there can be other things. Interest income, this side interest expense, and this income comes balance sheet. This side we have asset, which is loans given. In liability side, we'll have deposits, savings account and fixed deposits. This leads to expense for the bank. This leads to income for the bank. The assets leads to income and the liabilities lead to expense. If interest rates change, the income can increase or decrease, expense can increase or decrease, and in the end, the gap may also increase or decrease. This impact is called interest rate impact on a bank. Interest rate impact. Interest goes up, income may go up, expense may also go up, and the net amount may go up, may go down. We'll see certain points over here, but this is what a bank is trying to earn. Net interest income minus the interest expense. In that, the first thing is gap exposure. What is gap exposure? Is assets, the income earning assets are 18,000, liabilities 15,000. That is the interest earning assets and the interest expenditure liability are those which have a floating, not the fixed. Floating means those which can change based on interest. This is called interest rate sensitive asset. This is called interest rate sensitive liability. Gap is 3,000. If interest rates go up by 1%, income will go up by 180. 1% of this. Expense will go up by 1%, 150. Net 30 crores I will earn. This is a positive gap situation or a favorable gap. What is gap? Is the difference between the rate sensitive asset and rate sensitive liability. Rate sensitive asset and rate sensitive. I've talked about increase. Decrease would have been the other way around. Or liabilities more, assets less. Liabilities more, assets less. The opposite can happen, and this got tested in your recent exam. You can see that question later, but arises from a mismatch in principal amount, maturity date or repricing date. Positive gap, assets are greater than liability. Negative gap, liabilities are greater than asset. Very simple. Positive gap into increase in interest rate, benefit. Positive gap, decrease in interest rate, loss. One positive, one negative. Positive gap, increase in interest rate, income will go up. Positive gap, decrease in interest rate, income will go down. Negative gap, decrease in interest rate, happy. Two negatives will ultimately improve my NII. Negative gap and decrease in interest rate, because negative gap means I have more liability and interest rates are going down. Expense will go down more, income will go down lesser. Negative gap, positive into positive or negative into negative is favorable for us. That is first point. Second point is basis risk. Basis risk is the asset and liability which you see here, same 18,000, 15,000 or any different number. The interest income on the asset changes based on repo rate. Just an example. And this changes based on MIBOR. The one expense changes based on repo rate, one changes based on MIBOR. The basis is different. The basis is different. It can also be fixed also, but fixed discussion is not happening. One changes based on repo. So my income may go up by 2%. Interest repo rate end up by 2%, and the expense side only 1% increase, or the opposite. Expense side 2% increase, income side 1% increase. That is the income. See, what is very important point is interest income depends on the interest rate, and the interest rate changes based on repo rate for the income, and for the expense it changes based on MIBOR. And if both are not moving exactly same percentage, I may get impacted. When interest rates seem to move item in different magnitude, asset on fixed rate, liability on floating rate. This is even more extreme. Asset has only fixed rate, liability has floating rate, then we are totally gone. At least in my example, I said one MIBOR and the other one is based on some other metric. When interest rates change, the impact is what we are analyzing. Embedded option risk. Embedded option means my customers to whom I have given loans, when they find any significant increase or decrease in interest rate, significant increase or decrease in interest rate, may try to do prepayments. For example, let us take an example. I have given loans at 12%, interest rate down to 8%. These customers prepay loans. These customers prepay loans. So I was earning 12% earlier. Now I earn only 8%. Now I earn only 8%. This is exactly what we did in bond refunding. Here, customers were paying 12%. Interest rate went down. They prepaid. They prepaid their loans because 12% there is the fixed rate of interest. Goes to 16%. They keep quiet. They keep quiet. They continue with 12%. This side, FD, customer deposited at 6%, and suddenly interest rate up to 10%. Interest rate went up. These guys pre-closed their FD and create a new FD at 10%. New FD at 10% versus 6%. Unnecessary extra expense. And this side, the loan which I extended, 12% income was coming. Now only 8% will come. So prepayments could be done. Prepayment of high interest loan when rates fall, or premature withdrawal of deposits when rates rise. All this will impact my NII, net interest income. Yield curve risk. Yield curve risk is, we have learned that yield curve, there were three types of yield curve. One is flat. Flat means long-term interest rate equal to short-term interest rate. Normal and inverted. This we saw when we did security valuation. Do see it in the concept book if you haven't seen this earlier. Flat means long-term interest equal to short-term interest. Here long-term interest is greater and here long-term interest is lower. Now what happened is my loans are based on long-term interest rates and my deposits are based on short-term interest rates, or the other way around. Loans are based on short-term interest rates, deposits are based on long-term interest rate. Unfortunately, the movement in the interest rates is kind of unfavorable for me. I will show this in an example in some time. Kind of unfavorable for me. When it is unfavorable, I get impacted. When it is unfavorable, I get impacted because of this. Any non-parallel movement affecting the net interest income, NII, affecting the net interest income. Price risk. Price and interest rates have inverse relationship. Price and interest rates have inverse relationship. So in case I have lot of investments made, and interest rates go up or go down, that can impact me. It can be the other way around also. Interest rates rise, bond prices fall, leading to losses. Price and yield has inverse relationship. Reinvestment risk means whatever income I'm generating, that is out of an investment. A bank made an investment in government security. It gives you income in form of coupon that has to be reinvested. If you are reinvesting it at a lower rate, here rates fall is a problem, here rates rise is a problem. Both can be offset with a concept called duration or immunization. Again, in security valuation, we saw a concept called duration or immunization. Net interest position risk. See, banks generally earn money by giving loans, taking deposits, taking savings account value. Most of the time, the banks will have more earning asset than paying liability, because in the liability they'll have current accounts where they don't pay interest. Savings account, they pay insignificant interest. So if I have more assets, less liability, interest paying liability, if there is a reduction in interest rate, again my NII will go down. Again my NII will go down. I'll now show it in an Excel in 2 minutes maybe. I'll just show you this again. Gap exposure, assets and liabilities, reprice. Reprice means change at different times. Floating rate loans funded by fixed deposit. Basis risk, different benchmark. Repo rate, FD rates is by something. Embedded option, prepayments being made. Yield curve, short term and long term interest rate. Loans, 10-year government security. Deposits, 1-year treasury bill. Price risk, inverse relationship between yield and price. Bond prices fall. Reinvestment risk, future cash flows are reinvested at uncertain. And net interest position risk basically means that in case interest rates go down, I could see a fall in my income. I could see a fall in my income. Okay, let us see examples now. Let us take that sensitive assets are 10,000, sensitive liabilities are 8,000. 10,000 into 12% I earn, 8,000 into 8% I pay, net income 560. If interest rates go up, this can become 13. As of now, my income is 560. We'll see what is the impact. 13, 9%, income up by 2580. Favorable gap. There is a favorable gap, 1% up. Favorable gap is 10 and 8, 2000 favorable. Income has gone up. This becomes from 12, 11, and from 8, 7, interest income has gone down. Favorable gap and negative gap. Going back to original example, 12 and 8. So the first one was on gap exposure. Second one, basis risk. What is basis risk? Is this 12 increases to 12.5, but 8 increases to 9. 0.5% increase and 1% increase. 0.5% increase and 1% increase. Income has gone down. Or 1% increase, 0.5% increase, income has gone up. Income has gone up. This is what interest rate risk is. 560 became 620. 1%, 0.5%. I can talk about down also. 11 and maybe 7.5. 560 became 500. Or this is 11.5 and this is 7. 590. What is the impact on income? Non-parallel movement. Embedded option. Originally this was 12, 8. People started doing prepayments and other things. So 12 became 11.5. Nothing changed on the other side. Some places there's a change, has gone down because of prepayments. My effective income has gone down. Or FD are pre-closed and new FD created a higher rate, 8.5. 8.5 became 520. The small examples. I'm just playing around there. Yield curve risk, original 12 and 8. This became 12.75. This became 8.95. 8.95, almost same number, or let me keep it as 12.5, 9. It is 530. So what is the impact on the income? What is the impact on the income because of this? This we have understood. Now, how can I hedge the interest rate risk? How can I hedge this interest rate risk? Again, more from a banking point of view. First technique is called asset and liability management. This is a framework which is given by RBI to be used by all the commercial bank. They should try to match their liabilities and assets, so that they can maximize the net earning from interest without taking major risk, without having the major risk. A classic point is, if you have 10,000 sensitive asset, maybe keep 10,000 sensitive liability and keep both on repo basis. This is the original number. Both on repo means 13, 9. Income is maintained at the same level. Income is maintained at the same level. Asset and liability management framework. Forward rate agreements. Here We have understood how FRA works when we did question. So I try to freeze a future investment rate or a future borrowing rate, and with that I eliminate my interest rate risk. These two are called traditional methods of interest rate risk management. I'm not talking much on the FRA side. The newer methods, you're aware of all the three: interest rate futures, options, and swaps. In futures, we try to lock in the interest rate by doing buying or selling of a base bond. Interest rate option, there is a cap option or a floor option, and swap is exchange of interest rate, where fixed could be exchanged with floating, floating could be exchanged with fixed. The same thing, just a quick summary with some example. ALM, matching floating loans with floating deposit. FRA, fixing a future interest rate. IRF, you sell your interest rate bond futures or buy futures. Options, cap or floor. And interest rate swap, swapping of fixed versus the floating, fixed versus the floating. With this, I am done with the discussion on how interest rates are determined, concept of benchmark rates, different types of interest rate risk. This you please understand with this example only, that how does income increase or decrease for the bank. This is their NII, income minus the expense. How can NII change? Then the methods to manage the risk. And now I come to types of interest rate swaps. In swaps, ICI metal talks about 4 swaps. Plain vanilla swap means one guy pays fixed, other guy pays floating. Fixed versus floating. Exchange of fixed versus floating. Basis rate swap means exchange of MIBOR, which is a floating rate, versus repo rate, which is also a floating rate. MIBOR versus repo rate, LIBOR versus MIBOR, two benchmarks which are variable. Example is 1 month LIBOR versus 3 month LIBOR, or 1 month MIBOR versus repo rate, or 1 month 3 month MIBOR. Anything can be done. Asset swap means exchanging one asset's income or expense with another asset income or expense. For example, gold return exchanged with silver return. I will pay gold's return to you, you pay me silver's return to me, the net can be settled. Gold return versus silver. Exchanging fixed rate investments like bonds for floating rate investments like index. You can do for bonds versus index, gold versus silver. And in all these three swap, there is a notional principle at the start. If that principle is going down, it is called amortizing swap. For every reset period, when we did one problem on collar solving, we saw that the notional principle remains same. But if the notional principle comes down, that is called amortizing swap. Some of the examples here: plain vanilla swap, interest fixed versus floating, 8% fixed versus MIBOR plus 1, 1 month MIBOR versus 3 month MIBOR, bond 7% versus MIBOR 1%, and amortizing, where the outstanding principal falls each year. The outstanding principal falls each year. Okay, our ICI material also has a term called swaption. Swaption. The meaning of swaption is swap plus option. Normally, if I enter into an interest rate swap, fixed is exchanged with floating, or floating is exchanged with fixed, and I have to mandatorily execute it. Swaption gives me the flexibility to enter into an IRS after 6 or 12 months if things are favorable. For example, I want to enter into a swaption where I'll pay fixed rate 8% versus floating rate. Fixed rate 8% versus floating rate. This is the swaption. Now, in this swaption, I will wait for 6 months. And after 6 months, if interest rates in the market are 10%, I will execute this swaption and pay 8 and receive the floating 10. Pay 8 and receive the floating 10. Pay 8 and receive the floating 10. If interest rates are only 6%, I don't want to pay 6%, pay 8% fixed rate and receive a floating rate of 6%. Pay a fixed rate of 8% and receive a floating rate of 6%. That time I will not execute the swaption, or I'll allow it to lapse. The terms will be decided by the contract. It could be that you can decide once at the beginning, and after that things can again change. So an interest rate swaption is simply an option on an interest rate swap. Option on an interest rate swap. It gives the holder the right but not the obligation to enter into IRS. Fixed rate payer swaption gives the option owner the right where he will pay the fixed interest and receive the floating. The interest will be decided earlier itself. Fixed rate receiver receive the fixed rate and pay the floating leg. There are few places this is used. I'll show a better example now. Payer swaption, pay fixed, receive floating. This will be mostly for a borrower. If I expect interest rates to go up in the economy, what will happen is I will have this IRS. Interest rates go up, use the IRS and pay a lower fixed rate. Pay a lower fixed rate, locks the maximum borrowing. If interest rates rise, exercise. Interest rates fell, ignore the swaption. Ignore the interest rate swap, because you have the flexibility whether to use the swap or not. Receiver, this is mostly for an investor. Here it will be used when interest rates are going down. If interest rates go down, I will receive a higher fixed rate and pay a lower floating rate. Pay a lower floating rate. There are other places where this is used. It could be for a borrowing, which is that fixed rate payer swaption. Investment, fixed rate receiver swaption. Speculation, just playing around. Or you have lot of swaps already done, so you want to hedge those swaps as a banker. Embedded option means any prepayments are going to be done by the other party. When interest rates go up or go down, they will do prepayments. You use your swaption, execute the swaption and get offset the loss which is happening. Customers prepay. If they prepay, you use your swaption. Customers are prepaying their home loan. You use the swaption and have a fixed rate receiver and earn the higher fixed rate. Tendering, if I tender for a contract, I may need a borrowing, may not need a borrowing. If I really take a borrowing, that time, because if I win the tender, I'll take a borrowing. And if I borrow really, I will use the swaption or the IRS. Cheapest to deliver bond, we have seen it when we did this question. CTD bond is the one which gives the maximum profit, to the seller of the IRF. Normally, seller of the IRF will do a net settlement. But if you are going to do a physical settlement, CTD bond will say the inflow minus outflow. We have one problem solving also on this. Inflow for the bond holder or for the seller is equal to, the inflow is equal to future settlement price into a conversion factor, and the outflow is the quoted price of the bond. The gap is basically the income of the person who is selling an IRF. Please do see that question, there you will understand it better. Default risk basically means the other party is not making the payment. Failure or fall of the other party. We have CDS to protect against this. And this is fall of the interest rate. This is fall of the party. Fall of reliance fully is called default risk. Fall in interest rate is reinvestment risk, because my additional income by reinvesting the interests will go down. This is what broadly the risk is. This question came in May 26 exam. Zenith Commercial Bank, ALCO is evaluating the repricing risk. Following quarterly data is available. Rate sensitive asset, I'll put it in the table, 12,500. Rate sensitive liability, 15,800. And they have a net interest income of 450. I can't assume any random rate, but this is their income. Let me just try some rate. Okay, 10%, and this is 8%, 7%. The 450 is their income. 5% we got that income, maybe 420 is the 450 is the income, and that is also quarterly. So, okay, this is yearly rate. Okay, this is the point. The gap is called positive gap or negative gap. So in this case, we have a negative gap. Negative gap. Bank's earnings at risk is 8% of NII. That is, if the net interest income falls by more than 8%, I have lot to worry. Hedging is mandatory. Identify the gap. Gap is negative gap. Which is favorable? Negative gap, interest rate going up is problem. Negative gap, interest rate going up is a problem. This is a problem. Negative gap, interest rate going up is a problem. And negative gap, interest rate decreasing, both negative, good. Both negative, good. Profits will go up. So you see the impact. You can see this question later. Net decrease, net increase, and we calculate this as a percentage of NII, as a percentage of quarterly net interest income. Quarterly net interest income. Quarterly impact by quarterly NII will give earnings at risk, which is lower than 8%, and hence hedging is not needed. Not spending much time on that question. In case you want to learn this question, I have already released my May 26 suggested answer. There it is explained in depth. Now, as I do, I'm going to revise the entire chapter once from the beginning. Clear? We started with what impacts the interest rate, supply and demand of money. That is, if supply is more, interest rates will fall. Demand is more, interest rates will go up. Inflation and interest rate have direct correlation. Both will go up or both will go down. Government borrows a lot, interest rates will go up. Central bank increases repo rate, interest rates will go up. Central bank reduces repo rate, interest rates will go down. Central bank increases CRR, SLR. All this, when central bank increase, availability of money goes down, supply goes down, demand remains same, interest rates go up. These are actions taken by RBI. Then benchmark rates came into picture, because in case anybody wants to borrow money or invest money, they need a suitable benchmark rate to decide the interest rate. In India, you can do MIBOR or MIBID or MCLR or repo rate or bank rate plus some percentage. Without a benchmark rate, all our instruments like interest rate options, futures, caps, floors, all those will lose its existence itself, because for comparison I need a benchmark rate. Third point, risks faced by the bank, gap exposure, difference between interest rate sensitive asset and interest rate sensitive liability. More assets, positive gap, interest up, NII will go up. Negative gap, interest down, again NII will go up. Both positive or both negative. Basis risk, assets are based on fixed, liabilities are based on floating. Assets are based on 1 month MIBOR, liabilities are based on 3 month LIBOR. Embedded option, prepayment of home loans when interest rates go down, because you are continuing to pay higher, and prepayment or redemption of fixed deposits when interest rates go up. Yield curve risk, again loans could be based on 10-year government security return, and assets could be based on 1-year government security. How much is the impact? Price risk, yield and price has inverse relationship. Interest go up, you will be impacted. Reinvestment, interest goes down, you will be impacted. Both can be managed through a concept called immunization. Net interest position risk basically means the non-interest paying liability is a major source for profitability of the bank. So generally their assets will be more than liability interest earning, and if interest rates go down, their NII can go down. Then tools to hedge it. Traditional method, asset and liability management, that is balancing your variable assets with variable liability, floating assets with floating liability. And in case of FRA, you are freezing your future interest rate. These are traditional. Advanced or modern methods is called interest rate futures, options, and swaps. In the swaps, we learned that there are 4 categories of swap. Either it's a plain vanilla swap. What is plain vanilla swap is, here fixed is exchanged with floating, or floating is exchanged with fixed. Basis rate swap, 2 floating benchmarks are exchanged, 1 month LIBOR versus 3 month LIBOR. Asset swap, a fixed return asset versus a floating return asset. Example, a fixed ICICI bond versus ICICI shares, SBI bond versus ICICI share, or it can be 2 fixed also or 2 variable also. Amortizing swap means the principal amount will keep going down for every reset period. Swaption is swap plus option. It gives me a flexibility to enter into an IRS if I want. I could be a fixed rate payer swaption, where I pay fixed rate and receive the floating rate, or a fixed rate receiver swaption, where I receive the fixed rate, pay the floating rate. Fixed rate payer is generally for a borrower, receiver is generally for an investor. It has multiple purposes like speculation or hedging, or it could be for any tender contracts which we are doing. Then we learned cheapest to deliver bond means the profit which the seller of an IRF will get by delivering a bond which gives, or the bond which gives the maximum profit to the seller of an interest rate future. A CTD bond is one which gives maximum profit, and profit is equal to inflow minus outflow. Inflow is future settlement price into the conversion factor, and outflow is quoted price of the bond. We do have a problem on this. Please see the problem. And last part, default risk, company falls or fails. Reinvestment risk, interest falls. And we had one question in May 26. You do see that. And this, I'll again show you the CTD part, the one where I make maximum profit, future settlement price into the conversion factor minus the quoted spot price of the deliverable bond. With this, our IRM discussion is over. Thank you, friends. Namaste, friends. We now move to chapter 11, International Financial Management. When we did the practical problem solving part here, it was very basic. We worked on something called as international capital budgeting and international financing decision, investment and financing decision. And the focus was primarily on how to compute home currency NPV and foreign currency NPV, and we had certain rules or certain extra issues when we do an international capital budgeting problem. So from a theoretical point of view, I do see a lot of extra points or extra analysis is there in this chapter. So this can become little important from a theory point of view as well. Now, question 1, what are the complexities in multinational or international capital budgeting? When it comes to complexities, it is very simple. We are going to carry one forex risk, which is the currency conversion. Second, there can be a repatriation restriction, because of which the parent cash flow may not be equal to the project cash flow. Project is earning money, but that money we are not able to repatriate it back, and that can lead to difference in the cash flow. Double taxation can be there. Double taxation is taxation in the host country as well as the home country, and because of which certain challenges can come in our analysis. So major point is these three: double taxation, repatriation restriction, which leads to blocked funds, which leads to parent cash flow not equal to project cash flow, currency conversion, are the forex risk, exchange rate risk. Apart from that, if I'm investing in a country whose political scenario is not that good, it can lead to another challenge called political risk, because the political events in that country can impact the cash flow, and sometimes the place where I'm making an investment gives me certain holidays or subsidies which can uplift the project NPV, IRR, and profitability. The main problems are forex risk leading to currency conversion, repatriation restriction leading to blocked funds, leading to parent cash flow not equal to project cash flow, double taxation issue. This is question 1. Question 2, the same international capital budgeting. What are the problems again being talked about and the solutions to the same? The problems are going to be those 3 problems which I said. The first is forex risk. For forex risk, either we do hedging, or when we are doing our analysis, bring IRPT or the PPT technique and forecast the inflation, cash flow, and use the purchasing power parity theory and get the cash flow. So if there are any depreciation or appreciation, consider that in the analysis through the purchasing power parity theory. Blocked funds and transfer restriction, you can manage this slightly through transfer pricing provision. What is transfer pricing provision is, I may charge something to the subsidiary, I may charge something to the subsidiary entity, and sorry, my camera got disconnected. So what I was trying to say here is, if there are repatriation restriction, I can use my transfer pricing provision, and based on the transfer pricing provision, I charge something to the subsidiary and try to take the money from the subsidiary entity to our entity using the benefits of transfer pricing provision, charging some royalty, charging some overheads, and trying to recover that money. Dual tax regime, double taxation can be there. Analysis says only one thing: when you are doing your calculation of taxes, please consider the higher of the home or host tax to test the true profitability or true NPV of the project. Go through the higher of the home or the host tax rate to test the true profitability of the project. This is on question 2. 3 main problems which we already said. Forex risk, which can be eliminated to some extent by doing hedging or using purchasing power parity theory and forecasting the cash flow. Blocked funds issue, use transfer pricing logic. Dual tax regime, consider the higher tax rate in the analysis. Again, the same thing again. Project cash flow versus the parent cash flow. Project cash flow means Indian company doing a project in USA. The US subsidiary cash flow, is called project cash flow, and what could be repatriated back to the parent is called parent cash flow. If there are repatriation restriction, we will keep some money in US, try to do some FDs and other things, and transfer it back at the end of the project. So project cash flow evaluated on a standalone basis, it should earn a rate of return which is better than the local competitors, and that is the project cash flow analysis. USD cash flow, USD discounted, using local cash flow avoids currency conversion, and then convert to the parent cash flow. Parent cash flow means what the Indian parent is going to get, what actually reaches the parent, primarily the operating cash flow. Financing means if you give a loan and you're getting it back, that is not analyzed. Only the operating cash flow has to be analyzed. Care is needed to be taken. Operating cash flow, and with the operating cash flow, you evaluate the project and see whether it generates positive NPV from a parent cash flow point of view. Foreign currency convertible bond. This is nothing but convertible debt which we analyzed when we were in a security valuation chapter. Convertible debt are basically those which may get converted into equity on the last day or may redeem as debt, a hybrid instrument issued in a foreign currency. It pays regular coupon like a bond but may convert it into equity share. In India, companies like Suzlon Energy, JSW Steel, Jubilant Life Sciences have done this. There are benefits as well as disadvantages. Benefits is there is a flexibility to convert. Generally, the coupon rate will be on the lower side. Coupon will be on the lower side. Delayed equity, dilution, and when I'm trying to sell the FCCB bonds, it is easy for me to sell it because I can tell the investor that if company does well, convert into equity and get the benefit of equity valuation, and if company doesn't do well, then you continue it does debt and get it redeemed. So investor gets the upside as well as a minimum coupon. Disadvantages: high exchange risk are there for the Indian entity because coupon and redemption are in the foreign currency. It also adds as pure debt to the balance sheet. So in case my debt to equity is already on the higher side and my bankers are having certain restriction, then in that case FCCB is difficult to add on because my debt equity ratio will go up. So adds pure debt. Coupons are looking cheap. Coupons look cheap means 3-4%, but if it's unhedged and if there is a repayment to be done on the last day, this can add up to the cost of FCCB. In fact, Suzlon Energy went through a lot of trouble time because they were not able to redeem the FCCB and conversion was also not happening. So you may read about Suzlon Energy FCCB issue just to get some more perspective. Okay. Question 5. ADR. I think we all are aware of this. ADR and GDR we did when we were doing equity, when we were doing security valuation, we did discuss about the GDR and the ADR issue. GDR or ADR is technically same. This is basically Indian company wants to raise money. Indian company wants to raise money. Infosys, it wants to raise money from US investors, and the US investors are saying we are ready to invest, but please give the shares in US dollar. Give the shares in US dollar. I don't want any forex risk. So here what happens is an Indian company deposits the shares with a custodian bank who informs a US depository. Depository in India, we have depository like NSDL and CDCL. So US depository, they issue ADRs and these ADRs are traded on NASDAQ or NYSE in US dollar. An ADR holder enjoys the same economic rights and advantages, practically same thing. Only thing is GDR is generally in non-US currency, whereas ADR is generally only in the US dollar currency. So GDR can be traded in more than one currency, both within and outside the United States, and ADR is generally only in the US currency, only in the US dollar. In India, we have Infosys, Wipro, ICICI Bank, HDFC Bank, all have done ADR listing on US exchange, on the US stock exchange, NYSE and NASDAQ exchange. They have done this listing. Global depository receipt, American depository receipt, mostly both are same. From a utility point of view or from a execution point of view. Most GDRs are US dollar denominated. If you issue it in US, you call it as ADR. If you issue it elsewhere, you call it as GDR, and which can be in euro currency or a pound sterling currency. It can be in a euro currency or a pound sterling currency. Why are Indian companies issuing GDR? The point is very simple. When GDR issues happen, you are able to tap a bigger market, not only the domestic public market, you can also tap a global capital. You can raise money from US, UK, Europe, so multiple places you can raise the money. We learnt about cost of GDR when we did problem solving. Reliance Industries was among the first major issue to tap the GDR route. State Bank of India, Dr. Reddy Laboratories, several companies have raised foreign currency equity capital by listing GDRs either in Luxembourg Stock Exchange or London Stock Exchange. ADR listed in the US Stock Exchange, GDR listed maybe in London Stock Exchange. Outside the US is called GDR. Within the US is called ADR. Impact of GDRs on the Indian capital market. Moment GDRs have been issued, you are technically listed in multiple countries. So price discovery happens not only through Indian buying and selling, it also happens through US buying and selling. Market gravity shifts abroad. Price discovery migrates from Bombay to areas like London, Luxembourg, or your NYSE, so other places also, and sometimes it can lead to arbitrage opportunity. What is arbitrage? It is trading at different prices in different markets. Like there can be a BSE NSE gap, there can be a gap in Indian stock exchange price and the US stock exchange price. This also leads to global interdependence. India is no more insulated from the global events, so Indian investor also now need to track worldwide economic events. And they are saying that retail investors earlier maybe were getting certain benefits like steep discounts in rights issue or public issue. All these benefits may not exist once GDRs are also issued or ADRs are also issued, because it is not only India, it is global market. So such extra benefits may not be provided. The retail investors may get sidelined in India. These are the impact of GDRs. I'll again revise or again explain. ADR means issued in US. GDR means issued in non-US. And GDR impact is the market gravity shifts abroad, arbitrage opportunities can be there, global dependency comes in, and the retail investors may get sidelined in India. Okay. Characteristics of GDR issue. GDR is basically like a stock, like Indian stock, like in whatever benefits an Indian stock has, you'll have all the benefits. You'll get full upside. Only thing is no voting. There is no voting. Settle and Euroclear are basically in India. When you do a buying or selling, the buying or selling is noted in your depository or noted in something called as NSDL or CDCL. Like that, CEDL and Euroclear systems will be making record of who is buying and who is selling. Listed generally in London or Luxembourg Stock Exchange. Over the counter means not only traded through the stock market, it can also have an over the counter trading. Free trading, multiple currency, it is not only in Indian currency, US currency, UK currency, Europe currency. Forex risk continues with the investor. What is forex risk? Is Indian company will pay dividend in INR, converted at the, it will be paying in INR, converted to dollars by the depository and gives to the investor. If the dollar rate is not favorable, the investor will in the end get a lower amount. And there's a 45-day cooling off period. After a 45-day period, if you want to cancel your GDR, you can get it cancelled from the depository. Euro convertible bonds. The meaning convertible bond basically means it's a hybrid instrument where the bond can be converted into predetermined number of shares. Carries a fixed rate of interest. Conversion price will be there, and there may be a call and put option on top of it. This is true with the euro convertible bond. Converted into equity share. It is basically a convertible bond. Very simple. A convertible bond may get converted into predetermined number of equity share, can be optionally convertible or compulsorily convertible. Other sources of international finance, more or less self-explanatory. Euro convertible, zero coupon bond. Zero coupon bond means without interest, and they are convertible bonds but without any interest. Equity warrants. Warrants are like options. If you want, you can convert it, and if you don't want, you don't convert it. That warrants into shares, and the bonds may give you fixed interest income. Syndicated bank loans. Large loans pooled from top rated banks, international banks, generally on LIBOR or some other international benchmark. Euro bonds. The meaning of the word euro bonds means bonds issued outside the country of that currency. Example, a yen bond floated in France. A yen bond floated in France. An Indian bond floated in USA. Euro bond means debt issued outside the country of that currency. Foreign bonds means denominated in a currency which is not our Indian currency. I'll just take Indian currency example. Take a US currency or other currency. Commercial paper which we generally issue in India, like that euro commercial paper means issued in some other currency. Credit instruments, multiple other instruments are available where the forex risk may be there, may not be there, and they are saying Indian firm routinely have raised money in these instruments like syndicated loans, euro commercial paper, euro bonds. All these are the type of money. Zero coupon bond without interest. Equity warrants means warrants can get converted into share. Syndicated bank loans means loans from large international banks. Euro bonds means issued in a country which is outside the currency, or which issued in a debt issued outside the country of that currency. Foreign bonds denominated and sold in a currency which is a foreign currency for us. Euro commercial paper is CP issue in any other currency, and certain other credit instruments. These are parts on the financing instrument. If you see here, this is a financing instrument, how the money is raised. This is a financing instrument, how the money is raised. This is a financing instrument, how the money is raised. And the ADR is a financing instrument, how money is raised, by these companies. Okay. Also, we have an area called International Financial Center, IFC. This is very critical. India has also developed an International Financial Service Center. The purpose of an IFC center is very simple. It is within India. It is developed, for example, in India, Gift City within India, stays within India, within a country's border, but it has its own set of rules and regulation, under its own distinct set of rules and regulation. Whatever restrictions which Indian country may have, those restrictions may not exist in the International Financial Center. It serves customer outside its own jurisdiction. Flexibility in currency trading, banking, other financial services. Understand, very, very critical. It is basically something which is within a country's border, but works with its own set of rules and regulation. I'll come to the Indian Gift City in some time. With its own set of rules and regulation. The India's rules and regulations are not applicable. For example, India has a FEMA Act. That FEMA Act rules are not applicable to the Gift City. Cross-border reach caters to the needs of the customer outside its home jurisdiction, maybe outside India also. Currency flexibility, multiple currency, and it provides full service banking. Full service banking means banking, insurance, other services, raising money, investing money, everything would be provided. Important is own distinct set of rules and regulation. Benefits of establishing an IFC. If an IFC is set up in India, one other good benefits for us. Benefits is very simple. Because this IFC is going to tackle, so see, I'll tell IFC is very simple. Developing a Singapore style financial market in India, Singapore style financial market in India through the gift city. So the talent stays within India. Skilled professional who are working abroad get a domestic platform to practice and pursue global opportunity. Reverses brain drain. Brain drain means the Indian people are not going outside India, stay within the country. Repatriates the offshore business which was being done. If I wanted to raise some $500 million, I was earlier raising it through Singapore, going to Singapore and raising, or going to US and raising. Instead of going to Singapore and raising the money, I will raise the money through India's gift city, through brings back financial service transaction currently routed through overseas institution. Complex products, because it has its own distinct rules and regulation. Lot of restrictions which India, SEBI or RBI may have, those regulations may not exist. So complex products, financial derivatives, exotic derivatives, all that can be provided through an IFC. Now comes, okay, what are the constituents of an international financial center? Constituencies, what are the basic requirements? Great infrastructure is needed. Without a great infrastructure, you can't develop an IFC. Political environment should be stable. Government should not come and keep disturbing the operations. Accelerates foreign participation. Instability raises the risk. Strategic location closer to airport, seaport and other places. Good quality of life, because it will have best professionals of India as well as the abroad professionals. Regulatory framework should be there, but be fair, predictable and transparent. And sustainable means it should be able to absorb the shocks. Should be able to absorb the shocks. And now comes the India's gift city. Government of India operationalized IFC at Gift Multi Services SEZ in April 2015. Gift Multi Services that was set up in 2015 in Gujarat, and this is basically India's gateway for global finance. Adani wants to raise $500 million. Instead of going to Singapore, let us raise the money through the gift city. First IFC, FEMA exempt. As I said, FEMA rules are not applicable. Single window, competitive tax regime, relaxed company law provision, single window clearance, and any arbitration happens, international arbitration center is there, and lot of benefits are given, lot of tax exemptions also given with reduced taxes, SEZ regime. More financial institutions are setting up shop at gift city, offering foreign currency loans directly to Indian companies. Indian companies need not go to Singapore or need not go to Dubai, need not go to Mauritius. Gift city lets Indian bank, insurer, fund manager compete for the same offshore business that used to flow to Singapore, Dubai, Mauritius. All that is not needed. So gift city is one big discussion. I'll again kind of quickly discuss it. International financial center is basically set up within India or within the country's border with its own distinct set of rules and regulation. Purpose: cross-border reach, currency flexibility and full service banking. Benefits of setting up an IFC: majorly on the talent, repatriation of the offshore business, reverses the brain drain, and you can also do complex products. What are the basic requirements of an IFC? Highly developed infrastructure, excellent infrastructure, good political environment, strategic location, good quality of life, good rational regulatory framework, and sustainable economy. In India, Gift City, Gift Multi Services SEZ, set up the India's first IFC, International Financial Service Center. This was set up FEMA exempt, competitive tax regime, relaxed company law provisions, single window clearance. There was also an arbitration hub, reduced taxes. All these has led to Indian banks, Indian insurers, Indian fund manager taking or competing for the offshore business, which usually used to go to Singapore, Dubai or Mauritius, from the Indian soil itself. Sovereign wealth fund. This is there in our material. nothing significantly related to raising of money or investing. Now, what a sovereign wealth fund is? A mutual fund, like a mutual fund, where the only investor is government. Mutual fund, basically the wealth fund is only person who is investing here is the government. For example, Dubai. Let's take Dubai as an example. Dubai has lot of oil reserves, but oil has a finite life. Oil has a finite life. So what Dubai should do is, whatever they're earning from country's surplus reserve, natural reserve, bank forex reserve, privatization. For example, India does privatization of certain companies. All these money they should put it in a sovereign wealth fund and invest in other places to generate returns for the government, to generate returns. Like, see, I am in the earning phase now. Whatever salary I am earning, I put that salary in mutual fund. So after 10-15 years, when I stop earning, the mutual fund will give me the money. Similarly, if the forex reserves, if the surplus reserve, if the oil reserves are over, where will the money come? The money will come from the sovereign wealth fund. There are multiple categorizations. Stabilization fund. The role of stabilization fund is very simple. Oil $100 per barrel. Dubai earns a lot. When the oil prices go down, their income may go down. That time the stabilization fund will give you the balance income. Saving our future generation. Invest it and take and consider it for the future generation. That is, after 30-40 years, people will need money. So for that purpose, we are investing. Public benefit pension fund. The investments will happen, and after the investments are done, with this you will try to pay pension to the lot of people. Reserve investment fund, more like a safety caution. Strategic development, SWF. Strategic development is you're trying to develop certain businesses and other things. You may try to develop some companies also. The sovereign wealth fund, the classification is very much linked to this. Sovereign wealth fund, public pension fund, state owned enterprises, sovereign wealth enterprises. These are multiple ways in which they will invest their money. It is a mutual fund developed by Indian government for making investments out of their surplus reserve, if at all surplus is there. India's own national investment and infrastructure fund. But more than this, if you see global, Abu Dhabi Investment Authority, Singapore's GIS, Temasek, Qatar have poured billions into India, including they have invested in companies like Reliance Jio, Reliance Retail, which will give them returns in future. So SWF has invested in Indian companies. Now comes again the complexity part. We earlier learned about capital budgeting complexity. Now we are going to learn about working capital management complexity. Complexity in international working capital management. To me, again, the same points. I say I don't know, the same thing they ask in different ways. Multiple interest rate, tax rate, forex risk, government restriction. So these are the main problems. Government restriction is repatriation restriction. Forex risk is there. Multiple tax rate, double taxation regime. Wider financing option means you can raise money in multiple currencies that is available. That's like a benefit as well as a complexity. Multi-country complexity means you're not only bothered about India's rules and regulation, you're also bothered about other countries' rules and regulation. Capital convertibility gap. What is capital convertibility gap is? Full convertibility means the mobilization of the funds is easier. If there are any restrictions, then mobilizing and transferring the back to the other country can be difficult. India, I think, has no restrictions here. They allow full convertibility. International cash management. Objectives: minimize the currency exposure risk, that is your hedging risk. Minimize the transaction cost. We did 1-2 questions when we were solved. We minimize the transaction cost through something called as netting, bilateral netting and multilateral netting. Overall cash requirement without disturbing smooth subsidiary operation. Political risk needs to be managed, and any economies of scale or other benefits. We can centralize the money and invest it at one place also. That gives you economies of scale benefits. Benefits of centralized cash management. Either every company invests separately or all money is clubbed together and you do investment together. When you do investment together, you get certain benefits. So this allows for one thing called as multinational netting, cutting the transaction cost and the currency exposure. You can also try to bring in your transfer pricing mechanism by which you are able to enhance the profitability and growth, maintain minimum cash balance, more or less are self-explanatory, minimize the forex exposure risk, exploit any correlation you find between the currency movements payable versus the receivable. Netting your payable receivable, multinational netting, hedging risk, minimizing the cash balance or maintaining minimum cash balance, and generating maximum return by investing all cash resources together, clubbing it together and making the investment. One more thing they say, pool funds. When you pool the funds together, variance of a portfolio is always better than the sum of the individual variances, technically called diversification benefit. How can I optimize international cash flow movement? To me, again, the important part is netting. One important part is netting, bilateral or multilateral netting. Try to collect the money faster, manage your blocked funds through either transfer pricing provision or trying to making some fresh investments, ensuring that blocked funds are kept minimal or invested, lead and lag transactions. This enables us to get money faster. Transfer pricing rules to cut taxes, reduce the exposure by doing netting, and invest the excess cash. A significantly theory oriented chapter. Multiple questions were there. We have kind of discussed everything as we usually do. I'll also revise them now. First thing, what are the complexities in multinational capital budgeting? To me, three major complexity. One is double taxation, second is forex risk, third is repatriation restriction. There are other points around it. Exchange risk leads to currency conversion risk. Repatriation leads to blocked funds and parent cash flow not equal to project cash flow. Double taxation issue. Political risk can be there. Host may give certain benefits. Inflation related issue and terminal value estimation. Then international capital budgeting problems and solution. Again, I go back to those three problems. The first problem is your repatriation restriction. Transfer pricing can help in relaxing some blocked funds. The second part is forex risk, where we do hedging or we do purchasing parity theory to understand how much is the risk we are going to carry. Dual tax regime is when you evaluate a project, consider the higher of the host currency and home currency, tax rate to test the true feasibility of the project. Project cash flow means the cash flow which is being generated by my US subsidiary. Evaluate the project, discount it at the local discount rate, no currency, no problem. Parent cash flow is remitted cash flow. Discount this at the Indian discount rate. What cash flow reaches the parent? In case there are any restriction, use transfer pricing and other ways to get the money back to India. FCCB is basically a bond issued in a foreign currency which can be converted optionally or convertibility into pre-specified number of share. Advantages, flexibility is there to convert to equity. Investor gets the equity benefit as well as a minimum income. Delayed equity dilution. Disadvantages, it carries exchange risk, adds pure debt. Coupons look cheaper, but repayment risk is still there. American depository receipt and global depository receipt are Indian shares issued outside India in a US currency or a UK currency or a Europe currency. If the process is Indian company, deposits shares with a custodian bank, ADRs are issued by US depository and traders and traded in US stock exchange. If it's issued in US, it is called American depository receipt. Any other country, we call it as global depository receipt. And because of the GDRs coming in, the price discovery shifted outside India. We are no more insulated from the global market. It can throw away some arbitrage opportunity, and the retail investors will feel they are sidelined because they are not going to get those benefits like steep discounts and rights are public issue. GDR is basically an equity share, so you get full upside of an equity share without any voting rights. Like in India, we have a depository to record the transactions. Cedil and Euroclear will record the buyer and the seller. OTC trading can be there. It will be listed. Free trading is allowed. Multi-currency can be there. US and UK currency both can be there. Forex risk is there. And there is a 45-day cooling off period for cancellation of this. Euro convertible bonds are those bonds which are issued in a foreign currency, can be converted into pre-specified number of equity share, generally at a premium. Euro convertible bond or FCCB convertible bond, both are very similar. There are other sources of international finance. Euro convertible zero coupon bond, zero interest payment. Euro bonds with equity warrant means there is a fixed interest, as well as the warrants may be converted into shares. Syndicated bank loans means bank loans from global top rated banks. Euro bonds means debt issued outside the currency of that country. Outside the country of that currency, sorry. Foreign bonds is denominated and sold within a currency which is foreign to the borrower, which is for Indian borrower US currency. Euro commercial paper, CP issued in the euro currency, and certain other credit instrument. IFC is basically a place within India where the rules and regulations of India may not be applicable. Where the rules and regulations of India may not be applicable. Gift city in India, cross-border reach, currency flexibility, and full service banking. Benefits of establishing IFC, generally the retention of the talent reverses brain drain. Also, complex derivative products can be done through an IFC, and whatever transactions were happening outside India can now happen within India. Constituents of an IFC, highly developed infrastructure, should be very good infrastructure, good quality of life, stable political environment, strategic location, transparent regulatory framework, and a sustainable economy. Gift City is the place where India's first IFC was set. IFSC, International Financial Services Center, FEMA exempt, single window for clearance, competitive tax rate, relaxed company law provisions, and an arbitration hub is also there, which will support the ease of doing business. Sovereign wealth fund is basically a mutual fund of the government, where only the government is the investor. This will invest in multiple other places. For example, some of the Abu Dhabi SWF has invested in Reliance Jio and Reliance Retail. The purpose could be stabilization. Stabilization means in case income of government goes down, it will give some income for future generation savings, for providing pension to public as a reserve investment, or for development of certain companies, strategic development, SWF. International working capital management, again forex risk is there, multiple interest rates are there, multiple tax rates are there, wider financing options come, government restrictions can come, full convertibility or non-full convertibility, and multi-country complexity. Objectives of international cash management: minimize the risk, minimize the transaction cost, minimize the political risk, minimize the overall requirement, and get the benefits of economies of scale. What are the benefits of centralized cash management? Single investment, netting is automatically done, minimum cash is maintained in all the subsidiary, variance of pooled fund is better than the sum of individual parts. I can do netting of a payable versus a receivable, and hedging strategies can be deployed. These are the benefits. And how do I optimize the international cash flow movement? Accelerate the inflow of money, try to do lead versus lag, use the transfer pricing provision to release the blocked funds, net exposures, netting, do it, and in the end invest the excess cash. All this can help you in optimizing or improving the international cash flow movement. With this, the IFM chapter got over, a relatively bigger chapter. Lot of questions are there. If there are any doubts, you can send me a message. Thank you, friends. Namaste, friends. Now we are starting with chapter 10, foreign exchange exposure and risk management. Before I start discussing the chapter, I am sure you would be aware of what we learnt in Forex chapter. We would have learnt about first the basics part of it, where we learnt what are exchange rates, what is price currency, what is product currency. Then we understood spot rate, forward rates, arbitrage discussion was there, and in the end there was a discussion on hedging, where we learnt multiple techniques like currency invoicing, leading and lagging, netting, your money market hedge, forward contract, currency futures, currency options, swaps. Broadly, that discussion, along with something additional in the theory part, as we have been doing, I'll do it from the PPT and the theory material. First question, explain the role of SWIFT in foreign exchange. Now, the SWIFT basically stands for Society for Worldwide Interbank Financial Communication. That is the meaning for the term SWIFT, and this is basically to communicate between two banks. ICICI India wants to communicate with maybe a Citibank USA, and they want to do some transaction involving an Indian currency and another currency, or two global currency. According to the SWIFT model, all the currencies will have a 3-letter currency code. INR for Indian National Rupee, EUR for Euro, USD for US dollar. The purpose is very simple, that the communication is transparent. When the communication is transparent, they are able to give effect to the transaction in a reliable manner along with full security. So quick settlement with the security and reliability, the transaction is executed. Mostly standardized transactions, and this helps bring the financial agencies or the financial banks together. This is how the transaction is done in the practical world. Indian bank communicates to the SWIFT network. From there it goes to a correspondent bank, and ultimately the money goes to the beneficiary bank. In the context of this, when we solved problem, we would have learned something called as Nostro, Vostro and Loro account. Somewhere that will also come into picture. What is a payment gateway? Again, this is not exactly related to Forex. In general, I can discuss about payment gateway. Basically, without a payment gateway coming in between, for example, Bharadwaj Institute collects fees from you all. When we are collecting fees, our payments are routed through a website called InstaMojo, and we have a payment gateway partner who charges us around 2%, and the money comes to us. A secure virtual mode for transferring the cash, and without a payment gateway, collecting money from a customer will become kind of impossible in an automated manner. When you want to do transactions in an automated manner, in India, Razorpay, CC Avenue, these are the some of the payment gateway partners. In an international, you have PayU Global. All these are needed because customer with his card, UPI, wallet, net banking, he will transfer the money through a payment gateway. Money will come to the acquiring bank, and ultimately merchant will receive the funds. 24/7 convenience. If some student wants to buy our classes late night at 2 a.m., 3 a.m., automated payment happens and the transaction passes through. Multiple payment option, real-time reports. I can also refund to the customer. Some of the challenges which they say is, if the customer bank account is not supported, the payment gateway doesn't support all the banks. There could be limitation of some banks, some cooperative banks are there. Maybe they are not available. Limited bank network coverage, and sometimes you will see that during peak traffics, when many transactions are happening, we may see that failures happen in the payments. Even if you do it through GPay or PhonePe, some failure transactions will happen. Third, okay, this I discussed some time back. Nostro, Vostro and Loro, these are needed for even those SWIFT transaction. Nostro means our ICICI Bank has an account with your Citibank. Our ICICI Bank or our SBI has an account with Citibank New York. Vostro, your Citibank has an INR account with Indian Bank, has an INR account with Indian Bank, and Loro is an intermediate account for transferring funds. When I'm trying to transfer my funds from Citibank India is transferring money to Citibank, ICICI India is transferring money to ICICI USA, their own branch, but directly they are not able to do. So somewhere maybe an intermediate account is used called HSBC. SBI settling funds by HSBC to credit to a Bank of Baroda client for Bank of Baroda. Nostro, our account with you. Vostro, your account with us. And Loro is called as an intermediate account for transferring the funds. Intermediate account for transferring the funds to a credit of a third. And one important thing is, what is Nostro for us will be Vostro for the other country. What is Nostro? This is called Nostro account for India. SBI USD account with Citibank US. The US bank will say, this is your account with us. This is your account with us. What is Nostro becomes Vostro. What is Nostro becomes Vostro. We have seen this in problem solving. Merchant rate, interbank rate, again we saw it in problem solving. Merchant rate is for the rate for the customer. Interbank rate is for rate between the banks when they transact, plus or minus exchange margin. Plus or minus exchange margin. Interbank rate, bid rate, subtract exchange margin, ask rate, add exchange margin. 2 paise spread is there. Now 22 paise spread is there. All this we have seen when we did problem solving. What are the techniques for forecasting of exchange rate? Forecasting means how do I identify the exchange rates? Now, our material talks about 4 ways. One is called technical forecasting. Technical forecasting means use the past historical data, put charts. Using the charts, it is like technical analysis and fundamental analysis. Use the historical data, charts to predict the future value. Fundamental forecasting, either use IRPT logic or PPT logic or some other logic and do the forecasting. IRPT, PPT, using inflation, interest rates, we can try to build a relationship and forecast the exchange rate. Market based forecasting is use the actual forward rates in the stock market or in the banking market, futures rate in the stock market, forward rates in the banking market, take those rates and those rates may reflect the market expectation. And in the end, mixed is trying to have a combination of all. Technical forecasting based on charts, fundamental forecasting based on IRPT, PPT, and market-based forecasting is based on actual forward rates, and a combination of all will give effect to mixed forecasting. Factors that affect the exchange rate, the 2 primary factors we are aware of. One is purchasing power parity theory, high inflation, depreciation of the currency, high interest rate, depreciation of the currency. Apart from that, current or capital account deficit or surplus. That is the trade which India is doing with other country. Is there a deficit in the trade or is there a surplus in the trade? If we are having a surplus, our country is doing well, currency may appreciate. Otherwise, currency may depreciate. Trade barriers. If I put lot of restrictions on imports, then what will happen? My requirement for foreign currency goes down. If the requirement for foreign currency goes down, demand goes down, and the exchange rate will get impacted. So if India stops importing in dollar, which can't happen, but if it stops, India doesn't need much of dollar. If the demand for dollar goes down, the rate for dollar will go down, dollar will depreciate, INR will appreciate. Central bank action, many a times RBI will sell foreign currency or buy foreign currency to stabilize the rupee. When rupee is depreciating a lot, they will involve or they will bring a lot of dollars into the market. See, exchange rate in the end is basically a mix of demand and supply. When we learned interest rates also, demand and supply, government control, market expectation. And one example I have brought in, RBI in 22-23 intervened repeatedly to ensure that rupee depreciation does not happen. Today or currently, India wants other countries to invest in our country, bring lot of dollars, and because the exchange rate has been getting impacted, and to encourage dollar investments, government is trying certain measures. There were some tax incentives given for government security investments, and certain extra interest are being given if you do foreign currency deposits for NRIs. So government is trying to encourage so that dollar supply increases, dollar demand decreases, and exchange rate improves. Who are the various participants in the forex market? The first one, the main one, is the bank. Banks are the people who buy and sell foreign currency as per the customer requirement. Non-bank entities means Reliance Industries Limited or Adani Limited, whoever is buying foreign currency or selling foreign currency. MNC meeting import or export commitments. Then we have speculator who speculate on the exchange rate and do buying today, selling later, selling today, buying later, buying today, as well as selling and trying to make money. Arbitrager, we learnt about time arbitrage, space arbitrage, or triangular arbitrage, anything which they are trying to implement. And government may also participate to monitor the market and stabilize the exchange rates. These are the participants who are there in the exchange rate. Types of exposure, this came in May 26 exam and in a slightly different form. They did not ask a direct theory question. You see that question later. There are three types of exposure: transaction, translation, economic exposure. Transaction exposure is what we have been seeing continuously when we did problem solving. I have a foreign currency receivable or a foreign currency payable. The effect of that is called transaction exposure. Effect of exchange rate on outstanding contractual. Tata Motors has an export invoice in GBP and it is settled after some rupee up or down. What is the impact? Translation is more of accounting. It is more of accounting. That is when I prepare my balance sheet on March 31, I have to convert the subsidiary accounts into INR for consolidation purpose. When I do that, that is called translation exposure. This doesn't really impact me because my subsidiary will continue to have it in foreign currency only, but for accounting purpose. Economic exposure is a bigger point. What is economic exposure? Is the impact on my cash flows or value due to exchange rates. For example, Maruti Suzuki's long-term competitiveness versus the Hyundai competitiveness, because Maruti Suzuki is dependent on Japanese yen, and Hyundai may be dependent on the other currency. So what is the impact? Because if INR per JPY appreciates or depreciates, because Maruti has to pay certain amounts to its Japanese parent, and it can impact its pricing in India and ultimately its competitiveness. Transaction, that is when I settle any payable or a receivable, the impact of that. Translation, more for consolidation purpose. Economic is the overall impact on the company due to foreign currency going up or going down. Foreign exchange risk management and its importance. Risk management is very simple. I want protection against the appreciation or the depreciation of foreign currency, and for this we have learnt various techniques. We learnt techniques like currency invoicing, leading and lagging, hedge netting, forward contract. So why should I do this? One is protection against volatility. I don't want any kind of impact on my balance sheet or the P&L because of forex continuously moving up or down. If we do proper hedging, my exchange rate losses can go down, which can improve my profits, improve my competitive advantage, improve my cash flow, and sometimes it is also a regulatory requirement that you hedge yourself. It can become a regulatory compliance also. Main part is protects against volatility. Because of that, cost reduces, profits improve, cash flow improve, competitive advantage is there, and in the end, regulatory compliance. Natural hedging strategy. What is natural hedging strategies? I have my balance sheet. I have a debtor here in US dollar. Simple natural hedging strategies have a USD loan. We used to call it as money market hedge, but here similar to that only, I will be taking a pre-shipment credit in foreign currency. Pre-shipment credit in foreign currency. Instead of taking domestic loans for doing manufacturing, we have pre-shipment and post-shipment credit. So exporter avails PCFC loan, ships the goods, receives dollar, and use the dollar to repay the loan. Use the dollar to repay the loan. This is technically not even money market hedge, natural hedging. A Tirupur based garment exporter takes a PCFC loan in US dollar to buy the fabric, ships the order, repays the PCFC from the USD export, avoiding a rupee conversion. Avoiding a rupee conversion in the entire process. When I used to work in rating agency and speak to people, there are many people who try this natural hedging route. Non-deliverable forward contract. We did see one question around this when we did problem solving. NDF, basically forward contract, is generally physical settlement. NDF means no delivery, net settlement. Find out the difference between the buying rate and the selling rate, buying rate and the selling rate, and compute the profit or loss and settle this amount. The non-deliverable forward contract means forward contract with a net settlement. Generally this is done for a thinly traded or non-convertible foreign currency. Thinly traded means no major transaction happen in that currency. There are two dates they talk about. Fixing date is the date on which the transaction was to be executed. Basically the execution date for a forward contract. Find the difference, get the settlement amount, and settlement date is when the settlement happens. Generally same days it can be. Question 12. I'm not discussing anything here. Distinguish between options and futures. Options is basically it gives you a right but no obligation. Futures, it is mandatory that you have to execute it, and there can be a profit or loss. Only the seller, both parties have to perform. Premium is paid, no premium. Limited loss, unlimited gain, both have unlimited gain or loss. American option can be exercised anytime. European option on the last day. Futures are honored on the last specified date. Not much. We have done good number of problem solving on this. Currency swap. Currency swap is basically a transaction where two loans are exchanged with each other. Two loans are exchanged with each other both being in different currency, along with interest also being exchanged. First, there will be a spot exchange of principal, continuing exchange of interest, and in the end, principal is re-exchanged. Principal is re-exchanged. So I may take a loan in Japanese currency and through a currency swap convert into an INR loan. Convert into an INR loan. Treasurers can hedge currency risk. A lot of times cost savings can happen. What is cost saving? Is Indian loan 12%, Japanese loan 3%, swap is done, hedging is done, and still 7-8%. Still it is 7-8% diversification of borrowing. Currency swap also we saw problem solving. Major chunk on this chapter we have seen it as the problem solving part. Very limited new things. Okay, this can come as an MCQ question. What are the strategies for managing the exposure in foreign currency? There are 4 types of strategy. Low risk, low reward strategy, where I don't apply my brain. All exposures are hedged, whether it is attractive, unattractive. For example, for taking a forward contract, yes or no, we compare what outflow will happen in US INR in forward contract, what without forward contract. Here no discussion. Go ahead, hedge everything. Go ahead and hedge everything. This is called low risk, low reward strategy, not applying. Low risk, reasonable reward means sometimes I will do hedging, sometimes I will not do hedging. If the forward rates are attractive, do hedging. Forward rates are not attractive, don't do hedging. This is called selective hedging, which is called low risk under reasonable reward effort. High risk and low reward is everything unhedged. Everything unhedged. Everything unhedged. Extreme high risk and reward is also not there. And last is high risk and high reward is actively doing booking, cancellation, rebooking, cancellation, rebooking, cancellation, high risk and high reward. I'll want to show this in our book as well. That is the way this has been presented. Low risk, low reward strategy. All exposures are hedged. Low risk, reasonable reward. Hedge when it is good. Don't hedge when it is not good. High risk, low reward. Everything kept open. High risk, high reward. Active trading will happen. This I feel you should see day before exam. Please, this you should see. This can come as MCQ. Netting helps in minimizing the value of intercompany fund flow. I think we saw this earlier in one problem also, but I'll see it here. I have A to B 1000, B to C 2000, C to D 2000, D to E 2000. All are group company. If they individually transfer 8,000, amount will be transferred, whichever currency. A will give to B, B will give to C, C will give to D, D will give to E. Netting will say A can directly give E 2000. A can directly. So it minimizes the intercompany. Yes, it will minimize because you are going to convert different amounts into a single currency and see if you can reduce the transaction. When you reduce the transaction, overall admin cost and the gap between the bid and the ask. The gap between the bid and the ask is saved by the organization. Reduces admin cost, transaction cost, as well it reduces the number of transactions among the companies. Money market hedging, again we have seen problem solving. In a money market hedge, for a foreign currency receivable, I take a foreign currency loan, and for a foreign currency payable, I create a foreign currency deposit. Fixes the future rate, flexibility regarding the amount. I can cover whatever amount you want to do, and it is useful if forward contracts are not available. The only problem here is It is more complicated. It more complicated than the forward contract. Even when we solved problems, we used to find forward contract very easy to do. This was kind of complicated to do the calculation, and it fixes the future rate, which means if the rates become better in future, you can't get any benefit. That benefit can come if you go through currency option, where you have a right but not an obligation. All dealings in foreign exchange affect the exchange position whether delivery has taken place, but cash position is affected only when actual delivery has taken place. We did exchange position versus cash position accounting. In exchange position, I record all transactions, whether the settlement happens or not. Forward buy, recorded. Forward sell, recorded. Cancellation of forward buy, recorded. Cancellation of forward sell, record. Cash position will record only when the transaction is actually affected. Affected upon actual delivery, date of contract. Date of contract. So point is very simple. Any transaction recorded in exchange will be recorded in cash. Any transaction recorded in exchange may or may not be recorded in cash. But if something is recorded in cash, it will 100% be recorded in exchange. So exchange records everything. Cash records only when delivery has taken place. Explain the various technique explicitly does not involve and can be used to offset the foreign exchange exposure completely or partially without the transaction cost. With the transaction cost, we have techniques like currency futures option. First is invoicing in domestic currency, technically called currency invoicing. Leading and lagging technique, where we either lead the payment or lag the payment, and in lagging we may have to do something else. Netting reduces the exposure. Matching is same as netting. What is matching is we are trying to ensure that there are matching transactions within the group or the third party. These are little tricky. Price variation, increasing the selling prices in case exchange rates move adversely and collecting money from our customer. Asset and liability management is again more like money market hedge or matching transaction, where liabilities are balanced with assets so that foreign exchange risk is eliminated. We have seen 18 questions in around maybe 30 minutes, and as I do, I will be now revising everything. This chapter, I don't see major technical kind of questions here. SWIFT, this is basically Society for Worldwide Interbank Financial Communication. Every currency will have a 3-digit or 3-letter code. It is for standardized communication, quick settlement, reliable settlement with accuracy, with the security, and a transaction getting executed. Indian bank through SWIFT communicates to a correspondent bank, goes to a beneficiary bank. Payment gateway can be for a local transaction, can be for a foreign transaction. Local transaction, we have companies like Razorpay. Foreign transaction, we have PayU Global. Customer makes the payment through payment gateway. Money goes to the bank. From there, it goes to the merchant. 24/7 convenience, security is there, real-time transactions, multiple payment option. Challenges are in case the customer account is not supported by the payment gateway, and if there are peak transactions, any failure happening. Nostro account, our ICICI bank has an account with Citibank USA. Vostro account, your Citibank has a bank account with ICICI. Loro account, an intermediate account for doing a transaction where I transfer money from mine to an intermediate account so that it credits to a third bank. Merchant rate is the rate for the customer. Interbank is the rate among the banks. Merchant rate is equal to interbank rate plus or minus exchange margin. Techniques for forecasting exchange rate. Technical forecasting based on trends. Fundamental forecasting based on IRPT, PPT. Market based forecasting is basically using the actual forward rate, actual futures rate, and a mix of the three is called mixed forecasting. Factors which can influence exchange rate: inflation rates, interest rates. This will obviously impact. Inflation rates will increase, higher inflation depreciation, higher interest rate depreciation, current account deficit depreciation. If you have import trade barriers, currency may appreciate. Central bank can do buying and selling to improve the currency. Government can put in some restriction. And what are the market expectation? Who are the participants? Banks is the main participant. Non-bank entities who are trying to hedge a payable or a receivable. Arbitrage are there. Speculators are there. As well, we have government. Types of exposure: transaction exposure means a real transaction which is there in foreign currency, payable or a receivable, and when I'm settling this, the amount could be different, and the gap on the date of entry and date of settlement is the forex gain or loss. That gain or loss is the impact of transaction exposure. Translation is for doing something called as your, when I have consolidation to be done of foreign currency subsidiary, I'll have to convert them into Indian currency. That's translation exposure. Economic exposure is impact on my future cash flow or value due to currency appreciation or depreciation. Foreign exchange risk management: why should I manage the risk? As the name indicates, I don't want any volatility. Reduce cost, improve profits, improve cash flow, gives you a competitive advantage, as well as regulatory compliance. Natural hedging strategy: take a pre-shipment loan, pre-shipment credit in foreign currency, export your goods, receive the money, use the USD receivable and pay your loan. In the entire process, INR conversion is not needed. Non-deliverable forward contract means a forward contract where we do a net settlement. Net settlement is buy rate, sell rate comparison. Fixing date refers to the date on which the profits or losses is calculated. Settlement date is on the date on which the settlement is to be done. Options, futures difference. Options, basically the seller is only obligated to perform. Futures, both the parties have to perform. Here premium is paid, premium is not paid. Unlimited losses can happen for writer. Limited profits is there. And whereas in case of futures, both the parties will have unlimited losses. And option, if it's American option, can be exercised at any time. Futures are generally exercised on the last day. Currency swap involves exchange of principal, continuing exchange of interest, and a re-exchange of principal. Hedging reduces the interest cost, gives me diversification of borrowing, and this helps me in increasing my borrowing capability. Strategies for exposure management: low risk, low reward, everything is hedged. High risk, low reward, everything is unhedged. Low risk, reasonable reward is selective hedging. Hedging when it is useful and not hedging when it is not viable. And high risk, high reward is active trading, booking, cancellation, rebooking, cancellation, booking, cancellation. Netting will help you in reducing the amount of intercompany transfer, because A was to pay B, B was to pay C, C was to pay D, D was to pay E, and you net off this amount and A pays E. Reduces the amount of transfer, reduces the administration effort, reduces the transaction effort, improves the accuracy of cash flow forecasting. All this helps the organization. Money market hedges, basically for a foreign currency receivable, have a foreign currency loan, and for a foreign currency payable, create a foreign currency deposit. So helps us in hedging. Useful in case I do not have any other option of hedging like a forward contract. Slightly complicated than a forward contract, and on the last day I'll not get any benefit if the rates move. I will not be impacted, but I also can't get the benefits here. All transactions which are recorded are first recorded in exchange position. Moment you enter, you record it. In the cash position, it will be recorded when the settlement happens. So all exchange transactions may or may not be recorded in cash. but all cash transactions will be recorded in exchange position. There are various techniques for doing hedging without any transaction cost: currency invoicing, leading and lagging, netting. Then they say matching. Matching means matching the liability with the asset, which is more like a money market hedge. Price variation passed on to the end customer, and asset and liability management. With this chapter is fully discussed. Again, last 6-7 minutes would help you in giving you the summary, and anytime when you do revision, just focus on the last few minutes of discussion. Thank you, friends. Okay, we now move to chapter 5, security valuation, an extremely lengthy chapter from problem solving point of view. We have learned about equity valuation, bond valuation, rights issue, buyback, money market instruments. So multiple things we have seen when we did problem solving. Coming to the theoretical part, majority of that is discussed here, with maybe 2-3 newer things. I don't see any major new thing in the security valuation topic, but yeah, 2-3 places there are certain allied extra areas. The first question: what is the meaning of expected return and the required rate of return? Required rate of return is basically the return the security should generate, technically called as CAPM return. So my required rate of return can be computed as RF plus beta into RM minus RF. Whereas the expected return is what return the security is likely to give. Investor expectation of a return a share would deliver, and the comparison will give you alpha. Alpha is equal to expected return and the required return comparison. Alpha is equal to expected return and the required return comparison. Expected return and required return comparison. Expected greater than required, undervalued, buy it. Expected less than required, overvalued, sell it. So comparison of the two is this area, and that is technically called alpha. Next point: what is equity risk premium? The risk premium of a stock market is RM minus RF, and for the stock it is beta into RM minus RF. Beta into RM minus RF. The excess return equity investing provides over a risk-free rate. Nifty 50 12%, G-Sec 7%, the gap 5% is the risk premium of the stock market. Multiply that with beta, that will give you the risk premium of the stock we are evaluating. Nominal cash flow, real cash flow, I think that is more done when we did capital budgeting. Nominal cash flow includes inflation, real cash flow excludes inflation. Nominal cash flow discounted at nominal discount rate, real cash flow discounted at real discount rate. Nominal cash flow includes the effect of inflation, removes the effect of inflation. Nominal cash flow will keep going up, real cash flow may not go up at that higher pace, the gap being 6% inflation. 6% inflation. So if you are considering nominal cash flow, consider nominal discount rate, real cash flow, real discount rate. Generally the cash flows or the dividends or the interest will be nominal. Will be nominal means whatever is getting paid and recorded in books of accounts. Enterprise value. EV valuation we have done, and when we did EV valuation we learned that enterprise value is equal to equity, debt, minority interest, and we deduct the cash and cash equivalent. Equity, debt, minority interest. There are 3 types of enterprise value. Institute says total enterprise value. Operating enterprise value means total minus the non-operating assets. Core enterprise value is operating enterprise value minus non-core assets. Non-core assets. Total enterprise value: equity plus debt plus minority interest minus cash and cash equivalent. Operating minus the non-operating asset. Core minus the non-core asset. When we do this, we may do a relative valuation approach where we can say enterprise value of TCS is equal to sales into EV by sales of other entity, or EBITDA into EV by EBITDA of other entities. EV by EBITDA of other entities, or EV by sales. Majority what we did in problem solving. Duration, we learned that the time period at which we are able to recover the money, weighted average of the time period of the cash flow, helps in computing something called as volatility, which provides a measure of the price risk. Duration is the average time an investor takes to recover an investment if the interim payments arrive before maturity. If you have a 10-year bond and you are paying higher interest, the duration could be 6 years, and if you are paying lower interest, the duration could be 8 years. Time to maturity, shorter duration, less price risk. Coupon rate, higher coupon, money comes back faster, lower duration. This can come as an MCQ question if they wish to, saying that what is the impact of time to maturity and the coupon rate on the duration, technically the price risk. Duration gives effect to immunization. Whenever we invest in a bond market, we have two risks: price risk, reinvestment risk. When interest rates go up, bond prices go down, inverse relationship. Interest rates go down, bond prices go up, inverse relationship. Reinvestment risk, reinvestment income goes down. So bond value down offset by higher reinvestment income. Bond value down offset by higher reinvestment income, or bond value up offset by lower reinvestment income, where each of them cancel each other. When will cancellation happen? Immunization basically says that the duration of the portfolio should be equal to the investment horizon. What is investment horizon? Is when do I need the money? When do I need the money should be equal to investment horizon. I'm not even trying to explain much, because all of this we did when we did problem solving. Different types of yield curve. Maybe I'll spend little bit time on this. We have this in concept book also. We have three types of yield curve: normal, flat, and something called as inverted. Normal means long-term interest greater than short-term interest. Inverted is long-term interest less than short-term. Flat means both are equal. An inverted yield curve is an indication of an upcoming recession or an imminent recession. So normal yield curve, interest rates keep going up with the time period. Inverted, interest rates keep going down. Flat, same. And there's a humped yield curve where the medium means it is like this. Medium is higher and then again it goes down. Medium terms are higher than both short term and long term. Both short term and long term. And with the yield curve, we use the concept of yield curve to forecast the forward interest rate, which becomes the basis for the FRA chapter or your other areas like your interest rate caps and floors. Normal yield curve, interest rate going up, inverted interest rate going down, flat is same, and humped means the medium term interest rates are higher than the shorter and long term. Term structure theory. I think this is something which we haven't discussed in the theory part, and let us spend some 3-4 minutes on this. Term structure theory basically means how will interest rates be there over the longer run. For example, I find 1 year interest rate 6%, 2-year interest rate 7%, 3-year interest rate 8%, 5-year interest rate 9%, and normal yield curve. An inverted yield curve 9, 8, 7, 6. Flat yield curve 7, 7, 7, 7. We have different types of yield curve. The term structure theory says I want to explain the relationship between the interest rate and the term to maturity. Relationship between the interest rate and the term to maturity. Explain the relationship between interest rates and maturity. First theory is expectation theory. What does expectation theory says is, if your 2-year interest rate is 7%, using the 2-year interest rate, you can forecast the future short-term interest rate. Future, a 2-year interest rate of 7% can tell me what will be the future 1-year interest rate. For example, 1 plus 7% 2 years is equal to 1 plus 6% 1 year, and 1 plus the 1 year forward rate power 1 approximately can be 8%. The term structure theory basically says that long-term interest rates can be used as an unbiased indicator to predict the future short-term rates. Using the 5-year rate, you can predict the future 2-year interest rate after 3 years. Future, that is 3rd to 5th year. Use the longer term rates to predict the future shorter term rates. Future shorter term rates. Liquidity preference theory basically says that everybody in the market wants 7%, or let's take 6% plus liquidity premium. What is liquidity premium is, if I have to invest for a longer period, my money is stuck for a longer period, give me a higher liquidity premium. For a 5-year period, the liquidity premium is 3% in my example. For a 3-year period, the liquidity premium is 2%. For a 2-year period, the liquidity premium is 1%. And for 1-year period, no extra liquidity premium, 6% plus the liquidity. Investors are risk averse, demand a premium, to give up liquidity for longer periods. Give up liquidity for longer periods, to give up liquidity for longer periods, and this explains upward sloping interest rate. Downward sloping can't be explained by liquidity preference, because liquidity preference will say as you go for longer period, you need a higher liquidity premium. Third part, preferred habitat. Habitat is like home. What is preferred habitat is, there's a 1-year period, 2-year period, 3-year period, 5-year period. There are people who are willing to invest in some time period or willing to borrow in some time period. So there are people who want to invest in 1 year, borrow in 1 year. Demand supply gap will determine the interest rate. 2-year, there are people who want to invest, people who want to borrow. Their home is a 2-year period. Another guy home is a 3-year period. Another guy home is a 5-year period. I want to invest or borrow for 5 years. Demand supply premiums reflect supply and demand and not the term. So if there is lots of supply in year 5, it will have lower interest, and if there is lots of demand in year 1, it will have higher interest. So a preferred habitat theory can explain an inverted yield curve, can explain a normal yield curve, can also explain a flat yield curve. It can explain anything. It can explain any type of a yield curve, because interest rates have nothing to do with time period. Interest rates have everything got to do with demand and supply. Demand and supply at every time period and at every maturity. Convexity adjustment, again we did in problem solving. When I do the duration concept, duration says that bond price will be linear movement. In reality, the bond prices, a slight difference is there. There is a small gap between the blue line and the yellow line. This blue line and yellow line gap is kind of taken care with the convexity part, and convexity is V plus V minus 2 into V0 divided by 2 is called convexity adjustment. divide by V0 is called convexity adjustment in percentage, and delta Y square is called convexity, This concept, again, better to see the problem part of it. This chapter, generally the questions are more problem oriented only, except that in between theory which I saw, the term structure theory. Modified duration is a proxy, not an exact measure. True. Modified duration or volatility will give you a linear movement, whereas in reality the movement can be little different, and that gap is handled with convexity. It assumes a straight line, linear change, indicates a slight different change. Error is small but grows over large movement. Convexity adjustment is added to make it more accurate estimate. Risks are inherent and integral part of the market. There are two major types of risk: systematic risk, unsystematic risk. Systematic risk is the risk which is a macro risk affecting everyone. Unsystematic is a micro risk which is affecting the specific company. Market-wide factors, non-diversifiable, company-specific issue, and because of this, the stock market will keep going through the bull market and the bear market. Markets oscillate between bull phase and the bear phase, but risks are inherent: systematic risk and unsystematic. Reverse stock split. Stock split means 10 rupee face value becomes 1 rupee face value. Share price was 1000 divided by 10 will become 100. Reverses, this is the situation and you are making it this. A 100 rupee share will become 1000. Company reduces its number of outstanding share by combining existing shares into fewer share. 100 million share, 5:1 become 20 million share, and the price per share becomes 5x. Why are we doing this? Sometimes to avoid delisting in case there is a minimum price. Exchange says if the price is below 10, you cannot continue, very rare. Remove the penny stock tag. Certainly, sometimes financial institutions and others don't invest in companies whose value or whose share price is less than 10, more of a that is nothing to do with the worth of the company, because share price is not the worth, overall value is the share, but still some MF and FI may avoid them. And if you want to get yourself protected or not removed from an index, Zero coupon bond are those bonds which do not pay any interest. Here the duration is equal to life of the bond, no money paid in between. Purpose is very simple. I am in an earning phase. I invest in a zero coupon bond today. After investing in a zero coupon bond today, the maturity will happen after 20 years and I'll get back one bulk amount. I don't want any amount today. Deep discount. Significantly below face value, no periodic interest. NABARD issued a Bhavishya Nirman bond, 8,000, matures at 20,000. So invest 8,000, get back 20,000, 12,000 is the implicit interest. Arbitrage pricing theory, CAPM theory said RF plus beta into RM minus RF. Arbitrage pricing theory says no, there are multiple factors. So consider multiple factors in the analysis. Instead of one market-wide beta, you can have sensitivity to various factors. Interest rate into the sensitivity, sector growth into the sensitivity. Though it is good, but difficult to implement it. One good example, Infosys required return can be built from risk-free rate, sensitivity to interest rate movement, sensitivity to IT sector growth, rather than just going by the market beta concept. Money market instrument and their characteristic. Money market are short-term instruments. They are short-term instruments taking care of short-term liquidity less than a year. They are highly liquid. Good credit rating will be there. Default risk will be very, very limited. So short duration, large volume, market determined interest rate, highly liquid, safe investments. These are safe investments. What are the different money market instruments? We saw in problem solving, there was a treasury bill, which is basically issued by Government of India. Commercial paper issued by high credit rated companies. High credit rating companies can issue commercial paper. You can also have a commercial bill, which is basically a bill of exchange. Certificate of deposits, call money or notice money. Call money or notice money is generally for an overnight period to 14 days. Overnight means 1 day borrowing. Call money is generally overnight or short notice. Short notice is 5 days, 10 days. Treasury bill, Government of India, 1 year. Commercial bill is bill of exchange, 3 to 6 months. Certificate of deposits, term deposits issued by the banks to bulk depositor. CP, high rated corporates. Repo and reverse repo basically represents a transaction where a bank borrows from RBI or RBI takes money from the bank. Sale of securities with agreement to repurchase it later. We saw from a problem solving point of view. Repo and reverse repo, good to know this. This has got tested once in MCQ. There was a question on repo and reverse repo problem solving, but 2-mark theoretical question was there. You have to identify whether it was a repo transaction or a reverse repo transaction. Repo represents the rate at which RBI lends to commercial bank, and reverse repo represents the rate at which commercial bank lend their surplus funds to RBI. Repo is generally higher, reverse repo is generally lower. This is viewed more from a seller of the security who is borrowing the money, and this is viewed more from a supplier of the funds who is lending. In a repo transaction, commercial bank is the seller and the supplier of the funds is the RBI. Purposes, if I have any deficiency of funds in the banking system, and this is to control inflation, and here if there is any excess liquidity, and this is to control the money supply or provide. Here I want to control the inflation. Again, both are more from an inflation control point of view. Repo means people are going to borrow money. Reverse repo means people are going to invest. Purpose for which valuers are required. Valuers could be required if I want to do an IPO transaction, any acquiring companies acquiring another company, any one is IPO, one is any acquisition happening, merger happening, or I may do a valuation exercise more from a certain compliance point of view. Income Tax Act wants some valuation to be done, or a Companies Act wants some valuation to be done. These are the reason why I will need a valuation. M&A, demerger, takeover required under income tax, slump sale required by IBC Act, bankruptcy code, conversion for debt or security, capital reduction or restructuring. For these purpose, valuers are required. Valuers post qualification, you may work as a valuer by taking more qualification, more insights. You could be a valuer for the Income Tax Act, or you could be a valuer for the IBC Act, or you could be a valuer under the Companies Act or the SURFACI Act or the Arbitration Act. Lot of places valuers will be needed. Now question 19 says, what are the responsibility of valuers? Certain rules have been released. Rule 12E, for the valuers there are certain responsibilities. Basic thing is very clear: confidentiality and independence. Confidentiality, independence, integrity, more like our auditors thing. Integrity and fairness, independence and disclosure, confidentiality, independence, don't take any gift, have a reasonable fees. If you have a very high fees, it could mean that you are compromising your independence. Professional competence and due care, maintain the documentation, and don't overcommit, and don't take any work which is inconsistent with the reputation of the profession. Main thing I'll tell you: integrity, independence, competence, and confidentiality. Last part, precautions before accepting a valuation assignment. When I'm doing a valuation assignment, I cannot promise a precise number. I will do valuation and have certain assumption. Based on the assumptions, I'll do a valuation. Take care of emotional angle also account for emotion. Markets are driven by emotion as much as by model. Look beyond numbers, spend a lot of time on data. Quality is directly proportional to the time spent on the data quality, and balance the promoters will tell a lot of stories. Balance numbers with the story, because they'll say we are going to grow at a very rapid rate. Is the industry also growing at that rapid rate? Is the industry supporting that rapid rate? You will have to consider all that and then consider the valuation. This chapter I did not spend much time. 20 questions took me only 25 minutes because generally covered in our problem solving. As I do, I'll quickly revise them. Expected return is the return which the security is likely to give. Required rate of return is the CAPM return. The gap between the two is called alpha, expected alpha. Equity risk premium is the extra return the stock market gives, RM minus RF, multiplied with our beta. Third point, nominal cash flow includes inflation, real cash flow excludes inflation. Nominal cash flow discounted at nominal discount rate, real cash flow discounted at real discount rate. Enterprise values equity plus debt plus minority interest, deduct cash and cash equivalent. Operating enterprise value, remove non-operating assets. Core enterprise value, remove non-core assets. Two ways of doing valuation: EV by sales and EV by EBITDA. EV by sales and EV by EBITDA. Duration as a concept basically says the weighted average time period to recover the money which is invested. Longer duration, longer life, longer duration; shorter life, shorter duration. Higher coupon, lower duration; lower coupon, higher duration. Immunization basically tries to balance two risks. One is called interest rate risk and price risk. When interest rates go up, price goes down. When interest rate go up, price goes down, reinvestment income goes up. Balance both. Balancing will happen if the weighted average duration is equal to the time period or investment horizon, equal to the time period or the investment horizon. Next, different types of yield curve. Normal yield curve, long term interest greater than short term interest. Flat yield curve, both equal. Inverted yield curve, short term is more, long term is less. And humped yield curve means medium is higher than both of them. Question 8, which I feel is important, term structure theory explains the relationship between interest rate and the time period. First one is called your concept called expectation theory. Expectation theory basically says that using the long term interest rate, 5-year interest rate, you can predict the future short term interest rate, FRA concept. Second is liquidity preference theory, which explains an upward yield curve. Interest rate is equal to average interest rate plus liquidity premium. Higher liquidity premium, longer time period; lower liquidity premium, shorter time period. Preferred habitat theory basically means every person has their preferred home. Preferred home, if your preferred home is 3-year time period, and if there are lot of demand and supply, lot of demand, less of supply, higher interest rate; lot of supply, less of demand, lot of supply, less of demand, lower interest rate. So any time period can have any type of interest rate. Your longer period can have more interest, shorter period can have less, or shorter period can have more, longer can, it can explain any type of a yield curve. Convexity adjustment is needed because our duration based answer is a straight line, whereas the graph is generally a convex kind of a curved graph. The gap is adjusted through convexity adjustment. V plus V minus 2V0 divided by 2 divided by V0 divided by delta Y square. Modified duration is a proxy, not an exact measure, and the difference is the convexity adjustment. Risks are inherent: systematic risk, macro risk, unsystematic risk, risk specific to the company, and because of this the market will keep fluctuating between a bull market and a bear market. Reverse stock split is converting a 1 rupee share into a 5 rupee share. So 5 shares will become 1 share, share price will go down, number of shares will Share price will go up, number of shares will go down, market cap will remain same. Purpose to shed the penny tag, to shed the tag of penny stock, or to encourage mutual fund or other guys to invest in my company, to avoid delisting certain times, and to stay in the index. Zero coupon bond does not pay any interest, issued at deep discount. The difference between the issue price and the redemption price, the difference between the issue price and the redemption price is the implicit interest. Arbitrage pricing theory basically says RF plus factor 1 into RM minus RF, factor 2 into RM minus RF, and keeps going on like that. Money market instrument is market for short-term investments. Here they are highly liquid, large number of transactions will happen, generally what to say, high credit strength is there. They were safer investments, shorter duration. Different instruments are there. Call money or notice money, 0 to 14-day period. Treasury bill up to 1 year period by government. Commercial bill 3 to 6 months. Certificate of deposits issued by the, or deposits created with the banks by high credit rating companies. Commercial paper 7 to 1 year period, high rated corporates. Repo and reverse repo, that is give the security with an agreement to buy back them. Sale of security with agreement to repurchase later. Repo means rate at which the bank, Reserve Bank lends money. Reverse repo, rate at which the Reserve Bank accepts the deposit from commercial bank. In a repo, the objective is to control or is to give money supply in the market when there is a deficit. Reverse repo, when there is a surplus, take the money supply from the market. Viewed more from a seller point of view, viewed more from a supplier point of view. And here in a repo transaction, the interest rate will generally be higher. Reverse repo, the interest rate will generally be lower. For whom and all we need valuers, more from any merger, acquisition, takeover happening, or slum sale, or an asset or an IPR sale happens, mostly from an IBC point of view. Any conversion happens, debt to equity, capital reduction is done, or financial restructuring. The valuer has certain responsibility as per Rule 12, primarily independence, good competence, professional competence, and due diligence or due care is taken. Independence is there, confidentiality is taken care, integrity is taken care. Precautions before accepting: don't promise a precise number, you are going to based on assumption, you can't give an exact figure. Spend a lot of time on collecting data, because the quality of data will determine the quality of valuation. Look beyond the financials and also account for emotions and other things, and we need to balance the numbers part and the story part. Balance the numbers part and the story part. With this chapter is over. Very simple chapter, because no major theory oriented question here. Majority is what we did in problem solving, some extra points here and there. Thank you, friends. Okay, we now proceed to chapter 9, derivatives analysis and valuation, a relatively bigger chapter from a theory discussion point of view, but lot of points are covered when we did problem solving. First concept, what is a derivative instrument? A derivative instrument is one which derives value from an underlying asset. The underlying asset can be equity, forex, commodity, interest rates, precious metals. It can be anything. An example, a Nifty 50 index futures derives the value from Nifty 50 index, which derives the value from the price of 50 stocks which are part of the Nifty 50 index. These are the important rules. It is dependent on the underlying. It moves with the underlying. Whatever is the, if Nifty goes up, Nifty futures will go up. Nifty goes down, Nifty futures will go down. We will determine the profit or loss, deciding whether we have a long position or a short position. And if there is no underlying, there is no value for a derivative instrument. Whatever areas we have done when we did problem solving, I will be going very fast there. Point number 2. Who are the main users of the derivatives? Generally, companies will use it for hedging purpose. A retailer may use it for speculation or arbitrage. Corporation, hedging the currency risk and inventory risk. Example, Reliance Industries uses crude oil futures to hedge the crude oil prices. IT firms like Infosys use the INR USD derivatives to cover the forex risk part of it. Individual investors, speculation, hedging, and to increase the returns. Institutional investors are basically mutual funds, are big institutions. They may do it for the purpose of hedging, generally for hedging and arbitrage. And dealers are basically banks who are trying to help you in doing these transactions. Generally it is three purpose: hedging, speculation, and arbitrage. Hedging, speculation, and arbitrage. Corporation primarily for hedging. Individual investor, speculation, hedging is their yield enhancement. Yield enhancement is increasing the return. Institutional investor, hedging, yield enhancement, arbitrage. Arbitrage is there. And dealers is hedging and maybe earn the spread gap or earn the profit, earn the gap between the bid and the ask. One of the derivative instrument is also a forward contract. Differentiate between cash market and derivatives market. In cash market we do cash buying and cash selling. In derivatives market we do futures buying and futures selling. In a cash market you have to pay full money. In a derivatives market we pay only a margin money. Institute material says derivatives is less risky, whereas in reality derivatives is more risky. These are the broad difference. Tangible assets are traded, contracts are traded. You can buy even one share. Minimum lots are fixed. This is technically wrong because cash market is less riskier, derivatives is more riskier. You buy it for consumption or investment. Here it is speculation, arbitrage, or hedging. This needs trading account. This needs derivatives account or future trading account. Full money, you pay a margin money, you become a part owner, you do not become an owner. More or less self-explanatory. I will not be trying to explain much unless I feel the area is newer to us. Forward and futures. Forward is OTC traded, over the counter traded. Futures are traded through exchange traded. Futures are exchange traded. Forward can be customized according to the requirement. There's no lot size concept and generally physical settled. Futures, there is a lot size and it may not be customized to our requirement and it is generally cash settled. Trading personal basis or telephone, competitive arena, individually tailored, standardized, exchange over the counter, organized exchange. BSE, NSE is there. Settlement will happen on the last day. Here MTM is done daily. Mark to market is done daily. Actual delivery hardly takes place. No margin requirement. There's a margin requirement and there is a credit risk which is to be borne because the other party may not fulfill the obligation. Here, because the margin is collected, credit risk is not there. Because margin is collected, we do not have a concept of credit risk. Marking to market, we did something called as initial margin account, maintenance margin, and this margin is debited or credited with daily profit or loss at the end of the day. That is called marking to market. Means every outstanding is repriced daily to the settlement price. Profit or loss is debited or credited. I bought it at 24,000 one lot. It became 24,150. Profit of 150 will be added to my margin account. I can withdraw it if I wanted. And if I'm making a loss, margin will go down. And if it goes below the maintenance margin, I'll have to replenish it back to the initial margin. Advantages of stock index futures. Stock index futures means Nifty 50 futures. And stock futures means ICICI, SBI future. I want to do hedging. I can do hedging through a Nifty 50 futures because the index is a combination of 50 companies, and because it is an index future, it is difficult to manipulate an overall index. Margin is also on the lower side. Risk is also on the lower side because it will not have that much variability as compared to the individual stock future. Portfolio flexibility adds flexibility for institution holding diversified portfolio. Smaller margin can give you a speculation also, but with a smaller margin, I can do a proper hedging. Cost efficient hedging is cheaper as compared to hedging every stock separately, harder to manipulate, lower volatility, lower margin, and generally cash settled. Even stock futures are cash settled, but index futures are generally cash settled. I need not give delivery of 50. Advantages of stock index futures over stock futures. And the next point is almost same question. Uses and advantages of stock index futures. Portfolio flexibility. With a lower margin, I'm able to do hedging. Lower cost is there, cost efficient hedging, and I can also use it for speculation purpose. I can reweight my portfolio. Reweight my portfolio means I can change the weights in my portfolio without touching the cash portfolio. We can do arbitrage, we can do speculation, or we can do hedging. Portfolio insurance is hedging, leverage for gains is speculation, and arbitrage. Separate timing from selection is, I don't know which company will do better. There are 50 companies. So if you are not able to decide this, go ahead and do it in index futures. So you need not worry about the selection of the company. You can directly do it on 50 companies. And this has a quick entry as well as a quick exit. Quick entry as well as a quick exit because highly liquid. Options and futures. You very well know the difference. In futures, it is mandatory to fulfill the obligation. Option gives me a right but not an obligation. It gives me a right but not an obligation. Right but not the obligation. Obligated to square off. Value may fluctuate because value generally in futures the value falls, goes up or down because of underlying stock. In case of option, we have a concept called delta, and delta will tell how much will be the movement. You pay a premium, no premium, but you have to do initial margin. What are the factors affecting the value of an option? There are multiple factors. We learned about something called as delta, vega, theta, something called as rho. Rho means risk-free interest. Interest rates can affect the value of an option. The price of the underlying asset, time to expiry, volatility, underlying price, time till expiry, volatility, and interest rate. And this part is asked again in question 10. We have done problem solving, so I'm not even discussing this. Delta, gamma, theta, rho, and vega. And if you have a doubt, go through the problem solving part because we have done questions around it. Same way with exotic option. Again, we have done a 40 minutes discussion. So I cannot do that 40-minute discussion now in 2-3 minutes. So 10 and 11, see the practical problem solving part for both exotic option as well as option Greek. What are the risks impacting the financial products? Two major types of risks are there. One is called credit risk. Credit risk means default risk or the counterparty risk. That is, the other party is not fulfilling the obligation. Or I give a loan, they are not repaying the loan. Market risk is something which is uncontrollable. Market risk is adverse movement of stock market, interest rates, forex market. Financial derivatives will hedge this. Credit risk is mitigated through credit derivatives, where we have two credit derivatives: credit default swap and collateralized debt obligation. Again, both we did problem solving, but still I will discuss some part of it, and because some extra points are there here. But the exotic option and the option Greeks, no additional points are there, so that you will have to see only through the discussion there. How do credit default swap work? So there is a company. This company raises money through loan, and A has invested in the debt. A has invested in the debt of this company. I am worried whether this company will repay the debt, so I buy protection from a B. B is called the protection seller. A is the protection buyer. B is the protection seller. A is the protection buyer. If a default happens, then B has to compensate the loss which A is getting. Buyer pays periodic premium. seller assumes the default risk, reference entity the borrower whose debt is being protected. This is a OTC product. It is non-standardized, not traded in exchange. ISDA is your International Swap and Derivatives Association. They give the guidelines for this. Premium is dependent on the credit risk. If there is high credit risk, premium will be higher, and if there's no credit risk, if there is a lesser credit risk, premium will be lower. Generally, it is done for hedging. Naked CDS means without having a loan investment, I am taking CDS. That is speculation. That is speculation. Primary participants, reference entity, the borrower who is giving the loan, buyer who buys the protection, seller who assumes the risk. Hedging, arbitrage, speculation. Hedging means you have invested in, or you have given a fixed deposit, or you have given a loan and you are protecting. Arbitrage means I find that there is some inaccuracies in the pricing and I try to play around by taking two positions. Speculation is basically buying a CDS or selling a CDS, buying a CDS or selling a CDS with the objective to earn the premium, or thinking that default will happen and you will earn more. You are paid premium 2%, but you'll get return of some 70-80%. Settlement process. Again, we have done in problem solving. There are two settlement process. Physical settlement. In a physical settlement, the defaulted bond is given. The defaulted bond is given by the guy who has the defaulted bond is given by the guy to the other party, and the B, in my case, the protection seller, has to return the face value of the bond. Buyer delivers the bond, seller pays the par value. Cash settlement, find out the difference. Difference is the loss and settle only the loss. The difference is the loss and settle only the loss. That is called cash settlement. CDO and their types. CDO is same as securitization. Again, this is preferable for you to see in the detailed theory video, because in the detailed problem solving, 30 minutes of discussion, I can't make it in very shorter time. So CDO part also, I leave it to you for you to see the detailed lengthy video. Even CDS detailed lengthy video is there. CDS, CDO, exotic option and option Greeks. Okay, this is new. This is not covered in that video. Risks in CDO. CDO is basically going to invest in lots of loans. It could be a pool of housing loans, pool of personal loans, pool of education loan, or bonds. It carries all the risks which you see in bond investment. Reinvestment risk. What is reinvestment? Income came in, not able to reinvest it at a higher rate or at a good rate. Interest rate risk. What is interest rate risk? Is interest rate changes in the market. Based on that, my income changes. Default risk. The customers who took the loan from ICICI and that ICICI gave that portfolio to the CDO, these customers are not repaying. You'll understand this explanation only if you know what is CDO. For that, you please see the lengthy video first. Liquidity risk means not able to convert the bonds into cash quickly, or there is a timing gap. Interest income comes late and the CDO also has to pay certain amounts to the investor. So there is a mismatch. Prepayment risk is customers making early payment. When they make early payment, they generally will make early payment if interest rates are not beneficial. And then if interest rates go down in the market and they have to pay higher interest, they prepay. This prepaid money I'm not able to reinvest. Forex risk in case there are other securities, but generally these 5 risks are there for bond investment. The same risks continue here. Financial option and real option. I think this got tested in Jan 26 or May 26 exam. Financial option is call option, put option. Underlying asset are generally shares or an index. Real option is for a capital budgeting project, and the underlying asset is the real project. Financial option generally for a shorter period, real option generally for a longer period. Traded asset, projects specified in contract, estimated from the project cash flow. Shorter, longer. These are priced, that is traded in the market, and these have to be valued using certain model of valuation. We had some abandonment decision valuation using the binomial method or using the risk neutral method of valuing. But this is on real projects. Criteria for a commodity to be suitable for derivatives trading. See, commodities are there, and these commodities I want to do derivatives trading for a commodity. Like we have precious metals like gold, silver. I want to do commodity like maybe copper or something. A derivative is not going to be there for almost all the commodities. It will be there only for those commodities which are generally highly volatile in nature, because highly volatile means people will try to do hedging, speculation or arbitrage. Lot of demand and supply has to be there. If demand and supply is not there, if a lot of interest is not there, there's no point in creating a derivative instrument, because for a derivative instrument I need lot of buying and selling. So liquidity, active trading with reasonable buyers and sellers, volatility, market demand should be there. These three I said. Standardization is in case you are planning to do delivery on the last day, I need standardization of the product, and if delivery is not happening, then standardization may not be that critical. But without these features, a commodity cannot be suitable for a derivative trading. If some commodity whose price do not change much, there's no point in putting them into the derivative trading part. Users of commodity derivatives, my users remain the same: hedging, speculation, arbitrage. These are the primary things. Let's understand them. Instrumental needs: hedgers wants to reduce or eliminate the portfolio risk at low cost. Example, a cotton mill hedging on NCDX for the cotton commodity. Convenience needs, conveniences, because this is available in commodity derivative and I can get the product in a smooth manner or in an easy manner. It improves my ease of doing business, easy market access, and a good clearing system should be there. Peripheral services is because commodity derivatives come. People like me, I want to provide some research related to the commodity buying and selling. So I can give research, advisory, all this extra services can be added because of the commodity. The main need is instrumental need, hedging, speculation, arbitrage. Convenience need is it improves the ability to do the business, and peripheral services are the extra services which are developing because of this point. The development is happening because I can now provide some research service or an advisory service or a warehousing service. Advantages of the commodity market and commodity futures. Commodity market and commodity futures, moment it came into picture, it enables, if I'm a mutual fund manager, I will prefer holding derivatives. See, I want to invest in, let's assume, let's take copper. So instead of holding copper physically, I can hold it in copper derivatives. And because I'm investing in commodity, the commodity is technically considered as an indirect hedge against the inflation. Gold ETFs, or I can go through gold futures. When I'm investing in commodities, I am protecting myself against the inflation risk. These are the general products: agricultural, fibers, food, soybean, cotton, guar, energy, crude oil, heating oil, natural gas, metals, as I was saying, copper, aluminum, gold, silver. What are the advantages of commodity future? I want to buy copper. Easiest, best way is to buy copper futures rather than buying coppers in physical form. Buying copper futures rather than buying copper in physical form. There are risks and all, but these are the advantages of the commodity market and the commodity futures. Next point, types of commodity swaps. We learnt about swaps in interest rate angle. We also learnt about something called as an asset swap. What is asset swap? Is in an asset swap, returns from one security is swapped with another security. In commodity swap, the two sides of it could be commodity. For example, an Indian oil marketing company like IOC swapping a floating crude price for a fixed one. That is, I am entering into a swap saying that I will pay $100 and will receive the crude price. Mirror the fixed floating interest rate swap, but both the parts are commodity based indices. I will pay fixed $100 and receive the floating crude price. Commodity for interest swap. Commodity, as the name indicates, exchanging the return on a metal basket for a rate linked to MIBOR. If you remember, we did one question where the Sensex return was swapped with fixed interest. Here metals could be gold, could be a basket of metal, where the return from them is swapped with the interest part of it, or basically the MIBOR part of it. I pay metals return, receive a fixed interest or a floating interest, depends on whatever the plan says. So these are two types of commodity swaps. The PPTs are very good. They are self-explanatory. Even we have covered it here. But what I generally feel is, read the PPT once. After you read the PPT once, then you go through here. You will understand it better. Then you go through this part of it. Your understanding will be better. Next question. Characteristics of commodity swaps that affect valuation. Valuation of a commodity. We have not even tried valuation of an interest rate swap. Here they're talking about when you try to value a commodity swap, you have to forecast. What are the cash flows which are going to come, and based on the cash flow, we do a valuation. General point is very simple. Valuation is generally done by present value of future cash flow discounted at investors' required rate of return. So for valuing a commodity swap, we will have to factor in the factors which will impact the cash flow. Cost of hedging. If there is a high cost of hedging, it will impact the cash flow. Liquidity, variability of bid and ask. Any credit risk. Credit risk means other party is not even fulfilling the commitment. Administrative cost, brokerage cost, all these will impact the valuation. The most important part is commodity markets are unique. Limited participants are there. Because of this, it is very difficult to do a commodity swap valuation. And there is also good relationship with the real market. They call interrelation with cognate market. Example, agri commodity prices will be influenced by monsoon and the global energy market alike. So there are a lot of factors which impact. I will read this commodity swap part again once. First is, I think that should be the last question. Let me just see if, okay. So commodity swap again. Criteria for it to be eligible, it should have high volatility. There should be high liquidity, good market demand, standardization and deliverability should be possible. Then who are the users or need of the users. What is the need of the users? One is the real needs are hedging, speculation and arbitrage, which is called instrumental needs. Convenience needs, it improves the ease of doing the business by ensuring an efficient market and availability of the commodity. And third is the peripheral services which get added on, research, advisory, or the warehousing services. Commodity market advantages is a mutual fund can buy multiple commodities rather than physically buy it in futures market or commodity market, and with this you are able to hedge against the inflation. Commodity futures, specifically the advantages, you get the cheapest and easiest way to hold copper without physically holding it, hold cotton without physically holding it. Three major categories are traded. One is your agricultural, energy and metal. Types of commodity swap: fixed versus the floating swap, $100 versus the floating crude price. Or commodity for interest swap means returns from a commodity index is swapped with the interest, fixed interest or floating interest. Characteristics of commodity swap that affect valuation: there are a lot of cash flows which go, brokerage fees have to be paid, transaction cost may have to be paid, there is a credit risk to be paid, or there is a capital cost which is there, cost of hedging is on the higher side, liquidity may or may not be there, and what is the variability of the bid and ask spread. And as such, commodity market is extremely unique, very limited participants are there, and there is interrelationship with the real market or cognate market. The agri commodity prices are influenced by the monsoon and the global energy market alike. It is influenced by lot of these people. Okay, we proceed ahead. Embedded derivative means there is a contract, and in the contract a derivative instrument is sitting inside, or there is an equity share, and in the equity share a derivative instrument is sitting in between. It sits inside another contract, host contract. The host contract can be a debt, equity, lease, insurance, or sale or purchase contract. And if it is sitting inside this contract, we will have to do marking to market. Marking to market has to be done for this derivative instrument. For example, a convertible instrument issued by an Indian company. So this is primarily a debt instrument. But where is the derivative? The conversion option. And the value of the conversion option will keep changing based on the change in the price of the underlying asset. For example, if the price of the underlying asset share price goes up, the conversion becomes beneficial and there's an extra cost, right, to convert at a prefix price. Price is 80, but they'll convert at 60. So 20 is the extra loss for the company. Price reaches 100, they'll convert still at 60. That 40 is the loss. That is the embedded derivative. The conversion option. They give another example. A coal purchase contract may link the coal price. I'm planning to buy coal, but it is linked to not the coal price, it is linked to an electricity price at the delivery date, and there's an electricity price index. So you will have to see whether the price index is going up, going down. Based on that, my purchase price goes up, goes down. Based on that, my loss is increasing or decreasing. The purchase contract, while the pricing formula is the embedded derivative. Pricing formula is the embedded derivative instrument. With this, our general derivatives discussion is over. Institute material talks about two more types of derivative. I haven't covered that as problem solving because I haven't seen any questions around it. One is weather derivatives, and second there's an electricity derivative. Weather derivatives will seek protection against the changes in the weather. I am a farmer will be bothered if there is a huge rains or less rains. It can impact my crop, it can impact my prices, and it can lead to losses. If there is a extreme event. Insurance protects against extreme low probability event. Extreme low probability is flood, hurricane. Weather derivative focus is very simple. It generally hedges the volume risk. What is volume risk? I will say that the temperature average will be 40 degrees. If the temperature increases, maybe the demand for my product reduces, whatever, if at all there's a link. So if it becomes 41 degree, for every extra degree, I will get 1 crore compensation. For every extra degree, I will get 1 crore compensation because demand will go down. Demand hedges the volume risk, hedges the volume risk. Derivatives major protection is against the volume risk, not the price risk. Whereas the insurance part is protecting against the huge losses which are happening. So if the temperature is 40, goes up to 41, 42, 43, 44, I will keep getting compensation. If it goes down, I may not get compensation. It can be other way around also. I will say if it goes down, gets a compensation, and if it goes up, no compensation. It has to be defined in the agreement. Defined in the agreement. Insurance is for low probability but high loss events. Low probability but high loss extreme events. This is only the temperature fluctuation. Electricity derivative seeks protection against the electricity price changes. Electricity price changes. In Tamil Nadu, the government has not changed the electricity prices a lot. But if it's a private player who's providing electricity, the prices can change significantly. Now, let us first understand how is electricity generated. Electricity is generated from a power plant, and this power plant will give electricity for 20-25 years. So if I am a power generator, I'll be generating electricity for 20-25 years, and I will be bothered or worried if the electricity prices go down. In India, state distribution company is our Tangentco in Tamil Nadu, long-term power purchase agreement 20-25 years. Due to high capital cost, volatile spot prices, they need some protection. The protection are what we are aware. Forward contract fix the future electricity price between a generator and a buyer. Futures is through stock exchange, and swaps is exchanging fixed electricity for floating price or floating electricity for fixed price, or exchange the difference in the two. What is exchange the difference in the two? For example, fixed is 4. If floating becomes 4.5, the difference is 0.5. This 0.5 either could be given or could be received. Could be given or could be received depending on what the rate changes happen. So forwards are there, futures are there, swaps are there. Understand electricity derivatives is 20-25 year plant, and I'm worried if electricity prices go down. That time I need protection. Institute Metal talks about one swap called basis swap. Basis, the meaning of the basis is the difference between the two variable. It can be in derivatives. We learned about something called a spot price and the futures price. In IRRM, interest rate risk management, we saw a risk called basis risk. So here, let us assume there is a northern grid and a southern grid. Whatever is the difference in the price, I am generating electricity at maybe the southern grid, selling the electricity at the northern grid, or raising it at, or generating at northern grid, selling it at southern grid. Delhi region, southern region. Electricity generation happens at one place, sale happens at another place, and there can be a difference in the price. This difference in the price can be compensated to me for a fixed cash flow agreed at the start of the transaction. So this is 4, this is 6, you will give me 2, I will give fixed 1. This is 3, this is 5, you will give me 2, I'll give you 1. This is 3.5, this is 4, you will give me 0.5, I will give you 1. I will give. The difference is settled to me. The difference is settled to me. Once the difference is settled, I'll be able to get the price which is applicable at the place where I am, at the place where I'm generating the electricity. See, I generate electricity in northern grid at 4 and I sell it in southern grid at 6. Or I generate here where the price is 6 but sell it at 4. I am generating where the cost is 6 or the revenue is 6, price is 6, selling it for 4 rupees. The difference is compensated. The difference is locks in fixed price at different from the delivery point, making it an effective hedging tool for the difference in prices. I am generating at a place where it is 6 rupees, selling at a place where it is 4 rupees. Difference of 2 is compensated for a fixed payment. Compensated for a fixed payment. With this, derivatives is almost over. Key lessons from derivatives mishap. Derivative is a very, very risky product. So people in the past have not even understood what the instrument and taken risk without even understanding the instrument. So understanding itself is not there, then please don't buy the instrument. Exotic option. Do due diligence. Have your risk limits. Separation. What is separation? Is in a bank, there's a front office, there's a middle office, back office. Don't try to club them together. Maintain a firewall and have clarity. Hedger should hedging, speculator should do speculation, define the risk limit. Main part is understanding the product. Don't try to get into a product which you don't even understand. Don't buy a exotic option. Don't buy something called as a barrier option or a compound option without even understanding. Due diligence. In your institute material, some 4 or 5 case studies are there, good to read for you. And carry out your testing, do stress test, scenario analysis, simulation analysis, do your value at risk analysis, and try to ensure that you do not exceed that loss level. Cost of carry, contango and backwardation. I think we are aware of this when we did problem solving. Cost of carry is the difference between the fair futures price and the spot price, and basis is the difference between spot and future. And in a contango normal market, futures is higher, spot is lower, and the basis will be negative. A backwardation market, which is very rare, in a backwardation market, spot is on the higher side, futures is on the lower side. Spot is on the higher side, futures is on the lower side. That will technically have a positive basis. Purpose of trading in futures. Purpose, I think I cannot keep telling about the same thing. The 3 main purpose: speculation, hedging, and arbitrage. Speculation, hedging, and arbitrage. With a 20% margin, I am trying to speculate. Hedging is basically hedging my underlying portfolio for a volatile union budget session or a volatile result season. India's election results are coming. All that I want protection, hedging will be done. And the other part is arbitrage. This chapter majorly discussed in problem solving. Few questions I've not even discussed here, so that you may have to see from those areas. But as we do, let us quickly revise it. First thing, a derivative instrument is one which derives value from an underlying asset. The underlying asset can be equity, can be an index, can be interest rate, can be forex. No underlying, no value for a derivative instrument. It moves with the underlying instrument. It carries the volatility of the underlying instrument. Depends on underlying, moves with the underlying, determine profit or loss. No underlying, no value. Who are the main users of derivatives? It can be companies like Reliance and others. It can be banks and financial institutions. It can be individual investors or institutional investors. Corporations, hedging the currency and inventory risk. Individual investor, arbitrage, speculation, hedging, yield enhancement. Institutional, hedging, yield enhancement and arbitrage. And dealers to earn the spread. Cash market is cash buying and cash selling. Derivatives market is futures buying and selling. Here one share can be purchased. Here there is a lot size which is fixed. And in case of a cash market, I have to pay full money. In a derivatives market, margin is paid. Forward and futures. Forward is OTC traded. Futures is exchange traded. OTC traded means over the counter, can be customized according to the requirement, carries default risk. Futures do not carry the default risk and there's a margin to be paid initially. Marking to market is a practice of a futures where daily profit or loss is debited or credited to the margin account, and if margin falls below, recover from the customer. Margin goes above, the customer can withdraw the margin. Stock index futures over the stock future, difficult to manipulate an index, cheaper cost, easy to do hedging, lot of liquidity is there, lot of buying and selling happens for stock index future. Lower volatility, harder to manipulate, flexibility, cost efficient hedging. Same thing, advantages of stock index futures: index arbitrage, hedging, speculation, quick entry and exit, and I need not worry which company to buy. I can just buy the index. Separate timing from the selection. Options and futures. Options are giving you a right but not an obligation. Futures are mandatory to execute. An option you pay a premium. In futures, premium is not needed. Factors affecting the value of option: price of the underlying asset, theta, t time theta, then your risk-free rate rho, risk-free rate, which is technically called rho, and volatility. This is on various Greeks. I'm discussing it now, assuming you have gone through that 40-minute video. Delta measures the change in the underlying asset, the impact of the change in underlying asset on the value of the option. Gamma is delta of the delta. Vega, V stands for volatility, change due to volatility. Rho, change due to risk-free asset. And theta, change due to time to expiry. Exotic option, again assuming you have gone through it. Chooser option, it gives you a choice. You can decide it to be a call option or a put option before expiry. Compound option gives you an option to buy another call option or another put option. It can be call on put, put on put, put on call. Barrier option gets activated only if the price reaches a specified number. Binary option, the payoff is not the difference between exercise price and current market price. It is a fixed payoff. It's like a bet. Asian option is payoff is based on the average underlying price and not the last day price. Bermuda option is between your American option and European option. Multiple times can be exercised or one time can be exercised, but on a specific date. Basket option is instead of buying an option on one share, we buy on a basket of debt, equity and preference, and it could be a call basket or a put basket. Spread option bets on the difference between the two underlying assets. And look back option, you can decide either the most favorable strike price or the most favorable current market price for execution. Two types of risks are impacting financial product market. One is market risk, where you have interest rate risk, forex risk, your adverse movement of stock market. This is hedged through financial derivative. Credit risk is hedged through credit derivatives like CDS and CDO. CDS is basically a protection given by a financial institution to an individual investor. Protection buyer, there's a protection seller. Buyer pays premium, seller receives the premium and assumes the default risk, and the reference entity is the underlying entity. Application can be hedging, arbitrage or speculation. Hedging means I have an underlying loan, underlying investment and doing it. Arbitrage means I'm trying to play around the difference in the CDS spread and the asset swap. Speculation means without even having an underlying loan or investment, you are trying to do this. Participants, reference entity, buyer and seller. Settlement process, there can be a physical settlement where I give the defaulted bond and he pays me the par value of the bond, or we can settle the difference between the two. CDO is basically like securitization. The CDO is going to buy a pool of debt instrument like bonds, loans and other fixed income asset into a diversified portfolio. It earns interest and pays interest to its investors. Different tranches are there. There can be a junior tranche, senior tranche, or an equity finance. It can be a cash CDO where it holds the underlying asset. Synthetic CDO, it does not hold the underlying asset, but it holds the risk of the underlying asset through a CDS, which can be an unfunded one or a funded one or a CLN. Arbitrage CDO tries to earn income by ensuring that your income from the assets is higher than the cost associated with the borrowing and earn some profit. Risks involved in CDO, basically the risks which are involved in a bond instrument. Default risk, this is the counterparty does not make the payment. Interest rate risk, any basis risk, any interest rate risk is fixed versus floating difference. If interest rates go down and I have a fixed income, or interest rates go up, interest rates go down and my floating income goes down, interest rates go up and I continue to get the fixed income. Liquidity risk is not able to convert to cash. Prepayments happen, I will have a reinvestment risk and a forex risk. Financial option, underlying asset is shares, bonds, debentures. Real option, the underlying asset is the project itself. Financial option, shorter period. Real option is for a longer period, generally for a longer period. Financial option is priced in the market. Real option is generally valued by us. Commodity trading or commodity derivatives will come into picture if the commodity exhibits huge volatility, lot of buyers and sellers, ready-made demand is there, standardization is possible, and physical deliverability if possible. What are the user needs of the users of the commodity derivative? One is instrumental needs. Instrumental is the basic needs which I have, which is hedging has to be done, or speculation has to be done. Apart from that, I have convenience need, which is improving the ease of doing my business, easy market access, and an efficient clearing system. And there are peripheral services which can come. I can provide research services, I can provide advisory services or warehousing services. Commodity advantages is, if there is a commodity market, a mutual fund manager can buy the commodities through the commodity market rather than physically buying it and get a hedge against the inflation. And commodity futures are the easiest and the cheapest way to get the commodity exposure. Three major categories are there: agricultural, energy, and metals. Types of commodity swap: fixed crude price against a floating crude price, the real crude price, or commodity returns versus the MIBOR returns, commodity returns versus the LIBOR returns. Commodity swap that affect valuation, whatever affects the cash flow will affect the valuation: cost of hedging, brokerage fees, credit risk which is there, variability of the bid and ask, liquidity of the underlying commodity market. All these will impact the valuation. And commodity market is generally unique, limited participants are there, different driving factors are there, and there is a good relationship with the real market. Real market is agri commodity prices are influenced by monsoon and the other energy markets. Embedded derivative means there is a host contract. In the host contract, another derivative contract is sitting. Convertible bond, the convertible debenture is treated like a debt, but the conversion option is a derivative instrument which is sitting on top of the host contract. So when I'm trying to do my mark to market loss recognition, I will have to even do a mark to market loss recognition for a convertible debenture, because the value of the convertible debenture can go up or down based on the value of the underlying shares. Weather derivative seeks protection against the volume up or down. Ice cream volumes may go down if it's extreme weather condition, or lot of if the climate is very cold, that time volumes can go down. So I may enter into a derivative instrument which will say, if the temperature goes below 20 degree, for every degree you will have to pay me 1 CR, 2 CR. Insurance is against the extreme events where the entire crop will get destroyed, flood, hurricane, against that protection. Weather derivative, why did electricity derivative, why did this come into picture? A plant which is generating electricity invests for 20-25 years and they are dependent on electricity prices, so they want to fix the future electricity prices. They can fix it through forwards, futures, or swaps. And in swaps we have electricity locational basis swap. Generation happens in place A, high electricity prices, sold in place B, low electricity prices, so I'm getting lower income. The difference is compensated to me for a fixed payment which I decide at the start of the contract. Key lessons: don't invest without understanding the product. Have understanding, do due diligence, fix your risk limit, separate your the front office, middle office, and back office. Clarity should be there for the person who is hedging. He has to only do hedging. He can't get into speculation and do stress testing. Cost of carry is the difference between FFP and the spot price. Contango is a normal market where the futures is higher than the spot. Futures is higher than the spot, and backwardation is a reverse market where futures is lower than the spot. This is measured through basis. Basis is the difference between spot price and futures price. If you have a negative basis, which is a normal market, positive basis is a backwardation. The basis word is like that, but you understand contango is a normal market. In a normal market, futures will be at a premium to spot. Last part, purpose of trading in futures. Purpose is either speculation, hedging, or maybe arbitrage as well. With this, our discussion on entire derivatives is over. Any place you have any confusion, do send me a message. Thank you, friends. Namaste, friends. We now move to chapter 3, Advanced Capital Budgeting Decision. In the practical problem solving, we have already seen how cash flows are calculated, how various techniques of capital budgeting are done, and based on that we learnt about an investment decision, and then primarily a replacement decision, and then we saw certain things called risk analysis in capital budgeting, where we saw techniques like standard deviation, coefficient of variation, RADR, CEF, sensitivity, scenario, decision tree. The theoretical element is going to primarily focus on that, with some points extra being added. As we do, we will do it through a PPT and the theory material. The first one is impact of inflation in capital budgeting. This is very simple. We learnt that there are two types of cash flow. One is called nominal cash flow and second is called real cash flow. If you see here, the nominal cash flow is always higher than real cash flow due to inflation factor. As inflation goes up, the nominal cash flow will keep growing. But in reality, the growth may not be there if we remove inflation. That is called real cash flow. Concept says only one thing. When we are evaluating a project, nominal cash flow, use a nominal discount rate. Real cash flow, use a real discount rate. So adjustment for inflation is a necessity, because inflation is going to raise both the revenue as well as the cost. In case you include the inflation impact in the cash flow, please keep real required rate plus the rate of inflation. That is, consider something called as nominal discount rate. And another important point is depreciation is always on historical cost. So depreciation value will always be a nominal value. The real value you will have to bring down. One example, Tata Steel builds inflation into blast furnace expansion appraisal, some project they want to do, by discounting the nominal cash flow with a nominal WACC, and in the cash flow, expected inflation is considered. Coal and iron ore price inflation is considered in the calculation. Nominal cash flow, nominal discount rate. Real cash flow, real discount rate. Depreciation is always at nominal terms. It can't increase with the increase in the inflation factor. So they are always nominal. Nominal means what you record in books of accounts, and the real depreciation benefit could be lower. Second, impact of change in technology. Technology can be a game changer in many industry, including our industry, education services industry. The new AI tools which are coming into picture has significantly altered the way we prepare a material or the way we deliver our classes. So here the technology can alter the project cash flow or alter the risk of a project. It can alter the production process. It can improve quality, faster delivery, greater flexibility, and because of this, sometimes you may also see improved cash flow with reduced cost of capital. With reduced cost of capital, these are on the good side. Good side is technology can improve quality, faster delivery, better yields, greater flexibility, better cash flow. But the disadvantage is it can shorten a product's life cycle. Product's life cycle is introduction, growth, maturity decline. With the advancements, we will see some of the products going out of existence, How do I build this risk into my decision making? Because we don't know what impact can the technology have. So institute says you do sensitivity, scenario and simulation analysis. Sensitivity, I'll be keeping on discussing this, but you have already seen it in the practical problem solving. Sensitivity, one parameter change. Scenario, multiple parameter change. And simulation is running an exercise or running the project million times, running the experiment million times to understand what kind of returns the project is likely to bring. We also need to monitor what happens on the technology front and keep the exit option open. Because at some stage, because of technological advancement, if we feel we can't sustain, better to get out of the project. So we have seen question 1, impact of inflation, impact of changes in technology on capital budgeting decision. Technology can improve cash flows, reduce cash flows. Technology can increase discount rate, reduce discount rate, and we need to factor this in our analysis through sensitivity, scenario and simulation analysis, and keep the exit option open. Point number 3, impact of change in government policy on capital budgeting decision. Now, government plays a very big part in our analysis. Government can suddenly change the direct tax and indirect tax rate. They can change the direct tax or the indirect tax rate. If it changes, my cash flow gets impacted, because significant impact can have. Suddenly they increase the indirect tax rate, my selling price increases, my sales may dip. Direct tax rate increases, my cash flow goes down. Monetary policy means the RBI policy, where the interest rate, we learned in IRRM chapter that interest is significantly influenced by government and RBI action. So the interest rate hike or the availability of money supply through the CRR or the SLR ratio can impact the availability of money as well as the cost of funds. And other thing is stakeholder impact. Stakeholder impact means that policies changed by the company or by the government, I am not only impacted, my supplier, my buyer, service provider, anyone can get impacted. So there can be an impact on my stakeholders. Monetary policy has an impact on me as well as my stakeholder. Fiscal policy has an impact on me as well as my stakeholder. So a new government subsidy for green energy, suddenly a previously rejected project may become a viable project because government is giving subsidy. This is the impact of government action on capital budgeting problem. Same thing, impact of change in government policy on domestic capital budgeting. More or less the same thing is repeated again. We specifically, ICA talks about domestic and international capital budgeting. So if you see here, it is almost the same. Domestic, the two things I have already told. Revision in interest rates can change WACC, can change cost of debt, and fiscal policy, change in government policy on the taxation side. This is on domestic. Then on the international capital budgeting part, specific impact. So if you see our material, one question is specifically on capital budgeting decision, then specifically on domestic, then specifically on international. Could have been clubbed as single problem also. On the international side, we are going to not only get impacted with what we saw earlier, but there are other factors also you need to be aware. One is your exchange rate volatility. The INR per dollar rate or INR per GBP rate is highly influenced by RBI action and the government stability. It gets impacted by IRPT and other things, but government policies will have impact on forex rate, and forex going up or going down will impact my cash flow, ultimately the capital budgeting decision. Taxation treaty, that is double taxation avoidance agreement. In case I have invested in Sri Lanka, or I have invested in USA, or I have invested in Japan, and I'm trying to evaluate the project, if DTAA agreements change, again the cash flows will change. If cash flows change, our project may get accepted or rejected. And the third part is withholding tax. Withholding taxes, in case any money is getting repatriated from one country to another country in form of dividends, interest, royalty, is there any tax deducted at source, and that TDS at source can also impact. So impact of change in government policy primarily on cash flow, primarily on the cash flow. Exchange rate changes can impact, taxation treaty DTAA, and withholding. A small example, change in the US Fed rates, strengthening the dollar. US Fed rate is USA is taking an action which strengthens the dollar, makes a project in India less valuable, less valuable for a US parent company. This example you will understand once forex part is understood by you, and you are seeing this after completing all your practical area. So change in US Fed rate strengthening the dollar will make the project less viable for the US company. This is on the international capital budgeting, domestic capital budgeting, as well as general impact. Government action we have seen, inflation impact we have seen, technology impact we have seen. What is risk and uncertainty? Risk is something which can be measured, very simple. Uncertainty is something which cannot be measured. In our portfolio chapter, we measure risk through standard deviation. In this chapter, again, we measure risk through standard deviation coefficient of variation. Very simple. I am betting a dice. I'm betting on a dice. I have a 1/6 chance of winning, 5/6 chance of losing. I'm saying the number 2 will come or 3 will come. Uncertainty means I'm launching one revolutionary product in a market that doesn't exist. In this, I don't know what will happen also. Range of outcomes is unknown. Probabilities are not known, and it cannot be measured or predicted. You cannot measure on this side. Risk and uncertainty. Risk cannot be measured. So risk can be measured. Uncertainty cannot be measured. Why should I adjust risk in a capital budgeting decision? Very simple. If I put money in fixed deposit, the cash flows of the fixed deposit will be discounted. If I'm doing discounting analysis, I will discount them at a lower discount rate because fixed deposit carry lower risk, also gives lower return. SBI equity shares, if I'm investing, high risk, high return, high discount rate. So first is a mining project with an example in a war zone. A mining project in a war zone will have 25% return. But the discount rate for this could be very high, and this 25% in a mining could be weaker than a safe 8% bond. Could be 25% in a mining war zone is bad as compared to a safer 8%. So one is opportunity cost. Investor need compensation for taking higher risk. Real value check means you will have to discount the cash flows based on the risk. Adjustments reveal the certain value of risky future inflow. Hurdle comparison means cost of capital or the discount rate, and accuracy becomes better because if I have a very high over optimistic project. What is over optimistic project is I have a very good project giving 20, 30, 40, 50, 60% return. But the problem is the risk is very high there. And if I employ a very high discount rate, project may still get rejected. Project may still get rejected. So different projects need to have different discount rate based on the risk. And in this chapter, we learned risk can be measured through standard deviation, coefficient of variation, and like that we also had an RADR, risk index, multiple ways of measuring the risk. What are the various sources of risk? We keep saying that risk is there, risk is there. Where is the risk coming from? Now listen, when we did portfolio chapter, we broadly classified the risk into systematic risk, unsystematic risk. Systematic risk is macro factor. Unsystematic risk, the unsystematic risk is the internal factor or the company specific. Similarly, I have internal factors in the company specific or project specific. For example, Adani Power was doing a plant and there was a commissioning delay. There was a commissioning delay for the Adani Power Plant project. Adani Power Plant project, there is a commissioning delay. This is a project specific problem. Company specific, another example, Yes Bank's 2020 rating downgrade. When rating downgrade happened, rate of interest will go up. People may not be comfortable with Yes Bank. So a lot of outflows can happen. So overruns, estimation error, credit rating downgrade, key management exit, legal disputes, intellectual property issues, labor dispute, all these are internal. We also have external factor, which is company as a whole, primarily EIC, economy and industry. Company is the same. Economy issues, economic or international issue, the RBI actions, any new, that is monetary policy, fiscal policy and exchange rate problem. Industry specific, BS6 norm hitting automakers. Now, if you look at auto industry, there is one point which is still going on very prevalent. The petrol usage, E20 versus the non-E20 petrol. Some discussions are continuously happening on that. So if I am in the auto industry, I will have to manufacture vehicles which are compliant with this. This can again impact my cash flow. Market risk is, if anybody is coming extra, both are very similar. Market and competition risk, Jio's entry into the telecom sector, and market risk is your Porter's 5 forces model had certain points called entry of substitutes, and this is entry of new rival. Entry of substitutes and entry of, see, I did a project with a lot of expectation, but after doing the project, there are certain project specific issues companies having, company specific problems are there. Yes Bank downgrade happened, because of that all project got impacted. Industry specific issues are there, new competition is coming in, new products are coming in, new substitutes are coming in, and government action like fiscal policy and monetary policy and exchange rate. All these factors are the sources of risk. Risk is because what can go wrong, any of these can go wrong in a company. Project specific and company specific are the EIC, economy this side, industry this side, C this side, company specific, product specific. And in the external factor, we also talk about new competition, new substitutes. Mention the various tools available for incorporating risk and capital budgeting. I think we are very much aware of this. We did something called as probability distribution analysis and did expected NPV, standard deviation, variance, coefficient of variation. I'm not discussing anything. Conventional technique, RADR and CF approach, and the modern techniques are sensitivity, scenario, simulation and decision tree approach. All this we have seen as pure problem solving itself. So these are the various techniques available to assess or to incorporate risk in a capital budgeting decision. How will I evaluate project using RADR approach? Again, some of these points are already covered when we did theory. RADR basically said risk-free rate plus risk premium. A classic good chart here. If it's a risk-free project, 7% discount rate. Low risk project, 10% discount rate. Medium risk project, 13% discount rate. And a high risk project, we'll go with the 17% discount rate. The discount rate will keep changing based on the risk of the project. Based on the risk of the project, I am going to alter my discount rates. Okay, very simple. Project with higher risk, higher RADR, easy to understand, incorporates risk premium directly in the discounting. The problem is we take the same risk for every cash flow. NPV can be found. Okay, we take the, okay, that's not mentioned here, but we take the same risk. We take the same risk for every year, which is not a good thing to do. You should alter the risk every year. Every year means different RADR every year. And difficult to determine the risk premium. And I can calculate NPV, but I cannot calculate standard deviation, because for standard deviation, we need probability analysis, multiple options possible, and out of those options, which can work in an organization. Certainty equivalent is an extension of RADR approach, but here, instead of adjusting the discount rate, we adjust the cash flow, an approach that expresses a risky future cash flow in terms of a riskless cash flow. We used to do uncertain cash flow into certainty equivalent factor, certain cash flow. The uncertain cash flow is converted into certain cash flow, and I can alter the risk different here. Simple, easy to understand. Different risk levels, but the problem here is, there is again, how do I determine the certainty equivalent? How do I determine the certainty equivalent? There, how do I determine the RADR? RADR is at least once. CF, different CF for different years. Extremely challenging for anyone to do it in the practical world. Quickly comparing, RADR adjusts the discount rate, CF adjusts the cash flows, and uses a risk-free discount rate. Okay, in fact, that is also asked as a separate question. RADR discount rate is adjusted, CF cash flows are adjusted, risk-free rate plus premium, purely risk-free rate, and the risk assumption is constant. Constant means same RADR. Here you will have different risk for different cash flow. CF is a better method, difficult to follow. For example, when we did portfolio, we had a CAPM model and an APT model. APT, according to me, is a superior model, but still CAPM is widely used because easy to do. Next, these are conventional technique. Now we move to sensitivity analysis. Sensitivity analysis basically does, what is the impact on project's NPV if any one variable change, impact of change in a single variable on the NPV. For example, if finance cost changes, 11% NPV can fall. Units sold changes, NPV can fall by 19%. Land or construction cost changes, NPV can fall by 24%. Selling price changes, NPV can fall by 32%. Like this, we are trying to do different analysis. The impact on the project's NPV for the changes. Example, a DLF residential project is coming. NPV is most sensitive. How sensitivity analysis and all is done, we have seen it in the problem solving. Identifies the critical variance that can make or break the project. Simple technique. The only problem here is you consider only one change at a time, but generally variables are not independent. For example, If selling price goes up or goes down, along with that sales volumes will go up. You have to consider sales volumes going up, cost going up, along with that selling price may go up. If costs are going up, people will increase the price. So that other change is not considered in the analysis. Unfortunately, we do not consider the impact on other variables, which is where, but when we did problem solving, sensitivity analysis is what we primarily focused. Scenario analysis means combined effect of multiple changes. Combined effect of multiple changes. Combined effect of multiple changes. Multiple changes means change in sales, change in price, change in volume, change in cost, change in taxation, change in interest rate, all put together what is happening. Or we can also do a base case, a worst case, and the best case, and understand the impact of that on the project. Understand the impact of that on the project. Base case, worst case, and the best case, and analyze the impact of the same on the project NPV. Scenario analysis is a superior technique than sensitivity. For our exam problem solving, we have done more of sensitivity analysis, less of scenario analysis. Market crash may leads to 20%, lower sales 10%. Analyzing this combination will help us in deciding whether I can survive a recessionary condition or not. What are the main differences? I've already talked one variable, multiple variables. That's the main change. That's all. One variable at a time, multiple variables at a time. Complexity. This is easy to do. If I do it in an Excel, it is very fast. Complex. This finds the most sensitive parameter. It finds the extreme situation. Isolation means they are independent. All variables are independent. Here all variables are integrated and seen together. Monte Carlo simulation. The simulation is basically an exercise where I imitate a real lifetime scenario. This entire chapter, you will understand it very faster if you have already completed the practical part of it. So in simulation, I want to see Chennai traffic in some multiple experiments. What is multiple experiment? I run a first experiment. The first experiment says 5,000 cars, 2,000 buses, 20,000 two-wheelers will be passing through one road. How much traffic congestion will be there? Second experiment, 6,000 car, 3,000 buses, 90,000. You will keep changing. You will keep running the experiment. Simulation runs a very large number of trial transactions to obtain possible outcome and their probability. This is based on casino gambling mathematics. Casino gambling is basically you keep doing the experiment. Every experiment has a equal probability and run the experiment multiple times. What will this ultimately do? Ultimately, you may get a chart like this. This chart is called expected NPV chart, where this is called normal distribution. My NPV can be somewhere in this. My NPV can be somewhere in this. First experiment here, second year, third year, fourth year, fifth year. All these are experiment, and this chart will tell you the probability, normal distribution Z table. With this, somebody says there is a 68% chance that NPV will lie between 12 and 28 crore. NPV lying between 12 and 28 crore is 68% chance. The PPT which I have given, the letters are some places I've not been able to increase the size. So anyway, the PPT is also shared, so you can magnify and then keep seeing it along with it. Advantage, handles complex interrelationship, but the difficulties, again, it needs probability distribution. It needs probability distribution, which can be difficult for various variables. And here also we use risk-free rate. If you use risk-free rate for discounting, again, we are not getting the real NPV. Last technique, decision tree. In a decision tree, we just draw a diagram The diagram will give sequential decision making. Invest in new plant, start with a rectangle. Rectangle says yes or no. Yes or no is in our hand. Circle, anything can happen, each of it has a probability. Used to handle sequential investment decision. There are decision where you control means yes or no, event where you do not control or a chance, and probability distribution is given, and we draw like this, value in the reverse order. According to me, this chapter, nothing significantly new, more or less a known topic, because it is more to do with the problem solving. As we do, we'll take around 5 to 6 minutes and revise the entire part. We started with impact of inflation, where we basically learned that nominal cash flow, nominal discount rate, real cash flow, real discount rate, and depreciation is always nominal in nature because it does not increase with inflation, and you will have to bring it to real by doing discounting. Change in technology. Technology can increase cash flow, improve flexibility, improve production, improve yield, and can also decrease cash flow or decrease productivity or decrease yield. It can also have an impact on cost of capital, and my product life cycle may get shortened. How do I consider this in analysis? Sensitivity, scenario, simulation, keep monitoring, and keep the exit option open. What is the impact of change in government policy? Any government policy can impact my buyer, my supplier, my employees, the economy as a whole. All these can get impacted. So stakeholder impact is there, and two specific policies impact. One is fiscal policy, where direct and indirect tax rates are changed, and a monetary policy where interest rates and availability of money is changed. Specifically domestic is two things only: revision in interest rates and fiscal policy, monetary and fiscal. International is exchange rates change, DTAA agreements can change the tax rates for the investor and the withholding tax, that is the TDS rates, when you repatriate your profits or cash flow. Risk is something which can be measured. Uncertainty cannot be measured. In risk, you know a range of possible outcome. In uncertainty, we do not know the range. Why risk is required to be adjusted? Higher risk project, higher possibility of a variation, employ a higher discount rate. Because if risk is lower, I take a lower discount rate, and if I don't factor this, then always people will reject a 8% FD, saying that 15% equity is better. 15% equity may be better, may not be better, because risk is there. So risk has to be considered, and the risk has to be adjusted in our analysis. And without risk adjustment, we'll end up accepting lot of high risk projects because they are giving higher returns. But if you employ a higher discount rate, those projects may get rejected also. What are the various sources of risk? EIC, economy risk, external factor; industry risk, external factor. In industry, new substitutes can come, which is called market risk. New competition can come, which is called competition risk. And C, company risk, internal, project specific, company specific. What are the tools available? Statistical tools, probability distribution, variance, standard deviation. We employ these techniques. We also employ coefficient of variation. Then we have something called as conventional technique, RADR, and the CEF, and the modern technique, sensitivity, scenario analysis, simulation, and maybe the decision tree. RADR approach says discount rate has to be risk-free rate plus the risk premium. Higher risk, higher discount rate, easy to understand, easy to compute. Problem only thing is, in an RADR approach, I employ same risk every year, and difficult to identify what should be the RADR. What should be the RADR? Certainty equivalent approach focuses on adjusting the cash flow. RADR focuses on adjusting the discount rate. Uncertain cash flow into the certainty equivalent factor. Certain cash flow, simple, easy to understand. Difficult part is how do you determine the certainty equivalent factor. Adjust the discount rate, adjust the cash flow, risk-free rate plus risk premium. Here only risk-free rate. Constant risk is there, or constant RADR for all years. Different CF for different years, which means different risk adjustment. Sensitivity analysis helps in finding out the most sensitive parameter or the most critical parameter which can have an impact on making or breaking the project, impact on the NPV. The problem is all variables are independent. If they're independent, it is technically wrong. And also certain parameters we assume will not change, but there is a possibility that they may also change. What is scenario analysis? Scenario analysis, multiple changes at a time. We may try to evaluate a base case, worst case, and best case. Here we try to do an integrated analysis rather than an individual analysis. Sensitivity, one variable at a time, multiple variables at a time. Isolated scenario, integrated means all variables are taken together. Sensitivity, simple and quick. Scenario is complex due to interrelationship. Simulation tries to run the experiment million times and arrive at the possible outcome. Outcome could be NPV, outcome could be in some other way, that is profit, outcome could be in the traffic congestion time. Anything can be calculated. Handles complex interrelationship. Difficulties, it needs again probability distribution, and because of that it can become difficult to model the project. Decision tree is used for sequential decision making. Sequential means you start with a decision, yes or no. Yes means something will happen, again a decision, again a decision, again a decision. So wherever future decisions are to be taken, decision tree will give you the approach. It starts with a decision, which is a rectangle where you can control, and then there is a circle where you cannot control, which is called event or chance, and for the circle the probabilities would be given in the question. With this we are done with capital budgeting discussion. Every chapter, last 5 minutes alone you revise day before exam, so that it is easier for you to revise the entire segment. Namaste friends, let's now proceed to chapter 13, business valuation. When we did our problem solving discussion, we have learned about different methods of valuation, normal company valuation, distressed company valuation, startup valuation, ESG framework, and EVA and MVA. The theory discussion is almost similar here. No major new things. So here, this is primarily the same stuff. What are the approaches for valuation? We broadly classify the approaches into three. One is asset based, which is basically one approach we followed called net assets method. Sum of all assets minus sum of all liability. When you do this net assets method, you generally try to do certain revaluation if needed, and there are variants of the net assets method called net realizable value, which is the liquidation value, or the replacement value, which is the replacement cost. Earning based method is based on PAT into P multiple, or we are an FMP approach where we used to divide by cost of capital and call it as value of business. FMP method or the P multiple method, PAT or earning yield multiplier. Cash flow based, again we had two approaches, FCFF approach and the FCFE approach. FCFF, discounted at cost of capital, get the value of firm. FCFE, discounted at cost of equity, get the value of equity. Value of firm minus the value of debt will give us the value of equity. This is what we learned in the problem solving discussion. These are broad approaches. Cash flow versus income approach, how do they distinguish? Our income approach focuses on profits and with the profits we try to do the valuation. PAT into P multiple. Whereas in our cash flow approach, we focus more on the freely available cash. Freely available cash approach is very clear to you. Arrive at the free cash flow. Free cash flow means those money after meeting all our commitments. The major commitments are capital expenditure and working capital. So get those values, arrive at the future cash flow, discount it, get terminal value, and get the final approach. Cash flow focuses on more on future data. Your income approaches focuses more on the past data, past PAT into the P multiple. There can be a forward PAT also, but generally past data. How do we value unlisted companies? The approach which our institute material talks about is DCF approach. DCF is discounted cash flow approach, which is nothing but FCFF or FCFE. First thing we need to do is take the industry beta of the listed companies. I want to value an IT company. Take 10-12 IT companies, calculate their equity beta. From the equity beta, using the debt equity ratio, get the asset beta. After the asset beta is computed, then get our company's equity beta, get cost of equity, assuming getting our equity beta. Along with our equity beta, take the debt equity ratio and get the WACC. In this, another thing they talk about is you may have to adjust the financials itself. For example, if I'm a listed company, I'll follow all accounting standards properly, all Ind AS properly. I will comply with provisioning norms. But if I'm a private company, maybe I'm not doing this properly. So if there is a need, you may have to adjust the financials. Get the cash flow, discount it, and sum of the inflow is the value of the firm. In this, they talk about adding one more thing called as goodwill. Add one more thing called as goodwill valuation if at all there is any data. So take the industry beta, the industry equity beta, unlever it, get the unlevered beta or asset beta, use our debt equity ratio, get our equity beta, our KE, get WACC, discount, and get the valuation. This can come as a proper practical problem solving, and we have done questions around this. Relative valuation approach, the only approach which was used for normal company, distress company, startup. Relative valuation is very simple. PAT, if PAT is the basis, PAT into P multiple of the industry, or sales into value by sales multiple, or book value into MV by BV multiple. Take the industry multiple and use that. Find the drivers which best represent the multiple. Determine results using the ratio, comparable company, and in case you want, you may make certain adjustment. A chart is there in the side. This is past data. Okay, now the data has gone down significantly. 27 P multiple, 24, 21, and 23 P multiple for the 4 IT majors. Now the values have gone down because IT industry is going through a little bit of tough time. Chop shop method of valuation, otherwise called as SOTP, sum of the parts valuation. Again, we did problems around it. What is sum of the parts? Very simple. You have a good example. Let us take ITC. ITC has an FMCG business, has a hotel business, has a paperboard business, has an agri business, has another. Value each business separately, and the final value of ITC is the sum of all the 5 businesses together. Whatever I'm discussing in theory in this chapter is predominantly done when we did problem solving. That is why no major explanation is also needed here. Next, economic value added versus market value added. EVA computation, EBIT into 1 minus T, or we used to call it as NOPAT minus the invested capital into WACC, invested capital into WACC. This focuses on the yearly return, and this is very useful for a person who is an informed investor. Informed means he is aware of what and all is happening, and this was popularized in India by companies like Infosys. And this you have to determine because EV has a lot of adjustments. Market value added, there are no confusion here. Go to the market, find out the market value of firm. What is market value of firm? Is value of equity, value of debt, value of preference. Subtract the value of equity, value of debt, value of preference as per the book value, and the difference is called true value added. The difference is called true value added. Lot of companies, their market values will be 4 lakh crores, book values could be only 50,000 crore. The difference is called market value added. Next, valuing a non-going concern. Non-going concern means coming to the distress part of it. When it is a non-going concern, there are doubts whether this company will continue or not continue, whether the company will continue or not continue. Whenever we do valuation, we focus on cash flow, and along with cash flow, there used to be a terminal value. The terminal value is a perpetuity valuation or a multiple based valuation. The problem is if you are a non-going concern, there are doubts whether there will be any terminal value. So if you are a non-going concern, ideally we will arrive at a liquidation value. Liquidation value is basically if you sell all assets, repay all liability, the leftover value forces layoff, distress, denting investor reputation. But if you are a going concern, then generally a premium is paid. An example, same company liquidation value is 55, but if it's a going concern, may have a value of 100. One classic example, Kingfisher Airlines, which had a good valuation in the market, but moment there were doubts, it got down to the liquidation value. We have multiple approaches to do the distressed company valuation, which are done as part of problem solving. I have removed them from the theory oriented discussion. Next, why conventional method fail for distress? Now, conventional method is generally these three methods: asset based, earning based, and cash flow based. Generally these are the three methods. Now, in case of a distressed company, estimating cash flows are difficult, and they may not be generally profit making. Only asset based valuation is possible. But the standard DCF method, what is standard DCF? Discounted cash flow method, very difficult, because DCF assumes perpetual ever growing. There is no major terminal value because we are not sure whether the company will continue. Cash flows itself are hard to estimate. Discount rate may have to go upwards. Because of this, the conventional method like DCF method may not work. Still, the asset based method may work, and which is what primarily people do. Liquidation of all assets, settlement of liabilities, and get a value. Liquidation of all assets, settlement of liabilities. Why traditional method fail for startup? Again, the same thing. The three methods. The asset approach may not work because under asset approach, you need to have a lot of good assets. A startup will generally have intangible assets. So how will you put a value for the intangible assets? The tangible assets are not even there. Income or cash flow based approach also fail because there is no positive cash flow. Money itself is not earned in the startup. And the third approach, that is the cash flow approach, is clubbed with income approach. One, we do relative approach of valuation. Relative approaches comparing our companies with other companies, but generally you will not have a competitor itself. When you do not have a competitor, how are you going to do relative valuation approach? The relative valuation approach will also fail, income approach fails. Income includes the cash flow. Asset approach fails, and the market based approach also fails. The market based approach also fail because I do not have a comparable company. Value driver for startup. The meaning of value driver is how does the startup get value, or what are the reasons for a high or low value of startup. The most important thing, product. When Swiggy or Zomato came in, they came with one product or a solution offering, and that is the uniqueness of their offering which gave them good valuation. Management pedigree, that is who is managing the business and how much confident are they, what kind of experience they have. For example, Aman Gupta, who's handling this boat company, he's come out, I think, there. And if he starts a new company also, he may get a good valuation because of the management strength. Traction. Traction means, is there a good proof of the demand? Can they add more revenue streams? Zomato is trying to add more and more revenue streams. Swiggy is trying to add more revenue streams. So can I have additional ways of earning money? Industry attractiveness related to the traction part, demand supply gap, and are there any major competitors? These all determine if I have a startup, unique product offering, great management, good traction, multiple revenue streams possible, industry looks very attractive, there's a huge demand supply gap, demand is there, supply is not there, and competitiveness, no major competitor, I am the first mover, I will get a huge value. This is what they said. Nykaa and Zomato were valued pre-IPO heavily on traction, founder pedigree, and market size. Traction, founder pedigree, and market size, and not just the profits which are being earned. Digital platform. We did in problem solving itself. For valuing a digital platform, we have three approaches: income approach, market approach, and cost approach. Cost approach is sum of all the cost incurred. To develop a digital platform. Examples of digital platform are Amazon, are basically an online infrastructure which enables transaction. An online infrastructure which enables transactions. Good examples are Amazon, or you can take Swiggy, you can take Zomato. So here cost approaches just add up all the cost. Market approaches comparing our company with other companies and arriving at some multiple like P multiple, EV to EBITDA, price to book, price to sales, or price per user, price per active user, price based on GMV, gross merchandise value. What is GMV is in Zomato, if you order for 100 is called GMV, and their income will only be 10 in that, 10 or 20. The revenue will be 10 or 20, but the gross merchandise value could be 100, 200. So based on GMV multiple. Income approach is basically arriving at cash flow, or arriving at your something called as your profits, and arriving at the income. In order to arrive at the income figure, they say there are two approaches: top-down approach, bottom-up approach. Top-down means India as a whole has a market size for online food delivery of 20,000 crore. I will have a share of 40% and I will do 8,000 crore. Bottom up means from the available resources, Swiggy has presence in 20 states. 20 states, it has tied up with 5,000 restaurants. Each restaurant can give a business of 5,000. 5,000 restaurants, 5,000 per day, into the number of days is the likely gross merchandise value of Swiggy. That is called bottom up approach. Top down is from the top, you arrive at your number. and you may discount it at WACC or the cost of equity. We have in fact done problem solving around this. Professional or consultancy firm, example CA firm or law firm or management consultant. In order to value them, we generally follow a DCF method. DCF is discounted cash flow method. Arrive at the cash flow, discount them at FCFF, arrive at the value of the firm. Arrive at the value of the firm. After you arrive at the value, you may want to do certain things called as KPI adjustment. KPI means key performance indicators or benchmark adjustment. For example, in a CA firm, we expect that if 1,000 income tax returns are filed, only 5% will have scrutiny. Balance should not have scrutiny. Just a metric. It's not in the firm's control, but still, it's a metric they want to track. If when we file returns and if the scrutiny is more than 5%, our performance is weaker, we may have a lower valuation. So benchmark versus the peer, audited financial statement, terminal value, perpetuity valuation, arrive at the value, normalize income and cash flow. If any abnormal item are there, remove them, and finally track KPIs and benchmark. The last question, ESG framework. ESG is technically TBL framework, triple bottom line, which you learn in SCPM, where people focus on people, planet and profit. Here we need to focus on environment, which is profit, environment, which is planet, social, which is people, and governance, which is more of compliance. The profit angle is not talked in the ESG framework. So what they say is, if you are strongly ESG compliant, what is strong ESG compliant? Taking care of climate change, taking care of natural resources, taking care of carbon footprint, having diversity in recruitment, doing a community impact, ensuring data privacy, ensuring cyber security, complying with the governance norms, complying with your listing regulations, complying with your SEBI regulation. If you have a strong ESG framework, risk goes down, discount rate goes down, valuation can improve. Valuation can improve. And if you have a better ESG rating, you can also raise funds through green bonds. Green bonds are generally having lower rate of interest as compared to the normal rate of interest. Very quick discussion, 20 minutes, and we have done all the question discussion because there isn't anything majorly new here. Only thing I'm going to do now is revise as we have been doing in other chapters. Quick revision. Approaches for valuation, we have majorly three approaches. One is asset based, net asset method, or liquidation value method, or replacement cost method. Earning based method, PAT into P multiple, or cash flow based method, FCFF, or the FCFE approach. Cash flow versus income approach. Income approach is generally historical in nature. Take past profits and do the valuation. Cash flow is more of futuristic in nature. Go with the FCFF approach or the FCFE approach. Arrive at the future cash flow, discount, have a terminal value, and arrive at the valuation. Unlisted companies, if I'm trying to value, get the listed company equity beta. From there, get their asset beta. Use our debt equity ratio. Get our equity beta. Get the cost of equity, cost of debt. Do the WACC. And before doing all of this, adjust your financial statements if needed, in case some gaps are there. Discount cash flow, arrive at the valuation, give premium for goodwill if needed. Then relative valuation approach basically said that value your company by comparing the multiple of others in the industry. You may compare yourself with in an IT company, I compare the IT company majors like TCS, Infosys, Wipro and all, and I can do PAT into PE multiple, or sales into value by sales multiple, BV into MV by BV multiple. Chop shop method are sum of the parts valuation. Break the businesses into multiple parts, value every segment on a standalone basis using multiple metric on a standalone basis, value every business. Some could be valued based on profit, some could be valued based on assets, some could be valued based on cash flows, and put a total of all of that, and that is the value of the final entity. Example is ITC company. Economic value added is the extra value added every year. EBIT into 1 minus tax, or NOPAT minus capital employed into WACC. This was popularized by companies like Infosys. Market value added is the true value added in the overall market value of firm, minus the book value of firm. Valuing a non-going concern. In case you want to value a non-going concern is generally a company where liquidation is going to happen. So we arrive their value through liquidating all the assets and repaying the liability. So generally a non-going concern value will be on the lower side as compared to a going concern value. Conventional methods generally fail for distressed company because distressed company do not have profits. So I may not be able to estimate cash flows, estimate profit, and do the valuation. Generally, the valuation will be done by liquidation of assets. Terminal value is not there, cash flows are difficult to estimate, and the discount rate may also need adjustment. Startups, again, the traditional method fail. Your income approach or cash flow based approach doesn't work because profits are not there. Asset approach does not work because generally the assets are intangible in nature. Market approach will not work because you cannot be comparing your company. You cannot be comparing your company with any other company because I do not have a comparable company. So relative valuation also fails. Startup derives its value from multiple parameters: promoter pedigree, traction, the unique service offering, market size, competition in the market, revenue stream, industry attractiveness, demand supply gap. These are the value driver. Digital platform, you can do either a cost based valuation, adding up all the cost, or you can do a market based approach, which is comparing your company with another digital platform, or an income approach or cash flow approach, where the income or cash flow can be estimated using a top down approach from the overall industry to our company, or a bottom up approach based on the resources available. Professional or consultancy firm valuation is generally done based on cash flow, and when I'm doing this calculation, make adjustments to the numbers if needed. After the cash flows are done and valuation is done, do KPI comparison or benchmark comparison. If you are better at KPI, you deserve a higher valuation, and if you are weaker at KPI, you deserve a lower valuation. ESG, taking care of environment, social, and governance. Environment is planet, social is people, governance is compliance. If you are complying with all the three properly, you will have a high ESG rating. High ESG, risk reduces, discount rate reduces, and the worth of the company improves. And also you may be in a position to raise green bonds. Green bonds are those which are generally issued by companies which have good compliance with the ESG framework. With this chapter is over. If there are any doubts, you can send me a message.